This is going to be the costing marathon for CA Inter new scheme for May 24, September, or even January 25 exams. You can watch this. So this marathon is going to be mainly in the two parts. Part 1 is going to be 12 hours, which consists of these 5 chapters. And by the way, this particular revision class is being handled by our expert faculty, Ganesh Bharadwaj, and he needs no introduction, especially to all our Shrestha followers. You will get enormous clarity in the costing subject through this marathon itself. You will get a lot of insights into the costing paper. So, and the material which has been used in this costing particular revision class, you can download it from our Shrestha website. You can go to Shrestha for CACMA website. You just type in the Google Shrestha for CACMA, you'll find it in the list, in the top list. Okay. If you open PDF resources, you click CA Inter, you will find group 1, group 2. Click on the group 2. Inside that, paper 4, if you click on that, this one. So revision marathon material, you can download it. And the same material is what used by Ganesh Bharadwaj sir in this throughout this particular revision class. And one clarification I want to give you is this part 1 is exclusively recorded right now. Okay, very exclusively recorded, approximately this 12 hours. And part 2, we are uploading our previous version recording, which is also approximately for 12 hours. But part 1, we have done an excellent job in the revising the entire these tough chapters, especially overheads, marginal costing, process costing, especially these tough and lengthy chapters, and of course cost sheet and ABC costing. By watching these 5 chapters itself, you will understand, and believe me, you will get a different perspective on the costing paper. Your perspective is going to change after listening to this part 1 video itself. Then you start watching part 2, and we are covering entire syllabus of costing except 2 topics. One is employee cost and joint and byproduct cost. Except these 2 topics, rest entire syllabus we are going to cover through these revision classes. So make use of it, and whatever queries or doubts, if at all you are having, comment it in the below in the same video below. Give it as a comment. Whatever possible, Ganesh sir and myself will try to clarify your queries, whatever it is. So all the very best. Continue watching.
Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now let us get started with this beautiful costing revision, right? And as per the latest syllabus introduced in 2023. So now guys, before we get into directly into this particular revision, first let me give you an introduction regarding the chapters that we are going to cover, right? And also regarding the coverage in terms of marks and what you should be doing at the time when you are watching the lectures, be it a YouTube live or a Google Meet live, or even later on a recorded mode on YouTube, anything. But there are certain disciplines that you need to maintain from your side so that the learning experience will be massive, right guys? Fine. So now before that, first this is our material exclusively prepared for our revision, costing revision. I hope you all have got a copy of that. Copy as in, I mean the soft copy only, right? So please use this book, because we'll be following this book only throughout our revision. And this book has been carefully designed in such a way that all the major concepts are getting recapitulated throughout our entire revision marathon, right? That is number 1. And a few limited numerical problems will also be done. So don't think that I'm just going to say, these are the concepts here, so I'm not going to give you, I'm not introducing you to the CA curriculum. So here we are here to revise. So obviously I will also be doing numerical problems. Nothing need to be worried about it. Okay, fine. And yes, as I've already told you guys before, this is going to be the coverage of our, our revision batch. So now here, if you see cost sheet, overheads, ABC, these 3 chapters will be covered in part 1, right? For those who are watching it right now on live, will be covered in day 1, right? Then marginal costing and process costing. So this will be covered in day 2, right? These are big chapters, and that too, marginal costing is the biggest chapter of all, right? If you have watched our regular lectures, marginal costing alone, I think it came up to about 25 to 30 hours. We did about 31 numerical problems. Extremely exhaustive, a big chapter, but yes, we will be revising. Almost all the concepts will be revised here. Nothing needs to be worried. Then, yes, the next 3 chapters, service costing, cost accounting systems, and material cost. This will be covered in part 3. And finally, you will have standard costing, budgetary control, unit batch, and job costing. Technically speaking, unit batch is one chapter, job costing is another chapter. So the 12 chapters we are going to cover, and these 3 chapters will be coming in part 4. So this is going to be the agenda, and apart from this, we are going to do 150 plus MCQs and all the theory questions from all the chapters pertaining to our CA Inter costing syllabus. Clear with this? And these 150 plus MCQs and theories are basically, I'm going to take it from our regular recordings itself. I'm going to give it to you. So this is going to be the overall coverage of this particular revision batch. Are you clear with this, guys? All right. Now, one more thing. Please have the habit of catching up running notes, because as you know, this is going to be a revision batch. If you have attended my regular batch, you will be knowing much more the importance of the running notes that I keep telling you guys. So running notes is very, very important. So your ear should hear, your mind should process, and your hand should write. That's how it works. That multitasking ability will pay you off definitely in your exam hall, because an exam hall is going to be a very, very pressurized environment. Right, guys? So please catch up running notes, because not everything might be mentioned in the material itself. Right? That is one thing. And number 2, I know there would be a lot of questions regarding, sir, I have not at all touched costing. So is this revision batch sufficient for me? This is a very common question that I keep getting. Now let me make it very clear. Our regular batch is for 160 hours, and right now we are doing a revision, as the name suggests. So obviously, if you're watching this revision, of course, the ones who are watching it live, you're just a couple of weeks away from, or not even, less than a couple of weeks away from your main exam. But even if you're watching it later on, right, obviously the revision batch is generally done. So you revise it only after preparing it once. So the prerequisite here is that you should have at least learned the subject once. I mean, not necessarily from me, self-study, or from another faculty or anywhere, but at least you need to know what the subject says. But definitely, irrespective of your level of preparation, one thing I can assure you is that, yes, this is definitely going to be worth your while. That is, whatever is the limited time available, in that limited time, I will make sure that we are going to give our level best and make sure that we will be learning the maximum possible. Clear with this, guys? And these chapters put together will be coming up for a coverage of 90 marks out of the 120 mark component in your exam. By the way, your exam paper gets prepared. It gets printed for 120 marks, out of which you need to write for 100 marks. And of course, the coverage that we're going to do here is going to be for about 90 marks. Clear with this, guys? So these are certain things that I wanted to tell you well in hand before we get into this particular revision lectures. And guys, if you are, which many of us generally do, before the exams, we keep trembling with fear. We don't know what to do. Let me tell you one very, very, eye-opening fact. CA exams are not difficult to pass. Trust me, honestly, I'm telling you, because I have experienced both failures and, I've also made it to the top in my intermediate level, and of course I've literally failed multiple times in my final as well. So I know what exactly this student mentality would be, because I myself have been through that. Let me tell you, I'm telling this with my personal experience, both from my side as well as with the students that I've interacted till now. It's quite difficult to get a rank in CA. At the same time, it is difficult to fail also. I am again telling you, it's difficult to fail, meaning what? It's relatively easier to pass. The problem is not with the syllabus, or the problem is not with the subjects. The problem is here with the mind game. So we are being constantly wired in such a way that, CA exams are difficult. It's difficult to pass. Guys, you all have spent so much time with spending along with your books and sacrificing so many other things. At the end of the day, what is there a question? Should we even ask a question? The question is not for passing. It may be for exemption. So please throw out all these kind of what do I say, the rumors that you are made to believe. If you have worked for it, you will get it. That's about it. Clear? And of course, one more thing is the strategy part. That's why there is a logic for the sequencing of these chapters, because this is not the sequence that I follow in my regular lectures. In the regular lectures, the sequence will be a logical flow of understanding the subject, whereas here the sequence is based on the importance. The first 5 chapters itself is going to contribute more than 50-60% of the entire syllabus in terms of marks. That is the importance of the first 5 chapters that we are going to do. Clear with this, guys? Any doubts? Anything here? Any issues here? Shall we get started with the first chapter? Guys, yes, you guys can unmute and participate. The ones who are on Google Meet and the ones who are watching this on YouTube live, you guys can comment. Hello? Yes? Come on, guys. Yeah, let's start. Shall we? Yes. Okay, guys, fine. So now let's get started with the first chapter, cost sheet. So now, please take your the revision handbook that I've given you. So that's about the first chapter, cost sheet. So now, first, every time we start a chapter, I will be giving you guys a background so that it helps you to recollect whatever you would have learned till now, and we will enter into the core of the particular chapter, and apart from that we will also be doing the numerical problems. So this is going to be the manner in which I will take you forward with this particular revision batch. Now first, this is about cost sheet chapter. Now generally this chapter gets tested for about 10 marks, right, every attempt. This has been the case for the last 8 or 10 plus attempts. Every attempt they generally test this particular chapter for about 10 marks. Now before we get into this particular cost sheet chapter, now there are a few backgrounds that you need to understand before entering into this particular area. Now our subject, cost and management accounting, broadly has three objectives. We have learned it. What are the 3 objectives? Guys, unmute and participate. Come on. And the ones attending this on YouTube live, please post your use the chat box to write it. Come on, guys, come on, unmute. I don't have a problem. Come on, tell me, what are the 3 objectives of a subject? Yes, stock valuation and profit computation. Yes, guys, come on. Decision making and control, right? Now from the perspective of stock valuation and profit computation, the costs can be classified into expired cost and unexpired cost, right? Now to understand what cost will expire, what cost will not expire, for this you need to know what is a product cost and what is a period cost, right? And to know what forms part of a product cost and what forms part of a period cost, you need to know what you mean by manufacturing, administrative and selling and distribution expenses. Clear with this? Now do not worry, I will once again give a background of each of these things, and then we will enter into the the format of cost sheet. Now guys, imagine in a company there are 3 locations. One is a factory shop. Then you have a corporate office. Where the board of directors will be sitting. And then you have a sales depot. Right? Now, what happens in a factory? In a factory, the manufacturing activity will happen. That is, you purchase the raw material, right? You incur your labor and some other factory related cost, and the raw material gets converted into FG. This activity is called as manufacturing activity, correct? Now in a corporate office, what activity will be happening? Your administrative activity will be happening. By administration, you mean what the major decisions will be taken, right? So what should be the selling price that I need to fix? Should I open so many new factories in which area? So these are basically something that the board of directors will be doing. And now what happens in a sales depot? the selling and distribution activity will be happening. That is, they will pack the products and they will be dispatching it to the customer place and all. So the sales activity will be happening. Are you clear with this? Now the factory related cost can be broadly classified into direct material, direct labor, direct expense, and production overheads. Now, in your factory, broadly, these are the 4 expenses that you incur: your direct material, direct labor, direct expenses, and your production overheads. What do you mean by a production overhead? A production overhead refers to all the indirect costs that are incurred inside a factory. So the first 3 costs, direct material, direct labor, and direct expenses, these are called as prime cost. Because these are directly traceable on a per unit level of every single product. So if I am producing one product, I know 1 unit of a product, I know how much amount of material is required for it, how much amount of labor is required for it, how much direct expenses is required for it. For example, let us say I am a car manufacturing company, right? An example of direct material would be engine, right? So for every car that I manufacture, I need 1 engine. I can establish a direct relationship between this. Correct, guys? Yes. Now, the example for direct labor would be your assembly line worker. That is, to manufacture every car, I need to necessarily fit how many doors? 6 doors. That is 4 doors on 2 doors on 2 sides and 1 dicky and bonnet. Correct? Now every door fitting activity, right, needs to be done by one particular worker, and he takes 1 hour to fit 1 door, which means to manufacture 1 car, I can clearly come up with a relationship saying that I need 6 labor hours, and every labor hour I am paying at the rate of 100. So for 1 car to be manufactured, I need 600 rupees of labor. Like this, on a per unit level, I will be in a position to trace my costs. That is why this also forms part of my prime cost. An example of direct expense would be royalty payments. For example, in our regular batch also, I would have given this example. What example I gave? Can anyone tell me if you guys remember? Anyone here from the regular batch who's attended? Guys, anyone? Okay, fine. So so here, for example, Maruti Suzuki. Yes, you guys know Maruti Suzuki, right? So now in Maruti Suzuki, what they do is, actually, this is a joint venture agreement between Maruti Udyog Limited, an Indian company, and Suzuki Incorporation, which is a Japan-based company. So every time Maruti manufactures a car, they need to pay, let us say, 50,000 rupees of royalty to Suzuki Incorporation. Now, is this a direct material cost? No. Is this a direct labor cost? No. But it is some direct cost only, but neither material nor labor. Hence, we classify it under direct expenses. Are you clear with this? So, a direct cost which neither fits into the category of direct material and direct labor comes under the category of direct expense. Sir, how are you calling this a direct cost? Because every time I manufacture 1 car, I need to pay Suzuki Incorporation 50,000 rupees. Sir, is this related to production? Of course. Why are you paying him? Are you donating him some charity? No. He has given you the technical know-how as to how to produce this car. Hence, you are paying it as a remuneration for him. So, it is a direct expense. Are you clear with this, guys? So, these 3 are the components of prime cost which are readily traceable on a per unit level, right? Now, inside a factory, will you be only incurring direct costs which are readily traceable on a per unit level? Not necessary. For example, in a factory, you might be having your supervisor salary. Who is a supervisor? He is not a worker. He is the worker's boss. What will he be doing? He will just tie his hands like this and see whether the work is happening or not. Correct? Now you tell me, can I establish a relationship by saying, for every 1 hour, this guy ties his hands and oversees his workers, 1 unit of car will be produced. Can I establish a relationship like this? No. Hence, it is an indirect labor cost, correct? So, indirect labor will also form part of production overheads. Any kind of indirect costs incurred inside a factory will be fitting into the category of production overheads. Are you clear with this? Another example, factory rent. Factory rent, is it incurred in the factory? Yes. So it is a manufacturing activity related cost, but it is not directly traceable on a per unit level of a product. So let's say every month I am paying 1 lakh rupees to my landlord. Clear with this, right? Now this 1 lakh rupees anyways I'm going to pay him whether I produce 10,000 units that month or I produce only 100 units that month, correct? So I can't establish a direct relationship between the rent payments and my output. In this case, this is also an example of production overheads. So guys, nothing to be complicated here, very simple. Any costs incurred inside a factory, it can come only under these 4 categories. Are you clear with this? What are the 4 categories? Direct material, direct labor, and direct expenses. These 3 put together are called as what? Prime cost. Prime cost means your direct cost, right? And then you have something called as production overheads. What do you mean by production overheads? All the indirect manufacturing costs incurred inside the factory. Be very clear. That's why they are using the word production overheads. Clear with this? Overheads as a general name means what? Any indirect cost, correct? But those indirect costs incurred in the corporate office, sales depot, they are different. They will be treated as administrative overheads, selling overheads. They are different. Whereas the indirect cost incurred inside the factory alone will be called as production overheads. Are you clear with this, guys? Are you clear with this? Now moving on to the next location in a company, which is a corporate office, right? So in a corporate office, typically what happens? The board meeting happens, your director's remuneration, your auditor's fee, your accountant's salary, correct? So your factory buildings your office buildings depreciation, or if that office place is taken on rent, the rent payments, all these form part of your administrative overheads. In this case of administration costs, you don't have further classification as direct, indirect and all, nothing doing. Clear with this? All the costs incurred inside a corporate office are taken as administration overheads. Clear with this, guys? Similarly, on the other side, any costs incurred with respect to the sales and distribution activity are classified under selling and distribution overheads. Are you all clear with this, guys? Are you all clear with this? Right? So now, sir, why do we need this classification? Why do we need this classification? Because now, for the purpose of stock valuation, right? What do you mean by a stock valuation? Every time I produce and keep 1 unit, right, that stock needs to be valued, right? Stock is always valued at full manufacturing cost. Are you clear with this, guys? Stock is always valued at what? Full manufacturing cost. Clear with this? When I say full manufacturing cost, your direct material, direct labor, direct expenses and POH put together, every time you do a stock valuation, it gets valued at manufacturing cost. This is the reason why when you are preparing traditionally your trading P&L account, if you see here in your trading, you'll be having all your factory related expense here and your closing stock will be coming here, correct? No? Then what will you do? You will arrive at the gross profit, right? Now, what happens here is this gross profit is being carried forward here, and from here, you knock off all your other expenses called as SOH and AOH, all the other expenses, finally to arrive at your profit. Or in other words, have you ever wondered why stock gets valued in the trading account and not in the P&L account? It is because of this logic that stock should always be valued at manufacturing cost. For the purpose of stock valuation, you should not consider your administration overheads and selling overheads. Are you clear with this, guys? This is a very, very important understanding. That is the reason why most of the complications happen with respect to the manufacturing cost areas, right? With respect to AOH and SOH, these costs are very simple because they are anyways P&L items. They get knocked off against my revenue in bulk to arrive at the profit. Whereas what happens with respect to manufacturing cost? So whatever is the manufacturing cost is here, a portion of it escapes to the next year or remains unexpired and gets carried forward to the next year by way of stocks. So the stock valuation issue comes only with respect to the manufacturing cost. That is the reason why. So only with respect to the manufacturing cost related components, we have a lot of calculations in this entire subject. Are you clear with this? And the costs that are considered for the purpose of stock valuation are called as product cost, and the stocks and the costs that are not considered for the purpose of stock valuation are called as period cost. Are you clear with this? In our case, the product cost is nothing but manufacturing cost. The period cost is nothing but your administration overheads and selling overheads. Are you clear with this? So here the product cost, when I call it, the product cost is what? Manufacturing cost. Guys, what is the manufacturing cost? It has 4 components in total, right? 3 components that form part of your prime cost, and 1 is your production overheads. Clear with this? And then you have something called as period cost. Period costs are not considered for the purpose of stock valuation, right? And this period cost basically is nothing but AOH plus SOH. Are you clear with this, guys? Are you clear with this? Right? This is a basic understanding that you need to have before you enter into the subject. Are you clear with this, guys? Right? Now, one more thing. This period cost is there, no? AOH and SOH, it expires fully. What do you mean by expiring? That is, it dies fully in the current period itself. So this entire amount hits my P&L in the current year itself. Correct? Is there any amount of AOH or SOH I carry forward to the next year? No. Whereas with respect to the manufacturing cost, a portion of the manufacturing cost remains unexpired. What portion is that? To the extent of closing stock. Are you clear with this? Are you clear with this, guys? Are you clear with this? So here, can I come to a conclusion by saying period cost will expire fully. Period cost will expire fully. Whereas the manufacturing cost, what happens? It expires only to the extent of cost of goods sold, and it remains unexpired to the extent of closing stock. Are you clear with this, guys? Are you clear with this? My manufacturing cost remains unexpired to the extent of closing stock, and it expires only to the extent of cost of goods sold, and hence we started off with this concept of expired cost and unexpired cost. To sum up whatever I have discussed till now, expired cost means what? The cost that gets fully died, that fully dies in the current year, that gets fully knocked off against the current year sale to arrive at my profit. Whereas an unexpired cost is the cost that escapes from the current year and gets carried forward to the next year. The only unexpired cost is what? The manufacturing cost to the extent of closing stock. Are you clear with this? Or in other words, what expires is what? What expires is product cost expires to the extent of cost of goods sold. My period cost expires fully. What is a product cost? All the manufacturing cost, that is my prime cost components plus my production overheads. What is my period cost? My period cost is going to be my administration overheads and selling overheads. Are you clear with this, guys? This is a very important introduction you need to know before even you enter into the subject, right? So basically, this is something that I discussed for about 1.5 to 2 hours in a regular batch. So I've tried to condense it even for the benefit of everyone, right? Even if you have not attended the regular batch, I just wanted to set the context right, so that this will act as a launching pad to enter into the subject. Are you clear with this, guys? Right? Now, one more thing that I want to tell you. Now, I just told you right now, as of now, what are the costs that we have considered? The costs incurred inside the factory, guys, yes. The costs incurred inside a corporate office and the cost incurred in a sales depot, right? Now, what about interest? What about dividend expense? These are also costs for me, no? What about taxes, income tax, right? Now, always remember our subject costing considers only the costs that are incurred in these 3 areas. Are you clear with this? Interest, finance related costs, dividend, income tax, they are not at all considered in our subject. Sir, what is this, sir? Then our subject is incomplete. No, the profit reported by our subject is called as operating profit. Are you clear with this? It is called as operating profit, not my net profit. Not my net profit. So here from the sales, I adjust for all the costs that are related to my operations. I arrive at my operating profit. Operating profit is also known as EBIT. Are you clear with this? Right? From EBIT only, the finance related costs will be subtracted, which is a subject matter of discussion in your financial management. Are you clear with this, guys? So here the ground rules are set, right? So they have clearly identified whose area is what. So your FM starts from the point where costing ends. Are you clear with this? So in costing, we do not consider any kind of non-operating expenses or non-operating income. The only income we consider here is a sales revenue, right? So rental income, dividend income and all, we will not take it into consideration, because our objective itself is not with respect to reporting the final profit and all. That reporting of profit to the shareholders is actually the objective of financial accounting, not our cost and management accounting. Are you clear with this, guys? Are you clear with this? And one more thing I wanted to tell you. I told you that our subject has 3 objectives. The 3 objectives are stock valuation, profit computation, decision making, and control. Our subject doesn't have one objective. Our subject has 3 objectives, right? Whereas in your financial accounting, if you see, the objective is what? Prepare your financial statements, correct? Your balance sheet, P&L, your cash flow statement, and present it to the outsiders, that is the end users of the financial statement. There, the objective is different, right? Here, our objective is completely different. We are not going to report or show our results to any outsiders. The entire subject of cost and management accounting is purely for internal purposes. Clear with this? We are not going to report this. In fact, we should not report it, because these are all some confidential data. Just imagine you go to a nearby shop and buy a pack of milk bikis, and they are saying the MRP is 10 rupees. Suppose Britannia has released their cost sheet, you will be shocked to know that per packet they are making a profit of 6 rupees. Who knows? I mean, I'm just giving you a random example. If they have disclosed that per unit of a product they are making, the cost is only 4 rupees, but they are selling it at a selling price of 10 rupees. Now, what will you do? You will start a protest, right? First thing you will do is you will block all the roads, and we will all sit together, protest, ask Britannia to reduce the price. Obviously, the reason why I'm saying this is, yes, costing is always a confidential information. It is meant only for internal purposes. That's why even if you go for statutory audits, they will not entertain. At the end of the day, even auditors are outsiders only. They will not entertain the auditors to get to know about the internal costing and all in depth. No, to the extent that is required for the audit, they will give. That's about it, because that's a purely internal matter. That's a business secret. If they let it out, then obviously it is not going to, it's only going to pull down their business. Are you clear with this, guys? Now, as I told you, our subject has 3 objectives. Certain chapters of our subject are going on to achieve the objective of stock valuation, profit computation. Certain chapters are towards the objective of decision making. Certain chapters are towards the objective of control. Clear with this, guys? For example, the chapters of cost sheet, overheads, ABC and all, they fit into category 1, that is stock valuation and profit computation. Clear with this? Chapters like marginal costing, right, budgetary control, these chapters fit into the category of decision making. Chapters like your standard costing and even one part of budgets and budgetary control, these chapters fit into the category of the control objective segment. So the main reason why many students find costing difficult is they don't know how to approach the subject first, because you cannot see all the chapters from the same perspective, right? If a particular chapter helps you achieve the objective of stock valuation, profit computation, then cost needs to be looked at from the perspective of manufacturing, administrative, selling, right? The moment you move to marginal costing, there, we will be looking at the subject from the perspective of fixed cost and variable cost. Why? This is the perspective from which the cost needs to be looked at for the purpose of decision making. Are you clear with this? There, we are not bothered about the location where the cost is incurred. There, we are more bothered about the cost behavior, that is your fixed or variable in nature. Clear with this, guys? So, based on the objective a particular chapter is going to achieve, you need to know from which perspective cost needs to be looked at. Are you clear with this? Are you clear with this? Right? Just to give you an example, have you guys been to an airport? Have you all been to an airport? Right? Airport. Yeah. If you see in airport, basically, right, this example I've already given it also in our regular batch. But anyways, let me just give this example once again to appreciate this particular whatever statement that I just made right now. Now, in an airport, basically it's meant for transporting human beings, right? Yes, of course, animals are also transported, that's different, but predominantly human beings, correct? So exceptions are not examples. So predominantly human beings. Now what happens, let's say you want to go abroad, let's say to the US or somewhere abroad. Now you can't directly board this flight like how we catch our trains and all. So there is actually a process they follow, right? So what happens is initially, right? Initially when you enter, they do something called as, a security check, correct? So in the security check area, what they do is the same human beings only enter, but the human beings are classified into male and female, correct? Yes, guys, right? Both male and female are human beings, but here they classify it into male and female, correct? For the purpose of security check. After the security check is done, right? Everyone comes together. Then there is a place called immigration, right? If you're traveling abroad, there the immigration in that counter, if you see, they are not bothered about your gender. What they are bothered about is actually whether you are an Indian citizen or a foreigner, right? Because the procedures for an Indian citizen and a foreigner are different. Here it makes sense to classify the very same human beings as Indian citizens and foreigners. Clear with this, right? Now after the immigration is over, finally you go to the boarding gate, right? Boarding gate, that is the place from where you actually enter into the aircraft, right? There the airline company staff will be there, like beautiful staff will be there, right? So what they do is they are not bothered whether you are a male or a female. They are not bothered about whether you are an Indian citizen or a foreigner. There the very same set of human beings will be classified as economy class, business class and first class. Why? First class means they will give you one red carpet. Yes, they will assist you and all, right? And business class means the carpet will still be there but no assistance. Economy class, you get in, that's all, right? Based on the money you pay, the respect will be, you will be treated accordingly. Basically, guys, right, I'm just dramatizing it so that I can drive home the point. Basically, what I'm trying to say is, sir, human beings are human beings, sir. What is it you are saying in one place? You want to classify cost as manufacturing, your administration, selling. In another objective, you are saying, look at the same cost from the perspective of your fixed cost, variable cost. Look, here also, they were all human beings. Based on the purpose you want to achieve, right, the classification becomes different. That is what I want to tell you here, because for the purpose of stock valuation and profit computation, the same cost needs to be looked at from the perspective of manufacturing, administrative, selling. Clear? Whereas if you are in a decision making area, if you're using the concepts of costing for the purpose of decision making, now look at the very same cost as fixed and variable nature. Are you clear with this, guys? Are you clear with this? Then for the purpose of control, theoretically, there is one classification called as controllable, uncontrollable, right? There is not much of relevance for numerical solving of the particular subject. That anyways, we'll be seeing it at the time when we are doing standard costing. Clear with this, guys? But this entire subject revolves around the two types of cost classification. One is your manufacturing, admin and selling. The other one is your variable and fixed. Are you clear with this, guys? You should know when the cost needs to be looked at from which perspective. Clear with this, guys, right? That is about the introduction. That is about the introduction. So now let us get started into this particular cost sheet format. Now, I don't know how many of you guys would have mugged up the format of cost sheet. Guys, let me tell you one thing. Mugging up anything in subjects like costing and financial management is not even a sin. It is a crime, because this entire statement that we had here, right? Mark my words, in the next few minutes, you yourself will be able to tell this entire format by yourself. No need to mug up even a single line item. That's my commitment. Why do you think we have spent the last 30 minutes? This is not something to just give you a background alone. Now if you enter into this area, you will be able to appreciate it in a much better manner, and of course you will be able to tell the format all by yourself. Are you clear with this, guys? There is a beautiful saying of Abraham Lincoln: give me 6 hours to chop down a tree, I will spend the first 4 hours sharpening the axe. So if you have some time, someone's giving you a time to perform a particular task, don't directly jump into the task. He says, I will spend the 4 hours in sharpening the axe. I will do the preparation in such a manner that the execution will just take 2 hours out of the entire 6 hours. Clear? That should always be your approach. Right now, we saw this introduction. Now you yourself will see how easy this format of cost sheet is going to be. Clear with this, guys? So now let us get started into this format of cost sheet. Now, what is this format of cost sheet? Basically, this cost sheet is nothing but your P&L account in an inverted format. It's a P&L account in a statement format. That's all. Clear with this, guys? So what they are saying, the first line item is called as direct material consumed. So how do you arrive at direct material consumed? Opening stock of raw material plus purchases minus closing stock. Fine. You get the direct material consumed. Add your direct labor. Add your direct expense. I told you material, direct material plus direct labor plus direct expense is called as prime cost, right? To this, add your production overheads. You get your gross works cost. Add opening, closing, WAP and all these things are there. Sir, what is this? Why have they given so many line items? Now, look at this. Look at this. Now, guys, for you to understand the format of cost sheet, there is something called as flow of cost that you need to know. There is something called as flow of cost that you need to know. If you know this, automatically it's going to be a cakewalk. You need not even take efforts in remembering it. Clear with this, guys, right? Now, I told you in a company, there are broadly 3 locations. There is a factory, there is a corporate office, and there is a sales depot. Correct, guys? Now, let us zoom into the factory. Let us enter into the factory. Inside the factory itself, there are further 3 locations. There are further 3 locations. What are the 3 locations in a factory? One is called as stores. Stores is a place where raw material is getting stored, right? Then you have a place called as a factory shop. Factory shop is a place where the machines are there. The raw material is getting fed into the machine. The processing happens and raw material gets converted into an FG, or in other words, here is where the work is in progress. Are you clear with this? And once raw material gets converted into FG, now I will keep it in a warehouse. Are you clear with this? I will keep it in a warehouse. This is the place where my FG stock is stored. So broadly, when I say stock, there are 3 different types of stock itself. Correct, guys? Yes. Are you able to understand this? I have RM, I have WIP, and I have FG. Clear with this, guys? Right? Are you all able to follow this? Now, look at this. What are we trying to do? First, we are trying to calculate the total cost that we are incurring with respect to the production, right? So your total cost that you are incurring, right? To that, add your profit, you will be arriving at the sales value. Correct, guys? That is what your format of cost sheet says. Arrive at the total cost, add profit, arrive at the sales. Clear with this? Now, how do I arrive at the cost? Now, simple. Now, this is your raw material area, right? This is your raw material area. Now, what happens? At the beginning of this particular year, I must be having some opening stock of raw material. Agreeing with me on this? Guys, yes, right? Now, during this year, I would have purchased some raw material also. Guys, yes, right? I would have made some purchases, right? So basically, if I add the 2, this is the total raw material available with me. Correct? No? Guys, yes. Hello? Yes, guys, right? You guys can feel free to unmute yourself and participate, right? Because it feels as if I'm still in a recorded mode. So maybe you guys have come out of the recording mode, but I have not yet come out. Please, guys, unmute and participate. I don't have a problem as long as your background is, I'm absolutely fine. So you guys can unmute and participate. Do not worry about it. Do I look like a very strict person and all? You guys are hesitating a lot. Come on, guys, you can just unmute yourself and participate. Okay. Now, opening stock of raw material plus purchases is going to be the total stock available with you of raw material, right? Out of this, at the end of the period, I have some closing stock of raw material which is remaining unconsumed, correct? No? So can I say the opening stock of material plus whatever I purchased, this is the total available, minus whatever I didn't consume, right? This balancing figure is nothing but my raw material consumed, correct? So the total raw material available minus what I didn't consume is equal to the raw material consumed, correct guys? Hello guys, yes, you guys are clear with this, right? Right? Fine. Now raw material consumed means what? From the stores area, it will be fed into my machine, correct? No? Right? Or in other words, this raw material consumed will go here only to my WIP area. Guys, correct? Hello? Right? Fine? Right? So raw material consumed will enter here. Now raw material, by magic, it will not get converted into an FG. On top of this raw material, I need to spend direct labor. I need to spend direct expense. And I also need to spend production overheads. Correct guys? Right? In a factory, whatever other manufacturing costs are also incurred. Correct? No? Right? All these things put together, are the costs that I have incurred right now in this particular period. Guys, correct? Right? But wait, even in the WIP area, what happens? There could be an opening WIP. What do you mean by opening WIP? What do you mean by opening WIP? That is, some goods, some particular products, right? They were processed in the previous period, but the moment the previous period got over, still they were lying as a semi-finished product in the machine only. The balance processing will get completed in the current period, correct or not? Right? This is called as opening WIP. So here also I can be having an opening WIP. Similarly, I can also have a closing WIP. What do you mean by a closing WIP? I started the production, right? But at the end of the current period, it didn't get fully completed. It got semi-completed and it is still lying in inside my machine. Correct? No, that is also possible. Right, guys? Yes. Or in other words, can I say, so these are the costs that I'm incurring in the current period, right? Plus opening WIP minus opening WIP. Can I say this is nothing but the total value of the completed production? Correct or not? Guys, yes. This is the total value of my completed production, correct? So I call this as the cost of production. Cost of production means what? The value of goods that got produced in the current period. Are you clear with this? Are you clear with this? Now, where will this enter into? This completed units are FGs now. They will enter into my FG area. Guys, clear with this, guys? Clear with this? So they will enter into my FG area, right? So here is where they will come in. Right? In the FG area also, there could be an opening stock of FG, correct? So current year I have produced so many units, right? Already, one second, what happened? Nandini, please mute your background. Okay, who's that? Okay, right, coming back here, guys. So here, cost of production is there. This is the current period units produced, right? So now, over and above this, as at the beginning of the year also, there could be some units that I am still having as an FG. So opening FG plus the current year units produced is going to be the total FG available for sale. Guys, correct? Yes. Out of this, if I remove my closing FG, which means what? Unsold units, the balancing figure is nothing but my cost of goods sold. Correct, guys? Are you clear with this? Are you clear with this? Guys, are you all able to understand this? So here, my opening stock of FG plus my current year production is going to be my total goods available for sale. From that, you remove the goods unsold, you will get the cost incurred in respect of goods sold. Are you clear with this, guys? Are you clear with this? Right? Yes, guys. Now, this cost of goods sold, right? This cost of goods sold is nothing but the expired portion of my manufacturing cost. That's what I told you right now. My manufacturing cost will expire only to the extent of COGS. Correct, guys? To this, I will be adding my AOH and SOH. If I do that, I will be getting my total cost of sales. Are you clear with this? Now, I know for some students who have already seen the format, you might think that I have missed out a few line items. I will come to that. Please wait. Clear with this? This is exactly what the format says. Now you look at the format, you will understand. Now, Direct material consumed is how did you calculate? Opening stock of raw material plus purchases minus closing stock. This is exactly what we saw here. Guys, yes, right? You got your raw material consumed figure here. Yes, guys, done. Now, what do you have here further? To this, add your direct labor and add your direct expense. That's what we did here, direct labor and direct expense. These three components are all direct costs incurred inside a factory. So you subtotal it and give it a name called as prime cost. Clear with this, guys, right? To this prime cost, you add what? You add your POH also. Clear with this? It is called as gross works cost. Works means what? Works means factory, right? So you can use the word gross factory cost or gross works cost, anything works. Clear with this? Sir, why is it called as gross? Because you are yet to adjust for opening and closing WIP, right? So add your opening WIP, subtract your closing WIP. So add your opening WIP and subtract your closing WIP. You have something called as net works cost, or it is also known as factory cost. Are you clear with this, guys? Are you clear with this? Right? Are you all clear with this? Right? Now I know you must be having a question. Sir, what are these line items? What are these line items? You just now told us that if at all there can be any cost incurred inside a factory, they could only be categorized under the four categories: direct material, direct labor, direct expense, and production overheads. Now, what are these line items that are separately mentioned? Now, guys, what I told you is any indirect costs incurred inside a factory is called as what? Production overheads. Correct? Right? I still stand by it. It is production overheads. However, Institute actually came up with this new format about 8 years back, I think 6 or 8 years back. Before that, when I did my intermediate, all these things were not there, because cost sheet as such, it is not guided by like something like schedule 3 and all. It is something that people can prepare based on what they feel is relevant. So what Institute did was, from this production overheads, they separately took a few line items alone and they wanted to display them on the face of the cost sheet. Are you clear with this? That's all it is. Don't think it is something else and all. Look at what they have given. Quality control cost. What do you mean by quality control costs? The cost that you are incurring to check your quality of the product, your inspection related cost. Clear with this? Research and development cost. Basically, your research and development cost is nothing but your R&D expenditure, right? Why do you do R&D? So that you can produce it in a much better manner. You can either end up reducing your overall cost in the future, or maybe with the same cost you can increase your quality and all. So R&D is also related to production, right? Ideally, all these are indirect costs. Can these be traced on a per unit level? No, they cannot be traced on a per unit level. However, what they have done, that's why I said this is ideally a part of your production overhead. But Institute has, what they have done is they have taken these few line items separately, parked it on the face of the cost sheet. They wanted to display it on the face of the cost sheet. So one is quality control cost, then comes your R&D cost. Then the third one is administrative overheads related to production. Many students make a mistake here. This is not your corporate office expense. This is not your corporate office expense. Your corporate office expenses, administrative overheads, that is further, that is kept here separately. Clear with this? This is related to production. Sir, can you give an example? Can you give an example? Let me tell you, in a factory, right, there could be different categories of worker. One guy is an assembly worker. What does he do? He fits the doors of a car, right? Any labor, any wages that I pay him will fit into the category of direct wages. It's a prime cost component. Clear with this? Now, this assembly worker has one boss. What is his name? Supervisor. His name is supervisor. What does this guy do? He keeps his hand like this and he just oversees the work of his subordinates. Correct? Now, he also stands in the factory, but he doesn't work hands-on, right? He just does overall supervision. Now, this guy, whatever amount I pay, is it a manufacturing related cost? Yes, because it's incurred inside a factory, but I cannot call it a direct cost. It is an indirect cost, but incurred inside a factory. I classify it as POH. Correct, guys? Now, this guy also has one boss, right? That boss is not sitting in corporate office. that boss is also sitting in the plant only, in the factory only. He could be a plant head. He could be a plant head. He will not even come out of his AC room. In this particular plant or factory itself, there will be one AC room where he will be sitting. That plant's decision he will be taking. The factory related decisions he will be taking. Are you clear with this? Are you clear with this? So this is also indirect. Yes. This is also incurred inside a factory. Yes. But still institute wants you to categorize this separately. They want to give it a name called as administration overheads related to production. Are you clear with this, guys? We will do a sum, you will understand, right? Administrative overheads related to production means what? This is not your general admin expense, not your board of directors expense, that plant heads or that production manager's salary. Are you clear with this, guys? Are you clear with this? AC room in a factory, you remember like that. Are you clear with this, guys? That's why I started off with the locations that are there inside a company. Guys, are you all able to follow this? Are you all able to follow this? Yes, you guys are able to get it, right? That one. And finally, you have something called as a packing cost also. Remember, packing cost is a primary cost. Only the primary packing cost needs to come here. What do you mean by a packing cost? Right? The cost that I incur to pack my products. But what do you mean by a primary packing? Now, guys, packing cost can be of two types. One is a primary packing, the other one is a secondary packing. Wait, I will give you an example. Now let us say you want to go and buy a bottle of Coke. Coke means Coca-Cola. Don't think anything else. I'm talking about Coca-Cola only, right? So when you want to buy a bottle of Coca-Cola, now you tell me, guys, from the perspective of the company that manufactures Coca-Cola. Now, definitely that bottle that they give you, that PET bottle or plastic bottle, right? That comes under the category of primary packing. Meaning what? Without this primary packing, the product can never reach the customer. It can never be sold. Are you clear with this? What, can you go to their Coca-Cola factory and say, you pour, I will drink like this and all? No, it's not going to happen, right? Obviously, they need to pack it and give it in a bottle. Correct, guys? That's called as a primary packing. Primary packing forms part of your production cost. Whereas now like this, there will be thousands of bottles, right? That needs to be transported to many of their distributors. What they will do is they will have cartons. These cartons are also packing cost only, but they are not essential for the product to be sold. They are used only to facilitate my distribution. Hence, the secondary packing cost will come under SOH, selling and distribution overheads. Are you clear with this, guys? Are you clear with this? So, technically speaking, the primary packing cost also forms part of production overheads, but our institute wants it to be mentioned as a separate line item on the face of cost sheet. So, there are 4 line items that ICAI wants us to establish on the face of cost sheet. All these 4 line items are a part of production overheads only, but taken from there and mentioned on the face of cost sheet. Are you clear with this? What are the 4 line items? Come on, tell me, guys. One is QC cost, quality control cost. Then comes your R&D cost, research and development. Then administration overheads related to production. When I say related to production, remember that. AC room in a factory. And then your primary packing cost. Remember that. Clear with this Coca-Cola example. Right, guys? Clear with this? 4 additions. And there is 1 deletion. What is that 1 deletion? Credit for recoveries and scrap. Basically, when you are doing a production, there will be some wastage and all, no? Guys, correct? Small wastage will be there. Now, this wastage, if you're scrapping it off to an old dealer, right? If you're receiving some scrap income, now the cost incurred in respect of the unit scrapped has also been included here. So if you receive any benefit out of that, that should go on to reduce your cost. Logical. That's why we are reducing it here. Are you clear with this, guys? Are you clear with this? For example, you purchase a newspaper, right? Fine. At the end of the month, what you will do, you accumulate the newspaper. Whether you read it or not, it will definitely go to this old dealer shop. Correct? You will get some money out of it. So technically speaking, your newspaper cost is going to be the cost that you pay to the newspaper guy minus whatever is the scrap income that you will generating out of it. The net amount is only your cost, Guys, clear with this? That similar logic you can follow here. Are you all able to understand? Are you all able to understand? Technically speaking, all these line items are very much a part of your POH, but for presentation purpose, Institute wants us to present it on the face of cost sheet. Are you clear with this, guys? Are you clear with this? Now, if you add all these things, you get what? Hello, you get cost of production, right? You get your cost of production. That's the figure we got here. Guys, clear with this, right? Cost of production. To this, add your opening FG, subtract your closing FG. So add your opening FG, subtract your opening closing FG. You get what? COGS, your cost of goods sold. Correct, guys? Right? And now your goods have moved out of the factory. Directly, the two other costs are waiting. What are they? AOH and SOH. Add them both, AOH and SOH, you will get the total cost. It's called as cost of sales. Are you clear with this? From the cost of sales, you add your profit, you will arrive at the sales value. Guys, are you clear with this, guys? Are you clear with this? Now, when you are telling when you want to remember the format of cost sheet, don't remember it as a format. Remember it as a flow of cost. Are you clear with this? Right? So now, looking at this flow of cost, now tell me, guys, tell me the format of cost sheet once. Come on, tell me. Yes, you guys can unmute and participate if you want. Yes, the YouTube live students, come on. Yes, use the chat box. Come on, guys, make it interactive. First, your direct, opening stock of raw materials plus purchases minus closing stock of raw material gives you direct materials consumed. Correct, guys? Yes, visualize that. Direct materials consumed. So, direct material plus direct labor plus direct expense gives you what? Prime cost. Clear with this? Gives you what? Prime cost. Now, from the prime cost, add your production overheads. You get what? You get your gross works cost. Why are we calling it as gross? Because we are yet to adjust for the WAP stocks, right? Now, for gross works cost, add your opening WAP, subtract your closing WAP. Wait, you don't get your cost of production because Institute has done some drama here. 4 addition, 1 deletion. Clear with this? So, they are just calling it as factory cost or net factory cost, or just factory cost. Clear with this? Now you adjust for 4 addition, 1 deletion, which was originally a part of your POH. What are the 4 addition, 1 deletion? First, quality control cost. Then comes your R&D, research and development cost. Then your administration overheads related to production activity, AC room in a factory. And then your Coca-Cola example, primary packing cost and all, 4 addition and less 1 deletion. Your credit for recoveries, you do that. Now you get your cost of production. From your cost of production, now it enters into your warehouse area. Add opening FG minus closing FG. You get your COGS. From your COGS, add your AOH and SOH. You get your total cost of sales. Your cost of sales is nothing but your total expired cost. Are you clear with this? Total expired cost. That is, I told you, your period cost expires fully, no? Right? AOH, SOH. Correct? Your product cost expires to the extent of cost of goods sold. I told you. You remember? Guys, yes. Your manufacturing cost expires to the extent of cost of goods sold, whereas your non-manufacturing cost expires fully. So technically speaking, my cost of goods sold plus AOH plus SOH, whatever I'm doing, that is nothing but my total expired cost that can be knocked off against my sales to arrive at my profit. That's why the cost of sales is nothing but my expired cost only. Clear with this, guys? So from my cost of sales, you add a profit, you will get your sales. Guys, are you clear with this? Are you clear with this? Is it required to be mugged up, guys? Is this required to be mugged up? Absolutely not. Absolutely not. You just see a span of 1 hour, right? With the right introduction to the subject, we have also completed this particular format of cost sheet. Now, any kind of sum that comes in here, you will be in a position to tackle it. Are you clear with this, guys? Yes, there are certain other adjustments also. As we enter into this particular area, we will be finishing it off. Clear with this, guys? Any problem? Any problem here? No. Fine. Now, one more thing. If in the exam they are asking you, so prepare a cost sheet clearly mentioning the cost heads. Nothing, don't worry. Cost head stands for prime cost, cost of production, cost of goods sold, and your cost of sales. Clear with this? These 4 subtotals are called as cost heads. So why have I separately mentioned it? Some students felt that, sir, cost heads you didn't teach us at all. That is nothing but the subtotal only. Clear with this? In the exam, if they ask you for a cost head, it means these 4 items: your prime cost, right? Your cost of production, your cost of goods sold, and your cost of sales. Clear with this, guys? Right? Then let's move on to the next one. This is regarding direct expenses. Now, Look at this. Direct expense. Actually, what do you mean by a direct expense? Any cost that is directly traceable on a per unit level, but it does not form part of your direct material and direct labor. This is your direct expense, right? Now what happens is, this we follow only in India because globally there is no concept of direct expense at all. Globally, prime cost refers to direct material plus direct labor. There is no concept of direct expense and all. Everything else incurred in a factory, they've only put it under production overhead. But in India, we follow this concept of direct expense. There is a separate cost accounting standard that talks about direct expense and all. Anyways, that cost accounting standard is not required for CA intermediate. Now, what they have done is, they have given a list of line items that fit into the category of direct expense. Now, this is where, again, many students commit a mistake. Generally, if they see a line item in a question, they get confused as to whether this particular line item should be classified as a direct expense or should it be classified under production overheads. This is the biggest issue that many students face. Example, power and fuel. Power and fuel, right? You have power costs. Now, power costs. Now, one school of thought says that power cost is a direct cost. If I produce more, obviously proportionately my power cost is also going to increase. Correct? Another school of thought says no, power cost should be treated as a production overhead. It is not a direct expense, which is correct. It's not about correct or not. First of all, this particular direct expense itself is something that is unique only to India. Generally, globally, they don't follow the concept of direct expense. But anyways, for the purpose of examination, there are certain things that we need to follow. That is the reason why I have given this particular segment. Are you clear with this, guys? Right? Now, do not worry. We will be doing one or two comprehensive questions. You need not have to worry that all these applications will kick in. Clear with this, guys? So the expenses other than the direct material and direct employee costs, which are incurred to manufacture a product or for a provision of service, can be directly traced in an economically feasible manner to a cost object. Now, they have given the list of line items that definitely needs to be considered as direct expense. First, royalty paid or payable for production of or provision of service. I just gave you an example of Maruti Suzuki, right? The royalty payments should be classified under what? It should be classified under direct expense. Then, hire charges paid for hiring specific equipment. The word here is specific. Now, you might be wondering, sir, hire charges means what? I am taking an equipment on rent. If I pay a rent on that particular equipment, how can you say that it is a direct expense? If I own that particular machine, I would have provided for depreciation, right? Instead, I am renting it from a person. I am paying him rent, higher charges. How will you say it's a direct expense? It is only an indirect expense. That's the word here is specific. Meaning what? Let us say I am taking up a particular job, right? For me to do that job, I am hiring a particular equipment. Once the job is over, I will give back the equipment. So now, whatever higher charges I pay for this equipment should be exclusively charged only to that job. Hence, in this case, it's a direct expense. Are you clear with this, guys? Basically, this holds good only in a job costing setup. Are you clear with this, right? Are you clear with this? Similarly, if they use the word higher specific charge, your higher charges for specific equipment, please make sure that you put it under the category of direct expense. Then, once again here, the cost for a product or service specific design and drawing. Design and drawing means what? Suppose, for example, my customer comes, I'm Casa Grande, that is the, they are into real estate business, right? So now first, before they construct a house, there will be a drawing and all that needs to be done. So for a specific house, if I'm having a particular drawing for a particular job, in that case, now it's clearly a direct cost attributable to that particular job. So I will only classify it as what? I will only classify it as a direct expense. Are you clear with this, guys? Are you clear with this, right? Then you have what? Again, another thing, service specific software. See, anywhere you find the word specific, make sure that it fits into the category of direct expense, right? And any other expense which are directly related to the production of goods and provision of services. So they have just given a broad terminology here, but yes, this is what it is. So please make sure that royalty payments will come here, and anywhere if they use the word specific and all of that, then it fits into the category of direct expenses. Are you clear with this, guys? right? Now, next one, in this chapter, another issue is there, which is with respect to valuation of closing FG. Valuation of closing FG. Now, what is this? What is this concept of valuation? Now, guys, now let us say I have an FG, right? Let's say I have an opening stock of FG of let us say 1000 units at the rate of rupees 10. In the current year, I have produced, current year cost of production, I have produced, let us say, 10,000 units at the rate of 11. Right, guys? I have produced 10,000 units at the rate of 11. Now, totally in terms of units, how many units is available for sale? I have a total of 11,000 units available for sale. Correct, guys? Right? What I have done is, I have sold out of this 11,000, I have sold 9,000 units and I have a closing FG of 2,000 units with me. Are you clear with this? Right? I have a closing FG means what? I've not sold 2,000 units here. Now, first you tell me, this 9,000 units, now will I value it at 10 rupees or will I value it at 11 rupees? Because see, the total units available with me is how much? 11,000. From this 11,000 units, I have taken 9,000 units and I've sold it. Now, when I'm selling it, now am I taking it from the first lot or am I taking it from the second lot, or have I mixed everything together and taken it, I have not retained the identity? How will I know this? Are you clear with this? Or in other words, this is a clear-cut situation where your stock valuation issue comes into the picture. Are you clear with this? Now, to put it in simple terms, the concept of stock valuation comes when two cumulative conditions are satisfied. What are the two cumulative conditions? Condition number one, there should be multiple lots of receipts. And condition number two, each of the lot is valued at different rates. Are you clear with this? Right? So, multiple lots of receipts, each of the lot valued at different rates. In that case, your stock valuation issue comes into picture. Now, this is the point where you can go for a valuation method called as FIFO or weighted average. Are you clear with this, guys? Generally, we won't enter into FIFO or weighted average just like that. Suppose in this case, both were valued at 10 rupees. Even the current year production was also done at 10 rupees. Now, I will not be, I need not go and refer the valuation methods, because whether I take it from the first lot or from the second lot, everything is valued at 10 rupees only, no? So the problem itself will not be there. But here I have two lots and each of the lots are valued separately, are valued differently. Multiple lots of receipts, each valued differently. In this case, the concept of issues valuation or stock valuation comes into picture. So now the two broadly accepted methods are FIFO and weighted average. What do you mean by FIFO? FIFO refers to first in, first out. Now, if I am following FIFO method, how will I value this 9,000 units? I will say this 9,000, first I touched my first lot, 1,000 units at the rate of 10, correct? Then what will I do? The balance out of this 9,000 minus 1,000, the balance 8,000 came from the second lot at the rate of 10. Are you clear with this? And finally, this 2,000, anyways, it is coming from the second lot only. This will be valued at the rate of 10. Are you clear with this? So, this is how FIFO is being done. Guys, are you all able to understand? So, I have handpicked all the major issues in this particular chapter and I've compiled it so that it will be easier for us to discuss those most important adjustments happening in this particular chapter. Look at this. This is what they have given. The same example, only they have given a different example here. That's about it. If suppose they are following a LIFO method, suppose LIFO method is being followed, what will happen? 9,000 will completely come from the second lot, last in, first out. Are you clear with this? Suppose the company is following a LIFO method. So now in this case, what I will do is, so this 9,000 units that I'm selling, I will say that it entirely comes from a second lot because it's a last in, first out. Whatever came in last will go out first. So I will value this entire 9,000 at the rate of 11, right? So this is the rate of 11. Second, guys. Yes, this is at the rate of 11 only. Yes, I'm sorry. Here also it was the rate of 11. Yes, and here the closing stock of 2,000 units. That's where I will make a bifurcation and I will say, look, the first 1,000 is valued at the rate of 11 from the second lot, and the remaining 1000 is valued at the rate of 10 coming from the first lot. It completely goes from the reverse side. Guys, clear with this? These are some CA foundation level things that you would have already seen. Hello? Yes? You guys are clear with this? You guys are clear with this? Right? Fine. Then how about your weighted average method? In case of weighted average method, I don't retain the identity of any of the lots. So what I do here is, okay, so I've got 1000 units at the rate of 10, and I've got another 10,000 units at the rate of 11, right? So now what's the value for this? 1000 into 10, it's going to be 10,000, and here it's going to be 1,10,000, 1,10,000. Right? So now what is the total value? The total value is going to be 1,20,000, right? 1,20,000 is the value for how many units? 11,000 units, right? So per unit, what will be the value? Come on, can anyone tell me this? Per unit, what's going to be the value? Come on. 8.909, is it? Okay, so 1,20,000 divided by 11,000, that gives you 10.909. Okay, so 10.909 is going to be the per unit value. So what I will do is, I will value both this 9,000 units as well as this 2,000 units uniformly at the weighted average rate of 10.909. Are you clear with this, guys? Are you clear with this? So first of all, understand when the concept of issues valuation or stock valuation will come. When will it come? Two cumulative conditions, multiple lots of receipts, each valued at different rates. This is when the concept of your stock valuation issues will kick in. Clear with this, guys? So here I have given some different example, but it is all, the concept is all one and the same. Fine, guys, right? So now let's go to one illustration. This is one popular question that I've seen in the past exam. I think this was once tested for about 10 marks, I guess. So let us just quickly run through it. Now, guys, one more thing. I've given all the solution. That is for, that is in order to save the time for our discussion. But please don't peep into the solution first. Try to attempt it. Take a notebook, try to scribble something and try to participate. That is when you will get the best learning experience. You don't audit the solution by ticking it. No, it doesn't work like that, right? Take a notebook and start doing it. Start doing it. The moment I read the question, you start doing it. The thinking process should kick in. Clear with this, guys, right? Now, what have they given? Direct material is 50% of the total cost. The direct wages is 30% of the total cost. The direct expense and overheads is going to be 20% of the total cost. And the selling price is given as 2,000 rupees. Now, what have they given? Selling price 2,000 rupees. Material, wages, your expense and overheads, all the expense components are expressed as a percentage of total cost. Clear with this? Then the next year, the direct material cost will increase by 15%. The direct wage cost will increase by 10%. The profit will reduce by 20% as compared to the previous period if the same selling price is maintained. Prepare a cost sheet for the current and the next year. Now, guys, I'm not doing some vanilla questions, easy questions. I'm not doing. I'm picking up some really good questions so that, it's worth your time, right? Please do it. Please try to crack this. Please try to crack this. I'll just give you about 30 seconds time. Just try to crack it. Try to crack it, guys. Do something by yourself. And then anyways, I'm going to discuss. Come on, let's do it. Okay. Okay, good to see the participants on YouTube as well participating. Good, guys. Good. I'm so happy. Look, guys, whatever you do, make sure that you're giving your best, making the best use of it. That's all. That's all. Do not waste even a single second of your time, especially given the fact that you are just before your exams. Make the best use of your time. Now, guys, what have they given here? The selling price is given as 2,000 rupees. All the components of cost are expressed as a percentage of cost. So now what they are saying is, in the current year, so direct material is going to be 50%. So let the total cost be X. Direct material 0.5x, direct wages 0.3x, your direct expense and overheads put together is going to be 0.2x, right? And then they have given that the selling price is going to be 2,000. So obviously my profit is going to be how much? 2000 minus X. Are you clear with this? Right? Any issues here? Any problem here? No. Next, what happens? Next, what happens? They are saying in the next year, the direct material cost will increase by 15%. Means what? As compared to the previous year's material cost, the next year's material cost will increase by 15%. Or in other words, in the next year, it's going to be 115% of 0.5x. Are you clear with this? Are you clear with this? Right? Are you guys clear with this? Please nod or do something like that. You guys, whoever has turned on the camera. Yes? Yeah, guys? Fine. So it's going to be 0.575x. Similarly, for direct wages, they have said the wage cost is going to increase by 10%. When they say increase by 10%, it means as compared to the previous year. The previous year it was 0.3x. The next year it's going to be 110% of 0.3x. It's going to be 0.33x. Nothing has been mentioned with respect to your direct expense and overhead. Continues to be your 0.2x. Are you clear with this? And then if you add up the entire these three things, you get a total cost of 1.105x. Are you clear with this? Now what they are saying, if the same selling price is maintained, right, my profit will be reduced by 20%. My profit will be reduced by 20%. Now you tell me here how much will be the profit? Can I say this is nothing but 2000 minus 1.105x. This 1.105x is nothing but the revised cost for the next year. Guys, correct? Right? Now they have said this next year's profit 2000 minus 1.105x is nothing but 80% of the previous year profit. That is why they say the profit will reduce by 20%. Are you clear with this? This is equal to 80% of the previous year profit, 2000 minus x. Guys, clear with this, guys? Clear with this? Look, this is basically, they have given you hints to frame two equations and solve it. Clear with this, guys? Now once you do this and solve, you will get the x value, and once you get the x value, the current year figures and the next year figures can be populated and you can complete the answer. Are you clear with this, guys? Are you clear with this? The most important part is understanding the question, framing these two equations, arriving at the x value. Once you do that, the remaining part is just what? They have just plugged the figures and they have just put it up here. That's about it. Are you clear with this, guys? Are you clear with this? Here the crux is regarding framing the two equations and calculating the x values. Done, guys? Right? Done? Clear with this? Fine. So now let's move on to the next question. Look at the quality of questions they are asking. Now, honestly, the standard at which the institute is testing is now beautifully increased. Beautifully increased. So conceptual learning is the way forward. Are you clear with this? So please pay more focus on that. Next, yes, one more small illustration. This was actually kept as an adjustment in one exam question. They had kept this as an adjustment in one big question. So the remaining part of the question was simple. Just this part was alone. Many students found it difficult. So I just picked it here. Now look at this. Production overheads is given as 40% of conversion cost. What do you mean by conversion cost? What do you mean by conversion cost? Now guys, conversion cost means all the costs incurred inside the factory except my material cost. Are you clear with this? All the costs incurred inside the factory except my material costs. That is the costs incurred to convert my RM into FG, right? So when I'm taking the conversion cost, only the cost incurred to convert the RM into FG should be considered. Don't take the raw material cost also. Clear with this? Basically, in a factory, what are all the costs that I incur? I told you, direct material, direct labor, direct expense, production overheads. These four are the expense that you incur inside a factory, right? The sum total of these three is called as conversion cost. Are you clear with this? Are you clear with this? Now, I also told you that globally direct expense is not considered, right? But in India alone we consider. If direct expense is given in the question, you can also consider that. If it is not given in the question, you just ignore it. Are you clear with this? That's why here they have mentioned conversion cost is direct wages plus POH. Just the labor and POH they have added. If direct expense is that also needs to be added. Are you clear with this, guys? Guys, are you all able to understand? If they have given you the conversion cost, it means what? All the manufacturing costs incurred inside a factory except what? Except your direct material. Are you clear with this, guys? So now what have they given? So the POH is 40% of conversion cost, and they have given that the direct wages is going to be 2 lakh rupees. Calculate the POH. Now that's pretty much simple. If you know what conversion cost stands for, now you can do it. So POH is equal to 40% of The conversion cost is nothing but your direct wages plus POH. If a direct expense is not given, you can ignore it, right? So 2 lakh plus POH. So in this equation, if you see, POH is the only variable that is missing out. So with this, you can find out the POH value. Guys, clear with this, guys? Any problem here? Any problem here? Guys, are you all able to understand this? Right? Shall we proceed forward? Yes. Now, a few more things. The treatment of special items. Now, guys, please participate on your chat box or by unmuting yourself. Now, look at this. Look at this. You tell me. I will give you a line item and tell me where these costs, where it should appear in the cost sheet. I will give you line items. You please tell me in which category will this form part in your cost sheet. Where will it fit into? Clear. First one, audit fees. Guys, don't look at the solution. Audit fee. Logically think, visualize. So the 3 locations of a company I told you, visualize. Audit fee. This is a management related expense. Don't think it's a non-operating. No, without an audit, a company cannot run, right? It's a mandatory phenomenon, right? So you can't run a business without all these things. So audit fee comes under AOH. Scrap sales, separate line item, 4 addition, 1 deletion. Clear with this? Now there is one more way of treating it. Suppose, guys, what happened? I purchased some materials, raw material. I'm saying I purchased raw material. Now, some raw material got destroyed or it got, obsolete, and I had to chuck it away. I just scrapped it off. Now, if it is a direct, just raw material, as such raw material without processing, the raw material scrap can alternatively be adjusted here while calculating my direct material consumed. Here, you can also reduce. That is, while calculating the direct material consumed, here also you can reduce the direct materials, scrapped off. Are you clear with this? Alternative only I'm saying. It is not mandatory. Clear with this, guys, right? So they have given one line item. So in some sums, the institute study material, direct material scrapped off, they have added one more line item here, and the scrap sales of direct materials has been inserted here, reduced to arrive at the direct material cost, which is correct. Nothing as such, nothing like that. You can do any of the method. Ultimately, your answer will not change. Guys, clear with this, guys? Clear with this? You guys are clear with this? Fine. Next. Right. Quality control expense. Yes. QC cost, 4 line item, 4 addition, 1 deletion, separate line item. Royalty payments is going to come under what? Your direct expenses. Then lab testing costs. It's basically your R&D expense. Again, a separate line item. Abnormal losses. So abnormal losses are not considered. What are they? At the time when you're doing process costing, you will understand. Fine. Ideally, you should be knowing by now because you are in a revision batch. But anyways, right? So I will be talking about the treatment of losses when we do our, the process costing area. Do not worry. Director's fee. Come on, guys. Director's fee. Where will it come? Director's fee. Where is it going to come? Yes. Administration overheads. Yes. AOH. Then amortization of jigs and fixtures. Basically, jigs and fixtures are nothing but they are also some type of fixed asset. As a jig is a small machine with a relatively lesser life. Clear with this, right? So it's like a depreciation treatment, POH. But remember, if they are using the word, if it is being used for a specific job or if it is being used for a specific assignment, in that case, it will fit under the category of direct expenses. Are you clear with this, guys? Are you clear with this? So please be careful here. Please be careful. Look at this. Special frame for manufacturing. Clear with this, right? It's coming under direct expenses. R&D expense, separate line item. Now here comes the beauty. Material handling costs. Many of you will be thinking that material handling cost should come under the material cost. No, this comes under what? This comes under production overheads. Why, sir? I told you the 3 locations inside a factory. No, not the company. In the factory itself, there are 3 places. Your stores, factory shop, and your FG warehouse area. I told you, no? Guys, yes. Now look at this. From the stores, the raw material will have to be transported inside the factory itself. It needs to be transported fed into the machine. Guys, correct? That is called as material handling, right? That is nowhere related to material cost. It is a material handling cost that fits into the category of POH only. Are you clear with this, guys? Are you all able to understand this? Are you all able to follow? That's pretty much important for you to know, right? So that's what comes here as material handling cost. The next one, bad debts, income tax, dividend and interest expenses. These are non-operating expenses, never considered in our subject. Are you clear with this, guys? Are you clear with this? Now, income tax, dividend, interest and all, you know. Sir, bad debts, sir. Some students feel bad debts is a part of SOH, selling overheads. Absolutely not. Absolutely not. What do you mean by selling overheads? The costs that you incur to sell your product. Correct? Now, if I know that, bad debts means what? It shows my inefficiency to recover the money post sale. Correct? I have made the sale and I'm not able to recover the money. If I know that I'm not going to recover the money, I wouldn't have made the sale itself in the first place. So it is something that happens post sale, and it talks about your inefficiency. It has nothing to do with the sales activity. It is a post sale expenditure, nowhere relating to our subject. It is not at all operating. Clear with this, guys? Are you all clear with this? Now, here income tax, you all know income tax is not ideally an operating activity. Yes. One student asked me on brilliant doubt. I don't remember the name of the student. Sir, in our, accounting AS3, accounting standard 3, there you have this, cash flow statement being categorized into 3 aspects: your operating activity, financial activity, and your investment activity. There, sir, your income tax form part of our operating activity. But here you are not saying this. Look here, the objective itself is different. We are strictly talking about the expenditures, the expenses that are relating to manufacturing and selling my product. Whereas income tax is a charge on your profit. It's a charge on your profit. It has now direct correlation with your operations. Are you clear with this? That is the reason. That is the reason why income tax is not an operating activity. It is not considered here. Dividends, interest and all. So all your finance charges will never form part of our subject. I told you that will come under your financial management. Are you clear with this, guys? Yes, very good. Sanjay, someone has said after sales. That's very good. Right. Now, one more thing I will ask you, one more question. So now tell me, guys, bank has charged some interest on loan taken. So will it be considered or not in our subject? Will it be considered or not in our subject? Guys, yes or no? Bank has charged an interest, right? Will it be considered? No. Perfect. Next, bank charges. Will they be considered? Bank charges. Will they be considered? Bank charges. Will they be considered, guys? Bank charges. Will they be considered? Hello? Bank charges. Can someone answer? Right? On YouTube or on Google Meet, someone can answer this. Bank charges. No, sir. Bank charges will not be considered. No. Bank charges form part of AOH. Look at the last minute twist. So bank charges will be part of AOH. Why, sir? Are you deviating from your own logic? No. I will tell you your thought process. You would have thought, okay, a bank, why do I go to a bank? Because I want to take a loan. So for that loan, they would have charged some money. So for that reason, I'm paying something. It's a finance cost. No, not at all. Not at all. Banks don't just do this lending activity. First of all, guys, for any business to function, you need a bank account for sure. Correct? Now, to maintain this bank account, every year the bank charges some AMC and all. You know that. Your debit card expense, your debit card annual charges. You have this, if you have exceeded your number of transactions per day, they will give one charges. SMS charges, right? Net banking charges. Correct, guys? Yes. Checks, the number of cash withdrawal, if it exceeds, for that they will charge. Now you tell me, are these finance related? No, they are related to your day-to-day administration, hence they form part of AOH. Don't think that if at all the word bank comes, it's related to finance. No, basic operating of a bank account, operating a bank account itself is actually something related to my my day-to-day routine, administrative activity. So for that purpose, they are charging something. That's why I'm calling it as a bank charge. I didn't say processing fee for loan, right? Processing fee for loan, maybe you take it as a finance charge. Clear with this? This was once tested in exam. That's why I'm doing all these things in a revision batch. Else, we don't have the time to waste here right now. Are you clear with this, guys? This is for, yes, business account maintenance. Correct. Clear with this, guys? Yes. Next, the cost of website maintenance for online sales. Look at this. This adjustment came in RTP November 2022, long back, right? Website maintenance pertaining to sales activity. Yes, you take it as your selling and distribution overheads. Clear over this, guys. Then your canteen expenses. Now, guys, wait. It depends on where the canteen is present. If the canteen is present in a factory, I will put it under POH. If it is present in a corporate office, it is AOH. If it is present in my in the sales depot, that's going to be my SOH. Clear with this, guys. Depends on the location, right? Primary packing costs, yes, it's going to be a separate line item, right? Fringe benefits means what? Some employee related benefits you are giving. Wait, again, it depends on to which employee you are giving. If he is a direct worker, the fringe benefits for direct worker will form part of direct wages, right? If he's going to be an indirect worker, that supervisor guy who is standing like this and all, then it's going to be a POH. Guys, it's a very simple. It's a very simple thing. Please understand it logically. That's about it. Clear with this, guys, right? Do not think that there are so many things to remember. If you know the underlying logic, any kind of situation can be handled. Clear with this, guys. The most important that I felt was, one is this material handling. The other one is the special, whenever the word special comes, put it under your direct expense. Then this bank charges, that was something else actually, because generally students miss that, right? Clear with this, guys. Clear with this. Fine. Now, we'll be doing a couple of numerical problems here, right? Anyways, the solutions are given, but nevertheless, let us do these numerical problems. Good sums I have handpicked in such a way that it predominantly covers all the major part of this particular chapter. Clear with this, guys. Now, let us get started. What have they asked? Impact Limited provides you the following details of its expenditure for the year ended 31st of March 2021. Now, guys, basically this sum, what they have done, they have given so many line items, and asked you to prepare a statement of cost. Basically, they have asked you to prepare what? Your cost sheet. This is all they have asked you to prepare. Clear with this, guys. Now, what we need to do is, now nothing is there in the sum in terms of valuation, stock valuation, nothing. You need to take a particular line item and properly park it in the correct category. That is all you need to do. Clear with this, guys. Clear with this, right? Now, what I will do is, line item wise, I will be reading, right? I will be giving a 2-3 second pause, right? You guys answer and then I will give my answer. Clear with this, guys. Shall we do it like this? Shall we do it like this? Yes? Done? Fine. Right. Okay, fine. Now, first, raw materials purchased. Where does this come into? Raw materials purchased. Okay, guys, but before this, 1 second. One last time, let me just put up the format of cost sheet. Now, this time you guys are going to tell me. I will put it here. So now, first, how does your format of cost sheet comes, guys? One last time. Again, I'm going to do this. So first, your raw material, opening stock of raw material plus purchases. Come on, tell along with me. Plus purchases minus closing stock of raw material gives you what? Direct material consumed, or this is nothing but your direct material cost. From this, add your direct labor, add your direct expense. That gives you what? The prime cost. From your prime cost, add your POH, right? You get what? Your gross works cost. Why is it called gross? Now I'm going to adjust for WIP. Add opening WIP, WIP, less closing WIP. Now I call this as just works cost or my factory cost. Technically speaking, this is my cost of production. But what happened in this POH, what they have done, they have just taken a few line items and they have parked it separately. So I just call this as works cost or factory cost. Clear with this? From here, what I do, 4 addition, 1 deletion. What are the 4 addition? Number 1, quality control cost. Number 2, research and development cost. Number 3, administration cost related to production. Correct, guys? Right? And then number 4, you have a primary packing cost. Remember, Coca-Cola. Guys, clear with this. Now, if you do all these things, of course, minus what? Minus your credit for recoveries. Now you get what, guys? You get your cost of production. Clear with this, guys? Now, from this cost of production, now I'm entering into the warehouse area. Right? Visualize. Put yourself in that position. Now what happens? Now to this add opening FG, right? So now opening FG plus cost of production is the total available for sale minus closing FG. Now I'll be getting my COGS. This is my cost of goods sold. Now it moves out of my factory itself. Now the other two period cost line items are waiting for me. What are they? Add your AOH, general AOH, corporate office, add your SOH. You get something called as, come on, what is the name? Cost of sales. Very good. You get your cost of sales. To this, add your profit, you get your sales. Now tell me guys, you guys only told me this format. Clear with this? Now remember this, remember this, remember this. Now let us get going with this numerical problem, right? You tell me where these line items should come. We will be doing it along together. Fine. So first, raw material purchase. Raw material purchased, where will it come? Raw material purchased. Of course, this is a separate line item. This comes under what? The direct material component, direct materials purchased. Now, GST paid under composition scheme. Where will it come? Where will it come? It will not come. Huh? Okay, it will not come. Why will it not come? It will not. Guys, okay. Now look at this. Look at this. Now, you need to know a little bit of GST, right? Don't say that, sir, I am appearing for group 2. So GST is there in group 1. So I don't know. Definitely not acceptable. Not by me, by the institute. They are not accepting it. Now, look at this. In GST, again, I am just going to give you a bird's eye view. We cannot enter into that because that's a full discussion asset. In GST, you have a concept called as input tax credit. Most of you must be ideally knowing it. For the benefit of those who do not know it, let me make it very clear. There is a concept called as input tax credit, which means what? Which means what? Now, whatever GST that you are paying to your supplier, right? It is ideally not a cost. It is like a cashback benefit. To put it in very simple terms, when you are selling, whatever GST you collect from your customer, from that you adjust whatever GST that you pay to your supplier, the net amount alone you pay. Or in other words, if the GST paid by you to your supplier is eligible for ITC, it is not at all a cost. It is actually an asset. It is a current asset. It is similar to a prepaid expense, right? We don't call it a prepaid expense. It is a current asset basically, because you have paid your money right now, and it can be adjusted at the time you are paying to the government. Clear with this, guys? Now, in this case, they have mentioned GST is paid under composition scheme. There is something called as composition scheme in the GST law, which says that, to put in short, it says that if GST is paid under composition scheme, then it is not eligible for any input tax credit. Which means if you have paid the GST under composition scheme, it forms part of your cost only. And because in this case GST is paid under composition scheme, this 10 lakh rupees should form part of your material cost. Are you clear with this, guys? Are you clear with this? Are you clear with this? I'm repeating, this 10 lakh rupees was a GST paid under the composition scheme. And in this case, if you see, this 10 lakh rupees is not eligible for ITC. Only if it is eligible for ITC, I'll call it as a current asset and all. I told you that cashback benefit or the adjustment is available. There is no ITC concept at all in composition scheme. Hence, whatever you pay, right, it is like a hundi only. It will just go off, right? You can't get it back and all. So basically, it's a cost. What cost is it? Your material related cost only added to your material cost. Clear with this, guys? One very important adjustment. The same question had they given GST paid and just stopped it there, or they had given ITC allowed, in that case only you should have ignored it. Are you clear with this? So don't say GST means ignore or GST means consider. You should know that if ITC is eligible, then consider it. I mean, if ICC is eligible, then ignore it. It is not a cost at all for me, right? It's like a cashback benefit. Now, if your GST is not eligible for your ITC, or in other words, in this case of composition scheme and all, it is very much a part of your cost and it needs to be added up to your material cost. Classify this only under material cost category. Clear with this, guys? Clear with this? Right. Next one, freight inwards. Where will it come? Freight inwards. Where will it come? Guys, where will it come? Freight inwards. Where will it come? Freight inwards. What do you mean by freight inwards? The transportation cost that I incur to bring my raw material from my supplier's location to our location, to the stores. Now, this is a cost that you are incurring to bring your raw material to the present location. This will also form part of your direct material cost. Are you clear with this? Another important adjustment. Guys, clear with this? Know the meaning. Yes, very good Murthy, very good Priya, yes, very good. Aarti, yes, everyone. Yes, Harija, yes, very good, very good, very good. Right. So now this also forms part of your, what? This also forms part of your direct material cost, for a simple reason that any cost that is incurred to bring your raw material to the present location and condition should form part of your material cost. Clear with this, guys? Clear with this? Next, trade discounts received. Trade discount received. What will you do with this trade discount received? Guys, answer, come on. Think and answer. Exactly. Very good, Bharat. Reduce it from the cost. Reduce it from what cost? Reduce it from direct material cost. This needs to be adjusted. Why? Because it's a trade discount. Trade discount basically is what? Because you're purchasing in bulk. Because of the volume, they are actually giving you a discount. Are you clear with this, guys? Now, 1 minute. The same question, instead of trade discount, had they used the word cash discount, what will you do? Guys, instead of trade discount, had they given cash discount, what will you do? If they had given cash discount, what will you do? Come on, tell me. Can anyone tell me? If it is a cash discount, what will you do? Will you reduce it from the costs? Right? Will you reduce it from the cost, or will you do something else? Can anyone tell me this? Okay, direct material deduct. No. If it is a cash discount, it needs to be ignored. It is not at all something, whether cash discount given or cash discount received, whatever it is, it should never be considered, because cash discounts are non-operating items. They are non-operating items. Very good, Bhavani. Very good, Mani. Yes, very good, very good. Aarti, everyone. Yes. So now the reason I will tell you. What do you mean by a cash discount? I will be willing to give you a cash discount if you make the payment within a stipulated time. Correct? No? Ideally, in your working capital management and all, there's a separate segment called receivables management that talks about cash discount corporate. Right? Cash discount is ideally a compensation for early payment. That is the time value of money difference. It's a finance related item. Not many know this. Ideally speaking, cash discount, why I'm giving it, I will not give anyone. If you see, if let's say you are giving someone a discount, a trade discount is given for the business volume. A cash discount has nothing to do with the volume. The cash discount is purely based on the timing at which you're going to receive the money from. You will say, if you pay within 10 days, then I will give you a discount, extra discount of 1%. Why? Because generally you can take 30 days time, but if you are paying me 20 days earlier, if you are just making the payment in the 10th day itself, now I'm getting my money 20 days early. Now for this 20 days, I can put it in a bank account and enjoy my interest. So now for me to motivate the person to make the payment early, I am passing on that little benefit to him. It is ideally a non-operating item only. It has nothing to do with your operations. Clear with this, guys? Always remember, add this item also somewhere here. Your cash discount should be ignored. Cash discount, whether received or given, should be ignored. Are you clear with this? Because it's a finance item. It is 100% a finance item. Clear with this, guys? But yes, definitely you can consider trade discounts. Next, wages paid to factory workers. We all know it's going to form part of your direct labor. Then contribution made towards employees PF and ESIS. Now again, employees provident fund, it depends on which employee we are talking about. If it is a PF pertaining to a direct worker, then classify it under direct wages. If it is pertaining to your supervisor, put it under POH. Now in this case, institute has taken a stand that this also forms part of direct labor, because this line item comes immediately after the factory workers. They have taken a stand that this contribution made to PF and ESI is for the factory workers, and hence they have considered it under the direct labor category itself. Are you clear with this? So in this case, since this is also your direct wages related item, so you put it under direct labor. Next, production bonus paid to factory workers. To whom you are paying? Factory worker. Any amount that you pay him is basically a direct labor only. Yes. Next, an interesting adjustment. Fee for technical assistance. Fee for technical assistance. Can anyone tell me where this fits into? Can anyone tell me where this fits into? Huh? Yes, very good. This fits under direct expense. This fits under direct expense. Now, this technical assistance part, basically, again, Institute has taken a stand that this technical assistance, generally you take it only for a specific job. Generally, you don't take a technical assistance. If you want a technical assistance, then every time, then you would rather have your own staff. Are you clear with this? So, whenever they're talking about technical assistance, it means it is pertaining to a particular job. It is exclusively charged to the job and directly traceable per job. Are you clear with this? And because of that, Institute has classified this under direct expense. It's once again one important part. So, I would rate this as very important because this is some place where I've seen many students go wrong. Right, in our regular batch also many students committed a mistake in this area only. Yes, that is quite confusing. Next, amount paid for power and fuel. Amount paid for power and fuel, right? It could either be a direct expense or you can put it under POH, but here again Institute has classified it under direct expenses. Let us also follow that. Then job charges paid to job workers. What do you mean by a job charge? What do you mean by a job charge? Let us say I have a factory and I'm in the business of converting raw material into FG. But what happens? I'm running at full capacity. My entire workers are fully occupied. What happens is that now I take the help of my next door neighbor, right? That is the next shop or the next factory. If you see, they are also into a similar business. So what I tell them, look, currently I am not able to, I'm not able to use my staff. But at the same time, I cannot turn down the order that I've got. What I do is, I will supply the material to you. You use your labor, right? Convert this raw material into FG and give me the FG. Are you clear with this? Now, for this work, right? Per unit, whatever is the cost, you tell me. So, I am taking the services of another person to convert the raw material into FG using his factory, using his labor. Are you clear with this? I will only provide the material. Now, this conversion activity is being done without using my own staff and my own resources. This is called as a job charge. Are you clear with this? So now clearly this job charge is a direct line item, but I can't call it as a material and a labor. So I classify this under the category of direct expense. Are you clear with this, guys? Know the reason and do it. Yes, Sanjay, Gokila, Vaishnavi. Yes, very good. Very good. Yes, Madheshwaran, everyone. Yes, Murthy. Okay, many people have answered this. Very good. Very good. Fine, guys. Then stores and spares. Stores and spares. Where does this come into picture? This clearly comes under production overheads. Stores and spares are basically the components that you use along with your machines. Clear? No, stores and spares is not direct expense. It's not direct expense. It is going to be, stores and spares are going to be your, this one. They are your production overheads, because these are actually your spares for your machines. Clear with this, guys? Then depreciation on factory building will come under POH. On office building will come under AOH. On plant and machinery, where is plant and machinery located? Don't say depends on the location. Plant and machinery will be located only in a factory. Clear with this? This comes under POH. Are you clear with this, guys? Guys, based on the location, you just need to classify. Any problem here? Hello? Hello? Guys, you guys are clear with this? Yes, yes, yes. Done. Next. Yes, correct. It's all POH. Then salary paid to supervisors. Salary paid to supervisors. Where does this fit into? Come on. Yes, it comes under what? It comes under production overheads. Right. Salary paid to supervisor comes under production overheads. Then repairs and maintenance. If it is paid for plant and machinery, it's going to be POH. If it's for sales office building, where will this coming to? Guys, come on, participate. Where will this coming to? Huh? Yes, yes, come on, guys. Answer, please answer. It's going to be SOH. Right? And repairs and maintenance paid for vehicles used by directors. Where will this come? Where will this come? This comes under AOH. Now, I have seen students tell me, sir, vehicle used by directors, sir, it comes under drawings, sir, personal use and all. No, you consider this as an official use, obviously, else why else will the company pay? Clear with this. So it's obviously official use of the directors. The directors are located in the corporate office. Clear with this, guys. Done. Next, similarly, insurance premium. If it is paid for plant and machinery, it's going to be POH. If it's for the factory building, again it's POH. Now, expenses paid for quality control check activities. Where will this come into? Hello? Come on, guys, answer. Where will this come into? No, not production overheads. We have a separate line item for this. Yes, 4 addition, 1 deletion, separate line item. QC cost, we have quality control. Guys, clear with this? Yes, separate item. Correct. No, Sanjay, it's not POH. It comes under quality control. Guys, remember the format of cost sheet. This is the reason why we spend so much time on that. Clear with this? 10. Research and development cost paid for improvement of production process. Once again, we have a separate line item. R&D. Clear. Expenses paid for administration of factory work. Where will this come into? Where will this come into? Administration costs related to production. Clear with this? Once again, a separate line item. Are you clear with this, guys? Are you clear with this? Next, salaries paid to functional managers. First, production control. Where will this come into? Where will this come into? Your salary paid to functional managers. Under that, they have given finance and accounts, sales and marketing, production control. First, production control. Where will this come into? Where? It will come as administration overheads. They have given production control, no? Guys, where will this come in? This will come as a separate line item where administration costs related to production. This guy is sitting in an AC room in the factory. Production control manager. Are you clear with this? Are you clear with this? It is not POH. It is not POH. Yes, I think very few students got this right. This is a very confusing adjustment. I do agree, but yes, beautiful adjustment. It comes under administration cost related to production. Mark this as important. Mark this as important. I think only one got it right. Yes, I think Priyanka Kanagaraj. Okay, very good, very good. Okay, so this comes under administration overheads related to production. Administration costs related to production. Clear? It neither comes in your POH nor does it come under AOH. It is administration costs related to production. Then the others are easy. Functional manager, salary, finance and accounts. Where is this guy sitting at? Where is this guy sitting at? This comes under AOH, right? Sales and marketing. This comes under SOH because it's a sales related cost. Then salary paid to general manager. General manager comes under AOH. Clear? Packing cost paid for primary packing necessary to maintain the quality. Where does this come into picture? Separate line item. Very good. Separate line item. Similarly, for redistribution of finished goods, packing cost. Where will this come into? Very good. SOH. This comes under SOH. Remember the Coca-Cola example I gave you guys. Now you are able to understand why I'm giving all these examples. The reason is only for this. Next, interest and finance charges paid for usage of non-equity funds. Where will this come into picture? Where will this come into picture? Yes, come on. Tell me, Ramya. So it should not be considered. It should not be considered ideally. But in an earlier version of our study material, they have taken it as a separate line item. But strictly speaking, no, it should not come. It should not be included. Sir, what should I do in exam? Ignore it, write a note. If you are ignoring it, don't blindly ignore and leave it there. If you are ignoring something, you should write a note clearly saying, look, this is a non-operating item and hence I'm ignoring it. Clear with this? Yes, very good, very good. Yes, it is to be ignored. Fee paid to auditors. AOH. Legal advisors, independent directors. All these are AOH. Clear with this? Right, guys, visualize which place the cost is incurred. Put it in that bucket. That's all, guys. Right, then. Payment for maintenance of website for online sales. Yes, I think we've already seen this. SOH. Yes, then Performance bonus paid to sales staff. Once again, it is SOH, right? They are sales staff. Then the value of stocks. Okay, these are separate line items. Opening stocks and closing stocks we've got here. Clear with this, guys. 10 marks. 10 marks. That's all. And look at this. Amount realized by selling of waste generated during manufacturing process. What should you do? Separate line item. Deletion. In that 4 addition, 1 deletion. Deletion component of 66,000. Clear with this. Now from this, you need to prepare a statement of cost and clearly showing all the cost heads like prime cost, factory cost, cost of production, COGS, and your cost of sales. Clear with this, guys. 10 marks. 10 marks. Can't you get it? Very, very simple, provided you know the logic and then you know this particular, the format of cost sheet. That's about it. That's about it. Guys, clear with this? Do you need to mug this up, guys? Please tell me, do you need to mug this up? Absolutely not. Absolutely not. You just see, in less than 2 hours, we got introduced to the subject, right? The revision, and the entire chapter is almost getting over, right? And I have one more sum here. I think one more sum is left up, right? So we'll do that sum right now. We'll do that sum and then we will proceed forward to the next chapter. That's about this. Fine. Now let's go to the second question here. Now, Easy Shoe Feed Company. Again, guys, I am discussing the sums that give you a comprehensive coverage. Number 1. Number 2, also the ones that are important from an examination perspective. I have handpicked these sums for exclusively for discussion because in the regular batch, that's comprehensive. All the sums are discussed, but in a revision batch, I need to definitely make sure that for the time that we spent, whatever is the best value possible that needs to be given. Clear with this, guys? Right. Now, let's get started here. Easy Feed Shoe Company manufactures two types of shoes, A and B. The production costs for the year ended 31st March were as follows. So the production cost they have given, material, wages, POH, the total figures have been given. There was no work in progress at the beginning or at the end of the period. So forget the WIP part. It is given that direct material in type A shoes consists twice as much as that in type B shoes. The direct wages for type B were 60% of those of type A. The production overheads was same per pair of A and B types. Administration overheads for each type was 150% of direct wages. The selling cost was 1.5 per pair. And the production during the year was type A 40,000 pairs, of which 36,000 were sold, and type B 1,20,000 pairs, of which 1 lakh units were sold. The selling price was 44 rupees for type A and 28 rupees per type B. Prepare a statement of cost and profit for each pair of each type. This is what they have asked as a question. Now guys, what you need to do is, we need to prepare a cost sheet, but the only difference here is you have 2 products. It's a multi-product scenario. What are the 2 products that we've got? A and B. Simple. You need to prepare a cost sheet, same format, direct material, labor, production overheads and all that. Now guys, don't think that, sir, in this question, those 4 addition, 1 deletion are not given. If they are not given, then it is not there. That's all. Clear with this? Then in that case, your gross work. So here, if you see, your direct material plus direct labor plus direct expense gives you prime cost, plus POH gives you gross works cost. Now, you don't have opening and closing WIP. So your gross works cost itself is equal to your net works cost or your works cost. Then you don't have 4 line addition, 1 deletion. So your works cost itself will be equal to your cost of production. All bypass only, like a bus route, all bypass, right? So cost of production. There you have an opening stock minus closing stock. That adjustments you do, you will get your cost of goods sold, and it goes on. But the issue here is, I need to prepare the cost sheet for 2 products. But the problem is what? They have given us the costs in a consolidated manner. That is, for example, direct material is how much? 15 lakh rupees. 15 lakh rupees is the direct material cost for material A or for material B. No, it is for A plus B put together. I need to bifurcate and find out what is the direct material for A and what is the direct material for B. And how will I do that? Using the hints given below. Clear with this? This is the issue in this particular question. Are you all clear with this? Are you all clear with this? Now, how are we going to do this? This is where many students commit a mistake. Committing a mistake at least is not a problem. They come out of the exam hall with full confidence that they have done this question right, and two students will be arguing that their answers will be correct. My answer is only correct. Like this, two students will be arguing among themselves without knowing that both of them are actually arguing for wrong answers, right? Two different wrong answers, for that they are arguing. Now the beauty of this sum, institute loves this sum a lot, right? In fact, in one of the attempts, I exactly predicted that this question is going to come, and it actually came, and that was something that I felt very happy, because this question is something else. Institute keeps testing this once a while. Now, what is the problem here in this question? So the general mistake that students do here is, what they do is, first, let me talk about the material component. What have they said? The material in type A shoes consists twice as much as that in type B shoes. Or in other words, if you look at this A and B with respect to the material consumption, so if B consumes 1 unit of material, A will consume how much? 2 times of what B consumes. 2. Correct, guys? Yes. Are you clear with this? So now the material consumption ratio will be, right? So 2:1. Correct or not? Yes. Yes. Which means every time I lift 1 kg of raw material to produce product B, I need to take 2 kgs of raw material to produce the same 1 kg or 1 unit of product A. Are you clear with this? So to produce 1 unit of A, it requires 2 times the material that is required for product B. Are you clear with this, guys? Are you clear with this, guys? Yes, Priyanka, this is super pensum. Yes, Kaju Katri. Yes. Wait, I'm coming. Wait. Okay. Now, what happens here is, we think that, okay, fine. So what you need to do, this 15 lakh rupees need to be apportioned in the ratio of 2:1, right? So this is like that Vadivel comedy that comes in, no? Says, Aalukku oru vadaiya pichittu annan thambi rendu per, something like that only. Now, the problem here is you are missing out on a huge fact. So what generally students do? 15 lakhs, 2:1. So 15 lakh into 2 by 3. How much is it? 10 lakh rupees, give it to A. 5 lakh rupees is the share of B. So material cost you are given totally 15 lakh. I have bifurcated A and B, right? Like this, for each and every component they have given some hint. With that I will find out, and I will prepare the product wise cost sheet. What is the problem? Here? Now, let me tell you this, the famous Kaju Katli example. Now, what happens is, right, let me just give you an example. Now, there is a sweet called Kaju Katli. Many of you guys will be knowing this, right? It's in the diamond shape and all. Now, I like this sweet so much, really. The problem is my brother also likes the sweet. So what happens? There will be a fight whenever a new box of Kaju Katli is being purchased. Now what happened? One day my mom bought a box of Kaju Katli, right? So what she did was, she silently bought it, kept it in the kitchen. She wanted to surprise us. So what she did was, in the late evening, she bought a box of Kaju Katli, kept it in the kitchen. She wanted to make the surprise the next morning. She wanted to tell us that, look, I purchased Kaju Katli and all. So the next morning, when she went into the kitchen, she got surprised. Why? Because the box was empty. So now the problem is, she wanted to know the culprit. Now she called me. I said, so I of course I had, but just like how Vijay says, pasi ponathukku apra saapra idli ondilla illa. So something like that. So I only had my share. I didn't take anyone else's share. My brother also said the same thing. No, I only had my share, so he only ate extra. So now all these problems were there. Now what happened? Now my mom couldn't resolve this issue. The next day, she once again purchased this box of Kaju Katli, but this time on her way back, she went to a nearby electronic shop, purchased one CCTV camera, placed it in one corner of the kitchen, right? Just to know who is going to be the culprit. So now this is like catching the rat only. So now we got to know that another box has come inside. So what we did? So first I went. I took 2 pieces of Kaju Katli, I ate and I went off, right? Now, my brother came, he went into the kitchen and he took 4 pieces of Kaju Katli. Now, tell me guys, who is the culprit? Who is the culprit? Right? That is, you can have your share, but you should not have too much and all. Right? Relatively, who is the culprit? Both are culprits only. Relatively, who is the culprit? My brother. Correct? Now, what I did was, I forgot telling you one more part. Yes, both are culprit. That's why I said both are partners in crime, but relatively is what I'm asking. But I forgot to tell you one part. What was it? I visited the kitchen 10 times. My brother visited the kitchen only 2 times. Now you tell me, overnight fully, I have taken how many Kaju Katlis? 20 pieces Kaju Katli. Right? But my brother has taken only 8 pieces of Kaju Katli. Now you tell me who is the real culprit. Now you tell me who is the real culprit. This you will say. Yes. Okay, right. So I'm the culprit. Okay, fine. Now guys, coming back to the discussion here. The problem here is, you guys were focused so much on the material consumption per unit, but you forgot to consider how many units of A and B were produced, right? In this case, if you see, every unit of B requires only 1 kg of raw material, let us say, and every unit of A requires 2 kgs of raw material. No doubt, I do agree. But what has happened, I have produced only 40,000 units of A, whereas I have produced 1,20,000 units of B. So technically speaking, not just the material consumption ratio alone should be considered. I should also include the production. I should also take that into factor and use the weighted ratio as a reasonable base to apportion my cost. Are you clear with this? Here, what I did was, you guys were misled when I said I took only 2, my brother took only 4. That is consumption per visit to the kitchen. What I didn't tell you was the number of visits to the kitchen. That also plays a role. So finally, now to look at the culprit, what we need to do is, we need to consider both the consumption per visit along with the number of visits. In this case, both the consumption ratio and the production ratio put together, the weighted ratio should be the reasonable base for apportioning a common cost. Are you clear with this, guys? Are you clear with this? And hence, in this case, don't jump to a conclusion by saying 2:1. No, 2:1 is only per unit consumption pattern. Like that, the number of units of A and the number of units of B produced are completely different. That also needs to be considered. So technically speaking, I'll multiply the 2 here. It's going to be 8,000. Here it's going to be 1,20,000. Sorry, is this 8,000? Sorry, 80,000 and 1,20,000. So technically speaking, here both are divisible by 4, no? So it's going to be in the ratio of 2:3. The answer will fully change. You would have done it based on 2:1. But ideally speaking, it should have been done on the basis of 2:3. Guys, are you clear with this, guys? Are you clear with this? The Kaju Katli example, the reason why I gave, by the way, my brother hates Kaju Katli, so don't worry. I mean, I gave this example to dramatize so that you at least don't forget this in the exam hall. That's the main reason why I did that. Are you clear with this, guy? Is this a real story? Yes, ma? Okay. That's the concern now. No, it's not a real story. Don't worry, it's not a real story. Obviously not. The way I was dramatizing, you guys believed, huh? Okay. I made it a point that, it looks very dramatic so that you at least, it stands out on top of your memory. Like, how can it be real and not? It's not like that. Okay, real stories I will not tell only. Okay, guys, fine. Are you clear with this? Are you clear with this, guys? Okay, so this is how it works for each and every component of cost. So now the solution, this is how I have prepared and I've given you. Look at this. Look at this. Now, the apportionment of direct material cost. Look at this. The consumption ratio is what? 2:1. The production is how much? 40,000 is to 1,20,000. Marry the 2 figures, multiply the 2 figures. It's going to be 80,000 is to 120,000. So now it should be apportioned on the basis of what? 2:3. So now if you have here, the line item is there on the top. It should be in the ratio of 2:3, right? So what is the total material cost? It's going to be 15 lakhs. So 15 lakhs apportioned in the ratio of 2:3. So how much is this? Into 2/5 and into 3/5, right? Yes, into 2 by 5 and into 3 by 5. So how much you get here? It's going to be, yes, 6 lakhs and 9 lakhs. Is that what? Is the calculation correct? Hope it is. Just a minute, guys. 1 second. Yes, right. Right, guys. Clear with this? So it's 6 lakhs and 9 lakhs. Are you clear with this, guys? Are you clear with this? Yes. Similarly, for direct wages, what has happened? They have given here, read the question carefully. The direct wages for type B were 60% of those of type A. Means what? Means what? If so, A and B are there, right? If I take 1 hour to produce 1 unit of B, I will be taking only 60% of that. 0.6 hours to produce 1 unit of A. So here the consumption ratio is going to be 0.6:1. Clear with this, guys? Clear with this, guys? Right. Look at this. It's going to be 0.6:1, or have I mentioned it the other way around? The direct wages for type B is 60% of A. Okay, so I'm sorry here. It's going to be, if A consumes 1 hour per unit, B is going to take only 60% of that. It's going to be 1:0.6, or you can say 100:60. Whatever it is going to be the same. It's only a proportion. Clear with this, guys? So look at this. It is going to be 100:60. But consumption ratio alone should not be taken. It should be multiplied with the production ratio. How much is the production? 40,000, 1,20,000. So you multiply the two, you get 40:72 as the overall weighted ratio. That has been reduced down to how much? 5:9. So I have a total direct wages of 8,40,000. So 8,40,000 divided by, so 9 plus 5 is going to be 14, right? So divided by 14, that's going to be 60,000 into 5 is equal to, yes, you get 3 lakh and 5,40,000 respectively. Guys, clear with this? Calculation also has been mentioned here, but the main important crux here is with respect to finding out how to operate these kind of questions. Are you clear with this? Any problem here? Any problem here, guys? You guys are able to follow this? Yes. Reciprocate, guys. Right? Done. Next. Moving on to the next one. The production overhead was same per pair of A and B. Means what? Don't apportion the cost equally. Consumption ratio alone is 1:1. Once again, this needs to be multiplied with my production ratio as well, right? So look at this here. Production for POH, consumption ratio is 1:1. Right? That is only on a per unit level. The number of units should also be considered. So the production ratio is being considered here. Multiply the two, you get what? 4:12. That's nothing but 1:3. And the POH is apportioned between A and B in the ratio of 1:3. Are you clear with this? So it's 90,000, 2,70,000. The figures have been populated here as well. So it's going to be 90,000 and 90,000 and 2,70,000. This is basically a subtotal, right? That's about this. So now if you do it, you get what? You get your gross works cost. Correct, guys? Now, opening WAP, closing WAP is not there. So this is also your net works cost. 4 addition, 1 deletion is also not there. Hence, this is also equal to your COP. Are you clear with this? Hello, guys? Clear with this, guys? Yes. Next. So now add opening FG. Opening FG is not there. Then do you have a closing FG? Yes, in this question you have a closing FG. How? I have produced 40,000, out of which I've sold only 36, which means the remaining 4,000 pairs of A is remaining unsold. That's a closing FG. Similarly for B, 1,20,000 is what I have produced, out of which 1 lakh I've sold, which means 20,000 pairs or 20,000 units of B is remaining unsold. Guys, correct or not? Yes, you guys are clear with this. So it's 40,000 and 20,000 respectively. So now that needs to be valued at what? The full manufacturing cost. The full manufacturing cost per unit, we already have it with us. Clear with this, because we have unitized all these things here. So we have the cost of production per unit. We have the cost of production per unit here. And with that, we'll just multiply with the closing stock. So now look at this. For that, I've given a separate working note here. Look, the total production minus sales, that gives you what? The closing FG, right? So multiply that units of FG with your cost of production per unit, you will arrive at what? Your closing FG. Are you clear with this? This closing FG value has been mentioned here as well. This closing FG value has been mentioned here as well. So it needs to be a deduction. And if you do that, you get your final cost of goods sold. The cost of goods sold is 8,91,000 and 14,25,000 respectively. Clear with this, guys? Right? Now, ideally speaking, you can further continue and say add AOH, add SOH, you will arrive at your cost of sales, right? From that add profit, you will arrive the sale. Or there is another way of doing, you break it into a two statement approach. That is, ideally speaking, this is the right way of doing, but anyways, in the institute they had asked for a format of cost sheet. So in that format they had made it as a single format of cost sheet, but technically speaking it should have been a two statement approach. So this is another way of presenting. What we do is we come from the reverse. Sales, right, minus cost of goods sold gives you gross profit. You remember your trading and P&L account. Sales minus cost of goods sold gives you your gross profit. This gross profit goes here. From that you reduce your AOH and SOH, you get your operating profit. That format has been used here. If you want, you can also use a single statement format, not a problem. But let me tell you the reason why I have used this. Now, in your income statement, now what are the units sold? They have sold 36,000 units of product A and 1 lakh units of product B, right? Now the selling prices have been mentioned in the question. The selling prices have been mentioned in the question. Yes, the selling prices are, where is it? Is it being given here? Yes, look at this. 44 and 28. The selling prices are given here as 44 and 28. So first you arrive at the sales value. So 44 and 28 multiply with the respective units, you will get the sales value minus your cost of goods sold, which we just calculated. You reduce the two, you will get your gross profit. Correct, guys? Now what have they mentioned? So AOH has been mentioned. So AOH for each type of overhead, it is going to be how much? 150% of the direct wages. So the direct wages anyways is readily available on a product wise level, right? 3 lakh and 5 lakh 40,000. So put 1.5 times the respective products direct wages. So you get this AOH. For example, here it is 3 lakh rupees. 3 lakh into 1.5, that gives you how much? 4,50,000. That is the AOH for product A. Similarly for product B, it's going to be how much? 5,40,000 into 1.5, that's going to give you how much? 8,10,000. Clear with this? Then you have SOH as well. So the selling cost was how much? 1.5 rupees per pair. Now always remember, the selling cost and administration cost, the period cost are always linked to the units sold. So 1.5 rupees per pair sold, not per pair produced. Are you clear with this? Right? That's why I have clearly mentioned the units sold here on the top. So now if you see this 1.5 into 36,000 gives you 54,000. 1.5 into 1 lakh gives you 1,50,000. So that you do. So now sales minus cost of goods sold, you get gross profit minus AOH minus SOH. You finally arrive at your operating profit. Are you clear with this? Now remember one thing. In your cost sheet, you need to present the cost sheet in a total level as well as on a per unit level. It needs to be presented in total as well as on a per unit level. But how do you unitize it? Sir, simple, no sir. Take the total column, divide it by the number of units. Now the question is, will you divide it by the number of units produced or by number of units sold? Now look at this. Up to the cost of production, right? These components are tied to units produced. Are you clear with this? Right? Whereas from COGS till the end, right, all these costs are tied to units sold. So, or in other words, your product costs are tied to units produced, your period costs are tied to units sold. So that is the reason why I have given this big flower bracket and all. To arrive at the cost per unit, these components should be divided by units produced, and from here onwards it needs to be divided with units sold to arrive at the per unit level. Are you clear with this? This is the reason why I generally prefer preparing a two statement approach where I say that the cost sheet stops at COGS. Your cost sheet stops at cost of goods sold, right? It stops here at cost of goods sold, and here on the top itself I will mention the units produced, because your cost sheet components will be tied with the units produced, whereas your income statement, I call the second statement as income statement, right? These income statement components are tied to your units sold for the purpose of calculating the per unit cost. Are you clear with this? So to unitize it, clearly remember up to the cost of production, so you can unitize it based on your units produced, and from your COGS it needs to be unitized on the basis of units sold. Are you clear with this, guys? Are you clear with this? This is all about this particular chapter, and in this chapter we have almost touched upon all the major aspects of this particular chapter. Clear with this, guys? So of course this is not a substitute for a regular batch, because a regular batch obviously it's going to be comprehensive. About 10 hours we are going to do the entire single chapter itself. So this is going to be a last minute revision, is going to help you to recapitulate all the important concepts that were covered originally in our regular batch. Clear with this, guys, right? With this, one very important chapter is being done and dusted. Okay, someone has a doubt here. So for AOH, nothing is mentioned. We have to classify as product or production or general. Okay, so if AOH, if they have just mentioned it as administration overheads, it needs to be classified as AOH general only, because AOH specific, that is related to production, needs to be specifically mentioned as such. Or in that particular previous question they had given us that production control manager's salary and all. So their scenario was clearly, it was very clear and evident that it is administration cost related to production. If they have just mentioned it as admin, take it as an income statement item, that is treat it as this particular general administration expense only, right? Should we follow the two statement format? Okay, for sums that involve stock valuation, yes, you can do. But for questions like the previous questions, definitely not do, because the previous question was fully a test on the format of cost sheet. If a question comes like this, definitely don't go for the two statement approach. So two statement approach, when I can do, for this question it is accepted. It is accepted by the institute. Generally, wherever stock valuation comes in this question we had to value your FG and all, no, right? The FG valuation and all was done. So whenever the stock valuation comes in, you are free to use a two statement approach. If the question tests you more specifically on those 4 line items, 4 addition, 1 deletion, scrap and all these things, in that case, then definitely follow only the the single statement approach. Clear with this, guys, right? So this is the conclusion that I can give you with respect to the usage of a single statement approach or a double statement approach. Are you clear with this, guys? So with this, we have completely covered and revised this particular chapter called as cost sheet. Now let's move on to the revision of the next chapter, which is overheads. Now, to give a backdrop of this chapter is slightly big as compared to the other chapters, and this forms the core of the absorption costing, right? So now in this particular revision that we are going to do, I will be touching upon the major aspects of this overheads chapter. So definitely covering the entire overheads chapter is not possible. So the major aspects of overheads chapter will definitely be covered, right? And from an examination perspective, the never miss areas, I will just recapitulate it. Clear with this, guys? So this is going to be the agenda for the chapter overheads. Now, in this chapter, broadly, these are the 5 things that we're going to discuss. One is the concept of semi-variable overheads. Then we'll be doing the concept of primary and secondary distribution. Then about the absorption costing. Then 2 relative areas called as capacity determination and machine hour rate problems. These are 2 allied areas, right? And we will also be doing a few numerical questions in this particular segment. Fine, guys. Now first, let us start this chapter off with the standalone area called as semi-variable overheads. Now, the semi-variable overheads, what is it? Now, if you see, costs can either be a fixed cost or a variable costs, right? As you all know, what is a fixed cost? A cost that remains constant in total. For example, and a very good example regarding this could be your factory rent. Let's say I'm paying a monthly rent of 1 lakh rupees to my landlord. This rent is not going to change depending on how many units I produce, right? So whether I produce 10,000 units or I produce 1 lakh units, now the rent as such is going to remain the same. Yes, guys, right? So this is an example of fixed cost. Now, what is an example of a variable cost? Example for variable cost would be material cost, right? So in this case of variable cost, so what do you mean by a variable cost? This cost is incurred only if I produce the next additional unit. If I don't produce an additional unit, the cost with respect to that need not be incurred. For example, let us say for me to produce every unit of a pen, I need to use some plastics that is worth 5 rupees, right? Only if I produce that one pen, I need to incur 5 rupees, right? If I produce 10,000 pens, my material cost will be 10,000 into 5. If I produce only one pen, it will be 1 into 5. Or in other words, variable cost remains constant on a per unit level, right? And it moves proportionately with respect to the volume, whereas fixed cost, no, it remains constant in total. Are you clear with this? This is the basis of cost behavior pattern. Fixed cost remains constant in total and variable cost remains constant on a per unit level. Clear with this? Now, what do you mean by a semi-variable cost? Now, there could be certain costs which are neither constant on a total level nor they are constant on a per unit level, right? These types of costs are known as semi-variable cost. Now, for all the decision making purposes, definitely cost needs to be classified as your variable and fixed component. By the way, guys, the objective of this particular chapter overheads is actually stock valuation profit computation. This chapter is not a decision making area. That's why I said this is actually a separate segment of this chapter, a unique area alone, right? In this particular area alone, we will be seeing the concept of semi-variable overheads. So it's a separate segment in this particular chapter. Once this is done, then the remaining portion of the chapter is going to be interlinked. So this is a separate segment of this particular chapter. Now, for all decision purposes, I was telling you in the earlier session, that is in the cost sheet area, that for all decision making purposes, cost needs to be classified into variable and fixed. Now, there could be some costs which are neither constant on a total level nor they are constant on a per unit level. Now, these costs are called as semi-variable costs. Now, with the semi-variable cost, I cannot do any kind of decision making. So, what I need to do is this semi-variable cost needs to be necessarily segregated into the variable component and the fixed component. Are you clear with this? How do we go about with that is what we are going to discuss here. Segregating the semi-variable costs, right? So in this segment, we are going to see what are the conditions to be met, right? There's something called as high-low point. There's something called as simultaneous equation. And what will you go about? What will you do in case the capacity is given in terms of percentages, right? These are some typical areas where institute is testing. If at all this particular concept comes in, these are the areas that they are testing. Now, first, as I told you, fixed cost always remains constant on a total level. The variable cost always remains constant on a per unit level, and definitely two activity levels should be given to segregate your semi-variable cost into your variable component and fixed component. A typical example. Now, what they are saying is, when I'm producing 5,000 units, my repairs and maintenance cost is how much? 24,000 rupees. When I'm producing 8,000 units, my repairs and maintenance cost is going to be 36,000 rupees. Now, first, tell me whether this cost is a fixed cost. Tell me whether this cost is a fixed cost. This cost is clearly not, one second. So this cost is clearly not a fixed cost because it is not constant in total, right? Clear with this? Clear with this? Now, can I say this this cost is a variable cost? For that, I need to arrive at the per unit cost. So now look at this. At 5,000 units level, what is the per unit repairs and maintenance? 24,000 divided by 5,000. That gives me 4.8 rupees. Whereas at 8,000 units level, it is 36,000 divided by 8,000. That is going to be 4.5 rupees. Now, if you observe here, this repairs and maintenance cost is neither constant in total nor is it constant on a per unit level. Now, this is a clear-cut case of a semi-variable cost. Now, what am I going to do in a semi-variable cost? I need to necessarily segregate it into variable component and fixed component. Sir, how will you do that, sir? See, clearly we can understand that in repairs and maintenance, some portion is fixed, some portion is variable. So, put together only this repairs and maintenance is there. Clear with this? Now, if I mix the two and all, I can't take a meaningful decision out of it. Hence, it necessarily needs to be segregated into variable and fixed component. How are we going to do that? logically, you tell me repairs and maintenance cost is 24,000 rupees if my production, my volume is going to be 5,000 units. If I increase the volume by 3,000 units, right, what happens? My repairs and maintenance cost increases by how much? It increases by 12,000 rupees, correct? It increases by 12,000 rupees. From 24, it becomes 36, right? Now, can I say that this 12,000 rupees increase is nothing but the variable component pertaining to the 3,000 units, correct or not? Yes, this 12,000 rupees, see, overall this repairs and maintenance has both fixed as well as variable element in it. Now, if my repairs and maintenance cost is increasing, right, because I'm increasing my output, it is purely because of the variable component sitting inside it. Or in other words, I can say that this 12,000 rupees is nothing but the variable costs pertaining to this incremental units of 3,000. So technically, what is my variable cost per unit? 12,000 divided by 3,000. I would say that the variable cost per unit is 4 rupees. Are you clear with this? Now you take any one output level. Now at 5,000 units output level, what is my repairs and maintenance? 24,000 rupees, correct? Right? And we know that this 24,000 rupees of repairs and maintenance has a variable component as well as a fixed component in it. So this 24,000 rupees is equal to, right, the variable component is how much? 5,000 into 4, that's going to be 20,000 plus the fixed component inside it. So now we can find out the fixed component. The fixed component is going to be 24 minus 20, 4,000 rupees. Are you clear with this? Or in other words, I can say repairs and maintenance, the variable component is 4 rupees per unit and the fixed component is 4,000 rupees in total. Are you clear with this? Now using this, I can take any kind of meaningful decisions. Are you clear with this? Now look at this. This is called as a high-low point. What is a high-low point? When they have given a semi-variable cost, necessarily they need to give two data, that is the semi-variable cost pertaining to two output level needs to be definitely given. Only then you can do it. Now what do you do here? The variable component you will find out by using this formula, delta total cost divided by delta units, or in other words, there's nothing but the change in total cost divided by change in units. If you do that, you will get the variable cost per unit of 4 rupees. Now what will you do? You go to any one output level, right? So the total cost minus the variable component gives you the fixed component. If you see here from the lower point, so 24,000 was the total cost minus of 4 into 5,000, the variable component gives you the balancing figure of fixed cost. Are you clear with this? So this is how you segregate your variable, you segregate your semi-variable cost into variable component and fixed component. And now with this, you can try to prepare the cost levels for any output. Are you clear with this, guys? Are you clear with this? So always remember, costs for all decision making purpose needs to be represented either as a fixed cost or as a variable cost. Clear with this? If there is a semi-variable cost, segregate it into fixed and variable component, and the variable cost always makes sense only if it is represented on a per unit level. Fixed cost makes sense only if it is represented in total. Are you clear with this, guys? This is called as your high-low point. Similarly, the very same sum can also be done using something called as simultaneous equation method. How will you do it? Very simple. Total cost is equal to variable cost plus fixed cost. Correct? No? Right? Because this semi-variable cost has a component of variable as well as a component of fixed in it. So you say that let the variable cost per unit be A and the fixed cost in total be B. Okay, so two variables we are taking. You frame an equation. This 24,000 rupees of the repairs and maintenance cost is nothing but 5,000 units into the variable cost A. So 5,000 A plus B. Correct. Similarly, this 36,000 rupees for the second output level is going to be 8,000 A plus B. Are you clear with this? So now you have framed two equations. Solve the equations for the A value and B value. A value is going to be your variable cost per unit and B value is going to be your fixed cost. Are you clear with this? These are different methods in which your overall semi-variable cost can be classified into variable and fixed. Sir, why are we seeing all these things in this particular chapter of overheads? Because generally the semi-variable cost and all actually fits into the category of overheads. Generally, your other items, other indirect expenses will only be semi-variable in nature. Technically speaking, these are a part of your flexible budget area. These are a part of your flexible budget area. That's why I said this particular segment of discussion alone is ideally not a part of the score of overheads chapter, because whatever we are going to see from now on in this chapter, like primary distribution, secondary distribution, absorption, it has a completely different objective to achieve. Are you clear with this, guys? Fine. And in case they have given it in terms of capacity, you know, the production, the output volume can be expressed either in units or in capacity. Suppose they have given this capacity. Let's say they have given at a 30% capacity, my total cost is 23,000. At a 70% capacity, my total cost is 43,000. If they have given it like this, then using capacity levels also you can do it by taking an assumption and all. They have just said here, let 100% capacity be 100 units. In that case, a 30% capacity is going to be 30 units. A 70% capacity is going to be 70 units. Now with this, what will you do? You have two levels. You have two levels of cost. You have two output levels. So now the segregation will be the difference in my total cost divided by the difference in units. You'll get the variable cost per unit. That is what they have done here. Delta total cost divided by delta units. They have arrived at the variable cost per unit. Now you take any one output level. There you take the total cost. From that you subtract the variable component. So here they have taken, yes, the first part, 23,000, that is the total cost, minus the variable component is what? 30 units into 500, the variable component. The balancing figure is going to be your fixed cost. So now with this, they can find out that the variable cost per unit is 500 rupees and the fixed cost in total is going to be 8,000 units. Are you clear? 8,000 rupees. Now, if you have the data like this, now for any output level, you can arrive at the repairs and maintenance cost, because now you have the variable component and the fixed component readily with you. Are you clear with this, guys? This is the concept of segregating your semi-variable cost, and that is a separate matter of discussion in this chapter. It's ideally a separate area by itself. Clear with this, guys? Right? Now park this concept aside. Now is when we are going to enter into overheads. Clear with this? Shall we get started? Shall we get started here with this particular segment of overheads, the core of overheads? Now only we are going to get started. So now the first part is a standalone discussion. It's been done now. Now is when we are going to start off with this chapter of overheads. Clear with this, guys? Shall we get started? Shall we get started? Come on, guys. Come on, use the chat box. Yes, guys, participate. The Google Meet, guys. Now turn on your cameras. Do I need to tell you, guys? Come on, guys, turn on your cameras, please. I tried my level best to do this VC as well. So please, guys, it's only for you. It's only going to benefit you. And it also gives me a motivation that yes, people are actually interactive, right? So that's the reason, that's the whole purpose of it. Okay, and don't worry, the YouTube guys, I am constantly checking the comment box, the chat box, do not worry, right? So yes, okay, fine. Great, guys. Now let's get into this chapter. Now guys, full attention. One of the core discussion is what we are going to do here. And trust me, it's not an easy thing for a faculty as well, because this is slightly a big chapter. I'm going to condense it and put it in such a way that whatever limited thing that we are learning here in this revision, that also gives you a value addition, because I don't want to just do something for the sake of it. And no, that's not the point here. You have assembled here, so you guys have given me the responsibility over your time. So please make sure that you are also making the best use of it. Now, this chapter, overheads, the second one. Right. What is this chapter all about? Now, this chapter helps you achieve the objective of stock valuation and profit computation. Stock valuation and profit computation. As I told you earlier, our subject has three objectives: stock valuation, profit computation, decision making, and control. And this chapter helps you achieve the objective of stock valuation and profit computation. Sir, how, sir? We saw in the cost sheet discussion that every unit of stock is valued at full manufacturing cost, or in other words, every unit of stock is valued at direct material plus direct labor plus direct expense and your production overheads. Correct, guys? Full manufacturing cost. Your AOH and SOH are period cost, P&L items, whereas these four are your trading account items used to value every unit of stock. Clear with this, guys? So now, whenever I am actually valuing my stock, I need to know what is the per unit cost of direct material, what is the per unit cost of direct labor, what is the per unit cost of direct expense, and what is the per unit cost of POH. Now, guys, direct material, direct labor, and direct expense, these are called as prime cost components. You guys know this, right? We just did it right now. Prime cost components. Now, I don't have a problem with prime cost components at all. Why? Let us say I am producing 1 unit, right? Whatever it is. For every unit of pen that I manufacture, right, I know exactly for 1 unit of pen how much amount of material is required, right, and what is the material cost per unit of that material also. Or in other words, my direct material, direct labor, direct expenses, my prime cost components are readily traceable and available on a per unit level. Agreeing with me on this or not? Agreeing with me on this or not? Yes, but the problem lies with my production overheads. Why? Production overheads by nature are indirect manufacturing costs. These are the indirect costs incurred inside the factory. I do not know on a per unit level, I do not know how much is the production overheads incurred. Correct, guys? Agreeing with me on this, right? These are items of costs that are incurred in bulk. These are items of costs that are incurred in bulk. Like, for example, an example of production overheads will be your factory rent, your repairs and maintenance, your supervisor salary, your depreciation, right, etc. There could be 20-30 line items of expense. Now, how can I trace them on a per unit level? I don't incur them on a per unit level. Are you agreeing with me on this or not? Now, in this chapter, now, overall, to achieve the objective of stock valuation and profit computation, I need to have the manufacturing cost per unit. Are you clear with this? Only if I have the manufacturing cost per unit, I know how to value every unit of my stock. So, number of units lying in my stock into this manufacturing cost per unit, I can arrive at the stock valuation and achieve the objective. Now, for me to arrive at the manufacturing cost per unit, I don't have a problem with respect to the prime cost components because they are readily available on a per unit level. The problem lies only with respect to my production overheads. So the overall objective of this chapter is to calculate the overhead cost per unit. Are you clear with this? Only if I calculate the overhead cost per unit, I will be able to arrive at the manufacturing cost per unit. Only if I know the manufacturing cost per unit, I can achieve the overall objective of stock valuation profit computation. Are you getting the chain link here? Clear with this? So the immediate objective here is to calculate the overhead cost per unit. Agreeing with me on this or not, guys? Yes, you are all able to understand this. Now, sir, what is the big problem? What is the big problem, sir? You said you have line items, so many line items. These are all indirect costs, not readily traceable on a per unit level. We also understand that, but what is the problem? You collect all the costs, take the total overheads, right? Divided by the number of units produced. You get the overhead cost per unit. No, matter solved, right? Why do you have to keep a separate chapter and make our life miserable? Guys, are you clear with this? This would be your next question. Take the total overheads, right, divided by the number of units produced, right, arrive at the overhead cost per unit. You said the objective of this chapter is to calculate the overhead cost per unit. Yes, we have found it like that. What is the big deal? Now, let me give you an example just to tell you why this could not work out like it. Let me give you an example to tell you why this could not work out like the way you just told me. Now, let us say I'm a company called Titan. Have you all heard Titan? Right? Tata's, it is in Tata Group. Right? By the way, Titan's stock is shot up like anything. That is FM topic. Coming back here. Now, Titan is in the business of manufacturing what they are in the business of manufacturing. The famous thing that they are known for is watches. Right? Not just watches. They also manufacture your eyewears, your eye gears. You know that, right? So Titan Eye Plus, they have a separate chain of stores there. So eye gears, right? And let us also say they also manufacture wallets. Example, clear with this guys, right? Now what has happened is, let us say in a same factory, using the common factory, in a single factory, what they have done, they have manufactured 10,000 watches, right? 20,000 eye gears, right? And then they have manufactured 30,000 wallets. Are you clear with this, guys? Are you clear with this? Now let us say overall in this entire year, they have incurred an overall total overheads of 6 lakh rupees. Overheads totally incurred was 6 lakh rupees. Now you tell me this 6 lakh rupees, right? If I were to follow whatever you just said, so take the total overheads divided by the total number of units. So in that case, overheads divided by number of units, overheads figure, the numerator I have 6 lakh rupees. What will be the denominator? Can I say the denominator is 10,000 plus 20,000 plus 30,000, 60,000? Absolutely not. Now you tell me this is 10,000 watches. This is 20,000 different product altogether, eye gears, and 30,000 wallets, further another different product. Now these are dissimilar items. This is like asking 4 monkeys 5 plus 5 donkeys is equal to how much, right? You can't add dissimilar items. Are you clear with this? Are you clear with this? In this case, the denominator itself is indeterminate. Now don't tell me, sir, 6 lakh rupees are apportioned in the ratio of 1:2:3. What is the basis? What is the basis? Watch could be a high value product, right? A gear, eye gear could be a completely different product, and wallets, the cost consumption pattern itself could be different. You can't directly jump to the conclusion by saying add up everything and you just include it here. No, first of all, the denominator itself is indeterminate here. Are you clear with this? Are you clear with this? And hence this is one of the reasons, and hence it is not as simple as taking up your total overheads, dividing it by the total units, right? And then arriving at the overhead cost per unit. No, it doesn't work like that. Are you clear with this? This is the reason why we are having a separate chapter called as overheads. And in this chapter, whenever I use the word overheads, predominantly it refers to production overheads. Why? Because only the production overhead cost needs to be broken into a per unit level. This issue is not there for AOH and SOH. Why? They are anyways period cost. They are not considered for stock valuation. P&L items, it hits your cost sheet in bulk. It hits your P&L in bulk. Are you clear with this, guys? So clearly understand, the word overheads generally means POH plus AOH plus SOH, but about 95 to 98% of this chapter revolves around production overheads only. Are you clear with this? First understand this, right? So whenever in the context of this chapter I am using the word overheads, you understand that I am referring to production overheads. Clear with this, guys? Clear with this? Now first you understood the objective of this chapter, number one. Number two, why we have the separate chapter, why are we studying it separately, and why is it not directly like, taking the total numerator divided by the denominator? Yes, you guys are able to follow this? Yes, guys? Now coming to the core of discussion. Sir, now what is the solution, sir? On one side, I have some multiple line items of expenses, correct? These are some bulk expenses. And on the other side, I have multiple products, and each of these products I need to calculate the overhead cost per unit. So the ultimate objective of this chapter is what? To calculate the overhead cost per unit of watch, overhead cost per unit of eye gear, overhead cost per unit of wallet, correct? No, I am dealing in multiple products. Product wise overhead cost per unit I need to find out. Are you clear with this? Right? Sir, how are we going to bridge the gap? On one side, we have the bulk items of expenses, and on the other side, we need to arrive at the overhead cost per unit of each of the components. How are we going to do this? Using a three-step procedure. What are the three-step procedure? The first step is called as primary distribution. The second step is called as secondary distribution, and the third step is called as absorption. Are you clear with this? And these three steps put together is only called as absorption costing system. Are you clear with this, guys? Are you clear with this? Right? This is the basis. This is the basis and the reasoning why you are learning this particular chapter. Clear with this, guys? Right? So the 3-step roundabout procedure called as absorption costing system. What are the 3 steps involved? First, you do something called as a primary distribution. Then you do something called as a secondary distribution, and then you do something called as absorption. At the end of this 3-step process, what would have happened? Multiple line items of bulk expenditure would have got converted into overhead cost per unit of watch, overhead cost per unit of eye gear, overhead cost per unit of wallet. Are you clear with this? And the entire chapter revolves around how do you do it. And having done that, there are some further more complicated issues. What are they? These are the subject matter of discussion that we're going to see in this chapter. Clear with this, guys? This is a bird's eye view of this chapter. Shall we get started? Shall we get started? Guys, shall we get started? Yes, done. Now, let me give you an example. Let me give you an example, right? Let us take an example of this Tirupur cotton belt, right? So, for those who do not know, there is a place in Tamil Nadu called Tirupur, which is known for its, textile industry, right? You take world-class top big companies like Arrow or Alan Solly or any big companies that claim themselves to have high-quality products. At the end of the day, predominantly, if they are doing business in India, they would have been manufactured in Tirupur. So technically you are paying more for the brand and not for the product. Coming back here, so Tirupur belt, world class. You should see how they are doing it. You will even get a low quality product and you will even get a top quality product. They have multiple ranges. You will be mind blown, right? That is the level of this textile, the depth of textile industry that we have here. Something that we all need to be proud of in this, the country needs to be proud of. Anyways, coming back here, let us take an example of that. Now, what happens? Now, let us say first I have the line items of expenses. So, let us say I have your factory rent. Then I have supervisor salary, right? Then I have repairs and maintenance. Then I have depreciation of plant and machinery, right? All these things I am just having, let's say, power expense. So I have multiple line items of expenses. Now, first step of this absorption costing system is what? Primary distribution. What does primary distribution say? Now, let us say this particular company, what company? The textile manufacturing industry. Let us say they have the following departments in their organization. They have the following departments in their, in their factory. Let us say they have a spinning department. Then they have a weaving department. Then they have a printing department, right? And apart from that, they also have a canteen, right? And they have stores department. Clear with this? Now if you see the spinning department, I call it as P1 for our discussion. Weaving department, I call it as P2. Printing department, I call it as P3. Canteen department, I call it as S1. And stores department, I call it as S2. Sir, what is this P series and what is this S series? I will tell you. Now, if you see, typically in a textile business, first they will take the raw cotton, they will first spin and take the thread out of it. That is a spinning department. Having taken that thread, it needs to be woven, right? Based on whatever you want, maybe a sari or maybe a shirt or maybe a pant or whatever it is. That happens here in the weaving department. And once the weaving is also done, it needs to be printed. The color dyeing that you want, the pattern that you want, that needs to be done. And that's about it. Then the final product is over. Clear with this? So these three are the departments through which every product will get passed by. Clear with this? So the departments through which the products passes by are known as production departments. That's why I'm calling this as P1, P2, P3. Are you clear with this? Are you clear with this? Now in the factory, these three are not the only departments. They also have a canteen department to provide food to all the workers working in the factory. Similarly, they have a stores department to handle all the raw material and all. Now, my production does not get routed through these two departments. But these two are the departments which support the production departments. These are called as service departments. Are you clear with this? Are you clear with this? So clearly understand, in a factory there will be production departments and service departments. Production departments are the departments through which the products will pass through, and the service departments are the departments which are meant for assisting the production departments. Are you clear with this, guys? Are you clear with this, guys? Now, what the primary distribution says is, the primary distribution method says is, first, these line items of expenses are there, no? These line items of expenses are there, no? Right? Distributed between all the departments in the factory. Distributed between all the departments in the factory. Why? Why do you have to distribute it between all the departments in the factory? Because, so this chapter says that the reason for you to incur an expense is because you are having a department. If you don't have a department, you will not be incurring any cost. Are you clear with this, guys? Hence, so what you do is, these line items of expenses are basically incurred because of the presence of department. So you need to apportion all the line items of cost to all the 5 departments. Are you clear with this, guys? The 5 departments are, in this case, there could be 4 departments, there could be 20 departments also. In our example, I've taken 5 departments. Clear with this, guys? Sir, okay, sir, but on what basis will we do? On the basis of benefits derived ratio. Meaning what? For example, factory rent, right? Let us say it's a common cost, right, of, let's say, 1 lakh rupees. This is incurred by all the departments put together only. No, it's a common cost. What will you do? It needs to be apportioned on the basis of the floor area taken by each of these departments. Clear with this? Similarly, your supervisor's salary, use a reasonable base. Your supervisor's salary should once again be apportioned between all these 5 departments, maybe on the basis of the number of employees working below them in each department, or maybe on the basis of direct wages. Your repairs and maintenance could be on the basis of the capital value of machines deployed in each of these machines, each of these departments. Your power cost may be based on the machine hours consumed by each of these departments. Are you clear with this, guys? Or in other words, first, the primary distribution states that whatever is the line item of expenses, there could be 20-30 line item of expenses. At the end of primary distribution, each and every line item of expense should be apportioned between all the departments using a reasonable basis. Are you clear with this, guys? At the end of primary distribution, what would have happened? So 20 line items of expenses will now be reduced to just 5 line item of expenses. Are you clear with this? Right? Because now at the end of primary distribution, you will only be having P1 overheads, P2 overheads, P3 overheads, S1 overheads, and S2 overheads. And each of these overheads will be having a share of all the 20 line items based on the benefits that they have taken. Are you clear with this, guys? Now 20 line items got reduced to just 5. Are you clear with this, guys? Yes. Now at the end of primary distribution, right, now comes the second step called as secondary distribution. Now what happens in a secondary distribution is that, now, what secondary distribution says, okay, now at the end of primary distribution, you have only 5 figures, no? P1 overheads, P2 overheads, P3 overheads, S1 overheads, and S2 overheads. Now, what secondary distribution says is, look, why do I have the service departments? Why do I have the service department? To support my production departments only. So now, technically speaking, S1 and S2 departments, right, they are meant to serve only the other 3 P1, P2, P3 departments. So they are saying secondary distribution asks the service departments to redistribute their share of overheads back to the production departments, right? So S1 needs to give its share of overheads fully to P1, P2, P3, and stores departments. S2 should also do the same. So that is, the secondary distribution says the service department overheads should be redistributed back to the production department. Sir, on what basis, sir? On the basis of services rendered ratio. Services rendered ratio. I will tell you what it is. For example, canteen, the services rendered will be on the basis of the number of employees sitting there. Correct? No? Right? So canteen, what does a canteen do typically? They provide food to all the staff. Are you clear with this? Right? So the canteens cost, S1 department overhead, should be redistributed back to P1, P2, P3 on the basis of number of employees. Are you clear with this? Whereas a stores department, so it's basically this department handles all the materials and all that. So it needs to redistribute S2 department's overhead back to the production departments, maybe on the ratio of using the basis of the number of requisitions raised in a particular year, or maybe the material handled by each of the department. Some reasonable basis will be there. Are you clear with this, guys? Are you clear with this, guys? Are you clear with this? Yes. Now at the end of secondary distribution, what happens? The 5 figures will now get further reduced to just 3 figures. So now you will be having only P1 overheads, P2 overheads, P3 overheads. But guys, mind you, the total remains the same. The total remains the same. Obviously, the total will remain the same. The number of line items alone will reduce. If you add here the 20 line items, whatever is the total, that total will be equal to the total of P1 plus P2 plus P3 plus S1 plus S2. Further here also, after secondary distribution, the P1 plus P2 plus P3, it will give the same total only, because the total overheads will not change. Now the department wise share alone keeps on changing. Are you clear with this, guys? Are you clear with this? So at the end of secondary distribution, now all department overheads now gets converted only into production department overheads. Clear with this, guys? Right? Now comes the third and the most important part, called as absorption. So now what they need to do, so this is a textile industry, textile company, right? So now let's say they deal in 4 different products. They deal in menswear, right, ladies wear, kids wear, and let us say they also deal in footwear, right? Now what I need to do at the end of secondary distribution, now I have reduced down all the line items into just 3 line items. I have 3 bulk figures with me, correct? P1 overheads, P2 overheads, P3 overheads. Now this I need to convert it into overhead cost per unit of menswear, overhead cost per unit of ladies wear, overhead cost per unit of kids wear, and overhead cost per unit of footwear. Now once I do this, the objective of this chapter is done, and with this I will be able to achieve the overall objectives of stock valuation, profit computation. How? Now I got my overhead cost per unit for each of the different types of products. Readily my prime cost components are waiting for me on a per unit level, right? Just add the production overheads per unit, you will arrive at the total manufacturing cost per unit. With that you can do the stock valuation, and the entire subject is done with respect to this objective. Clear with this, guys? Now here if you see, I have 3 bulk figures. Now how am I going to convert this into the per unit level? That is the subject matter of discussion in the third phase, called as absorption. Clear with this, guys? That is slightly an intricate technique. Clear with this, guys? So overall, this is the big picture of this particular chapter. This is the big picture of this particular chapter. Now if you just go through this particular material, now you will be able to understand this, right? So now yes, the primary and secondary distribution. Okay, so let me just walk you through this. The primary distribution, this is what I told you. See, what happens here is, now there are multiple line items of expenses. There are multiple line items of expenses here, correct? There are multiple line items of expenses here. So all the line items of expenses should be apportioned between what? Should be apportioned between all the departments, production and service, correct? This is called as primary distribution, correct? So at the end of primary distribution, so many line items of expenditure gets converted into all department overheads. Clear with this, guys? Then comes your secondary distribution. What will you do? The service department overheads are redistributed back to the production department. So at the end of secondary distribution, you have what? You have only your production department overheads. Are you clear with this, guys? Are you clear with this? Is everyone able to understand this? Right? Now let me take a small illustration. Let me take a small illustration here. Now you look at this, guys. We will be doing a comprehensive question with respect to this 3-step procedure. Do not worry about it. Now guys, now one more thing I want to tell you, right? This primary distribution is fairly simple. What is primary distribution? The primary distribution is line item of expenditure need to be apportioned between all the departments using some benefit derived ratio, logical basis. Clear with this, guys? This anyone and everyone can do. What does the secondary distribution say? The secondary distribution says that the service department overheads need to be redistributed back to the production department. Clear with this? Now there are different methods of secondary distribution. There are different methods of secondary distribution. This is very, very important understanding. There are multiple methods of secondary distribution. Now, many people know that there are different methods of secondary distribution, but the problem is they do not know that there is actually a rule as to when to use which method. So, if you see secondary distribution, broadly speaking, there are three methods. Broadly speaking, there are three methods. The first one is called as direct redistribution method. Direct redistribution method. The second one is called as stepladder method. Stepladder method. And the third one is called as, yes, reciprocal services method. Reciprocal services method. And under the reciprocal services method, there are broadly three methods here. One is called as simultaneous equation method. Then you have something called as repeated distribution method. And finally, you have something called as a trial and error method. One not so good method, but anyways, it doesn't get tested much, but anyways, it's not a very good method as well, right? Clear with this, guys? Now, there are broadly three methods I told you: direct redistribution, stepladder, and reciprocal services. And the reciprocal services can be done either using simultaneous equation, your repeated distribution, or trial and error method. Okay. Now there is a rule, right? When to use which of these three methods. Basically, these three methods under the reciprocal services method will give you the same answer. That is simultaneous equation, your repeated distribution, and trial and error. These three methods will give the same answer, right, under the reciprocal services method. Clear with this, guys? Now, sir, what are we talking about here? The service department overheads need to be reapportioned back to the production departments, right? Now, when to use which method is what we are talking about right now. Are you clear with this, guys? Are you clear with this? Now, look at this. First, let me take an example. Direct redistribution method. That is the first method. Now, direct redistribution method, when will you use it? Direct redistribution method, when will you use it? Let us say I have three production departments, P1, P2, P3, right? Then I have two service departments, S1 and S2. Clear with this, guys, right? Now, in this situation, let us say S1 is a stores department. S1 is a stores department and S2 is a repairs and maintenance department. Clear with this? Now you tell me, a stores department will provide services to the production departments, correct or not? Yes, guys. Will they provide any service to repairs and maintenance department? No, because stores generally, stores department provides services only where the material movement is there. The material movement will not be there here for S2 and all. Correct, guys? Are you clear with this? Guys? Yes. Similarly, here S2, the service department 2 is a repairs and maintenance department. S2 department also provides services to P1, P2, P3 only. S2 also will not provide any services to S1. Or in other words, wherever there is a situation where there is no give or take between the service departments, there is no give or take. In that case, I can use my direct redistribution method. Are you clear with this, guys? Are you clear with this? I'm repeating, when there is no give or take between the service departments, only then my direct redistribution method should be used. Are you clear with this, guys? Yes, you guys are able to understand this? Now, when do I use stepladder method? Let us say P1, P2, P3. I have three production departments, and S1 and S2. I have two service departments as well. Now, let us say S1 department is a stores department. S2 department is a canteen department. Now, what happens? Stores, anyways, These two departments will provide services to production department. That goes without saying, because they are service departments, they are meant to serve the production department. But what happens? Will stores department provide any service to the canteen department? No. What has the stores got to do in a canteen, right? Whereas the canteen department, will they provide service to stores department? Yes, they will provide food. They will not discriminate whether you are a production department guy or a a service department guy. Whoever comes in, they will serve the food. Correct? No, right? That's our Indian culture also, by the way. Yes. So basically here, this canteen department will definitely provide service to the stores department, but in turn, they will not take any service from the stores department. Or in other words, when there is either a give or a take, in other words, nothing but when there is a one-way traffic, only then you should be using stepladder method. Are you clear with this, guys? What are these methods? How to do it, that we will see. But first, you should know when to approach which method. Are you clear with this, guys? Are you all able to understand? Right? So only when there is a one-way traffic, right? You should be even using this method called as what? You should be using this method called as stepladder method. Clear with this, guys? Done? Now let me give you another scenario, and I want you guys to answer me properly. Now let's say I have 3 production departments, P1, P2, P3, right? And then 3 service departments, S1, S2, S3, right? Now forget the production departments. For you to choose the method, you should only know the relationship between the service departments. So now let me tell you this. Let us say S1 provides services to S2, right? Let's say S2 provides services to S3, right? And let's say S3 provides services to S1. Clear with this? In this scenario, you tell me, can I use stepladder method or not? Or to put it simple, is there a one-way traffic in this question, or no more than one-way traffic? So I just want an answer from you all. Come on, guys, participate on the comment section. By the way, someone is asking if this is live. Yes. So now tell me, guys, is this a one-way traffic question or not? Is this a one-way traffic or not? Come on, guys, answer. Huh?
One-way traffic.
So now this is a one-way traffic question only. Why? Look, the relationship of the give or take should be looked at from the perspective of taking 2 departments at a time. Now some students might think, sir, S1, what it is doing, it is also providing services, it is also receiving services, so now it is not a one-way traffic. No, you should not provide a service and receive a service from the same department. If you look at this, between S1 and S2, there is only a give or a take, correct? Between S2 and S3, there is only a give or a take. And between S1 and S3, once again, there is only a give or a take. Are you clear with this? That is, you take only 2 departments at a time and see whether there is a one-way relationship between them. If not, then you say, fine, okay, two-way traffic, the next method we will go. Are you clear with this? So the relationship should be seen between 2 departments at a time. Don't say as a whole, I'm giving as well as I'm taking. You can give to one department and you can take from another department. Still it is called as a one-way traffic only. Are you clear with this? In that case also, we will be using only the stepladder method. Clear with this, guys? This was a past exam question. I'll show you a question that was very, very nice. Well coined. Right? Clear with this, guys? Done? And the third one, as you all know, is going to be a two-way traffic. Means what? P1, P2, P3. Let's say S1 and S2, right? And between the service departments, there is both give and a take. Let us say S1 is a housekeeping department, S2 is a canteen department. Housekeeping department means what? They will clean the place and all that. So they will also clean the canteen, correct? So housekeeping provides services to canteen. In turn, canteen also provides services to housekeeping department. So that is a two-way relationship, two-way traffic established here. In this case, you will be going for what? You will be going for the reciprocal services method. Clear with this, guys? And whenever you have a two-way traffic, those sums can be done either using either of the 3 methods, that is simultaneous equation, repeated distribution, or trial and error method. Clear with this, guys? We will be seeing what these methods are, but before that, first understand when to use these methods. Clear with this, guys? First of all, we are talking about secondary distribution. Primary distribution anyways is not a problem because that is done using some reasonable basis, and that's about it. Clear with this, guys? Clear with this? Now let's go to the question. Let's go to the illustration here. So the reapportionment method. Reapportionment stands for secondary distribution. The secondary distribution method 1, that is the direct redistribution method. What will you do? So they are saying this company has 2 production departments, 2 service departments, and they are saying department X, which is service department, provides the services to A and B in the ratio of 3:2. Similarly, department Y also provides services to A and B only in the ratio of 1:1. Means what? Between X and Y, there is no relationship, no traffic. Clear with this? Don't say one-way traffic. See, the first method is no traffic. The second method is one-way traffic. The third method is two-way traffic. Clear with this, guys? Clear with this? Yes. No traffic. Fairly simple. So what will you do? So this is the overhead as per the primary distribution. So anyways, the line items of expenses have been already converted into all department overhead. So now what is the objective here? Right now, secondary distribution. So the service department overheads need to be given back to the production department. Correct, guys? So it needs to be given back to the production department at the end of the primary distribution. The service department should not have any overheads with themselves. Everything needs to be given back to the production department. Are you clear with this? So now what will I do here? This 2000 rupees of department X, service department X, will be apportioned in the ratio of 3:2. Correct, guys? So I will reduce 2000 here and add up 1200 rupees share for department A and 800 for department B. Similarly, department Y share, entire amount of 1000 is being given back to A and B in the ratio of 1:1, 500, 500. Now at the end of the secondary distribution, what happens here? Department A gets a total value of 6700 rupees. Department B gets a total value of 4300. If you add the two, how much is it coming out to? 11,000 rupees. Correct, guys? Right? Now, overall, before we started, this total would have also been the same 11,000. 5,000 plus 3,000, it is 8,000. 8,000 plus 2,000, 10,000 plus 1. So this was also 11,000 rupees. So total value will not change, but only the internal composition will keep changing. Are you clear with this, guys? Are you clear with this? So now all department overheads has further reduced to only production department overheads. Are you clear with this? First we saw it under direct method, and in direct method, when will you use it? When there is no traffic. Are you clear with this, guys? In exam, please don't write no traffic and all. This is a word that I am telling you, right? It is not officially used for ease of understanding, right? That's why I'm saying it basically talks about the relationship between the service departments. Clear with this, guys? Next, step ladder method. We will be doing a sum. Do not worry about it, right? Then comes your repeated, your reapportionment method. That is your reciprocal services method. When will you use reciprocal services method? When there is a two-way traffic. Guys, I'm yet to do one-way traffic. Do not worry, I have a very good sum. We will be doing it. Fine. So now two-way traffic, under that the first repeated distribution method, we will be seeing how it works. Now basically guys, so when will you use your two-way traffic, your repeated distribution methods and all, your reciprocal services method? When there is both a give and a take between the service departments. In this case, if you see, Department X and Department Y are service departments, right? Department X provides services to A, B as well as to Y. Correct? No? Guys, yes. So, Department X provides services to Y. Yes. Now, Department Y in turn, anyways, it provides services to A and B. They are production departments, right? But it also provides the services to Department X. Are you clear with this? Clearly, there is a two-way traffic, and hence we are going and doing the sum under the reciprocal services method. And under the reciprocal services method, the first method is what? Okay, the simultaneous equation, we will do it. Now, first we are doing it under the repeated distribution method. Are you clear with this, guys? Are you clear with this? What does this repeated distribution method says? First, they are starting on with the primary distribution summary. So 5,000, 3,000, 2,000, 1,000. This is the primary distribution summary. So now what they are saying is, now simple, you keep on distributing it. So first, Department X, right? It has a share of how much? 2,000 rupees. Reduce this 2,000 and give it to A, B as well as Y in the ratio of the services rendered. So 5:4:10. You just distribute it between all the other three departments. So now what happened? This 2,000 got distributed between A, B and Y. Are you clear with this, guys? Are you clear with this? Now what happens? As of now, Department X has a zero balance. Correct? Guys, yes? Department X has a 0 balance. Now Department Y has how much? 1000 originally, plus now it got 200 rupees share from Department X. Correct? No? Now I am in the secondary distribution. My objective is to make my service department cost 0 and give it back to everyone. Now what I do is this 1200 rupees I need to redistribute it back to A, B and X also. So once I do that, I give it to A, B and X, the ratio of 4:4:2. Now what happens? Now Department X originally was 0. Now it has now got a share of how much? 240 rupees. Guys, clear with this. Clear with this. Now I was actually enjoying my position because I thought my job was over, right? 0. But now what has happened? Again, I'm getting a share from Department Y. Clear with this. Now what will you do? What will you do? Once again, you redistribute it. That's why it's called as repeated distribution method. Once again, this 240 share, you apportion it on the ratio of 5:4:1. Now what happens? Y was 0 till now, it got a share of 24 rupees. Now once again redistribute this 24 in the ratio of 4:4:2. Now you do it. Now what happens? Now X gets a share of 4 rupees. Now keep on distributing it till the time the value is very, very nominal. Now if you see this 4 rupees, if I distribute it, once again the ratio of 5:4:1. Now if I further do it, it will exactly be 40% of that. Yes, this is going to be 1.6 and this will be 0.4 technically. So now what they did, instead of saying 2, 1.6 and 0.4, they took this 0.4 and added it up with the B value and they made this as 0. Are you clear with this? Or in other words, the repeated distribution needs to be done till the time when the final value becomes very negligible and it can be rounded off and given back to the production departments. Now finally what has happened, X and Y became 0 and then I achieved the objective of converting the all department overheads to just the service, the production department overheads. Are you clear with this, guys? This method is called as repeated distribution method. Are you clear with this, guys? Are you clear with this? Any issues here, guys? Any issues here? Right, now let's quickly move on to the next one. The very same sum can also be done under another good method. In my opinion, I would always suggest, if there is a two-way traffic, only follow simultaneous equation. Unless the question is specifically asking you to do it under repeated distribution, please do it only under simultaneous equation method. Now what is this? What is this? So how do you do this? Now first we will be calculating. In this, it's a 3-step procedure. Step number 1, we will frame the equation. Step number 2, we will solve the equation. And step number 3, we will be calculating the apportionment. What is it? Now, since there is both a give and a take here, now if you see, now Department X, what is the Department X share of overheads? Can I say Department X has its own share of 2000 rupees of overheads, right? Plus it will be getting 20% of the Department Y share of overheads. Correct? No? Right? Or in other words, can I frame an equation and say X is equal to 2000 my own share plus 0.2 of Y. Correct, guys? Clear with this? Clear with this? Right? Now Department Y on the other hand, can I say is nothing but 1000 plus it will be getting 0.1 of Department X's share. Correct? No? Right? So here I will say X is equal to 2000 plus 0.2 Y. Then what is Y? Y is equal to 1000 plus 0.1 X. Are you clear with this? Are you clear with this? So now what we will be doing here is, so now you take any one of the equation. Let us take the equation number 2. Right? What is equation number 2? Y is equal to 1000 plus 0.1 into X. Now instead of X, you substitute X with this value of 2000 plus 0.2 Y. So now if you do that, the entire equation will now be rewritten just in terms of Y. That is one variable. You solve for this equation, you will arrive at the Y value and then substitute it any one of the equation, you will get the X value as well. Are you clear with this? Are you clear with this? What is this X value and Y value? Wait, I will tell you now. Now what you need to do is, so the step 1 was framing the equation. The step 2 was solving the equation to arrive at the X value and Y value. The step 3 is your apportionment. Now in this apportionment, what are we going to do? This is how it started, right? This is how it started. 5,000, 30,000, 2,000 and 1,000. First, from X, you reduce how much? You apportion 2245 rupees. Sir, why will I do that, sir? Why will I do that? I have only 2000 rupees. That is the beauty of simultaneous equation method. It says, now currently you have only 2000. But later on, you will once again get from Y, no? That I am anticipating it well in advance, and now itself I am asking you to apportion 2245, so that tomorrow when you get 245, that will also get knocked off here itself. You need not repeatedly do it. Just one time you apportion and leave it there. Are you clear with this, guys? Are you clear with this? So now itself you apportion 2245, the X value, in the ratio of 5:4:1. Correct, guys? Clear with this, right? Now what happens? Y gets a share of 1000 plus 224. This was already found out by our simultaneous equation method. Now it says happily distribute the 1224 in the ratio of 4:4:2. If you do that, now X will be getting a share of exactly 245. Now overall, if you see, this gets knocked off, and finally you have only the two departments overheads. Are you clear with this, guys? Are you clear with this? Or in other words, what we did here was, under the repeated distribution method, if you see, what was the total value of X amount distributed? Once we distributed 2000, then we distributed 240 rupees, then further we distributed 4 rupees. Totally we redistributed how much? 2244. 2244. Similarly, Y, how much we redistributed? 1200 plus 24. It's going to be 1224. Correct, no, guys? Right? So instead of calculating the figure by redistributing it, this directly here itself, I think this is 1000, no? Okay, yes. So here directly by framing the equation and solving, here we found it at the beginning itself. There is no point for us to repeatedly doing it. So now instead of 2244 there, because of that round off it's there, it is 2245 and 1244. This figure of how much you have to redistribute in total was found out at the beginning itself. Based on that, now the redistribution was done. Are you clear with this, guys? Are you clear with this? In simultaneous equation method, we can check answers. Yes, you can check the answers accurately. Yes, guys, are you clear with this, guys? Yes, you guys are able to understand this, right? This is about your simultaneous equation method. Are you clear with this, guys? There is another method called trial and error method, not a great method, so that's why I'm not discussing it here right now, because it's not worth the time for discussion. Clear with this, guys? Maybe if you want, you can just go through it in your study material, but beyond that, it has never been tested and it's not a very great method as well. Right, guys? Fine. That is about the discussion of primary distribution, and the secondary distribution under direct method and under the reciprocal services method. Now let us do one sum relating to the step ladder method. Shall we, guys? Yes. Now please take your question number, I think it's question number 1. Is it question number 1? Yes. No, question number 1. Just a minute. One second. Let me. Yes. Question number 1 only. Okay, guys, please don't look at the solution. Please do not look at the solution. Now, read this question. A manufacturing company has 2 production departments, P1 and P2, and 3 service departments, timekeeping, stores, and maintenance. The departmental distribution summary showed the following expenses for the month of December. So P1, P2, right? And then stores department overheads, timekeeping department overheads, and maintenance department overheads. Basically, what they have got us is they have the total primary distribution has been done, department wise overheads has been given here. Additional information they have given. Production department, okay, I think there's a mistake here. So production department is only P1, P2. Service department includes stores. Please make this correction. Only these 2 are production departments and these 3 are service departments. Okay. Now look at this. What have they given? The number of employees in each department is given. The number of requisitions made in each department is given. The machine hours in each and every department is given. Apportion the service department expense to the production cost centers P1 and P2. Basically, what have they asked for? Secondary distribution. Have they given you which method to follow? No, they have not asked you for the method. They want you to find out which method needs to be used. A brilliant sum a brilliant sum, right, wherein they have not given the method directly, and also the services rendered ratio and all, that is the relationship between the three departments. They have given, cleverly they have given three service departments, right? I just asked you a question, no? S1 provides to S2, S2 provides to S3, S3 provides to S1, and I asked you guys whether it's going to be a single one-way traffic or two-way traffic and all, right? This sum is beautifully coined. It's a very small sum, but the issue here is to identify which method it comes out to, right? Now basically guys, a stores department, what does a stores department do? It will issue the raw materials. It does requisitions. Material requisitions will be honored by the stores department. Clear? So the services provided by the stores department should be evaluated on the basis of number of requisitions. Similarly, a timekeeping department. What do you mean by a timekeeping department? They actually keep a tab of how many hours were spent by employees in which department and all. They maintain the attendance and all. So the timekeeping department, actually they provide services on the basis of the number of employees. Does it make sense? Right? And then you have a maintenance department. Maintenance department services are based on the number of machine hours. Correct guys? Yes. So now first, let us not even get into the sum. Let us not even get into the numerical problem. First, we need to find out which method of secondary distribution we need to follow. Agreeing or not? Guys, agreeing or not? Right? Now, which method we need to follow? Again, depends on the nature of traffic between the service departments. Right? I'm only bothered with the service departments. Correct? No? So, what I'm doing is, I'm taking the three departments and putting it as a matrix. Right? Timekeeping, stores, maintenance, right? Here I am keeping this as a service receiver, and timekeeping, stores and maintenance, here I am putting it as a service provider. Clear with this guys? Now you tell me, timekeeping department, first one more thing that you need to know, self-service should be ignored. What do you mean by self-service? Timekeeping department, what do? Wherever employees are there, the timekeeping department will be having a work there. Correct? No? That is, they keep a tab of their attendance. In the timekeeping department also employees are there. No? So they provide service to themselves also. No? Ignore that. If you consider that, then it will always be a loop. I will be giving a share of my own cost to myself and it will be never ending. Clear with this? So always, because our objective is what? To give away all the service department costs to the production departments. So self-service should be ignored. So timekeeping to timekeeping, stores to stores, maintenance to maintenance. First put a dash here. Are you clear with this? Clear with this guys? Now tell me, timekeeping department, do they provide services to stores department? Simple. How do you know? If there is an employee in the stores department, it means they are providing service. In the stores department, are there employees? Yes. So I'm putting a tick here and saying timekeeping provides services to stores. Now timekeeping, do they provide services to maintenance department? Yes, there are some employees there also. No, correct. So I'm putting a tick here and I'm saying yes, timekeeping provides services to maintenance also. Clear with this guys? Next, stores department. Does the stores department provide services to timekeeping? So go to the number of requisitions. In timekeeping department, there is no requisition and all, which means if there is no requisition in a particular department, the stores will play no role there. So clearly, the stores department does not provide any services to timekeeping department. Clear with this guys, right? And does the stores department provide any services to maintenance department? Yes, there are some requisitions in the maintenance department, which means they are providing it. Are you clear with this guys, right? Now let's go to the maintenance department. Does the maintenance department provide, the maintenance department will be providing services only when there are machine hours. So if you see, there are no machine hours in any of the service departments. So clearly, the maintenance department is not providing services to timekeeping as well as to stores. Are you clear with this? Now with this, what you can conclude? Look at this. You have three departments: timekeeping, stores and maintenance. Correct? Now timekeeping provides services to stores, correct? And timekeeping also provides services to maintenance, right? Stores, on the other hand, provides services only to maintenance, and maintenance, on the other hand, does not provide services to anyone. Now, anywhere can you see a relationship of a two-way traffic here? Anywhere is there a two-way traffic? You take any two departments between timekeeping and stores, only a give is there. right? Between stores and maintenance, only a give is there. Between timekeeping and maintenance, once again, there's only a one-way traffic. Clear with this, guys? So between any two departments at a time, there is only a one-way traffic, and hence this is a very fit case for the step ladder method. Are you clear with this, guys? Are you clear with this, guys? Yes. First, we are proving which method needs to be used, and only then we can even enter into the method. Clear with this, guys? Hello, guys. You guys are clear with this, right? You guys are clear with this? Fine. Yes, Ramya, you're understanding? Yes, Murli, everyone. Bharat, you guys are able to follow? Fine. Now comes the step ladder method. How do I do this? First, you list out all the primary distribution summary, whatever you've got, right? Now it's very simple. So timekeeping department, I need to apportion the costs on the basis of number of employees, correct? No, right? So I will do it on the basis of number of employees, ignoring my own employee. So I need to ignore self-services, correct, guys? Yes. So now I'll be doing it in the ratio of 20:15:5:10, right? So 20:15:5:10. So we are doing it in the ratio. I've changed the sequence. That's why. So now what happens here? This 4,000 gets reduced from the timekeeping department, and it gets evenly apportioned between all other departments. Are you clear with this, guys? Right? Next, what happens? The stores comes in. The stores departments, what they will do is, the stores department, I need to apportion on the basis of number of requisitions. So here that is going to be 12:10:3. Clear? So this 5,800 rupees, that is 5,000 plus 800, the 5,800 component gets apportioned in the ratio of 12:10:3, right? Now stores department cost has also been fully apportioned. Now I have a balance only in the maintenance department of 3,000 plus 400 plus 696. It's going to give me 4096. This amount needs to be apportioned between A and B alone, I mean P1 and P2 alone, in the ratio of 24:6. Yes, or 4:1, whatever it is. So once you do that, finally what happens? Now you have only these two departments overheads, your production department overheads. Now this method is called as a step ladder method, because after apportioning it, you can see the step-like sequence. Are you clear with this? This is the reason why it is called as a step ladder method. Are you clear with this, guys? Are you clear with this, guys? Right? And that is about this particular concept of step ladder method. It can be observed that there are no reciprocal services among the service department, hence we can use step ladder method, right? While distributing overhead, distribute the overhead of that department which provides services to maximum number of other service departments, and go in the descending order. If you look at this, the timekeeping department provides services to how many other departments? Two departments, stores and maintenance. The stores departments provide services to only maintenance, and the maintenance department does not provide service to any other service department, correct? So what I will do is, I will apportion it in the same order. First, I will apportion the timekeeping department's overheads, then I will apportion the stores department overheads, and then I will go and apportion the maintenance department overheads. Are you clear with this? That is the reason why timekeeping, stores and maintenance, this sequence we followed. Are you clear with this, guys? Are you able to understand, right? And that is about the entire concept of secondary distribution. Clear with this, guys? Clear with this, guys? Done. So this is one interesting sum. This is one interesting sum that was once tested. I think recently it got tested sometime back. So please be very clear with the concept. Don't think that you can use any formula, any method at any given point of time. It really doesn't work that way, right? So you need to know which method needs to be picked at which point in time. Clear with this, guys? Clear with this, guys? So that is about this particular question of step ladder method. Now with this we have finished the primary distribution, right? And we have also finished the secondary distribution. Clear with this, guys? Right? Now we need to move on to the third phase of this particular chapter, which is called as absorption. Now where does absorption fit into this category? Now I told you guys that let's say at the end of secondary distribution, I am left with P1 overhead, P2 overhead, P3 overhead on one side. What I need to do, I need to calculate the overhead cost per unit of menswear, kidswear, ladieswear, and the footwear. Correct? The 4 different products that I deal in. This is what I need to do. So there is a gap that needs to be bridged, right guys? There is a gap that needs to be bridged. Now, how am I going to do that? How am I going to do that is what gets captured under this particular third phase of discussion called as absorption, right guys? So now let us get started with this concept of absorption. How do we do it? How do we do it? Now, let me give you a small example with respect to that. And once we do this example, we will be doing a comprehensive sum that covers primary distribution plus secondary distribution and absorption, all the three, right? Now, let us say I have two production departments, P1, P2, right? Now, the secondary distribution summary, I have done the secondary distribution. It says that P1 department's share is 20,000 rupees. P2 department's share is 15,000 rupees. Clear with this, guys? Done. Now, what happens here? What happens here? Let us say I have one more data with me. What is the data? The labor hours. The labor hours spent in department P1 is, let us say, 5,000 hours. Totally in P1 department, a total of 5,000 labor hours were clocked, right? And in P2 department, a total of 3,000 labor hours were clocked. Now, I will say representatively, it cannot be exact, but representative, because these are all indirect expenses. But I need some reasonable base to actually come up with some kind of a relationship, correct? So now, can I representatively say in department P1, right, for every hour spent, what is the overhead cost? To 20,000 rupees divided by 5,000 hours, can I say it is going to be rupees 4 per hour, correct? Similarly, in department P2, I will say 15,000 rupees divided by 3,000 hours, it is going to be rupees 5 per hour. Or in other words, okay, let us say the company deals in two products. The company deals in two products, A, right, and B. What happens? Product A, right? It passes through department P1 and P2. It takes 3 hours. It spends 3 hours in department P1 and it spends 2 hours in department P2. Similarly, I have another product B, which spends, let us say, 2 hours in department P1 and 3 hours in department P2. Are you clear with this? Guys, clear with this? Now what I will be doing is, now I have some bulk amount of expenses. Now what I did, using some reasonable base, in this case I took labor hours. I tried to establish that overhead, right, using that base quantity, and I said, okay, generally I can say that in department P1, I generally incur 4 rupees for every hour spent. Clear? In department P2, I generally incur an overhead cost of 5 rupees for every hour spent. Correct? This relationship being established is called as absorption rate. Are you clear with this? This is called as absorption rate. So what is the meaning of this 4 rupees per hour? This is not product specific, product A or product B. If you spend 1 hour in my department, I will charge you with 4 rupees of overheads. This is the meaning. Clear with this, guys? Now, product A spends how many hours in department P1? 3 hours, right? Each hour I will give it a share of 4 rupees. Similarly, product B spends 2 hours in department P1. Each hour I will give it a share of same 4 rupees only. Are you clear with this? Similarly, product A spends how many hours in department P2? 2 hours. Each hour will be given a share of 5 rupees. Similarly, P2 spends 3 hours in your product B spends 3 hours in department P2, and each and every hour should be given a share of 5 rupees here. So now if I do this, finally what I arrive at here, so now this is going to be 3 into 4. So that's going to be 12 rupees. 2 into 5. This is going to be how much? 10 rupees. So overall, I would say the overhead cost per unit of A is going to be rupees 22. Are you clear with this, guys? Similarly, the overhead cost per unit of B, how much is it? 2 into 4, 8. 3 into 5 is going to be 15, right? Overall, it's going to be how much? Rupees 23. Are you clear with this? This way, finally, I achieved the objective of this particular chapter. So it started off with multiple line items of expenses like rents and rates, your factory rent, your supervisor's salary, your repairs and maintenance, depreciation, all these things. Primary distribution, I actually distributed all the line items of expenses to all the departments, right? And then secondary distribution, that is service department overheads got redistributed back to the production departments. And now absorption, using, I picked up a base quantity, tried to bridge the gap, and finally I converted the production department overheads bulk figures into overhead cost per unit of each of the product that the company deals in. It could be 5 products or 6 products. Let's the company say it deals in A, B, C, D, E, 5 products. Each of the product, you just tell me how many hours it has spent in this department. Based on that, I can calculate the overhead cost per unit. Are you clear with this, guys? Are you clear with this, guys? This process is called as absorption, the third process. So absorption is a 2-step procedure. So what are the 2 steps involved? Step 1 is calculating the absorption rate, and step 2 is having calculated the absorption rate, I charged it on to my product. Correct? 3 into 4 I did, 2 into 5 I did. That is, that absorption rate, I multiplied it with the actual hours taken by each of the products. Correct or not? Right? This is the second particular step in this process, which is known as charging of overheads to the product. So now in your absorption, you have 2-step procedure. The third step, the third phase of this discussion, the absorption part has 2 steps. Number 1 is calculation of absorption rate, and number 2 is charging of overheads to the products. Are you clear with this, guys? Are you clear with this? And with this, overall, this chapter's objective is getting achieved. Clear with this, guys? Yes, done. This is what they have explained here. Now 1 minute. In this case, what I did, I took labor hours. I took labor hours as the basis to calculate the absorption rate. Guys, yes. Sir, should I always use labor hours as the basis? No. There are 6 different base quantities. There are 6 different base quantities that you are allowed to take. In this case, we took labor hours. Labor hours was one such type of a base quantity. Clear with this, guys? There are 6 different types of base quantities that you can take. What are the 6 different types of base quantities that you can take? Labor hour, machine hour, then direct labor cost, direct material cost, direct labor cost, prime cost, and your production overheads. Or in other words, look, the first two are expressed in terms of hours. That is 4 rupee per hour, 5 rupee per hour. The next 3 are expressed as a percentage. That is what I will do is budget overheads, right? Let us say if it is material cost, I will say 20,000 rupees is the here. This is going to be my secondary distribution, right? And in department P1, let us say my material cost overall is 1 lakh rupees. So what I will do is, so the absorption rate will be 20,000 divided by 1 lakh. So I will say generally the department P1's overhead is going to be 20% of the material cost. Are you clear with this? Right? Because if the numerator and denominator are both in rupees, it needs to be expressed as a percentage. And finally, the last method is your production units method. Production units method means what? Directly units. Right, directly the units. Suppose they have given 20,000 rupees is the department P1's overheads, and let us say overall some 5,000 units were manufactured in this department, right? That is A, B, everything put together. Let's say all are like similar items. So now what I will do, 20,000 divided by 5,000, I will say for every unit, whether it's A or B, I will charge it with an overhead of 4 rupees per unit. Are you clear with this? Right? This way also it can be done, right? So this is the last method, the last type of base quantity that can be used. Sir, why only 6 types of base quantity? If you notice carefully, all these 6 line items are some way or the other some direct items. When I say direct items, these 6 items are readily available in total as well as available on a per unit level. In this example, if you see, I knew how much was the total labor hours, and I also had the labor hour on a per unit level, right? Only because the fact that this given data was available on a total level as well as on a per unit level, I could bridge the gap of converting a total bulk indirect cost into a product level. Are you clear with this, guys? That is, all these 6 types of base quantities are generally available both in total as well as on a per unit level. This helps us to bridge the gap of converting that bulk line item of production overheads into overhead cost per unit of each of the products. Are you clear with this? That is the reason why we have only the 6 types of base quantities that are allowed. So what are the 6 types of base quantity? The first 2 are ours: labor hour rate, machine hour rate, right? Then you have 3 percentages: percentage of direct material, percentage of direct labor, and add the 2 percentage of prime cost. Are you clear with this? And finally, you have production units method. There are only 6 different types of base quantities that can be used. Are you clear with this, guys? Right? And the moment you calculate the absorption rate, that's why calculation of absorption rate is what? Budgeted overhead divided by budgeted base quantity. The base quantity could be any of these 6. Are you clear with this? And the moment you find that out, that is step number 1, calculation of absorption rate. Once you find out the absorption rate, that absorption rate should be multiplied with the actual base quantity consumed. In this case, what we did, we calculated that 4 rupees was the absorption rate, multiply it with 3 hours, you will get the overhead cost of that particular department. Similarly, for department P2, it's going to be 10 rupees, add up the 2, you get the overhead cost per unit. Are you clear with this? It's a 2-step procedure. Guys, are you all able to understand? Don't think that labor hours is the only basis for apportionment. Clear with this, guys? Clear with this, guys? Under or over absorption is an advanced level. I'll come to that, but before that, we will do a numerical problem. Guys, are you all understanding till now? Are you all understanding till now? Yes, this is actually, we are touching upon every single thing, almost every single thing in this chapter, right? So now let us get going with the next numerical problem, which is, I think, question number 2. Yes, question number 2. This was a past exam 10-mark question, a very good question. So a comprehensive problem. We'll be doing it now. Just give me a minute. Right, guys. Now, Superclass Company Limited has 3 production departments, X, Y, and Z, and 2 service departments, A and B. Now, they have given the line items of expenses, rents and rate. Guys, please don't look at the solution. I humble request you, if you want to get the best learning experience, don't look at the solution. The solution is meant only for ease of discussion. We don't have much time right now, right? Since it's a revision batch, in regular batch, every single sum, every single figure, I will be doing it on, I will actually be writing it along with you guys. That's how it is. In a revision batch, we need to pick up some speed because it's a revision actually. So here, if you want, I can do it, but I don't want to waste your time. That's the main reason, right? So please don't look at the solution. If you do look at the solution, it's actually, the effect will not be there that much. Okay. So now, what are they given? Some different line items of expenses like rents and rates, lighting and electricity, indirect wages, power, depreciation, other sundry expenses and all. Line item of expenses have been given. Are you clear with this, right? What else have they given? The following are the further details. Floor space, right? Department wise, they have given X, Y, Z, A, B. What is the total floor space? 10,000 square meters, right? That 10,000 square meters, the breakup is given. Which department has taken how much area? This has been given. Why have they given this? This is the basis to apportion my rent and rate cost. Are you clear with this? Primary distribution. Guys, yes, clear with this. Next, lighting points are given. This is the basis for apportionment of lighting and electricity. Direct wages has been given, right? So now this is the basis for apportioning your indirect wages. Why indirect wages? Indirect wages is the supervisor's salary, correct? So who will be supervised? He will be supervising the direct workers only, right? If the number of employees headcount is given, you can take it. Here, the next reasonable basis, direct wages, you use that as a base. Clear with this, guys? Done, right? Then you have power costs. You can take horsepower of machinery. Then depreciation is given. So you can use the cost of the machinery as the reasonable base, right? Then they have given some working hours. We will see what it is and all, right? Then the expenses of the service departments A and B are to be allocated as follows. They have given this. Why have they given this? Why have they given this? Hello?
Secondary distribution.
Yes, this is a secondary distribution data. Now you tell me, guys, by looking at this dabba, you tell me whether this is going to be a no traffic, one-way traffic, two-way traffic. Which one needs to be followed? Come on. It's one-way traffic. No, Priya Sharavanan. It's not a one-way traffic. Look at this. Yes, it's a two-way traffic. It is reciprocal services method. Absolutely. Now how? Because department A provides services to department B. That's why you have a 10% here. Now, in turn, department B also provides services to A. Yes, there is actually another 10% coming up here. Yes, absolutely. Yes, it's going to be a reciprocal services method, two-way traffic. Which method to follow? any of the three methods, repeated distribution, simultaneous equation, or what is the other one? Your trial and error method. But which one is suggestible? If you want to save your time in exam, that too with accuracy, better follow simultaneous equation method. Clear? Frame two equations. So 3-step methodology. First, frame the equations. Number 2, solve the equations. And number 3, do the apportionment. And life is simple. Clear with this, guys? Fine. So first, primary distribution based on this data you need to do. Right? So the line items of expenses gets converted into what? All department overheads. Now that all department overheads further redistributed back, and now you will be getting your production department overheads. That's the end of secondary distribution, right? Now look at this. You are required to calculate the overhead absorption rate per hour in respect of the three production departments X, Y, and Z, because at the end of secondary distribution, you will just be left with X overheads, Y overheads, and Z overheads, correct? Now, what will be the total cost of an article, that is a product, with a material cost of 80, direct labor cost of 40, which passes through X, Y, and Z for 2 hours, 3 hours, and 4 hours respectively. Now, what they are saying, the company is in the business of manufacturing a particular product, right? For that product, they have given the direct material costs, they have given the direct labor cost. Sir, how did they find it? These are prime cost components readily available on a per unit level. This entire chapter of 3-step big procedure of absorption is applicable only with respect to indirect manufacturing cost of overheads. So prime cost components are always waiting for us. Are you clear with this, guys? Are you clear with this, guys? Guys are able to follow this, right? So now what happens here? Now they are saying overhead, they are asking us to charge it. So now what they have said is this particular product, it passes through departments X, Y, and Z, and the time spent in each of these departments are also given. So first, what we need to do, we need to calculate the absorption rate per hour for department X, department Y, and department Z, and multiply that with the respective hours, so that now we will arrive at the overhead cost per unit of this article. Now we can add the production overhead cost also per unit. You will arrive at the total manufacturing cost. Clear with this, guys? So all the 3 steps are involved in this particular numerical problem. Clear with this, guys? Clear with this? So now and they have clearly given in this question, it is going to be what? The base quantity is taken as labor hours. Sir, how do you know, sir? Because that is the only data which is given in total as well as on a per unit level. Are you clear with this? Are you clear with this? Right? So now if you look at it here, they have given the working hours, no? Guys, they have given the working hours here. Are you clear with this? They have given the working hours here. So now what we will do is at the end of secondary distribution, we have the department wise overheads divided by the respective hours. You will get the absorption rate, multiply it with 2, 3, and 4 respectively for each of the department. You will get the overhead cost per unit of the product. Are you clear with this, guys? Done. You guys are clear with this, right? But that is not all. This sum has another beautiful hidden treasure. Now, this is something that many of you guys will miss. Now, if you are especially, you can't afford to miss this in case you have attended the regular lectures. So all those red ink items and all should pop up right now the moment you read this question. Anyone from the regular batch, can anyone tell me what other beautiful adjustment is hidden in this question? Very good. Right. Now, guys, what students generally do, I will tell you. So now in this question, what you have is primary distribution. You would not have imagined at all that this treasure or this particular catch is being kept in the primary distribution area. We all think that how many line items of expenses are there in this question? 1, 2, 3, 4, 5, 6. So these 6 costs, what you will do, you will take a basis and you will apportion it, correct? But no, there is one 7th line item also in this particular question. Now, what is that 7th line item? If you look at this, so rents and rates, your lighting and electricity, indirect wages, power, depreciation, right? All these things are there, right? Other expenses. Now look at this, direct expenses of service department. Direct wages of service department. Now, what is this, sir? What is this? Now, before that, one more thing, I think one more doubt many of you might be having. Other expenses, why should I apportion it on the basis of direct wages? So, I will apportion it equally. Why should I apportion it on the basis of direct wages? Generally, this is based on the assumption that, globally accepted assumption, that human beings are the reason. human beings are the reason for incurring some additional cost. Hence, if nothing is mentioned about other expense, we don't know what is other expense, right? So many other miscellaneous expense put together, you apportion it on the basis of direct wages. That is the logic here. Now, sir, direct wages of service department, why am I considering here? First of all, we are in which chapter? We are in overheads chapter. Now, if at all something enters into my primary distribution, what can enter? Only my production overhead figures, production overhead expenses can only, indirect cost can only enter into my, indirect cost only can enter into my primary distribution, correct? Sir, wages and all is a prime cost component. Why are we seeing it here? This doubt is there or not? Guys, yes? Now, this is what I'm going to clarify here. Now, look at this. In this question, beautifully, they have hidden this line item. They have hidden this line item under this category. That is, you might think that they have given direct wages in this question for the purpose of taking it as a base to apportion a major line item. No. Now, they have given in the sum that X, Y, and Z are production departments. A and B are service departments. Clear with this, guys? Now, no doubt, direct wages forms part of your prime cost component, but not all direct wages. Let me give you an example. Let us say I am in the business of manufacturing pens. Okay, I am in the business of manufacturing pens. Right now, I have P1 department, P2 department, P3 department. Apart from that, I have one more department called as canteen. Right now, they have given direct wages of canteen department, some figure is given. Direct materials of canteen department, some figure is given. Clear? Now, guys, you tell me in a canteen, that is from the perspective of a canteen, right? Direct material will be what? Tomatoes and potatoes only, right? Tomatoes and potatoes will only be direct material, guys, correct? Right? From the perspective of a canteen, the cook's wages will be a direct wages, right? There will be 3 cooks, and on top of them, there will be 1 chef. The canteen will say the cook's salary is going to be direct wages. The chef's salary is going to be an indirect wages, correct? No? That is what they will say. But you logically think from the perspective of the company, whether you are paying for the cook or you are paying for the chef, everything is indirect from the perspective of the product. Will my product pass through the kitchen? Guys, will my product pass through the kitchen? No. So always remember the direct wages or indirect wages, whatever it is, the direct wages or direct materials or any direct cost of a service department is always indirect from the viewpoint of the company. Are you clear with this? So the direct is from the perspective of the respective department. Clear with this? But from the perspective of the entire company as a whole, that is still an indirect cost. Are you clear with this, guys? Hence, that is the reason why we have not taken the direct wages of X, Y, and Z production departments in this particular primary distribution table. You look at this here. We have not taken the direct wages of production department. Only the direct wages of the service department were considered, because though they might call it direct from the perspective of the service department, it continues to be indirect from the perspective of the company as a whole. Are you clear with this, guys? Many students have missed this. Many students have missed this across India. Sir, how do you know, sir, all India reach only for you? No, nothing of that sort. So after every attempt, there will be something called as examiner's comments. There, question wise, the examiners will give their expert commentary, as in they will say, for this question in across the country, so much percentage of people got this answer right, or so much percentage of the people they got it wrong. To this extent, institute gives a lot of data. It comes once in 6 months in your students magazine, the month immediately following the result, whatever the magazine that comes in, or in the month of result, whatever it is. So they generally question wise, subject wise, question wise, they give you an expert opinion on that, so you can see where the students commit a mistake. Now when institute is actually coining all the questions and all, so what they do is this also they take into account, because they know generally where students commit a mistake. right? An attempt may be a first attempt for you, but institute has been taking, it has been conducting exams for the last 50-60 years, so they know where exactly students stand. And of course, costing, FM and all the subjects, accounts, these subjects are right from the beginning. So obviously institute has a very good track record of where students commit a mistake and all. That's the reason why I'm saying these are very, very important things. I have handpicked questions based on, the order of importance and where you guys generally make a mistake. Because if I am doing something that you guys already know, then there's no point or value addition here. Clear with this, guys? This is one very important thing. If this, if you miss to enter this into your primary distribution, then obviously this particular portion of your indirect costs will not enter into the products at all. Are you clear with this? So it will result in under costing. So you would have incurred a cost, but you wouldn't have charged it to your customer. Look at the impact that it can have in a real life scenario. Are you clear with this, guys? This is the importance of it. Fine. So now once that is done, so what they did was they arrived at the primary distribution, right? And once primary distribution figures are there, now you need to do secondary distribution under what method? Under your reciprocal services method. We will be doing it under your simultaneous equation. So A is going to be how much? So A is going to be 9250 plus 0.1 of B. Correct, guys? Similarly, B is going to be 3150 plus 0.1 of A. Correct? So the first step was what? Under the secondary distribution, reciprocal services, the simultaneous equation method, 3-step approach. First, frame the equation. Having framed the equation, what will you now do? Solve the equations, substitute 2 in 1 or 1 in 2, you do anything. So convert the entire equation using one variable A or one variable B. If you do that, you will get the A value and you will get the B value. Clear with this, guys? Any problem here? This solving is not a major area, but the major mistake can happen in these areas that I just told you. The first one is regarding missing out on this. The second one is regarding finding out which method you need to follow and all of that, right? Now, having done this, you need to do the apportionment. So now what you do, first you apportion A. So 9662, you fully apportion it on the ratio of 2:3:4:1. That is the services rendered ratio, right? And now you have what? Now you have here B. It gets apportioned 4116. Again, it needs to be apportioned in the ratio of 4:2:3:1. Guys, can anyone tell me how much is this? It's I think there's some typo error here. Can anyone tell me how much is this? I think it's 412. Okay, I myself found out 412. Okay, right? So once you do that, ultimately your service department costs will become nil, and then you will be ending up only with your production department overheads. So now your secondary distribution is done. Guys, clear with this? Clear with this? Now finally the third step, you need to do absorption. So what will you do? Department wise, you have the secondary distribution summary, right, divided by the respective base quantity. So what is the base quantity here? Labor hours. They had given in the question, the labor hours is 4670, 3020 and 3050, right? So now we just need to put it up here, right? So now you arrive at what? You arrive at the absorption rate by using your labor hours as the base quantity. Clear with this, guys? Guys, are you all able to understand this? Are you guys able to understand this? Right? You guys are able to understand, right? Now, once this is done, we need to charge the overheads to products. Once again, in this question, they have given that every unit of product X spends 2 hours in department X, 3 hours in department Y, 4 hours in department Z, right? Department wise, we know how much is the overhead rate to be charged. You have all of that. So now you multiply it and finally you get the overhead cost per unit of this product, which is equal to 58 rupees, right? We are not done yet. Now for us, the prime cost components are waiting readily on a per unit level. 120 rupees is the prime cost per unit. To this, directly go and add this 58 rupees. Now you get the total manufacturing cost per unit, which is 178 rupees. Now with this, I can go on and achieve the objective of stock valuation and profit computation. Are you clear with this, guys? Are you clear with this, guys? Yes, you guys are able to follow?
Yes, sir.
Done, guys, right? Fine. This is the core and the most intricate discussion of this entire chapter. In fact, of the entire subject itself, because overheads is a very heavy chapter. It's a big chapter as a whole. And many students fall into the trap of actually, skipping this chapter. Guys, please don't do that. I don't believe, or I don't propagate skipping any chapters. But if at all you want to dilute something, maybe do it somewhere else, not in overheads, because overheads is the core chapter based on which the remaining chapters are all built on, right? Without overheads, it's not just overheads. It is called as absorption costing method. If you go to your study material, they would have written overheads hyphen absorption costing method. The entire, it's actually a technique of costing. It runs parallel to marginal costing. That is the importance of this chapter, right? It is something else. This is the backbone based on which the other chapters revolve around. Your cost accounting systems, your cost sheet, in fact, all these chapters are based on this. So ideally, in my opinion, this chapter is always a must. So do not, please do not skip this chapter or do something of that sort. Are you clear with this, guys? Done? You guys were able to follow? You guys were able to understand? You guys were able to understand this, right? So now let's move on to the next concept in this particular chapter. Very, very, very important concept, which is treatment of under or over absorption of overheads. Now, for you to enter into this concept, you need to know one concept called as predetermined rate versus actual rate. Predetermined rate versus actual rate. What do you mean by this, sir? Now, we saw that absorption rate, overhead absorption rate is equal to overheads divided by some base quantity, and we saw that the base quantity could be any of the 6, correct? So your machine hours, labor hour machine hour, percentage of direct material, direct labor cost, and your prime cost, and finally you have your production units method. So all the 6 methods, any one you can pick, right? So of course you can't use all the methods at a single time. Obviously only one at a time you can then be used. Now, let me give you an example, guys. Very, very important understanding. This is a conceptual explanation, right? Without this, you can't even enter into the next area called as under or over absorption. You wouldn't believe. If you know, it's very, very simple. 10 marks, like you can take 10 marks in both your hands. That is the importance of the concept that we are going to see right now. Now, catch up running notes. Now, let me just give you an example. Let's say budgeted overheads, right, is equal to rupees 3 lakh. The budgeted hours, right, for the purpose of our discussion, I am taking the base quantity as hours. Okay, it could be any of the 6 base quantities. Please understand that is equal to 20,000 hours, right? Now they have given you actual overheads is equal to rupees 3 lakh. And the actual hours is going to be 15,000 hours. Now the question here is, if you calculate the absorption rate, that is, if you calculate the absorption rate using the budgeted data, that is, if you take the budgeted numerator divided by the budgeted denominator, that is the budgeted overheads divided by the budgeted hours. If you do this, then that absorption rate, since it is calculated using a budgeted data, it is called as a predetermined rate. Are you clear with this? Predetermined rate is also known as standard rate, is also known as budgeted rate, and all these are alternative terms for this. Predetermined rate, budgeted rate, standard rate. These are all some alternatively interchangeably usable words. What is that? Nothing but calculation of absorption rate using the budgeted data, right? So if I use the budget data for calculating my absorption rate, how much will be my absorption rate? 3 lakh rupees upon 20,000. That gives me how much? Rupees 15 per hour. Suppose I calculate the same absorption rate using the actuals, that is the actual numerator divided by actual denominator. So now that is called as an actual rate. Actual absorption rate is going to be 3 lakh divided by 15,000 hours. That's going to be how much? 20 per hour. Guys, correct? Now, just now we did questions regarding the 3-step absorption costing system, wherein the third step was what? Absorption. correct? Absorption involves two steps inside it. Number one, calculating the absorption rate. Number two, charging of overheads to the products. My question to you is, the absorption rate that we calculate, should it be a predetermined rate or should it be an actual rate? Or in other words, for the purpose of charging overheads to the products, should I use the budgeted data or should I use the actual data? This is the question that I am asking you. Should I use the budgeted data or should I use the actual data? Right? Now, while many of you might think that, sir, what question is this, sir? 3 lakh rupees is the overage I've actually incurred. 15,000 hours is the hours that I've actually spent. Where is the question? Obviously, I need to use 20 rupees per hour. The actual rate only needs to be used because that is the actual cost that have been incurred. No. You need to necessarily use only the predetermined rate for the purpose of overhead calculation. Or in other words, whenever I say absorption rate is always calculated on budgeted data only. Are you clear with this, guys? Are you clear with this? There are 3 reasons for this, out of which the main reason alone I will tell right now, right? Because let us not get too much into it. Generally, I make an elaborate discussion about this in my regular batch, along with numerical examples, some illustrations and all. Right now, you just understand why we use budgeted predetermined rate, that is the budgeted data. Now guys, what is the subject that we are learning? Cost and management account. To put it in short, costing. Now, we are not here to do a post-mortem work, right? Like accounts. Now, I'm not undermining your financial accounts. Financial accounts has its own objective. That's why these are all multiple branches of accounting only. Clear? It has its own objective. After a transaction takes place, you record it in your books and publish the results to the end user. That is the objective of your financial accounts. That is not what we do in cost accounts. In cost accounts, I need to concurrently value my stocks then and there. Whenever I say stock, please remember, stock is not closing stock. Stock is every unit produced is called as a stock. Clear with this? Or in other words, now just imagine, can anyone tell me what is the journal entry for closing stock in your financial accounts? Journal entry for closing stock in your financial accounts? No. In your financial accounts, there is no entry at all for closing stock because your stock is never valued in financial accounts. It gets valued only in cost accounts. That's why in all your numerical problems, in all your final account sum, closing stock value will be given as a separate adjustment. You plug it on the credit side of your trading account and plug it on the asset side of your balance sheet and it gets tallied. That's all. It's an adjustment item. There is no single journal entry or there is no valuation of stock under financial accounts. Stock valuation gets done only in cost accounts. Sir, how, sir? Why are we able to value your stock? Because in costing, the moment, right, a particular output, FG, comes out of my machine, I should immediately value it, right? I should immediately value it. Or in other words, costing cannot wait till the end of the year. Are you clear with this? So, the moment a particular product, this pen, I'm a pen manufacturing company. Now I have inputted material, labor, and I've incurred all the other expenses and all. The moment this pen comes out of the machine as a final product, now I know how much amount of material has gone into it. Actuals, do I know? Yes. I know every unit of pen consumes 5 grams of plastic. Every gram of plastic is so and so rate. I know how much labor hour was required. Every hour of labor, how much am I paying? Actuals is no. Your direct expense, how much am I actually incurring? That also I know. The prime cost components are known in actuals. But you tell me, is the production overhead figure available on actual the moment the product comes out of the machine? No. For me, if I were to use the actual rate, then what I should do is, the moment the product comes out of the machine, I need to accumulate it, wait for the year end, finally arrive at my overall cost, add profit and fix my selling price. Can I say, if someone comes to your shop and asks you, sir, what is the cost of one pen? Wait, sir, the year is not yet over. Let the year get over. I will get my actual data. I will accumulate everything and I will fix my selling price. Absolutely, that is nonsense. It doesn't work that way. Or in other words, the moment a product comes out of the manufacturing unit, that is the machine, I need to readily value it, because in costing we pass entries for consumption of resources, not just for your revenue recognition and payment. No, we also pass entries for consumption of resources. We saw the flow of costs, from stores. If I'm moving the materials to my, if I'm moving the materials from stores to my factory shop, that also I pass an entry in cost accounts. This does not get captured in your financial accounts. From one hand, if you give money to the other hand, your financial account says that is an internal transaction, I will not record it, right? There has to be a concept of mutuality. Only when I deal with a third party I will account, whereas that is not the case in costing. If you consume something, the consumption is also getting tracked here. Are you clear with this, guys? Or in other words, here costing can't wait till the year end. Now the moment a particular pen got manufactured, now I need to charge it with an overhead. Correct, guys? Now you tell me, will I be having the actual rate the moment it comes out of the production facility? No. So what is the rate that I will be having with me? Only the predetermined rate. Are you clear with this? Are you clear with this? Or in other words, always remember, whenever I say absorption rate means only budgeted rate or predetermined rate, because costing cannot wait till the year end. Are you clear with this, guys? Are you clear with this, guys? Yes. Now what happens here is, so finally if you see, now I can classify the overheads, as in the figures, in terms of figures, I can classify this into three. What I will say, budgeted overheads. What is my budgeted overheads? In this case, my budgeted overheads was how much? 3 lakh rupees. Correct, guys? I budgeted to incur how much? 3 lakh rupees. On the right extreme, I have my actual overheads. What was my actual overheads? Coincidentally, in this case, that is also 3 lakh rupees. Right, guys? Now, in between, I have one figure that is called as absorbed overheads. I have a figure called as absorbed overheads. Now, how do I charge my absorbed overheads? Very simple. So, now the moment a product comes out of my machine, I will charge it with how much? 15 rupees for every hour actually spent in the product. I'm repeating, I will charge rupees 15 for every hour actually spent by the product. Are you clear with this? Or in other words, the total overheads charged will be my predetermined rate into actual hours, because the moment a product comes out of the machine, I know the actual time it took. That actual data is available with me, correct? It has already come out of the product, it has already come out of the machine now. I know it took 3 hours or it took 4 hours, as the case may be. So the hour data, the base quantity consumed, this is the reason why we use the base quantity consumed, plural tense we use, because that is readily available then and there. What is not available is only my absorption rate. So here, technically speaking, the absorbed overheads is a hybrid figure. It is predetermined rate. It's been applied on the actual base quantity consumed. In this case, the absorbed overheads will be 15 rupees I charge every time for every hour actually consumed. Totally, at the end of the year, how many hours were consumed? 15,000 hours. Correct? 15,000 hours were consumed. So overall, if you see, the absorbed overhead is going to be how much? Rupees 2,25,000. Are you clear with this, guys? Are you clear with this, guys? Are you clear with this? So here, the budgeted overheads is nothing but overheads planned. Actual overheads is nothing but overheads incurred, right? And my absorbed overheads is nothing but overheads accounted. Are you clear with this? That is, this is the figure that will be appearing on my cost sheet. Are you clear with this? Because in my cost sheet, your prime cost components are actuals because they are known then and there, but your overheads figure alone is always absorbed. Don't think that it is actual. Till now, what have I done? I have not yet reached the end of the year. Till now, what have I done? Using the predetermined rate, I have applied it on every single hour that has been actually spent. That is what I keep doing. Guys, are you clear with this, guys? Are you clear with this? This is the core of absorption costing. This is the core of absorption costing. Now, what has happened? Finally, I reached the end of the year. Clear with this? Finally, I reached the end of the year. Now, what has happened? I noticed that till now, costing had accounted how much? it has accounted for an overheads figure of how much, guys? 2,25,000. But now I've reached the end of the year. Now I have the actual figures with me. Guys, yes. How much is the actual? 3 lakh rupees. So now what has happened? Now I find out that, look, I have accounted for only 2,25,000. But the actual figure is what? 3 lakh rupees. Now this needs to be, the difference between the two now needs to be rectified. No, see, no matter what, I should bring my actuals into the books. That is for there for sure. But why I was forced to use a predetermined rate because costing can't wait till the year end and the actual rate is not known then and there. Are you clear with this? That was the only reason I used my predetermined rate. Guys, clear with this, guys? Clear with this? So now what we do here is I take my predetermined rate, multiply it with the actual base quantity consumed. I keep on doing it. At the end of the year, I find out that, okay, absorbed overheads is 2,25,000 means what? Costing has accounted only to the extent of 2,25,000. But at the end of the year, now I find out the actual to be how much? 3 lakh rupees. So now you tell me the difference between this 75,000 rupees is there, no? Guys, correct? This 75,000 rupees, I call it as under absorption. Are you clear with this? Are you clear with this? Means what? This is under accounted. I am yet to account for this 75,000 rupees of expense. So now guys, equally there is a chance for a situation of over absorption happening. Right? The absorbed overheads could have been 3,50,000. In that case, 3,50,000 minus 3,50,000 rupees would have been my over absorption. Are you clear with this? I now need to go and bring down my cost. Are you clear with this, guys? In this case of under absorption, I need to introduce fresh cost because as of now, I have accounted only for 2,25,000 rupees. So now what has happened? I should have accounted for 3 lakh. So now at the end of the year, I am passing the rectification entry. So that rectification treatment is only called as concept of under or over absorption. Guys, are you clear with this? Now, all this concept of under or over absorption, why do we have? Because we are forced to use something called as a predetermined rate. Had I taken the actual rate, my absorbed and actual figures would have been the same, no? Correct, guys? This is happening purely because of the predetermined rate. Even the hours are actuals here. The rate alone is actually a budgeted rate. So purely because of the use of predetermined rate, which I'm forced to use. Because of this only, there happens to be a difference between the overhead accounted and the overhead incurred, which needs to now be bridged by using a concept called as under or over absorption. Are you clear with this, guys? Are you clear with this, guys? Done? You guys are able to understand this? You guys are able to understand this, right? This is the concept of under or over absorption. So for our explanation purpose, I will take under absorption and explain. Similarly, you understand that that is the case with over absorption. Now, what do we do with this? What do we do with this? This particular under or over absorption. How do we deal with this? 75,000 rupees is there, right? It now needs to be accounted, no? Guys, yes, clear with this? Now, if you see, what would have happened is, now, basically your production overheads, is it a trading account item or a P&L account item? It is a trading account item. That is, or in other words, it's a manufacturing cost, product cost, correct or not? Yes, guys. So technically what has happened till now, if you see in my trading account, there is nothing called as trading account in costing, but to make you understand, I'm saying till now, costing has recorded only for 2,25,000 rupees. Correct, guys? With respect to production overheads. Now you have a trading and P&L account. Now comes a question. Should this 75,000 rupees of under or over absorption, should it be treated as a product cost or should I treat it as a period cost? Now the next question is, should this be treated as a product cost or should it be treated as a period cost? Right? If you're saying you're treating it as a product cost, basically, or in other words, should it be taken to my trading account or should it be taken to my P&L account? This is the question, right? Now, globally, what they say is, take it as a period cost, meaning what? Hit the 75,000, take it to the P&L and close it off. Life is simple, right? Now, if I take it as a product cost, what will happen? There will be a huge impact. Now, guys, I would have already valued my stocks and all, right? By taking only 2,25,000 as my product cost. Now, once again, if I'm taking this 75,000 to my trading account, what happens? Now, the stock valuation will also change. Correct? Are you clear with this? If I take this as a period cost, that's very simple. Only my profit will reduce. But if I take it as my product cost, my stocks and all will change. Once again, I need to rework. Are you clear with this? Are you clear with this? Sir, what should we do, sir? Now, this is where in India, what we follow is wait. Don't jump to a conclusion. 75,000 rupees in this case is an under absorption, right? So what our Indian, the cost accounting standards and all say is, now do not jump into a conclusion. Do not jump into a conclusion. First, this 75,000 rupees is there. This is an under absorption. See why this 75,000 rupees of under absorption is there. Why this 75,000 rupees of under absorption is there. Classify it into two, right? So let us say out of this 75,000, right, 5,000 rupees difference was due to genuine price level changes, inflation, sir. Sir, originally I prepared this predetermined rate. I arrived at 15 rupees per hour by taking into account that overall, sir, my factory rent and all will be so much, right? Genuinely because of inflation, there to the extent of 5,000 rupees, there was a deviation. Balance 70,000 rupees, I'm just giving you an example, was due to inefficiencies of the company's side. Are you clear with this? So I'm repeating, there was a 75,000 rupees of difference, that is your under absorption. Now they have found out that out of this 5,000 rupees is due to normal reasons, is due to normal price level changes, and 70,000 rupees is due to abnormal reasons. This abnormal reasons could be what? Your inefficiencies and so on. Are you clear with this? Maybe our staff took more time, or they were actually not that efficient, they took more leaves, or there were strikes, so many other things. Clear with this, guys? Now what they are saying, under or over absorption to the extent attributable to normal price level changes should be treated as a product cost. Should be treated as a product cost. Are you clear with this? And the under or over absorption to the extent attributable to all other reasons, your abnormal reasons, inefficiencies, should be treated as a period cost. Are you clear with this? When I say period cost, directly take it to your costing P&L account and make it fully expire in the current year. Are you clear with this, guys? Are you clear with this? Are you all able to understand this? You guys are able to understand this? Now comes the major problem. Now comes the major problem regarding the product cost. Sir, now I am freshly introducing this 5,000 rupees as my product cost. Wouldn't there be a problem? Now my stock valuation, everything will change. Yes, it will change. Now to put things in a much better manner, let us go back to that flow of cost which we saw in the cost sheet area, right, where I told you all the costs are debited here. Now as of now, the production overhead figure that I would have debited here was how much? 2,25,000 absorbed figure. Correct, guys? Guys, are you all able to follow this? Guys, are you all able to follow this? This is a very intricate discussion, right? Generally, this alone I take about 2-3 sessions in the regular lecture. So please be careful. Please be attentive here. I am condensing it because it's a revision batch, right? Now look at this. Look at this. So as of now, by the end of the year, I noticed that till now I have accounted for only 2,25,000 rupees here. Now they are asking me to further account for this 5,000, that is treat it as a product cost. This 70,000 anyways will go to my P&L account. That's not a problem. They are saying, sir, now you should also treat this 5,000 rupees as what? As your product cost only. Now, what is the issue here? What is the issue here? Now, already throughout this, during the course of the period, what I would have done, so all these things will be there, right? Your overall cost is there. So a portion of it is your cost of production, a portion of it is your closing WIP, right? And then in your FG ledger, what you have, this cost of production would have gone. There you have some opening FG also, right? Opening FG plus cost of production, that's your total goods available for sale. Out of this, partly some units would be sold, partly some units remains unsold. Clear with this? Or in other words, if you see, technically speaking, I would have valued my closing WIP, right? Then this cost of production represented by way of COGS and closing FG. Or in other words, these three figures would have been valued only by considering 2,25,000 as my production overheads. But at the end of the year, now they are saying, no, this 5,000 should also be treated as a product cost. Now what will happen? Now to the extent of this 5,000 rupees, I need to now once again redistribute it between these three parties. Because now if I add a cost here, ultimately these three are the ones who gets affected. Are you clear with this, guys? Are you clear with this? Guys, are you all able to understand this? Right? So what happens here is your under or over absorption to the extent attributable to price level changes, which is now treated as a product cost, will impact your three different accounts, or in other words, will impact three different people. Who are these three people? Your units sold represented in your cost of goods sold, your units unsold represented in your closing FG, and your incomplete units. Are you clear with this? Why this happens? Because till now I considered my PO heads as only 2,25,000. Now suddenly they are asking me this to consider this 5,000 rupees also. When are they asking me to do this? At the end of the year. By then I would have already valued all my stocks and finished off, because costing can't wait till the year end. Now at the end of the year they are saying this 5,000 rupees is genuinely because of the price level changes. Go and change it. Now I need to give its impact on these three ledgers. Are you clear with this, guys? Are you clear with this? And how will I do that? How will I do that? Very simple. So now here if you see, this 5,000 rupees is the under absorption to be treated as a product cost. No? Guys, correct? Right? Now I am just putting it up here. Right? This product cost that we saw in our example was how much? 5,000 rupees. Right? It needs to be distributed between how many people? Three people. Who are they? Units sold represented by way of COGS. Right? Units unsold represented by way of FG, and your closing WIP, that is incomplete units. Now let us say they have given 4,000 units of 4,000 units were sold, right? 750 units were unsold, and let us say 250 units were incomplete, equivalent units. This data is given. Now what you will do, you will apportion this 5,000 rupees, the extra amount of this under or over absorption attributable to your normal reasons, will now need to be given to these three people in the ratio of the units that are available. Are you clear with this, guys? Are you clear with this? How do I do that? Now you can directly do it. No, that is 5,000 distributed in the ratio of 4,000 is to 750 is to 250. You can directly do it, guys. Correct? Guys, correct? But wait, Institute has introduced one concept called as supplementary rate. So difficult or nothing. What you need to do is add the three. How much is it? 5,000 units. Correct? Hello, guys. Guys. Yes, Ramya, Priya, Murli. Yes, you guys are following. Yes. So now what they are saying is add the three total units. How many units are there? 5,000 units are there. They are saying first to calculate something called as supplementary rate. Supplementary rate is how much? So your under absorption to be treated as a product cost, that is 5,000 rupees, divided by the total number of units, 5,000 units. So every unit should get a share of how much? 1 rupee. Are you clear with this? Now multiply this 1 rupee with each and every respective volume. So now you will get COGS should be increased by 4,000 rupees. Your closing FG should be increased by 750 rupees, and your WIP should be increased by 250 rupees. Now what has happened? The respective ledgers have also taken the impact, and now we can finally close our books. Are you clear with this, guys? Are you clear with this? Always remember, with respect to under or over absorption, first you compare what? How do you arrive at under or over absorption? Absorbed overheads gets compared with actual overheads. Correct? Now the under or over absorption could be there. How do you treat? First, find out the reasons. Normal reasons, abnormal reasons. Abnormal reasons, directly take it to your P&L. Normal reasons, wait. What you need to do is, you need to distribute it between three parties. Units sold, units unsold, and your incomplete units. That is COGS, closing FG, and closing WIP. And how will you do it? Based on the units that are lying in the respective areas. That directly you can do, but Institute wants you to do it using something called a supplementary rate. Nothing great here. Instead of directly apportioning it, you in between call something as a rate and apportion it. Are you clear with this, guys? Are you clear with this, guys? Right? And once this is being done, finally this entire adjustment of under or over absorption will be over. Are you clear with this? Are you clear with this, guys? Yes. Now what we will do is now we will take one numerical example in this regard. Now it was a past 10 mark past exam 10 mark question. I think in 2 consecutive attempts the same question, or I think a similar question, was tested back to back. That is the importance of this concept, because this is the heart piece or the core of absorption costing. So this is something that is a never miss, right? Fine, guys. So now let's go and do this. Let's go and do this here. Please take question number 3. Yeah, please take question number 3. Now, look at this. In a manufacturing unit, overhead was recovered at a predetermined rate of 20 rupees per labor hour, right? So the predetermined rate means what? Budgeted overheads divided by budgeted base quantity. Now, the total factory overheads paid and the labor hours actually worked were 45 lakh rupees and 2 lakh labor hours respectively. During this period, 30,000 units were sold. At the end of the period, 500 units were held in stock while there was no opening stock of FG. Similarly, though there were no stock of uncompleted units at the beginning of the period, the end of the period there were 10,000 uncompleted units, which may be reckoned as 50% complete. Means what? 10,000 units 50% complete is equivalent to 5,000 units 100% complete. Are you clear with this? So clearly you can say that units sold, how many units got sold, guys? 30,000 units. Units unsold, that is my FG stock, how much is it? It is going to be 5,000 units, right? And my closing WIP, how much is it? 10,000 into 50%, another 5,000 units. Why do I need all these things? To the extent of normal price level changes, it needs to be apportioned between these 3 using supplementary rate. Clear with this, guys? Next.
Yes.
The accountant was able to obtain the following other information. The actual factory overhead included the following items. Now, what have they said? So 1,25,000 rupees paid to workers for a strike period under an award. 25,000 rupees was some penalty. 40,000 rupees obsolete stores now written off. 10,000 rupees paid towards consumables relating to prior periods now paid after a settlement of a dispute. 2 lakh rupees of factory overhead for the period was still payable and not yet accounted in the books. On analyzing the reasons, it was found that 60% of the unabsorbed overheads were due to defective planning and the rest was attributable to an increase in the overhead cost. How would unabsorbed overheads be treated in cost accounts? Past exam 2-3 times it has come as a 10 mark question. This is a core of absorption costing, because though it might look as if it's just an under or over absorption, for you to know this, you need to know the concept of your predetermined rate versus actual rate. Are you clear with this, guys? Now, first, can anyone tell me what is the total overheads actually incurred? Guys, come on, look at the question. Tell me, what is the overheads actually incurred? How much was the overheads actually incurred?
5 lakhs.
How much was it?
45.
45. Okay, I'm sorry. 1 second. Yeah. Even the Google, even the YouTube guys, come on, tell me, how much is the overheads actually incurred? Guys, YouTube folks as well. Come on. Yes, everyone. 45 lakhs, 45 lakhs, 45 lakhs, 45 lakhs, 45 lakhs. Okay. And now don't ever tell me that CA exams are difficult. It is just that you have ignored it. Read the question carefully, guys, and tell me where you've gone wrong. Read the question carefully and tell me where you've gone wrong. There is no point in saying that exams are difficult. See, most of the things we are not observing carefully. Read the question carefully. This is like a 11th standard error that you have made. 11th standard mistake that you have made. Yes, 2 lakh not yet accounted, now got account. Look at this, guys. Total factory overhead paid alone was 45 lakhs. And at the end, they have given 2 lakh overheads was still payable. We are not following cash system and all, right? Actual overheads incurred is how much? 45 plus 2, 47. Are you clear with this? It is 47 lakhs. The first step itself, if you make a mistake, it is like operation success, patient dead only. You would have done the correct answer for a wrong figure, no point. It's called as a chain error. They will not give you marks for this. They will not, for a 10 mark question, they will not give you beyond 1 mark. Most of the times they will strike you and even reduce 2 marks from the previous question. Right, guys, come on, guys. This is not fair. This is not fair. Now, don't take me wrong. Don't take me wrong for saying this, but please be careful. It is okay to commit a mistake here. Doing it in the exam hall, 6 months is no joke, right? So please be extra careful when you're reading the question. This means everything for you. This should be your world. Clear with this, guys? Fine. So first we started off with 45 plus 2. First of all, the overheads actually incurred is 47, right? Now from this, remove all these figures. Anyways, they are all some abnormal items. They are anyways going to be taken to your costing P&L only. They are ideally not a part of your routine overheads that you generally incur. Clear with this, guys? So remove it off. Remove it off. So minus 125, 25, 40, 10. Remove off all these things. So net production overheads actually incurred is only 45 lakhs. Clear with this? What am I going to do with these figures? These figures, they have by mistake included in production overheads. They are not production overheads basically. They are all some extraordinary items, like so abnormal items. So anyways, they should have been taken to your P&L account, but by mistake they have included in your production overheads. So now you subtract it. Technically speaking, 45 lakhs is going to be your net production overheads actually incurred. Clear with this? Oh, now some students will come and say, sir, this only we were saying and all, right? I didn't ask for that. I just asked for the overheads actually incurred. Coincidentally here, this sum total and this sum total is matching. So this, you don't match along with that. Okay. So okay. That's why you were saying, Anil and all, now you're saying 45 lakhs still because of this only, Okay, and I should believe also. Okay, fine, guys. Jokes apart, but yes, if you meant this honestly, then it's fine. But please be clear, don't make this silly mistakes and all. It is going to cost you an attempt. Like 6 months is no joke. Anyways, guys, coming back here. So this is going to be my net production overheads actually incurred, correct? But what is the overheads absorbed? What is the overheads absorbed? So what is the overhead absorbed, guys? So the overhead absorbed is going to be, yes, they have given us a predetermined rate of 20 rupees, right? Multiply it with the labor hours actually spent. So 20 into 2 lakh, I'm going to get an absorbed overheads of how much? 40 lakh rupees. So overall, I know that 5 lakh rupees is an under absorbed overheads. I now need to come and account for it. Are you clear with this? Any problem here? No. How am I going to deal with this 5 lakhs? Now they have clearly said that 60% of that is going to be because of your, on analyzing the reasons, it was found that 60% was due to defective planning. You tell me this was unavoidable. This was avoidable only. Due to your inefficiencies, you have incurred extra. So what they are saying is 60% of 5 lakhs is going to be 3 lakh. This is going to be due to inefficiency. And now the product cost, the balance 2 lakh rupees is due to genuine price level changes. So to the extent of 2 lakhs, I will treat it as a product cost. And to the extent of 3 lakhs, I'm going to treat it as a period cost. Are you clear with this, guys? Any problem here? Now period cost, I don't have a problem. Take it to your costing P&L and knock it off. But this 2 lakh now needs to be introduced as a product cost. Now what happens? This 3 lakh needs to be shared upon those 3 people. Are you clear with this? This is the reason why I started off cost sheet itself with the flow of cost. Now you are able to understand. If I introduce it here, right, this guy takes an impact. So technically this guy enters here and he's represented by these 2 figures. So at the end, these 3 are the people who take the impact. So I now need to apportion between these 3 guys who were originally valued by considering a POH of only the absorbed figure. Now I need to introduce this figure extra also. That is my under absorption to the extent of normal reasons. Clear with this, guys? Are you all able to understand? Yes. Are you all able to understand? Right? You are looking at me as if you have muted, you have turned off the sound, and as if you're looking at some gymnastics that I'm doing here right now. Guys, you're actually understanding, right? Yes. Okay, fine. Right. Okay, guys, fine. So now what you now need to do is, so now we've got units sold, units unsold, and our incomplete units, 30,000, 5,000 and 5,000. So we can just add it up here, 35 and 5, you have a total of 40,000. So first we need to calculate what the supplementary rate. Remember, the supplementary rate calculation is there only for the under absorption attributable to the normal reasons. That is the one that is treated as a product cost. So take this 2 lakh, that is under absorption, treated as a product cost, divided by the total units of 40,000, you get 5 rupees is the under absorption share that you need to give for every unit. So multiply it with the respective units. So now what happens? The value of FG, the value of COGS and the value of closing WIP gets increased by 1,50,000 to 25,000 and 25,000 respectively. This way the 2 lakh rupees that I now accounted for has been given to these three people properly. Are you clear with this, guys? Are you clear with this, guys? Yes, you guys are able to understand this? You guys are able to understand this? So technically speaking, now how do you account for this is that overall you have an under absorption of how much? 5 lakh rupees, right? So this under absorption of 5 lakh rupees, out of this what has happened? Now cost of goods sold, I have given it a share of how much? 1,50,000. FG, I have given it a share of how much? 25,000. WIP, I have given it a share of how much? 25,000. And the period cost component of 3 lakh, that anyways I take it to my costing P&L, 3 lakh rupees. Are you clear with this? So now I pass the rectification entry and finally I can close my books. Are you clear with this, guys? Are you clear with this, guys? Yes, you guys are able to understand, and because of this reason, basically guys, you might some of you might be wondering, sir, this should be cost of goods sold, no? Why is it cost of sales? Because ultimately your cost of goods sold, right, plus AOH plus SOH, anyways it needs to enter into your cost of sales only, right? So that's why if you see, we will be seeing it in cost accounting systems chapter. Now your cost of there is no ledger called as cost of goods sold. If you want, you can keep, but anyways you will receive it from the FG and give it to cost of sales. So it will be a via media ledger. So directly they take it to the cost of sales ledger only, because it becomes an expired cost. Clear with this, guys? So now what happens is, because of this adjustment, now what happens is my profit comes down to the extent of 3 lakhs and 1,50,000. See, this 1,50,000 is my manufacturing costs getting expired. My manufacturing cost expires to the extent of cost of goods sold, I told you, right? This cost of goods sold gets knocked off against my current year revenue, right? This 3 lakh anyways is a period cost that also gets knocked off against my current year revenue, guys, correct? So 1,50,000 plus 3 lakh, 4,50,000 rupees gets adjusted against my current year revenue, right? So my profit comes down further by 4,50,000, and to the extent of this 25,000, it remains unexpired. It escapes to the next year. Are you clear with this, guys? Are you clear with this? Because these are valued in the stocks. Clear with this, guys? Clear with this, guys? This is how you need to understand the concept of under or over absorption. Clear with this? Is everyone able to understand this? Right? A very, very intricate discussion and a very technical discussion. Institute loves this area. Whether you love it or not, Institute loves this so much. So we are forced, you don't have any other option. So we should also love what the Institute loves only. Okay, clear with this? Yes, guys, done. You guys are able to follow this. Mark this as a very important question. Anyways, for that matter, whatever we do in the revision batch is all important, because I've taken only the most important areas here. But this is super important to, to make it more understandable for you. Clear, guys? Done. So that's about this particular segment as well. Now there are a few more allied concepts, small concepts. The major part of this particular chapter is over, right? So this is what it is. Maybe you can just go through it when you have free time, right? Because I've explained every single thing here. We have also done a numerical problem and we're done with this. Now there's something called as departmental overhead and blanket overhead rate. So now what is it? I will just tell you. Now guys, there is one more thing. Let us say a factory has two departments, P1, P2. Let us say the overheads is 20,000 rupees in department P1. Okay. And in department P2, the overheads is going to be 15,000 rupees. And let's say the labor hours in department P1 is 5,000 hours. And in department P2, it's 3,000 hours. Right? Now, there are two ways in which you can calculate the absorption rate. Now, one I told you based on the data you use, budget actuals. Now, forget that. That is one aspect. Another aspect is something called as blanket rate versus departmental rate. What is it? Now, two options are there. Option one, I can calculate the absorption rate department wise. I can calculate the absorption rate department wise. Now, let us say I am in the business of manufacturing two products, A and B. Product A takes 3 hours in department P1 and let's say 2 hours in department P2. Now product B takes 2 hours in department P1 and 3 hours in department P2. Okay. Now there are two ways in which I can apply the concepts of absorption costing here. One, what I can do is I can use something called as a blanket rate. Blanket rate means what? Now don't tell me how many departments are there and all in the company. First, what you do, total it up. That is, I will only calculate one absorption rate for the entire factory. Blanket, right? Add these two up. In the factory, what is the total overheads? 20 plus 15, 35,000 rupees is the overheads, right? And what is the total labor hours? 5,000 plus 3,000, it's going to be 8,000 labor hours. Correct, guys? Now, if you are using a blanket rate, now what I do is in a blanket rate system, I calculate a single absorption rate for the entire factory. So if I use this, the overhead rate will be 35,000 divided by 8,000. So I will say it is rupees 35,000 divided by 8,000 hours. So per hour, I will charge it with how much? 4.375 per hour. Yes, I will charge it with 4.375 per hour. Now, sir, how will I charge it the products? Product A, product B. Sir, product A spends 3 hours in department P1, 2 hours in department P2. No, I am not bothered about all that. In the factory, totally it spends how many hours? 5 hours. That's all I'm bothered about. Give it a share of 5 hours. Each hour, give it a share of 4.375. So it will come out to rupees 21.875. Well, thanks for the figure. Yes, 21.875. Now, how about B? B, sir, it spends 2 hours in P1, 3 hours in P2. Now, again, I don't need the breakup. Tell me the factory as a whole, how many hours it spends? 5 hours. So here again, it's going to be 5 hours into 4.375. It also gets a share of 21.875 rupees. Are you clear with this? Now, if you calculate a single absorption rate for the entire factory as a whole, this is called as a blanket overhead rate system. Are you clear with this? Now, the other one is called as what? Departmental rate system. What is it? The one that we have been doing till now. So we saw that P1, P2 is there. So department wise overhead, I have 20,000 rupees in P1, 15,000 rupees in P2, right? And then the labor hours are also given as 5,000 hours and 3,000 hours, right? So now what do? I calculate the absorption rate department wise and I say for every hour spent in department P1, so the products should be given a share of how much? 4 rupees per hour. Whereas for department P2, it's going to be how much? It's going to be 5 rupees per hour. Clear with this? So now I calculate the absorption rate department wise, not on a total basis. Clear with this? Now what happens is product A, I know that it passes through both the departments P1, P2. In P1, it spends how many hours? 3 hours. In P2, it spends how many hours? 2 hours. So 3 hours in the rate of into 4, 2 hours into 5. So here I'll be getting 12. Here I will be getting rupees 10. And if I add up the two, so every unit of A gets a share of rupees how much? 22 rupees. Right? Whereas for B, if you see, B also passes through P1 and P2. So it takes how many hours in P1? It takes 2 hours in P1 and it takes 3 hours in P2. Right? Every hour of P1 is charged with 4. Every hour of P2 is charged with 5. So here it's going to be rupees 8. Here is going to be rupees 15. If you add up the two, it gets a share of 23 rupees. Clear with this, guys? Now, which one of the two methods is better? Obviously, hands down, departmental overhead rate system. Why? Because one of the reasons is, look,
To know the cost of
technically speaking, department P2 is a costlier department. Department P1 is a cheaper department. Now, if you see, product B spends more time in a costlier department, lesser time in a cheap department. So it is fair that I should give it slightly more amount of overheads. Correct? No? Whereas overall, both the product spends 5 hours in a factory. No doubt. But the breakup also is important. Guys, correct? The product B spends more time in a costlier department. Obviously, its share of overheads is fair only if I give more. Are you clear with this? So the first reason why I'm saying a departmental rate is better is because a product might spend more time in a costlier department and lesser time in a cheap department. Now, all these things will be conveniently ignored if I follow a blanket rate. Are you clear with this, guys? Are you clear with this? That is number one. Number two, now look at this. If I use a blanket rate, what I will be doing? I will say total overheads divided by total base quantity. Correct? No? If I use a departmental rate, I have the flexibility to choose different base quantities for different departments. For example, department P1 is a machining department. I will use machine hours as the base. Department P2 is an assembly department. Here I will use labor hours as the base. So if I am following departmental rate, I have the flexibility to choose the base quantity department wise based on the factor that actually drives the cost in that department. Whereas if I use this particular blanket rate, I don't have such flexibility. For the entire factory, I have to necessarily use only one rate. Are you clear with this? So the second reason why departmental rate is better than my blanket rate is because of the flexibility to choose different base quantities in every single department. Are you clear with this, guys? Are you clear with this? Are you clear with this, guys? Yes. There is a third reason also. The third reason is, see, it is not necessary for a product to pass through all the departments. Agreeing with me or not? Agreeing with me or not? Let's say there are 3 departments, right? It is not necessary that all the products should pass through all the departments. Correct? If I follow a blanket rate system, I am forcefully giving all the departments' overhead costs to all the products, even though some products might not have passed through certain departments. Are you clear with this? So because of all these reasons, it is clearly evident that my departmental rate is better than my blanket overhead rate. Are you clear with this, guys? Are you all able to understand this? Are you all able to understand this? Yes. Now, the next chapter that we are going to see, ABC, yes, that will say that even departmental rate is bad, right? A better way of apportioning overheads to the product is an activity based costing system. Are you clear with this? So technically the next chapter we are going to see, ABC, is an extension of overheads only, but it is a modern way of apportioning overheads to the products. Are you clear with this? Are you clear with this? So I will be giving the same example. I will be giving the same example of departmental rate versus blanket rate. From there, so now we saw why departmental rate was better than the blanket rate. Now there we'll be seeing how activity based costing is better than the departmental rate also, because departmental rate also has some limitations. What that is what we'll be seeing. Are you clear with this, guys? So this is the next chapter is an extension of the present chapter. Are you clear with this, guys? Right? That is what they have mentioned here for departmental rate versus blanket rate. Clear with this, guys? Yes, fine. And that is about this area. Now this there is something called as capacity levels. That is your maximum capacity, practical capacity, normal capacity, actual capacity and all. You just quickly go through it once, not much of a value addition. There is one more important area that we are going to do right now, which is called as machine hour rate problems. Machine hour rate problem. Now, what is this particular concept of machine hour rate? So, yes, we are going to do this particular segment right now, and with this we will be finishing this chapter. Now, sir, what does this machine hour rate problems, why are you keeping it separately? Now guys, you all know that now we have 6 different base quantities for charging overheads, or in other words, for calculating the absorption rate. One of the base quantities is your machine hour. Correct? No? Yes. So what do you mean by a machine hour rate? Simple. Overheads divided by machine hours. Correct? No? I will represent the overhead per machine hour. That is called, it is one of the 6 different types of base quantity. That's all. So why are we keeping it separately and studying it here, and why are you calling it as machine hour rate problems and all? I will tell you, this one small technical thing alone is there, but beyond that, not much of complexities. We are done with all the very deep and very complicated areas are already done. This is just a slight extension of what we have seen before. Now, what happens? Now, generally we know that your manufacturing costs are of two types. One is your prime cost components, the other one is your production overheads. Your prime cost components are readily available on a per unit level, whereas the production overheads is not available on a per unit level, but we convert it to a per unit level by using a three-step procedure called as absorption costing system. That is what we have been seeing till now. Correct, guys? Yes. Basically, your prime cost components will have what? Direct material and direct labor and all. Guys, correct? Hello? Yes. Now, in some industries which are heavily tech driven, technology driven, highly mechanized industries, they will consider direct labor also as a part of production overheads. They will consider direct labor also as a part of production overheads. Sir, do not worry, it's a standalone area. It will be given in the question when they are considering it, right? Now, sir, what is it, sir? Can you give us an example? Yes. Now, let us say a company is in the business of manufacturing wooden doors. Right? Now, there are two ways of manufacturing wooden doors. One, you hire a carpenter. What he does, so he will bring a log of wood. In that, he will be doing all the workings and all, right? You will ask for a design on the door. So all these things he will be actually spending his time, right? And he will be doing. Correct, guys? Another way of manufacturing the same wooden door is, you take the help of a machine. What you can do is, if you're not aware of this, what these guys generally do, some big manufacturer, dealers of all these wooden doors and all, they have a system in which they enter the design of the door. The door's design will be there, right? Like this, I want maybe some small hole here, maybe whatever it is, right? All these things they will mention. The design will be done. One click of a button, parallelly 100 doors will be, the machines will start working on 100 doors parallelly. Are you clear with this? Guys, are you clear with this? One click of a button, or it may take 2-3 hours, but parallelly 100 machines will be on and 100 doors will be manufactured of the same design. Are you clear with this, guys? Now, all these 100 machines are operated by a guy called machine operator. Who is a machine operator? The person, the staff who operates the machine. Now, you tell me, guys, if I am hiring a carpenter and manufacturing a machine, I'm manufacturing a door. In this case, it makes sense to consider the carpenter's wages as a prime cost and take it as direct labor. Now you tell me, this machine operator, though he puts his hands on the job and he works, but I can't establish a direct relationship between the time he takes and the number of units that gets produced. Now what this guy will do, he will turn on the machine, he will go for a walk around the factory, right? He will find one nice sweet spot, he will just sleep there. After half an hour, 1 hour, he will come back, turn off the machine. Correct? Now you tell me, is his time spent directly related? Does it directly relate to the production or the number of units of your doors manufactured? No. In this kind of setup, it makes sense to consider the machine operator's salary as a part of your production overheads. Are you clear with this? Though he's an assembly line worker, but his time spent and the number of units produced are not proportionate, because this is an industry which is heavily mechanized and tech driven. Are you clear with this? In this case, it makes sense to consider even the prime cost component, which we generally do, that is the labor, the machine operator's wages, should also be considered as a part of production overheads. Are you clear with this? So in this case, what we do is, so the production overheads will include what? It will include the machine operator's salary, right, divided by the machine hours. That's all. This one inclusion in the numerator, that is all is there. Beyond that, nothing great is here. For this only, I gave this example. Clear with this, guys? Beyond that, nothing is there. Clear with this, guys? Yes. So now, shall we just go and do a numerical problem? Again, a repeated exam question, right? Let's do. And with that, we'll be signing off in this chapter. So the last one, question number 4. Yes. Now guys, read the question carefully. Read the question carefully. Again, a danger area. Okay, this is a danger area, so please be careful. Okay, a machine shop has 8 identical drilling machines manned by 6 operators. The machines cannot be worked without an operator wholly engaged on it. The original cost of all these 8 machines work out to 8 lakh rupees. These particulars are furnished for a period of 6 months. Normal available hours per month is 208. Absenteeism without pay is going to be 18 hours, right? Then the leave with pay is going to be 20 hours. The normal idle time, unavoidable hours, is going to be 10 hours. Then your average rate of wages per day is of 8 hours is going to be 20 rupees. The production bonus estimated on wages 15%. Value of power consumed 8050 rupees. Supervision and indirect labor 3300. Lighting and electricity 1200 rupees. Repairs and maintenance including consumables 3% in the value of machines. Then your insurance is 40,000, depreciation 10%, sundry works expenses 12,000, general management expenses allocated 54,530. You are required to work out a comprehensive machine hour rate for the machine shop, right? This is the question. This is the question. What do you mean by comprehensive machine hour rate? That is, take the total in the numerator. You should also consider the machine operator's salary. That should also be considered apart from your production overheads divided by the total machine hours, right? Now first. Now guys, in this question, first we need to calculate what? The total machine hours. What is the total machine hours? Have they given anything about the machine hours here? Can anyone answer? Can anyone answer? So what is the total machine hours given here? Have they given any data about the machine hours? Guys, please answer. What, you guys took a strategic time out? Please answer, no? Hello? Okay. Now, look at this. In this question, yeah, someone wants to answer. Yes, tell me, please. Yeah, go on. Okay. So now, look at this. In this question, what they've given is the machines cannot be worked without an operator wholly engaged on it, right? Which means what? The effective number of labor hours, the effective number of the machine operator's hours is going to be equal to what? It is going to be equal to the machine hours. Clear with this, right? Now what they are saying, there are 8 identical machines, right? They are manned by 6 operators, which means this figure of 8 is irrelevant. Why? Because only the time taken by the operator is going to be the total machine hours. Correct? There are only 6 operators here. So this amount, this figure of 8 is absolutely irrelevant for this particular question. Now what you do is, the normal time available per month is 208. From that absenteeism without pay 18 hours. Then leave with the pay is going to be 20 hours. Normal idle time unavoidable is 10 hours. Now what we need to do here is, look at this here. First, normal available time. One more very important thing that many students miss out is, this is all for a period of 6 months, right? So for a period of 6 months fully. Now first, what is the normal time available? 208 hours is the time available per operator. Guys, clear with this? Hello, clear with this? So now basically what happens here is, I have 208 hours per month. Like that I have 6 months. Like that I have 6 operators. So the total time available for 6 operators for 6 months put together is going to be how much? 7,488. Are you clear with this? Next, what they are saying here, read this carefully. Absenteeism without pay hours is 18 hours. Be very clear. Here they are not saying this is 18 hours per month. Clear? The first data they have mentioned it as per month. Here they didn't mention it as per month. Means what? This is 18 hours for 6 months put together. Are you clear with this? So now what you need to do, 18 hours, right, for 6 months put together only, but that is for one operator. So multiply with 6 operators. overall the absenteeism hours is going to be how much? 108 hours. So I am going to pay them. I am going to pay the operators for how many hours? 7380 hours. Are you clear with this? This hours is required to calculate the overall machine operator salary. Are you clear with this, guys? Now further they are saying something. What are they saying? So there is a leave with the pay. 20 hours overall for a period of 6 months. Every staff takes a leave of 20 hours put together, and normal time unavoidable, normal idle time unavoidable is another 10 hours. So for these hours, the machines are not going to work, correct? No. So what I will do, I will reduce that 20 into 6, 120, 10 into 6, 60. So the effective working hours is 7,200. Means what? The machines are running effectively for 7,200 hours, but however, I will pay the operators for how many hours? 7,380 hours. Why? Because this is a leave with the pay and a normal idle time. It is unavoidable. Means what? Your lunch break and all. I can't say I won't pay you for the lunch break and all that, right? Because if they are coming to work, obviously some normal idle time needs to be given. Clear with this, guys? Then why are we reducing it? Because whether it's normal or abnormal, whatever it is, anyways, we are, if they are not available near the machine is not going to run. So effectively the denominator, the total machine hours is going to be only for 7,200 hours. However, in the numerator, one of the components is my machine operator salary. For that, I need to consider 7380 hours. Are you clear with this, guys? Are you clear with this? Look at this. As the machines cannot be worked without an operator wholly engaged on them, therefore, the hours for which the 6 operators are available for 6 months are the hours for which the machines can be used. Hence, the 7,200 hours represent the effective working hours of machines. Are you clear with this, guys? You guys are able to follow this? Yes?
Yes, sir.
Right? Yes, Priyanka, that's right. And yes, Vaishnavi, yes, labor hour is equal to machine hour. Yes, you guys are right. Clear with this, guys? Done. Now, what have they given here? Now, with this, we calculated what? We calculated the denominator also, and we also calculated the overall hours for which I need to pay him. Then, one more thing they have given here. Yes. Look at this. So now I need to calculate what is the total machine operator's salary. So now how do I do that? Now look at this. They have said the average rate of wages per day of 8 hours is going to be 20 rupees. That is 20 rupees is the wage that I pay for 8 hours put together. Apart from that, there is a production bonus and all. Okay, right? So now the machine operator's salary, how will we compute this? Okay, it's taken as 800 upon 8. Just a minute. I think there is some issue with the question here. 1 second. What has happened? I don't think it's 20 then. It has to be 800. Okay, please guys, just change this figure. It's not 20. It's 800. Please change this figure. It is 800. Per day of 8 hours, they are paid 800 rupees. There is one small issue in the question. Please correct it to 800 rupees. Okay. So the average rate of wages per day of 8 hours is going to be, yes, 800 rupees. So they are getting paid 800 rupees for working 8 hours. Effectively, the hourly rate that they get is how much? 100 rupees. So that is what they have found out here. Effectively, it's going to be 100 rupees. Clear with this? And for a period of 6 months, I'm going to pay them for a total of 7380 hours. 7380 hours into 100. Overall, my machine operator's wages is going to be how much? 7,38,000 rupees. Are you clear with this? This is for a period of 6 months. So now what we do here, we just go and plug this figure here. Operator's salary is going to be 7,38,000 plus a production bonus of 15% on the 7,38,000. That's going to give you 1,10,700. Right? Apart from that, the other costs that we have here, value of power consumed. Right? The figure is, I think guys, all these are multiplied by 10. I'm sorry, some typo error is here. So please add one zeros. It's 8,500, 33,000 and 12,000. Please add one zeros here, guys. There was some issue in the printing. So please, typing, please add one zeros here. So now it's going to be the power consumed is 8,500. Supervision and indirect labor 33,000. Lighting and electricity was how much? 12,000 rupees. Yes. Now, another common area where students commit a mistake. Now guys, look at this. Repairs and maintenance including consumables was 3% on the value of machines. What was the value of machines? Guys, what was the value of machines? 8 lakh rupees. Correct? Hello, hello. Guys, answer please. It's 8 lakhs into 0.03. That's going to give you 24,000. Now, you will think that 24,000 rupees should be the cost considered here. No. No. See what they have given. These are furnished for a period of 6 months. What is furnished for the period of 6 months? Only up to this dabba they have given it for a period of 6 months. So all these data are assumed to be given per annum, which means you need to now convert it into a 6-month figure. So basically what you need to do is, here if you see repairs and maintenance, 3% on 8 lakh into 1 by 2, that is 6 by 12. You get 12,000 rupees here. Similarly, insurance, this is 40,000 for 1 year, for 6 months it's going to be 20,000. Depreciation, 10% on 8 lakh into 1 by 2, that's 40,000. Similarly, sundry works expenses, 12,000 into half, that's 6,000. And general management expenses apportioned here, 54,530 into half, 1 by 2, that's going to be 27,265. You add up everything, you get the denominator, you get the numerator, the total cost that needs to be apportioned, right? So the total cost divided by the machine hours. What is the machine hours? The machine hours, we got it as 7,200. You divide the two, now you get the comprehensive machine hour rate of 149.93, which means what? Every time a product passes through the machines, for every hour spent, I will be charging it with an overhead of 149.93. And what was special in this question? Here, we are also considering the machine operator's salary, which till now we were seeing it as a part of prime cost component. It has now been included as a part of your production overheads. Are you clear with this, guys? And that is about this particular chapter. Are you clear with this, guys? Are you clear with this? And overall, if you see right now, this is, it has taken us about 3 hours just to revise this chapter, right? But again, I'm telling you, there are certain other areas as well in this chapter. I'm not saying I'm covering everything, but in a revision batch, whatever is the best possible in the limited time, all the important areas we have definitely covered. So no doubt about that at all. Clear with this, guys? So with this entire chapter is over, and yes, that's about this. We have covered the semi-variable overheads, primary, secondary distribution, absorption, costing, the capacity determination, and yes, the machine hour rate problems. Clear with this, guys? And with this particular chapter of overheads is also over, right? Now, guys, let us start with the next chapter called as activity-based costing. Now, this chapter ABC is nothing more than an extension of the previous chapter, overheads. That is all about it, right? That is all about it. So this chapter ABC, as I just said, is an extension of overheads, right? Now in this chapter, what we are going to do here, chapter 3, your ABC, this chapter, the objective of this chapter is to calculate the overhead cost per unit. Overhead cost per unit. Sir, you said this was the objective of the previous chapter also, that is overheads. This chapter also, once again you are saying the overhead, the objective of ABC is to calculate the overhead cost per unit. Why do we need 2 chapters doing the same objective? Now let me tell you this. Now in the previous chapter, overheads, absorption costing system, that is traditional, it's called as a traditional costing system, right? ABC is basically your modern way of dealing with overheads. It's a modern costing system. In overheads, what we did, first we had items of overheads, correct? We have multiple line items of overheads. Now what we did, first we did a primary distribution. That is, we distributed the overheads to all departments, P1, P2, P3, S1, S2 and all we did, right? Then what we did, this production, the service department overheads were redistributed back to the production departments. That was actually done under the secondary distribution. At the end of secondary distribution, you had only P1, P2, P3 and all, right? And finally, we did something called as absorption, and we calculated the overhead cost per unit of A, B, C, D, etc. the products. Clear with this? This is what we did. This is what we did. Correct, guys? Now, this chapter ABC says the starting point for this chapter is also line items of overheads. The destination of this chapter is also to calculate the overhead cost per unit of every product that the company is manufacturing. What this chapter says is, we are agreeing with the starting point, we are agreeing with your ending point, but we do not accept the journey that you are doing. That is your primary distribution, secondary distribution. This journey has a huge flaw in it. It has a huge flaw in it. What is it? Is what we are going to study here in ABC. Clear with this, guys? Not much of any discussions, any intricate discussions like under absorption, over absorption. No, the root alone, how it should be different, is what we are going to learn here in ABC. Clear with this, guys? Now, first, in our traditional costing, the previous chapter, overheads, what we saw was there are line items of expenses like your factory rent, right? You had your factory rent, your supervisor's salary, you had your repairs and maintenance, you had your depreciation, and so on. It just went on. Now, what we did, we apportioned each of these line items to all the department cost, all the departments. Correct, guys? Now, why did we do that? Because we did it because we said overheads was telling us that, look, the reason why you are incurring the cost is because you have these departments, right? So, apportion all your costs to each of these departments. So now, because you are incurring these costs for the departments only. Are you clear with this? This was the logic given by what? Given by overheads. Now, this is where your ABC clearly disagrees. It says, look, you are not incurring overheads, or you are not incurring these expenses because you are having the department. You are incurring overheads because of the activities happening inside every department. I'm repeating. ABC says the presence of this department, P1, okay, then it means you are going to incur some expense. No. P2, expense. No. The presence of the department is not the reason for you to incur expense. There are activities that are getting done under every single department. It is the activity because of which the cost is being incurred. Or in other words, ABC says, because you have activities, right, it results in consumption of resources, and consumption of resources results in incurrence of cost, and hence apportioning the cost to the departments by giving a justification that the presence of department is the reason why I'm incurring the cost is absolutely incorrect, right? Ultimately, we are also going to find out only the overhead cost per unit, but the manner in which we are going to do, we are not going to route it through departments. Instead, we are going to route it through activities. That is what ABC is saying. Are you clear with this, guys? Are you clear with this, guys? Right. Now, what does ABC say? What does ABC say? Now, look at this. Look at this. We saw one previous example, right? Wherein we saw the concept of your blanket overhead rate versus departmental rate. Guys, yes, you guys remember this, right? Now, there we saw clearly that a departmental rate is much superior and better than a blanket overhead rate. Why? One of the reasons we saw was, right, if I am using a departmental rate, I have the flexibility to choose the base quantity which is more relevant for that department. Correct, guys? Guys, please reciprocate. Yes, you guys are following here, right? In other words, here, if P1 is a machining department, it makes more sense to apportion the P1 department cost using machine hours, right? If P2 is actually a labor department, an assembly department, it makes more sense to apportion P2 department overheads using labor hours. Clear with this, guys, right? So we saw that our departmental rate is much better than your blanket rate. Now ABC says even that departmental rate is also not correct. Why? Let me give you an example. Now what happens is, let us say I have a factory. So let us say we are using departmental overheads only, right? Let us say there is one department P1, there is one department P2, there is one department P3, right? Now P1, let us say, is a machining department. Okay. Now what happens? Let us say the machining department's overhead cost was 1 lakh rupees. I'm just talking about this single department, right? Blanket rate anyways is bad. No, we saw in overhead chapter the departmental rate is better. But ABC is further saying, wait, departmental rate is also not correct. Why? If you are using departmental rate, what will you do? This 1 lakh rupees, right? You will divide it by the machine hours spent in this department, arrive at the machine hour rate, use that as an absorption rate. Correct? Yes. Now they are saying, wait, don't blindly go based on department, further dig deep into this. Now in this P1 machining department, there are actually 3 activities happening. Okay. One activity, the first activity is called as machine running activity. Machine running activity. Then you have one more activity called as setup activity. Then you have something called as inspection activity. Right? Now they have found out that yes, in department P1 there are actually 3 activities that are happening, and the machine running activity, right, is actually incurring a cost of 60,000 rupees. The setup activity is actually incurring a cost of 15,000 rupees, and the inspection activity is incurring a cost of 25,000 rupees. Or in other words, the breakup of this 1 lakh is further broken down into activity wise. Are you clear with this, guys? Now, if you see, it will all make sense. Now, what has happened? Departmental rate was actually absorbing the entire 1 lakh rupees by taking machine hours as the base quantity. But technically speaking, if it is now broken down into multiple activities level, now you can see that only 60,000 rupees is driven by machine hours. Correct? Only 60,000 rupees is driven by machine hours. Setup activity cost of 15,000 rupees is driven by some other cost driver. Maybe that could be the number of setups. What do you mean by a setup activity? Let us say I'm starting a class. I'm doing a class here right now. Okay, right? Now, the moment I start a class, right, I need, before the start of the class, I need the setup to be done. The camera should be turned on, the light should be turned on, and all these recordings and all these streamings, everything should be done. Correct? Now, let us say that I am going to take a class for 2 hours, right? Let us say I'm going to take a class for 2 hours, right? On day 1. On day 2, let us say I'm going to take a class for 8 hours. Now you tell me whether I'm taking a class for 2 hours or I'm going to take a class for 8 hours, the setup cost or the setup activity will remain the same. Correct, guys? Or in other words, this setup cost or the setup activity cost is not driven by the number of hours, it is driven by the number of times I do the setup activity. Clear? So this 15,000 rupees is driven by a completely different cost driver. Are you clear with this? And this inspection, it has nothing to do with my machine hours. This inspection activity maybe is driven by the number of inspections carried out. Are you clear with this? So technically speaking, what activity based costing says is, look, even your departmental rate is wrong. It says if the name of the department is machining department, absorb everything based on machine hours. No, further break it down into activity level, activity wise find out what is the factor that drives the cost, keep that as the base quantity to arrive at your absorption rate. Are you clear with this, guys? Are you clear with this? That's why here we don't actually use departments as the basis for actually apportioning the cost. We further break it down into activity, and activity wise we find out the factor that drives the cost, right? And now it makes more sense because now the manner of apportionment will be much more meaningful. Are you clear with this, guys? Are you clear with this? This is exactly what ABC says. So what they are saying is, first list out the activities, right, and find out the activity wise cost, right? That activity wise cost is called as a cost pool. Pool means what? Collecting things together. It's called a pool. Clear with this? So activity cost pool means the activity, that particular activity's amount, cost amount that you're incurring. Clear with this? Then find out the cost driver. That is nothing but your base quantity. right, and arrive at your cost driver rate. This is nothing but the absorption rate that we saw there. Are you clear with this? Now, if you do it like this, it is going to be a much more meaningful manner of apportioning your indirect cost to the products. Are you clear with this, guys? This is all ABC says. That's about it. ABC chapter is over. That's all. Now, let us go and do the numerical problems. You will see it by yourself. Clear with this, guys? And of course, the terminologies alone will be slightly different. There, whatever we call as department, here these guys call it as activity. There, what we call as base quantity, here it's being called as cost driver quantity. There, what we call as absorption rate, here it's called as a cost driver rate. There, what was called as a departmental overhead, here we call it as a cost pool. That is the particular activity's cost amount. Are you clear with this? These are some basic differences, but for that, everything else is the same, and this is going to be a very structured and an easy chapter of all. Are you clear with this, guys? Every attempt they are testing for about 10 marks. ABC and overheads put together, short 10 marks. At times I've even seen 15-20 marks coming to these two chapters put together. So this is going to be a huge coverage, right? This is all about it. Sir, that's all, sir. Why is it why people say it's difficult? After finishing overheads, now if you see this, it is going to be easy because the base for this chapter is actually overheads. The flaws of overheads chapter are getting fixed under this particular chapter. Clear with this, guys? So now let's move on. Let's move on directly to a numerical problem. Look at this illustration. KD Limited is following an ABC costing system. The budget overheads, the cost drivers, and the volumes are as follows. Now look at this. Instead of departments, they have mentioned the activities, right? Material procurement activity, your material handling activity, your maintenance activity, setup activity, quality control, right? They have listed the activities. Each of the activity, how much is the cost incurred? That amount is called as cost pool. Learn the terminologies, right? The cost pool is given. Now they've also given the cost driver. What do you mean by a cost driver? The factor that drives that particular activity's cost. This is nothing but the base quantity. So material procurement activity is driven by what? Number of orders. Clear with this. Material handling driven by the number of movement. Maintenance hours. Setup, number of setups. Quality control, number of inspection. Clear with this. Now they have also given the cost driver quantity. This is nothing but the base quantity. The values are given. Totally in this particular year, 1200 orders were there, 1240 movements were there. So 17550 maintenance hours, 1450 setups, and 1820 inspections were there. Clear with this, guys? These are all given. The company has produced a batch of 7600 units. Its material cost was 24,62,000 and wages were 4,68,500. Right? The prime cost components are given. Usage activities of the said batch are as follows. So now this is all these cost drivers are for a year. Now what have they said here? One particular batch, they have given the data. So material orders were 56, 84 material movements were done, 1420 maintenance hours, 60 setups, and 18 inspections. You are required to calculate the cost driver rates and calculate the total and the unit cost of the particular batch. Now guys, very simple. Now it's a 3-step procedure, rather I would say a 2-step procedure in ABC. First, you need to calculate the cost driver rate. This is similar to what? Absorption rate. Now what will you do here? List out the activities, right? Now what is going to be your total activity wise cost pool? You take that divided by the total cost drivers for the year. You take it. Now you will arrive at the cost driver rate. Cost driver rate will be what? In this case, for every order, the material procurement cost is 1535. Material handling activity, per movement, the cost is so much. Maintenance, per maintenance hour, it is so much. Per setup, the setup cost is so much. Per inspection, the quality control cost is so much. Like this, you will arrive at the respective cost driver rates. Are you clear with this? Now what will you do? So they have given us that, look at this, for a particular batch, the batch size is how much? For a particular batch with a batch size of 7600 units, they have given the material cost and the wages cost. So now look at this, the material and the wages cost are given, and I think the batch size is 7600. Okay, 7600 units of a particular batch. So now material, labor, this is given. Overheads, how will you calculate? This batch has consumed 56 orders, 84 movements, 1420 maintenance hours, 60 setup hours, and 18 inspections. So what you need to do is take the respective cost driver quantity consumed and multiply it with the respective cost driver rate we just found out here. You marry the figures. That's about it. That is nothing but absorption rate into base quantity consumed. Here you call it as cost driver rate into cost driver quantity consumed. You just do it. So now what you will get is, you will get the product wise total for this batch. What is the total cost divided by the number of units? You will be arriving at the total cost per unit. Are you clear with this, guys? Anyways, this is the objective of this chapter also. Are you clear with this? The only difference is what? Instead of using departments as the base, here we used what? Activities as the base. Are you clear with this? Now there are a few lines of differences between your traditional overhead costing system, I'm calling it as TCS, traditional costing system, and ABC. There under the traditional costing system, what was called as departments, here it's called as activities. There what was called as departmental overheads, here is called as activity cost pool. Then what was called as absorption rate is here called as cost driver rate, and what was called there as base quantity here is called as cost driver quantity. This is all the difference between your traditional costing system overheads chapter and ABC, but for that everything else is the same, guys. Are you clear with this, guys? Are you clear with this? But it's equally important. It's equally important, no doubt. It's important because generally ABC sums will be big, solution will be simple. Why is it big? Because they need to necessarily give you a lot of data. Clear with this, guys? Done, right? Now let's do one numerical problem here. That's about the chapter actually. That's about the chapter. Now let's do a numerical problem here. ABC Limited manufactures two types of machinery, equipment Y and equipment Z, and applies or absorbs the overheads on the basis of direct labor hour. Presently, they are using the traditional costing system. They are taking the direct labor hour as the base quantity. The budgeted overheads and the direct labor hours for the month of December are 12,42,500 and 20,000 hours respectively, right? So with this, you can calculate the predetermined rate. This is as per the traditional system. The information about the company's products is given as follows. So equipment Y and equipment Z, the budgeted volume is given, the number of units of Y and Z produced, the direct material cost is given per unit, right? The direct labor costs. So every unit of Y takes 3 hours to complete, and every hour of Y is going to take what? And every hour is being paid at the rate of 150. So it's going to be 450 rupees. And every hour, every unit of Z takes 4 hours. And every hour is paid at an hourly rate of 150. So 4 into 150, 600 rupees is the labor cost per unit of Z. Now, ABC's limited overhead of 12,42,500. What is this figure? The total overheads that we had. Now they are breaking it. It's been identified with three major activities. Order processing 2,10,000, machine processing 8,75,000, product inspection 157,500. Now they have broken it down into multiple activities. These activities are driven by the number of orders processed. That is, your orders processing is going to be driven by the number of orders processed, your machine processing based on your machine hours, and your product inspection on the basis of inspection hours. The data are given below. Total number of orders processed 600. Out of that, 350 was the orders processed for Y and 250 were the orders processed for Z. Similarly, machine hours work total is given and product wise breakup is also given. Inspection hours total is given, product wise breakup is also given. Right now, required number one, assuming the use of direct labor hours to absorb or apply the overheads to production. Compute the unit manufacturing cost of equipment Y and Z if the budgeted manufacturing volume is attained. Now, using the traditional costing system, you calculate the absorption rate and all, charge it to the product and arrive at the total cost of the product. This is what they have asked for. Now, that's pretty much simple. We know that the direct material cost is given, direct labor cost is given. Now, how do you arrive at the overhead rate? Very simple. So, in the traditional system, it's going to be budgeted overheads divided by budgeted hours, 12,42,500 divided by 20,000 hours. So, how much is that going to be? That is going to be 62.125 rupees per hour. This is the absorption rate. Correct, guys? Right? Now, we know that, yes, product Y, that is equipment Y, took 3 hours and equipment Z took 4 hours. Right? So, we just need to multiply it here. So, equipment Y took 3 hours. So, it's going to be 3 into 62.125 and equipment Z took 4 hours. 4 into 62.125. So product wise, what is the overhead cost? 3 into 62.125, that gives you 186.38 rounded off. And similarly here it's 4 into 62.125, that gives you how much? Roughly, I think they have retained the decimals here. It comes out to 248.5. Now it's pretty much simple. What they have done, they have taken an absorption rate, maybe in this case even a blanket rate they have taken, and charge it off the products. Are you clear with this, guys? So with this, you've got what? The equipment Y and equipment Z's total cost, you have arrived at it. Clear with this, guys? Clear with this, guys? Now this is based on what? This is based on your traditional costing system. Next, suppose now they are using this ABC system. Now what will happen here under the ABC system? Look at this. Under the ABC system, the total overheads is now broken up into 3 different activities. So now we have the activity cost pool, and the activity wise we know what is the total activity cost driver consumed. So you divide the two, you can arrive at the cost driver rate. So now I told you guys that the activity based costing system, that's a 2-step approach that we need to follow here. So first you break it down into activity. This overhead cost ideally is called as cost pool. So now I have the activity wise how much is the cost, right? And what is the activity wise cost driver quantity? 600, 50,000, 15,000. I have this here. These are given in the questions, 600, 50,000 and 15,000. So whatever is the cost driver that drives the respective cost, that drives the respective activity that I need to take, and I have arrived at the cost driver rate here. So it's going to be 350 rupees per order processed. This is going to be 17.5 per machine process. And here it's going to be 10.5 rupees per inspection hour. Are you clear with this? So now that I've got the cost driver rate, what will I do now? Now under the ABC system, anyways, my direct material, direct labor, the prime cost components and all will not change whether I follow traditional costing or my ABC, because the traditional costing, overhead costing and your ABC deals only with the overhead component. They don't deal with the prime cost component. Now in this case, what happens here is, so now first you have the 3 products here. You have the 3 activities: order processing, machine processing and inspection here. Now look at this. So now what do you do here? First, you just have to marry the figures. With respect to order processing, the cost driver rate is how much? 350 rupees. 350 rupees. Now, I have 350 orders for Y and 250 orders for Z. So here it's going to be, right, 350 orders into 350 rupees. That gives you how much? 1,22,500. 250 orders into 350 rupees, that gives me 87,500. That is the cost driver rate multiplied with the cost driver quantity consumed for the respective product. If I do, automatically I will be getting what? I will be getting my respective share of the overheads for the respective products. Similarly, machine processing activity, if you see, what is the cost driver rate? 17.5 rupees. So I have the 17.5 rupees here. Multiply it with the respective machine hours taken by the products. The products, each of the products took how much? 23,000 and 27,000 respectively. So you just need to multiply it here. So 23,000 and 27,000. So this is going to be 23,000 hours into 17.5. This is going to be 27,000 hours into 17.5. Are you clear with this? This is going to be the respective calculation. Are you clear with this, guys? Are you all clear with this? Similarly, for inspection, per inspection hour, it's going to be 10.5. And how many inspection hours we spend for the respective products? 4,000 and 11,000 respectively. So it's going to be 10.5 rupees into 4,000, 10.5 rupees into 11,000. I'll get these figures. So now we've got what? The overhead cost for each of these 2 products as well. So now what do we do? Divided by respectively by the number of units, you will get the total cost on a per unit level. You will get the total cost on a per unit level. As simple as that. Guys, this is not a very intricate or a difficult calculation and all. Basically everything is the same. Instead of calling it as an absorption rate, I call it as a cost driver rate. Instead of calling it as a base quantity, I call it as a cost driver quantity, and I just charge it off to my products. Are you all clear with this, guys? Don't think that this is something else. This is very, very simple. The issue only is here you need to understand why we are doing ABC. Once you know that, it is going to be a cakewalk, and as simple as that. Clear with this? Done, guys? Are you all done? Are you all able to understand this? Right? What is the next part of the question? ABC Limited's selling price are heavily based on costs. By using the direct labor hours as an application base, calculate the amount of cost distortion that is under or over costed for each of the equipment. Now what they are saying, now look at this. If I follow the traditional costing system, what is the cost per unit? For Y it is 936.38, for Z it is 1298.5. Whereas if I follow the correct ABC system, the per unit cost is changing, correct? So now what we need to do is look at this. If I am following the traditional costing system, this will be the respective cost per unit. If I am following the ABC system, this will be the respective cost per unit. Ideally speaking, which is correct? ABC is correct, but currently the company is following what? Direct labor hour as the basis of apportioning your indirect cost. So now ideally every unit should have been costed at 976.8, but they are wrongly costing it at just 936.38. What has happened? The cost distortion is the product Y is being undercosted to the extent of 40.42 rupees. Are you clear with this? Similarly for equipment Z, presently they are valuing it, or they are costing it at 1298.5, but ideally speaking it should have been valued at 1266.16. The difference is what? They are overvaluing it by 32.34. Are you clear with this? Both undervaluing and overvaluing, that is both undercosting as well as overcosting, are bad. You need to use the right methodology of costing. So look at this. The low volume product Y is undercosted and the high volume product Z is overcosted using the direct labor hours for absorption, overhead absorption. See, a wrong methodology of absorbing your overheads will lead to a wrong selling price fixation, which will result in a huge failure of the business itself. Now, honestly, guys, this is the reason why many startups fail. What they do is, the moment they see little amount of money, they spend a lot in a lavish office and all that, without knowing that all these office are overheads. It needs to be properly apportioned. It needs to enter into the product properly and unitized properly. Based on that, the selling price needs to be fixed. They don't even know that the market is ready to pay that much. If they take all these costs and add it onto the product, now what will happen? The market will not be ready to pay because your price will be more. Your competitors will be fixing a price which is nominal. Right now, no one will come and buy it from you. Your business will crash. This is the reason ABC is actually a game changer in the industry, because for every activity it is showing you the driver. Right now, if you want to reduce the particular activity cost, you can just go and reduce the cost driver. That's all. Clear with this? So there is a direct relationship between the cost driver and the cost pool. If you want to reduce a particular activity cost, go and control your cost driver. Are you clear with this, guys? Are you clear with this? So for example, right, in your real day life, you can use ABC and all. For example, if you are a student who is attending a face-to-face lecture, right, your cost driver will be number of lectures held, not the number of hours. Because you will say, sir, every day if you keep totally, let us say I'm planning for a 100-hour session. Example, I'm telling you, if I every day keep a 2-hour session, so I will be conducting the class 50 times. Correct? Which means you need to come and go for 50 times. Your cost is driven by the number of visits or the number of lectures. Correct? If you are a face-to-face student, because every time you come and go, you will be incurring transportation costs. Correct? That you only need to bear. Yes, guys. Whereas if you are an online student, you will not be bothered about the number of lectures. You will only be bothered about the hours. Why? Because 100 hours you are watching a lecture, right? Accordingly, you need to be incurring some electricity cost, obviously some basic light, or you'll be using a system for that, some electricity cost that is driven by the duration, not by the number of lectures. Clear with this? So for you, the cost driver, you will be driven by the number of hours, the duration. Whereas a person who is attending a face-to-face, he will not be bothered much about the duration. He will only be bothered about the number of lectures. He will say, sir, this 100 hours, sir, you finish off in 10 days. 10 days per day, 10 hours you take, finish off. He will be happy. Are you clear with this? Are you clear with this, guys? Even in real life, you can use ABC in order to control your cost. Simple. You just list out all the costs that you are incurring, right? Break it down into activities. Obviously, you will know for this activity, this is the cost driver. You will be able to easily find out based on that. If you want to reduce your overall monthly expense, what you need to do is put an activity-based costing budget, right? And then you just try to reduce your activity cost drivers, the factors that drive the cost. automatically your cost, at least to some extent, can be controlled, or at least you will know where you're spending your money. Clear with this, guys? That is about this particular question. And there's one more question which is quite unique. I just wanted to share this with you as well because it's there in the study material. MST Limited has collected the following data for its two activities. It calculates the activity cost driver rates based on the cost driver capacity. Now look at this: power and quality inspections. Power and quality inspections, these are the two activities. They are driven by kilowatt hour and number of inspections respectively. So this is not kilowatt hours, this is cost driver quantity. So there are 50,000 kilowatt hours budgeted and 10,000 inspections budgeted, and the cost pool is 2 lakh and 3 lakh respectively. The company makes 3 products, M, S and T. For the year ended 31st of March, the following consumption of cost drivers were reported. Now what they have done, product wise, they have given the total kilowatt hours consumed and the total quality inspections done. Are you clear with this? Now compute the costs allocated to each of the product from each of the activity. Now first, what will you do? You will calculate the cost driver rate. How will you find out the cost driver rate? The respective cost pool divided by the cost driver quantity, the budgeted cost driver quantity. See, the concepts of your absorption costing remains the same. Here also you can work only on your budgeted data, because costing can't wait till the year end. So here also it is budgeted cost pool divided by budgeted cost driver quantity only. Are you clear with this? So here what we will do, we will arrive at the respective cost driver rate, multiply that with the actual cost driver quantity consumed. You will be able to apportion your overheads to the products. Now look at this here. Look at this here. Now you have the respective products M, S and T. Okay, fine. First, the cost driver rate is 2 lakhs divided by 50,000. This is 4 rupees per kilowatt hour. Inspection, quality inspection is 3 lakh divided by 10,000, 30 rupees per inspection. This is nothing but the data that they have given on the top, the first dabba. So 2 lakh divided by 50,000 and 3 lakh divided by 10,000. You arrive at the cost driver rate. What will you do now? Multiply it with the respective cost driver quantities consumed. Clear with this, guys? So now what will we do here? What will we do here? With respect to the power activity, right? So product M consumed 10,000 kilowatt of hours, product S consumed 20,000 and product T consumed 15,000. Multiply it with 4 rupees, because for every kilowatt hour consumed, the charge, overhead charge is going to be 4 rupees. So you will get a share of 40,000, 80,000, 60,000. So at the end of the year, if you see actual overhead charge is how much? It's going to be 1,80,000 rupees. Similarly for QC, the quality control, how much is that going to be? 30 rupees per inspection. Now product wise, they have given us that 3,500 rupees, 3,500 inspections were carried out for product M, 2,500 for S and 3,000 for T. Multiply the respective inspections with the 30 rupee of cost driver rate. You will arrive at the product wise share of quality inspection cost. If you add up, you get the overheads absorbed to the extent of 2,70,000 using the concept of ABC. Clear with this, guys? Clear with this, guys? This is what they've asked in the first part of the question. Number 2, calculate the cost of unused capacity. This is nothing but your under or over absorption using ABC. Now what I had budgeted, a cost of 2 lakh rupees for power, but what I had actually absorbed using ABC, I absorbed only 1,80,000. Guys, correct? Yes. So here the difference between the two is going to be what? 20,000 rupees. This is nothing but the unused capacity or unabsorbed overheads. Clear with this? Similarly for the quality inspection, I was planning to incur how much? 3 lakh, but I actually ended up consuming only or absorbing only 2,70,000. So here again there is an unused capacity to the extent of 30,000 rupees. Add the two, the total value of unused capacity is going to be 50,000 rupees. Are you clear with this, guys? Are you clear with this? Right? This chapter is, that's all. It's very simple. It's an extended arm of your overheads chapter. Do not see this as a separate chapter. That's what I would suggest. And this chapter is in fact much more logical and it's much more practical as compared to your overhead chapter. Clear with this, guys? Are you all able to follow this? Any issues here? Any issues here? Right? That is all about this concept of activity based costing, right? And with this, we have also completed this chapter. Remember one thing, there is a 2-step process in your ABC, all the sums. The first step is calculating your cost driver rate. The second one is charging your overheads to the respective products. So the terminologies alone are different, but for that, everything else is going to be the same. So that's what I said. Even in this chapter, the objective is to calculate the overhead cost per unit. right? It is same as the previous chapter of overheads. The only difference is the journey that it takes. There we did it based on departments. Here we are doing it based on activities. Are you clear with this, guys? With this, we have completed this particular chapter called as ABC as well. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj, and now we are in the day 2 or the part 2 of this costing revision series. Now, in this part 2, we are going to learn 2 chapters. We are going to basically revise 2 chapters. One is marginal costing, the other one is process costing. These two are supposedly the most important chapters, or 2 of the most important chapters in our entire syllabus, costing syllabus. And out of this, marginal costing is slightly the biggest chapter of all, so that's why I am starting off this day with marginal costing, so that let's finish it off properly and then we'll move on to the next one. Clear? So that is going to be the agenda for this part 2 of this costing revision series. Now this particular part 2 itself is going to contribute somewhere around 20 to 25 marks in your exams, right? Now the most important part that we are going to do here is as I told you guys earlier in the day 1 as well, marginal costing is the biggest of all chapters in our regular batch. I think about 25 hours approximately, if I'm not wrong. So here in this revision batch, obviously we can't cover all those, the entire number of sums that we did and all in our regular batch, and of course we can't completely do all the concepts. But yes, I have designed this particular revision module in such a way that we are going to touch upon all the important concepts. Predominantly all the concepts will be covered in this particular chapter, right? So the coverage will be as follows. I have just branched this chapter into 3. The first one is the basics, right? And then we have the cost, volume, profit analysis. I will tell you what all fits into this category. And then finally we have a particular segment called as absorption costing versus marginal costing. So I have just classified this chapter into 3 for the purpose of revision, so that it will be easy for us to recapitulate the entire discussion, right? Clear with this? Fine. So in this CVP analysis, right? CVP stands for cost, volume, profit analysis. It's another name for marginal costing. So we will be learning about the concepts of contribution, PV ratio, break-even point, cash break-even point, margin of safety, the CVP pairs, or as I call it, CVP jodis, right? Or the CVP couples, whatever it is. Then the break-even chart, the profit volume chart, sales mix, merger of plants, sensitivity analysis, indifference point, shutdown point, and key factor analysis. That's your limiting factor analysis. So we will be touching upon all these areas, and of course we will also be doing some numerical problems. This is what I have planned, and this will be done in such a way that it's going to be a very effective revision, because as of now I've not done a revision, or my revision video on marginal costing is not there anywhere on YouTube. So I thought, let me give a very holistic coverage of this entire chapter, despite the fact that it's going to be a revision, but let's revise almost the entire chapter. This is going to be the objective. So my humble request to you guys is, please participate then and there. Use the chat box and just participate. It's going to enhance your learning experience for sure. Catch up running notes. And for those who are going to watch this later on a recorded mode, right, you also participate as if I'm standing in front of you and doing this revision, so that it will definitely enhance your learning experience. Clear with this, guys, right? And trust me, this revision is definitely going to step up your preparation with respect to this particular chapters that we're going to do today for sure, right? That to that extent I can definitely give you a commitment. Now shall we get started, guys? Shall we get started? Right? Fine. Now this chapter, marginal costing, first let us get started with the basics. And for the purpose of getting into the basics of this chapter, let me take a numerical example. Now let us say that the selling price is rupees 10 per unit, the variable cost is rupees 6 per unit, the fixed cost is rupees 10,000, right, in total, and the sales volume let us say is 6,000 units. Let us say is 6,000 units, right? Now with this, let us try to prepare a marginal costing income statement, right? Let us revise what is the concept of PV ratio, a concept called as break-even point, a concept called as margin of safety, and of course, we will also try to calculate the profit. These are the 5 things that we are going to see using this particular example. By the way, before you start any chapter, you should know what is the objective that that particular chapter is going to help us achieve. This chapter completely revolves around the objective of decision making, which means this chapter needs to be looked at from the perspective of variable cost and fixed cost. So in this chapter, the cost classification will be from the perspective of variable cost and fixed cost. Clear with this, guys? Right. And there is only one concept in this entire chapter that deals with the objective of stock valuation and profit computation. That is the segment C of this particular chapter, which is absorption costing versus marginal costing. That is the only segment in this chapter that deals with stock valuation and profit computation. What it is, I will be doing it. I mean, I will walk you through at the time when we are entering into the segment C. But till then, predominantly about 95% of the chapter, all the other concepts of this chapter revolves around the concept of division making, wherein the cost classification will be strictly from the perspective of fixed cost and variable cost. Clear with this, guys? Now, how does the marginal costing income statement looks like? So the first one is the marginal costing income statement, right? So the marginal costing income statement goes as follows. First, you'll be having sales minus variable cost, gives you something called as contribution, minus fixed costs, finally gives you something called as profit. Now, we all know that variable cost makes sense only when it is represented on a per unit level, whereas fixed cost makes sense only when it is represented in total. Why? Because that is the cost behavior pattern of variable and fixed cost. Variable cost, an example would be your material cost, correct? So only if I produce the next unit, this variable cost will be incurred, whereas that is not the case with fixed cost. An example of fixed cost could be your factory rent, right? So in your fixed cost, irrespective of your output level, this 10,000 rupees will always be incurred. You cannot do anything about it. Clear with this, guys? Clear with this, guys? So marginal costing income statement says that, it is better if you present your income statement as sales minus variable cost, that gives you something called as contribution, minus fixed cost, that gives you something called as profit. Sir, why, sir? Rather, I could say sales minus total cost. When I say total cost, it's variable plus fixed, directly gives me profit. Why are you having one speed breaker in between called as contribution, and from there once again you're reducing fixed cost and arriving at a profit? This manner of presentation will enhance your level of decision making. Sir, how? Fine. First, let me just walk you through the statement, and once we are through with this, we will be having a lot of clarity as to how this helps us in our decision making objective. Now first, guys, now in this case, every time I sell a unit, what is the revenue that I get? I get 10 rupees, right? And every time I sell a unit, I also incur 6 rupees variably, which can be tracked on a per unit level, correct? So every time I sell a unit, I earn 10 rupees, and every time I sell a unit, I need to spend 6 rupees. So technically speaking, this 4 rupees is my variable profit. I can track this profit on a per unit level, correct? Now, is this my final profit? No. Why? Because my fixed cost is yet to be adjusted. So the variable profit is only called as contribution. Clear with this, guys, right? Why is it called as contribution? Wait, I will come to that. The name, the reason for the name, the logic for the name. Now, in this case, you tell me the company has sold 6,000 units. Each of the unit has given them a revenue of 10 rupees. So basically the sales is going to be 6,000 units into 10 rupees. That's going to be 60,000, right? Now the variable cost will be, they have sold 6,000 units and each of the unit had a variable cost of 6 rupees. That's going to be 36,000, right? Now if you do this, you get a variable profit of how much? You can even calculate this 6,000 units into 4, that gives you 24,000. Now, how much is your fixed cost? Your fixed cost is going to be 10,000 rupees. So technically you are left with a profit of how much? 14,000 rupees. Now, sir, why is this variable profit called as contribution? Simple. Now, I earn a variable profit of 24,000 rupees, that is called as contribution, right? Now, from this contribution, first I try to recover whatever fixed cost I have actually incurred, and whatever is earned over and above recovering my fixed cost is called as my profit. Or in other words, this variable profit contributes first towards recovery of my fixed cost and then towards generating my profit. Since it contributes towards two things, that is recovery of fixed cost and the generation of profit, they are using the word called as contribution. Are you clear with this? Right? This is the reason why instead of using the word variable profit, they are using the word contribution. Clear with this, guys? Clear with this, guys? Now, using this marginal costing income statement only, the other concepts like PV ratio, break-even point, margin of safety, and all of these are actually developed, and these are actually very much useful for us to take meaningful decisions. We will be seeing that. First, are you guys clear with the marginal costing income statement right now? Sales minus variable cost gives you contribution, minus fixed cost gives you profit. Now, this is the most important thing that you need to know throughout the chapter, because for every single sum that you are going to do, this marginal costing income statement is the base from which you need to enter into any kind of numerical problems in this chapter. Clear with this, guys? And are you all able to understand the logic for this income statement? Right? Fine. So now let's move on to the second one, B. Let's move on to the second one, B. Now, what have they asked for? They've asked for the PV ratio. Now, here we have sales minus variable cost gives you contribution, right? Now, on a per unit level, what is the sale, or in other words, my selling price? My selling price is 10 rupees. And on a per unit level, what is my variable cost? My variable cost is 6 rupees. And on a per unit level, what is the contribution, also known as the variable profit, to put it in layman words? So that is going to be 4 rupees, correct? Now, in terms of total value, that is for 6,000 units, what is going to be my total sales? My total sales is going to be 60,000 rupees. My total variable cost is going to be 36,000 rupees. And my total contribution is going to be 24,000 rupees. Agreeing with me on this or not? Guys, yes? Right? Now, what did I do? Very simple. On a per unit level, I generate a revenue of 10 rupees, I incur a variable cost of 6, and I make a variable profit known as contribution. From now on, I will be using the word only as contribution. I earn a contribution of 4 rupees. Now, for any kind of output level, I just need to multiply each of these three figures with the volume, in this case 6,000. So for any volume level, I can find out the total sales, the total variable cost, and total contribution. Agreeing with me on this, guys, right? Now, if I say that if I want to express all these things as a percentage by keeping my sales as 100, right? That is, if I want to express my variable cost as a percentage of my sales. Now, variable cost expressed as a percentage of sales is how much, right? If I generate a revenue of 10 rupees, I know that I will be incurring a variable cost of 6 rupees. Or in other words, can I say my variable cost ratio is 60%? Agreeing with me on this or not? That is, every time you generate a revenue of 100 rupees, 60 rupees is your variable cost, correct? Yes. So the variable cost can be represented both on a per unit level as well as a percentage expression. Agreeing with me on this? Similarly, contribution also move proportionately only. So can I say every time I generate sales worth 10 rupees, I am earning a contribution of 4 rupees. Or in other words, contribution can also be expressed as a percentage of sales. Now that percentage in this case is going to be how much? 40%. Agreeing with me on this or not? Right? This 60% is called as VC ratio, variable cost ratio, and this 40% is called as PV ratio. profit volume ratio. Are you clear with this? Sir, how is this profit? I told you contribution is nothing but variable profit. Are you clear with this, guys? So when they say PV ratio, it is nothing but contribution expressed as a percentage of sale. Are you clear with this, guys? Yes, you guys are all clear with this, right? Fine. So now, why do we use this expression? If I want, I can track my variable profit on a per unit level, or if I want, I can track my variable profit, that is my contribution, as a percentage level. Every time I sell a unit, I will earn 4 rupees of contribution. Or I can say, if I generate sales worth 100 rupees, I will make a variable profit of 40 rupees. Correct? Suppose they are saying, this year I'm planning to earn generate a revenue of 1 lakh rupees. In that case, 1 lakh into 40%. So 40,000 rupees is going to be your contribution. Directly we can arrive at the figures. Are you clear with this? So if the sales is given in the units, you can multiply it with contribution per unit to arrive at the total contribution. Or if the sale is expressed in value, you multiply that with PV ratio to arrive at the same contribution value. Are you clear with this, guys? These are all multiple ways of doing it. These are all multiple ways of arriving at the figures. Are you all clear with this? Are you all clear with this? Right? Next. So now your PV ratio is done. Now let's move on to the next one. So what is the other one? Yes, your break-even point. So now the next concept is called as break-even point. Now what do you mean by a break-even point? The break-even point is a point where I exactly make a profit of 0. That is, it is a point of sale at which there is no profit, no loss. Are you clear with this, guys? It is a point of sale where there is no profit, no loss, right? Now in this case, in our example, when will we be having a no profit, no loss? Can I say when my sales, total sales is exactly equal to my total cost, there will be a no profit, no loss. Agreeing with me on this? Right? Or can I say when my contribution is just sufficient to recover my fixed cost, that is when my profit will be 0. Agreeing with me on this or not? Guys, are you all clear with this? That is, when I earn a contribution that is exactly sufficient to recover my entire fixed cost, right? Then the point of sale at which my contribution is equal to my fixed cost is called as my break-even point. Now this contribution should not be more than your fixed cost. In that case, you will be starting to earn a profit. It should also not be less than your fixed cost. That will be a loss scenario. Your contribution earned should be exactly equal to the fixed cost. The point of sale at which my contribution is exactly equal to my fixed cost is called as my break-even point. Are you clear with this, guys? Are you clear with this? Now, guys, please do not mug up any formulas, right? Mark my words, there is not even a single formula that needs to be mugged up here. Everything is absolutely logical. Spend some little time and you are done. That's about it, right? So now in this case of break-even point, I told you it is a point of sale, right, where my contribution is equal to what? My contribution is equal to fixed cost, right? So it is a point of what? It is a point of sale. So how many units should I sell so that my profit is equal to 0? So we need to find that sales units only. So how do we do it? Can I say the number of units? So the sales units, I don't know what it is. I need to find out, into the contribution per unit, which we got here. The contribution per unit is how much? 4, right? Should be equal to the total fixed cost. In our case, what is the total fixed cost? 10,000 rupees. Correct, guys? Yes. So now, can I say the required sales units to exactly earn a 0 profit or 0 loss is going to be rupees 10,000 upon 4. This is nothing but how much? 2,500 units. Agreeing with me on this? So if I exactly sell 2,500 units, right, I will reach a break-even point. That is, there will neither be a profit nor will there be a loss. My contribution will be exactly sufficient to recover my fixed cost. Are you all clear with this, guys? Or in other words, this is nothing but fixed cost divided by contribution per unit. That is, I need to earn a contribution that is equal to my fixed cost, and every unit gives me a contribution of 4 rupees. So how many units should I sell to recover my entire fixed cost? That is the meaning of this. Are you clear with this, guys? Are you clear with this, guys? Right? Now, another way of doing it is, I told you, contribution can also be calculated by saying that it is nothing but sales in value into PV ratio. Correct? No? So, sales can be expressed in units, or sales can also be expressed in value. Sales in units into contribution per unit gives you the total contribution. Similarly, sales in value into PV ratio also gives me what? The contribution value only. Right? Can I say sales in value into PVR should be equal to my fixed cost? Right? So now sales in value into, what's my PV ratio here? My PV ratio is 40%. So can I say into 40% should be equal to rupees 10,000, or the sales, required sales in value should be equal to rupees 10,000 divided by 40%. So how much is that? 10,000 divided by 0.4, that gives you, yes, 25,000 rupees. Are you clear with this? Or in other words, if you directly want to calculate the break-even point in value, see, break-even point is nothing but a point of sale. And whenever they are mentioning about a sale, it can either be expressed in units or can be expressed in value. So if you want to calculate the break-even point in value, you can use directly the formula fixed cost divided by PV ratio. Are you clear with this, guys? Are you clear with this? Or there is one more way of doing. We found out the break-even point in units, correct? 2,500 units, right? And every unit actually has a selling price of 10 rupees. So 2,500 units into 10 rupees. This way also you can find out 25,000 rupees. So basically break-even point, remember, can be expressed as can be expressed in units, or it can also be expressed in values. Are you clear with this, guys? So now the break-even point formula, to put it short, if you want to express in units, it's going to be fixed cost divided by contribution per unit. If you want to express in value, it's going to be fixed cost divided by PV ratio. Are you clear with this, guys? Are you all clear with this? Always remember, if you want to find out something in units, use contribution per unit. If you want to find out the same in value, instead of contribution per unit, use PV ratio. As simple as that. Clear with this, guys? Clear with this, guys? This is one trick that you can use in marginal costing, a very logical trick as well. Clear with this, guys? So now, can I say that in our case, what was the break-even point in units? 2,500 units, correct? So if I am exactly selling 2,500 units, now there will be zero profit or zero loss. Correct, guys? No profit, no loss. Suppose I start selling more than 2,500 units, this will be a profitable situation for me. Suppose I'm not even able to reach 2,500 units, this is a loss situation for me. That is, at this point of time, my contribution earned will not even be sufficient enough to recover my fixed cost, and I will end up reporting what? A loss. Are you clear with this, guys? So the break-even point is a parameter. Any businessman will first calculate the break-even point and he will say, now, when am I going to achieve this? I need to first achieve this 2,500, and after that, whatever sale I make, that will only go on to generate my profit. Are you clear with this, guys? Are you all able to understand this? That is the concept of break-even point. Now, let us move on to the next concept called as margin of safety. Let us move on to the next concept called as margin of safety. Margin of safety. Now, how is it getting calculated? Now, what is this margin of safety? Now, guys, in our example, now tell me what is the total number of actual units sold. In our example, the company has sold a total of 6,000 units, right? So the actual sales is how much? 6,000 units. Now we just calculated that the break-even point happens at where? It happens at 2,500 units is what your break-even point is, right? Now margin of safety means the number of units sold in excess of my break-even point. Are you clear with this? So in this case, how many units have I sold in excess of my break-even point? I have sold 3,500 units in excess of my break-even point. This is called as margin of safety. Clear with this, guys? Are you all able to understand? Are you all able to understand? So I have sold 3,500 units over and above my break-even point. This is called as my margin of safety. Sir, why are we using the word margin of safety? Basically, what the businessman will look at is, okay, currently I am selling 6,000 units. I know that my break-even point is 2,500, which means currently I am in a comfortable position. Now, tomorrow, even if something goes wrong, max I can afford to lose a volume only to the extent of 3,500. If I lose volume beyond 3,500, I will end up in a loss situation. So to that extent of 3,500 units, I have a cushion, right? That is why it's called as margin of safety. Are you clear with this? This is the logic for the word margin of safety. Are you all able to understand this, guys? Right now, how would you calculate margin of safety? First, let me tell you this. Yes, this is nothing but you can take it as the total sales minus break-even point. Right now, have one thing in your mind. Now, in this case, what happens? The company is first, the moment they sell 2,500 units, the entire contribution will go on to recover the full fixed cost. Correct? Suppose they are selling 2,501 unit, right? The contribution generated by that one extra unit will directly go on towards generating profit. In this case, the company's profit will be 4 rupees. Correct? Suppose the company has sold 2,502 units. The company's final profit will be those 2 units into the contribution generated. So, or in other words, margin of safety is nothing but the profit generation sale. Agreeing with me on this? Right? The break-even point is nothing but your total sales that recovers your fixed cost, and your margin of safety is nothing but the total sales that goes on to generate your profit. Are you clear with this? So here the margin of safety can be easily called as your profit generation sales. Now, profit generating sales. Now, you just look at this. Now, I have something called as this entire marginal costing income statement. So, look at this here. I have sales minus variable cost gives me contribution minus fixed cost gives me profit. Correct, guys? Now, look at this. Interesting observation. So, now in this case, what's going to be my total sales value? So, it's 60,000, right? So, my sales is going to be 60,000, right? Then minus my variable cost, which is going to be 36,000, gives me my contribution, which is going to be 24,000, right? Minus fixed cost gives me 10,000, gives me a final profit of how much? 14,000. Correct? Now, can I say, look at this. Can I say this 10,000 rupees of fixed cost was purely recovered by the contribution generated from these 2,500 units? Agreeing with me on this or not? That is nothing but my break-even point. That is, I'm repeating, the fixed cost was completely recovered using the contribution generated by the 2,500 units. Agreeing with me on this or not? Or in other words, can I say the break-even point 2,500 units into the contribution per unit? How much is the contribution per unit? 4 rupees, right? So 2,500 into 4, that's how we got this 10,000. Are you clear with this, guys? Right? Now the overall 6,000 units that I have sold, right, that gave me the overall contribution of 24,000 rupees. 6,000 units into contribution per unit of 4 rupees, that gave me the overall contribution of 24,000 rupees. Agreeing with me on this or not, guys? Yes. Similarly, the profit I am reporting of 14,000 rupees, why? This purely came from the margin of safety units of 3,500. So 3,500 units into the contribution per unit of 4 rupees. That's how I got this 14,000 rupees of profit. Agreeing with me on this, guys? Or in other words, can I say my contribution is tied to my total sales, my fixed cost is tied to my break-even sales, and my profit is tied to my margin of safety. Agreeing with me, guys? So now I'm just writing it down here. So here, what we will write down is, so the total sales, right, is tied to the contribution. The break-even point is tied to your fixed cost, and your margin of safety is tied to your profit. Are you clear with this? And if the sales, the break-even point and the margin of safety, if they are expressed in units, right, you can multiply these figures with contribution per unit. Right? If these are expressed in values, you multiply them with what? You multiply them with PV ratio to arrive at these figures. Are you clear with this, guys? Are you clear with this? That is all about it. That is all about it. So marginal costing is nothing but one vertical statement and one horizontal statement. Remember this fully. Remember this fully. That is, your total sale is made up of break-even point plus margin of safety. Correct? Your total sales is nothing but break-even point plus margin of safety. Always remember, break-even point is a point, right? The balancing figure is my margin of safety. This break-even point will not change unless and until there is a change in my fixed cost or my contribution per unit. This will not change, right? Whatever excess sale that I make, if the number of units that I sell increases, only the balance cushion will increase. The margin of safety will only increase. My break-even point will not change. Clear with this, guys? So the total sale is nothing but break-even point plus margin of safety, right? And my total sales is tied up to my contribution. My break-even point is tied up to my fixed cost, and the margin of safety is tied up to my profit. Are you all clear with this, guys? Right? And margin of safety is nothing but my profit generating sale. This is something that you need to understand. This is something that you need to understand. So here, in order to calculate the margin of safety, you can use multiple formulas. Like you can use different formulas. Can I say margin of safety is equal to now you have, so we know that it is tied to profit, correct? So just now I told you margin of safety into PV ratio gives you what? It gives you profit, right? Or can I say margin of safety is nothing but profit divided by PV ratio? Guys, correct? Guys, correct? So margin of safety is nothing but profit divided by PV ratio. Or if you want it in units, you can say it is nothing but profit divided by contribution per unit. Are you clear with this? Similarly, I can also say margin of safety is nothing but, it is nothing but the total sales minus break-even sales. Correct? Or it can be in value, or if you want, you can also express it in units. Are you clear with this, guys? Yes, you guys are able to follow this, right? There are so many ways of arriving at your margin of safety, your break-even point. These are all different ways of reaching at the same destination. The problem is many students think that, these are all formulas to be mugged up. They will say, this is one formula, this is number 2 formula, this is number 3 formula, and they start on a mission to mug up all these things. It doesn't work that way, right? It can clearly not work that way, because this is absolutely logical. You can come up with the formula by yourself if you know the base understanding of this. Clear with this, guys? We just took about half an hour, and this is all about predominant portion of the entire chapter. Right now we will only be developing and entering into the other advanced areas, keeping this as the base. Are you all clear with this, guys? Are you all clear with this? Now one last time, so tell me, what is that marginal costing income statement vertically and horizontally? Vertically it's going to be sales minus variable cost. Come on, guys, tell. Sales minus variable cost gives you contribution, minus fixed cost gives you what? Your profit. And here on the horizontal side, you will be having the total sales that is broken up into break-even point and margin of safety. And your total sales is tied to your contribution using CPU, your contribution per unit, or PV ratio, as the case may be. Your break-even point is tied to your fixed cost, and your margin of safety is tied to your profit. As simple as that. And this is about the entire chapter, guys. Right now, if someone is asking you to mug up formulas here, it clearly doesn't work that way. Then you will find marginal costing difficult only. This is all about it. Are you all able to understand this? Right? Shall we proceed into a few numerical problems? Yes. And of course, they've asked for the profit as well. The profit, anyways, we found it. Right? Okay, fine, guys. So now, can you tell me a few formulas as to how do you arrive at profit? Profit is equal to, I can say, total sales minus total cost, or I can also say it is contribution minus fixed cost, correct? Or I can also say it is margin of safety in value into PV ratio, correct? Or I can also say it is margin of safety in units into contribution per unit. There are so many ways in which you can arrive at it. Guys, are you all able to understand this? Right now, these are all different formulas I've seen. Many people, they write it in one full sheet of paper and they start mugging it up. Now these are something, instead of wasting your time in mugging this up, if you spend your time in understanding the logic behind it, you yourself can write all these things by yourself. Clear with this, guys? Don't take the pain of remembering things. If you learn it conceptually, it will stay with you for a lifetime. That's about it. Clear with this, guys? Shall we proceed forward? Shall we proceed forward? Right? These are all like, it need not be, remembered. On the spot, you just visualize the vertical and horizontal statement. Marginal costing is sorted for a lifetime. That's about it. Fine, guys. Now, shall we move on to the numerical part? Okay. So this is what I've just mentioned it here in the book as basics and all. Beyond this itself, we have covered it right now. So you can just go through all these things. And one very important thing, the basic assumptions of this particular chapter. The basic assumptions of this particular chapter is selling price per unit will remain constant, variable cost per unit will remain constant, and the fixed cost in total, not the total cost, the fixed cost in total will also remain constant. Clear with this, guys? So what do you mean by this? What do you mean by this? Let us say I am selling 1 lakh units, right? Now for this 1 lakh units, for the first 20,000 units, I can't have a different selling price. For the remaining 80,000 units, I can't have a different selling price. No, right? Sir, in reality, it can happen. Yes, it can happen. What will I do in that case is a subject matter of discussion in CA final. Clear with this? You have a self-paced learning module there in strategic cost management. We will be seeing, not here in your intermediate level. That's an advanced level area. Clear with this, guys? In your intermediate level, suppose they have given a particular number of sale units, right from the first unit till the last unit you are selling, the selling price will be the same. The selling price can change. If at all it changes, it will be changing for the entire 1 lakh units. It will not be partly for some units you will be having one selling price, the remaining units will be having a different selling price. No, that is not a subject matter of discussion in intermediate. Similar is the case for variable cost as well as fixed cost, correct? If at all these changes, we will be seeing a concept called a sensitivity analysis, wherein we will be saying what will happen if there is a change in selling price, variable cost, fixed cost. Yes, but all these changes will be happening right from the first unit till the last unit you sold. Clear with this? It will not be partly for some units and partly for different units. That discussion is there only in your CA final. Are you all able to understand this? Right? This is the basic assumptions on which this entire chapter is being made. Yes, and the uses of marginal costing, of course, it is used for pricing, short-term decision making, and market penetration at a lower price. Now, one more thing, guys. One more thing. I'm not sure if you guys are aware of this. You have two subjects, right? Costing and FM, right? When I say costing, I mean cost and management accounting. Now, costing always focuses on short-term decision making, and financial management always focuses on long-term decision making. Have this very clearly in your mind. The decision making taken by costing is always 100% short-term. Costing will not take long-term decisions. Sir, I want to take long-term decision, then go refer FM. Clear with this? That's why these two are interconnected. That's the reason why, if you notice, only in FM you have the concept of time value of money, because we are going beyond 1 year. Have you ever seen the concept of time value of money in costing? No, because costing always talks about short-term decision, right? So which is important, sir? Long-term or short-term? Generally, we prefer long-term only. No, it's not like that. When you're starting a company, you start off with a long-term planning by doing capital budgeting and all that, right? But will everything go as per the plan? Suddenly something happens, a crisis comes in, you need to take an immediate short-term decision. That's when costing comes into the picture. Now, this is even more critical. Taking a short-term decision is even more critical, because given the scenario, you need to know what best needs to be done, right? Concepts like sensitivity analysis, your limiting factor, there is a scarcity of raw material, which I should use these raw material to produce which type of products. That is a short-term decision making. It's not permanent. If it's a long-term decision making, we need to refer FM. Clear with this, guys? So the ground rules are set. The boundaries are very clear. So long-term decision is taken only by FM. The short-term is taken only by costing. This is something that you all need to know. Right. Coming up here. So now in your CVP analysis, yes, the contribution, PV ratio, break-even point and all we've seen. Yes, the cash break-even point, I will come to that. The margin of safety, CVP pairs is also done. Now, what we will do is, let's move on to a numerical problem. One second. Let me just see. Okay. Yes, guys. Look at this. Yes, please take this illustration. Now, they have given that the selling price is 25, the variable cost is 15, and the fixed cost is 20,000 rupees. Now, wait. They are asking a lot of things like contribution, What will be the profit if they are selling 4,000 units? What is the sales required to earn a profit of 50,000? And all these things are given. Now guys, 1 minute. The moment you read any question in marginal costing, now don't keep on staring at the question. It will stare back at you, right? There is no point in it. What you need to do is immediately drop the marginal costing income statement, plug the figures there. That will automatically lead you to the solution. Clear with this? In this case, what I will do, sales minus variable cost gives you contribution minus fixed cost gives me profit. I will just plug it. Okay, only the units are given, per unit data is given. So 25 minus 15, the contribution per unit is 10. The fixed cost is given in total as 20,000. Rough work you do and keep, right? This will lead you to the solution. Now first, what have they asked for? PV ratio. How will you do it? How will you do the PV ratio? It's going to be 10 rupees upon 25 rupees contribution by sales, or say contribution per unit into selling price per unit. Anyways, so 10 upon 25 into 100, that's going to be 40%. Clear with this? Yes. Then what will be the profit if I'm selling 4,000 units? Very simple. The contribution will be 40,000 into 4,000 units into 10. 40,000. From that 40,000, 20,000 will be reduced for fixed cost. Remaining 20,000 will be my profit. 40,000 minus 20,000 gives me 20,000. Clear with this, guys? Right? That's about the second part. Third part, look at this. Look at this. What is going to be the sales required to earn a profit of 50,000? What they are saying, look, I want to earn a final profit of 50,000, right? What should have been the sales I need to make? Simple. Sales minus variable cost gives me contribution minus fixed cost gives me what? Profit. Now they have said they want to earn a profit of 50,000. This 50,000 will be earned after recovering for my fixed cost of 20,000. Correct? No, guys. Yes. Which means I should have generated a contribution that first recovers the entire fixed cost of 20,000 plus contributes to a profit of what? 50,000 rupees. So my contribution should be how much? 70,000. Are you clear with this? So to earn a profit of 50,000, I should have generated a contribution of 70,000. Correct? Right? Now for me to generate a contribution of 70,000, how many units should I sell? Very simple. 70,000 divided by the contribution per unit. Every unit gives me a contribution of 10. I need to earn a total contribution of 70,000, which means I need to sell how many units? 70,000 upon 10, 7,000 units. Are you clear with this, guys? Right? Or in other words, how do you do this? The sales required in units is going to be fixed cost plus profit. That is my required contribution divided by what? Divided by, yes, that divided by my contribution per unit. I think there is some mistake here. Just a minute, guys. There's some mistake. Okay, the final answer is correct. Look at this. I will just do it here. It's going to be 20,000 upon 20,000 plus 50,000, which is 70,000 divided by 10. Yes, 7,000 units. I think they have just done a mistake here. So if you want the sales in units, it's going to be fixed cost plus profit divided by contribution per unit. Are you clear with this? So I need to earn a contribution of 70,000 rupees, right? That 70,000 rupees, every unit is going to give me a contribution of 10, which means I can earn the 70,000 rupees only by selling 7,000 units. Clear with this, guys? Right? So the required sales is going to be the required contribution divided by contribution per unit. Required contribution is nothing but fixed cost plus profit. Are you clear with this? Similarly, if you want to express this in values, very simple, fixed cost plus profit divided by PV ratio. Or in other words, I know that my PV ratio is 40%. Meaning what? If I make sales worth 100 rupees, right, I know that I'm going to earn a contribution of 40 rupees. Correct? If this 40 has to be 70,000, right, how much should be my 100? Or in other words, 70,000 divided by 40%. Are you clear with this, guys? So wherever you are using the word contribution per unit, instead if you replace it with your PV ratio, you will be getting the sales in value. In this case, it's going to be how much? 1,75,000. Is this figure right? So it's 7,000 into 25. Yes, it's 1,75,000 or 70,000 divided by 0.4. Are you all able to understand this? Yes. To convert the rupees into units, 10 divide the sales. Yes, you can do that also. That's what I said. If you want, you can also first find it in units, 7,000 units, multiply it with the selling price of 25 rupees, you will get this 1,75,000. Or directly, if you want, you can say it is nothing but your fixed cost plus profit, the whole divided by PV ratio. Are you clear with this, guys? Now, I have seen many people write all these things as formulas and mugging it up, right? Required sales is equal to fixed cost plus profit divided by PV ratio. Tell 5 times, if not write 100 times imposition, doesn't make sense. You just put it up on a statement, it will lead you to the solution. What is the point in mugging up? You have a lot of other things to remember, right? Don't waste your time here. Clear with this, guys? Spend some extra 2-3 minutes, learn it conceptually. It will stay with you for a lifetime. That's about it, right? Then you have the sales required to earn a profit of 40,000 rupees after tax. Okay, when the tax rate is 60%. Now, guys, first let me tell you one thing. This is an exceptional case. Generally, taxes are not even considered in our subject. I told you this, right? But for some reason, they have given, I want to earn a profit of 40,000 rupees after tax. They have given that the tax rate is how much? 60%, right? So after tax, they want to earn how much? 40,000. So the tax rate is how much? 60%, which means if you earn 100 rupees, 60 rupees goes by tax, right? And the balance 40 is only left with you, right? This 40% is equal to 40,000. How much is the profit before tax that they want to earn? 40,000 divided by 40%, 1 lakh, right? That's all. Now this 1 lakh is a required profit. To earn a required profit of 1 lakh rupees, how much should be the sales that needs to be made? 1 lakh plus 20,000. 1 lakh 20,000 is going to be my required contribution, correct? So that divided by PV ratio or divided by contribution per unit, you will get the required sales in value or in units. Are you clear with this, guys? So that is what they have done. 1 lakh 20,000 divided by 0.4. So whatever it is, it's going to be 3 lakh rupees. Yes, fine. Or in other words, it's going to be 1 lakh 20,000 divided by, what's the contribution per unit? It is 15, 10 rupees, right? It is 10 rupees. 10 rupees, no? Yes, divided by 10. It's going to be 12,000. Are you clear with this, guys? And that's about it. That's about it. So if you want to express the sales in units, it's going to be 12,000. If it has to be expressed in value, it's going to be 3 lakh rupees. Done, guys. Yes, you guys are clear with this? Fine. The next one. What is the sales required to earn a profit of 25% on sales? Now, wait. What do you do? What do you do here? Don't immediately think what formula I should use. Put up the statement. It will lead you. So, sales minus variable costs gives you a contribution minus fixed costs gives you profit, right? So now they have given that, so they have asked us to find out the sales. Let's keep the sales as X, right? So variable costs gives you contribution. So what is the PV ratio, guys? What is the PV ratio? 40%. So can I say, if I keep my sales value as X, my contribution will be 0.4x, correct? Because basically my variable cost will be 0.6x, right? X minus 0.6x, it will be 0.4x, right? My fixed cost anyways is sorted. I know my fixed cost is going to be 20,000 rupees, right? This is going to be 20,000 rupees. So what is going to be my profit? They are saying I want to earn a profit of 25% on the sales. So 0.25x, correct? You have framed an equation. So can I say this is nothing but 0.4x minus 20,000 is equal to 0.25x, correct, guys? Or in other words, 0.4x minus 0.25x is equal to 20,000. Now 0.40 minus 0.25, that gives you 0.15, right? So 0.15x is equal to 20,000. X is equal to 20,000 divided by 0.15. So how much is that? 20,000 divided by 0.5. So 1,33,333. Are you clear with this? Or if you want to find it out in units, divided by the selling price, but of course there will be some decimal round off. So this is going to be divided by 25, is it? The selling price is 25. Yes, divided by 25, you get in units of 5,333. Are you clear with this, guys? Are you all able to understand? Very logical. This is why I said spend more time on the concepts. Again and again, I'm telling you, remember the Abraham Lincoln's whatever he said. So if you give me 6 hours to chop down a tree, I will spend the first 4 hours sharpening the axe. Spend more time on conceptual learning. The execution will just take a few minutes. That's about it. Clear with this, guys? Fine. With that, we are done with this particular basic illustration. Now, one more thing. Let's go on and do one question here at the back. Yes, this is a masterpiece question. Just a minute. Please take the first question for practice. I mean, not the practice sum, the classroom discussion question. Please take the first one, guys. Please take the first one. Now, what have they given? Read it carefully. Read it carefully. Look, ideally, this I have numbered it as question number 1, but there are 6 parts in this question, right? Once we finish all the 6 here, your basic concepts are going to be sorted. Sir, in exam, can we solve through the statement without using the formula. Now, which one you're talking about? See, in any of these methods that I told you, this statement is something that will lead you to the solution. When you are writing the solution, of course, you need to write the formula. In this case, if you see, there is not much of a formula, but everywhere else, you look at this, I also used a formula. I just asked you not to mug it up, but in exam, it needs to be written for sure. So here, how do I calculate the required sales to earn a profit? I'm saying it is I backworked and I calculated here. Okay, 70,000 divided by contribution per unit. But I need to mention it in the exam. How did you get the 70,000? It's nothing but 20,000 plus 50,000. That is nothing but fixed cost plus profit divided by contribution per unit. So what I told you is this has to be in your, maybe in your rough, or if you want, you can even put it on paper, not a problem. But definitely using this, you will be able to write the formula on your own. That is what I'm saying. I'm not saying formula is not required. Please don't mistake it as, I'm telling don't write the formula. No, I'm asking you not to mug up the formula. I'm saying you can write it on your own if you do the statement. Are you clear with this? So please write the formula like this, but you can easily do it provided you are having the statement with you. Right. So now let's go on to that first question. Where is it? Okay. Yeah. Now guys, read it carefully. If margin of safety is 2,40,000 and it is being 40% of the total sales, and the PV ratio is 30%, calculate the break-even sales, the amount of profit on sales of 9 lakh. This is the question. Now, what have they given here? The margin of safety is 2,40,000. So they are saying the extra sale that they have made over and above the break-even point is 2,40,000. And they are saying this 2,40,000 is 40% of the total sales. So how much is the total sale? 2,40,000 divided by 40 into 100. So the total sale would have been 6 lakhs. Agreeing with me on this? Guys, yes? Hello? Yes? So how much is going to be your break-even point? Break-even point is going to be 6 lakh minus margin of safety of 2.4 lakh. Guys, correct?
Yes,
Guys, correct. Or you can say 6 lakh into 60%. If 40% is my margin of safety, the balance 60% has to be my break-even point. Correct? No? Right?
Yes.
6 lakh into 0.6, that's going to be 3.6 lakhs. Are you clear with this, guys? Are you clear with this? So my break-even point is going to be how much? The break-even sales is going to be 3.6 lakhs. In this question, break-even point cannot be found in units. Why? Because the per unit data is not given. Have they given us the per unit data? No. They have only given us the values and percentages and the PV ratio. So had they given us the contribution per unit, we could have found out. So in this case, we can only express the PV, your break-even point in terms of values. Next, calculate the amount of profit if my sales is going to be 9 lakhs, right? So what will be the profit if my sales is going to be 9 lakhs? You can prepare the statement and you can find out. Correct, guys? So PV ratio is how much? 30%. Now, can anyone tell me what is the fixed cost in this question? How much is the fixed cost? How much is the fixed cost? So fixed cost is going to be how much?
1,08,000.
1,08,000. Perfect. How did you get 1,08,000? Very simple. I told you, remember the marginal costing Jodis. Break-even point into PV ratio gives you your fixed cost. Correct? Break-even point is a point which generates a contribution that is equal to fixed cost. So the contribution generated at the break-even point is equal to nothing but your fixed cost. Correct? So 3,60,000 into your PV ratio of 30%, that's going to be 1,08,000. So you get a fixed cost of how much? 1,08,000. So now with this, you can calculate, you can prepare that entire marginal costing income statement when the sales is going to be 9 lakh. So when the sales is going to be 9 lakh, so 9 lakh into 0.3, it's going to be 2,70,000. That's going to be my contribution minus fixed cost of 1,08,000. I will be getting what? I will be getting a profit of 1,62,000. Correct, guys? Yes. Look at this. This is what they have also mentioned. The break-even point is 3,60,000, and your what is this? The profit. Yes, the profit is going to be 1,62,000. If I'm not wrong. Yes, 1,62,000. Now there is another way of calculating the profit. What is it? Using the concept of margin of safety. Guys, we know profit is equal to margin of safety into PV ratio. Correct, guys? Hello? Hello? Guys, yes? Yes, Prashant? You there?
Yes.
Right? So, remember the Jodis that I told you. Your profit is nothing but, can I say, margin of safety into PV ratio. Correct? Now, when I'm generating sales worth 9 lakh rupees, how much is the margin of safety? 9 lakh minus 3.6 lakh. My 3.6 lakh is my break-even point. Any sale I make over and above this 3.6 lakh is called as my margin of safety. 9 lakh minus 3 lakh 60,000 is how much extra sales have I made? 5 lakh 40,000. That is the margin of safety. That into 0.3. 30%, that is directly going to give me how much? 1,62,000. This way also I can find out my profit. Look guys, you can play around with the figures provided you have your horizontal and vertical statements of marginal costing. Clear with this? Are you all able to understand? This is much more easier way of doing it. Clear with this guys? Right. Let's move on to the next one. X Limited has earned a contribution of 2 lakh rupees and a net profit of 1,50,000 on sales of 8 lakh rupees. What is the margin of safety? Now, if you just read the question, you cannot make out anything. What should you do first? Guys, what should you do first? Put up the statement, scribble it, it's okay, right? Put up the statement, it will lead you to the solution. And with that, you write the formulas and present it in the exam. Presentation part, you do it, not a problem. But how do you know what to do? That can be done only if you prepare the statement. Sales minus variable cost gives you contribution minus fixed cost gives you profit, right? Now, it has earned a contribution of how much? 2 lakh rupees. Okay, and then they have said a net profit is going to be 1,50,000. So a lakh and 50 here. And then what have they said? The sales is going to be 8 lakh rupees, right? Now clearly you know what is the PV ratio? 2 lakh upon 8 lakh into 100. It's going to be 25% is my PV ratio.
Yes, sir.
Guys, yes. Now what have they asked us? What is the margin of safety? What is the margin of safety? One look you can answer. One look you can answer. What are the jodis? Margin of safety is connected to what? Margin of safety is connected to what? It is connected to profit, correct? So margin of safety into PV ratio is going to be equal to your profit. Now what happens here? Or can I say margin of safety is equal to profit divided by PV ratio? Yes, profit is 1,50,000. PV ratio is going to be 25%. So my margin of safety is going to be how much? 1,50,000 divided by 0.25 is going to be 6 lakh. Guys, clear with this? Clear with this? That's about it. That's about it. But when you're writing in the exam, you should write this formula for sure. I am not saying don't write the formula. Please don't misunderstand. I am saying, I'm telling you the ways to write the formula by yourself. That's what I'm telling you. Clear with this, guys? Are you all able to follow this? Are you all able to follow this? Right? So first they also calculated the PV ratio. And then margin of safety is equal to profit by PVR. It's 1,50,000 divided by 25%, 6 lakh rupees. Are you all able to understand? Guys, yes, this is actually a beauty provided. You are able to understand the base of marginal costing. Next one. Let's move on to the next one, the third one. The ratio of variable cost to sales is 70%. Wait, they have given the VC ratio. So what is the PV ratio? 30% is the balancing figure. The break-even point occurs at 60% capacity sales, right? Capacity sales means what? The company has some capacity, right? Maximum capacity. We don't know how much that is, but they are saying when I am operating at just 60% of my total capacity, at that point itself my break-even point happens. Clear with this? Compute how much is that capacity sales, right? And when the fixed costs are 90,000 rupees, also compute the profit at 75% capacity sales. There are two questions here. Number one, first calculate what is the total capacity sales. That's what they are asking. Number two, if the company is operating at 75% capacity sale, how much will be the profit? Two things they are asking us to find out. Now first guys, now look at this. In this question, once again what you need to do here is you need to first put up the marginal costing income statement, right? Now I'm just doing it in a rough here, but anyways it's being done. The solution is being done. Now guys, please participate along with me. Now first, what have they given? The ratio of variable cost to sales is going to be 70%. It means that my PV ratio is going to be 30%. The break-even point occurs at 60% of the capacity. First, can I calculate the break-even point? Will I be in a position to calculate the break-even point? Yes. How can I calculate the break-even point? Fixed cost I have, PV ratio I have. So now the jodis, fixed cost is always tied to my break-even point. Correct? Right? So break-even point is equal to fixed cost divided by PV ratio. We know that, right? So in this case, my break-even point is going to be how much? 90,000 rupees divided by my PV ratio of 30%. So 90,000 divided by 0.3, that gives me how much? 3 lakh rupees. Done guys. Yes, it gives me a it gives me a break-even point of 3 lakh rupees, right? Now they are saying this 3 lakh rupees is equal to 60% of my capacity, which means how much is the company's 100% capacity? So the capacity sales is going to be, if 3 lakh is going to be 60%, how much is going to be 100%, right? So divided by 60 into 100. So I can say that company has an overall capacity to sell, generate revenue worth 5 lakh rupees. Are you getting this, guys? Are you getting this? This capacity sales is not actual sales. They are saying that I have a capacity overall to sell worth 5 lakh rupees. Are you clear with this? Now the second part of the question, compute the profit when the company is operating at 75% capacity. Now their actual sales is going to be how much? 75% of 5 lakhs. How much is that? 3,75,000, correct? When I am operating at 3,75,000, how much is going to be my profit? Right? Very simple. I know that my break-even point is how much? 3 lakh rupees. And now my actual sale is how much? 3,75,000. So what is my margin of safety? Margin of safety is going to be 75,000 rupees. Correct, guys? Yes. So margin of safety into PV ratio of 30%, into PV ratio of 30%. So 75,000 into PV ratio of 30% gives me how much? 22,500. So I would say now 22,500 rupees is going to be my profit when I am operating at a 75% capacity level, which generates a revenue of 3,75,000. Guys, are you clear with this, guys? Any issues here? Or if you want, you can also prepare a marginal costing income statement. But if you do that, you need to calculate the fixed cost. And for you to calculate the fixed cost is given in the question, right? That way also it can be done. So in that case, what will happen? The sales is going to be 3,75,000, right? Into PV ratio. So 3,75,000 into 0.3, that is going to be 1,03,500. That is going to be what? That is going to be your, yes, that is going to be your contribution, right? So 3,75,000 into, one second, into 0.3. Okay, it's 3,12,500 minus 90,000 of fixed cost. You will get the same 22,500 rupees. Guys, are you all able to understand this? Guys, are you all able to understand this? Yes, right? There are multiple routes to the same destination. This is why I said, if you know the vertical and horizontal statements of marginal costing, you can play around with it like a puzzle. Right, guys? Done? Done? Shall we proceed forward? Yes, guys? Yes. Prashant, Ramya, Sheba. Yes, the others also. Priya, Bharat, and the ones online and the ones on YouTube live. Everyone, guys, you there? Shall we proceed forward? Okay, great. Fine. Now let's move on to the next one. So the fourth question, PV ratio of X Limited is 50% and the margin of safety is 40%. Now be very clear. PV ratio is calculated as contribution upon sales into 100. That is vertically. Margin of safety is done horizontally. That is, if out of the total sales made, 40% is margin of safety, right? So don't confuse the two. Place it properly. Calculate the net profit when the sales is going to be 1 lakh rupees. How will you do that? How will you do that? They have said my total sales is 1 lakh. My margin of safety is how much? 40%, which means my margin of safety in value is how much? 4 lakh into 40%. 40,000 rupees is my margin of safety. This is nothing but my profit generating sales. So 40,000 into 50% PV ratio is going to give me my profit, because margin of safety into PV ratio is going to be my profit, 20,000 rupees. Guys, are you clear with this, guys? Right?
Yes, sir.
Right? This could all be MCQs. Who knows? Who knows? This could even be MCQs. Ideally speaking, this can be an MCQ question. Clear with this, guys? Let's move on to the next one. Ascertain the profit when the sales is going to be 2 lakh rupees, the fixed cost is 40,000 and the break-even point is 1 lakh 60. So they are asking us to calculate the profit when the sale is 2 lakh, right? The fixed cost is 40,000, break-even point is 160. How will you do that? How will you do that? Can you tell me in this question, how much is the PV ratio? Please don't look at the solution. How much is the PV ratio?
25%.
25%. How did you calculate the PV ratio? Now in this question, you need to have some presence of mind. Fixed cost and the break-even point are given, right? Now make use of the marginal costing jodis, right? So your fixed cost divided by PV ratio is equal to break-even point, correct? Or in other words, PV ratio is equal to fixed cost divided by break-even point, correct? No, right? Fixed cost is how much? 40,000. Break-even point is how much? 160,000. So 40,000 divided by 160,000. In this case, my PV ratio is going to be 25%. Correct, guys? Now with this, you can calculate your profit. Sales is 2 lakh. So 2 lakh into 25 percentage gives you how much? A contribution of 50,000. 50,000 minus yes, the fixed cost of 40,000 rupees. So now you get how much? 10,000 rupees of profit. Guys, are you clear with this, guys? Are you clear with this? Look, this is exactly what I've given here as well. All the solutions are provided. It is not the solution for which you are attending the lecture. It is for the process, the thought process, the way in which the journey is all that is important. Clear with this, guys? This is how you need to look at the questions, and this is how you need to, crack it. Clear with this, guys? Done? Any issues? Shall we proceed forward? Right.
Yes,
the next one. Let's move on to the final one. Ascertain the sales when the fixed cost is 20,000, profit is 10,000, and the break-even sales is 40,000. Look at this. Calculate the sales when my fixed cost is 60,000, profit is 10,000, and the break-even sales is 40,000. Now, 1 second. I'm just erasing this off. Now, if it is mentioned like this, right? So immediately and all, you might not know what to do. That's why I keep on telling you, put it up on a statement that will lead you to the solution. Now look at this. Sales minus variable cost gives you contribution minus fixed cost gives you profit. Now what have they said? When the fixed cost is going to be 20,000, right? The profit is going to be how much? 10,000. Okay. Now they have asked us to calculate how, and the break-even sales is 40,000. They have asked us to calculate, find the sales figure. Now tell me, guys, in this position, how much is my contribution? My contribution is going to be profit plus fixed cost, the balancing figure 30,000, right? Now they have given us the break-even sales, right? They have also given us the fixed cost, correct? So with this, I can calculate the PV ratio, fixed cost divided by break-even sales, that is 20,000 divided by 40,000. 50% is my PV ratio, correct? So, or in other words, contribution divided by PV ratio can give me sales. So if I may generate sales worth 100, 50 rupees is going to be my contribution, right? So if 50 is equal to 30,000, how much is going to be my sales? Or in other words, sales into PVR is equal to contribution, correct? Or in other words, sales is equal to contribution divided by PVR. In this case, it's going to be 30,000 divided by 50%. How much you get? That's going to be 60,000 rupees. Are you clear with this, guys? Are you clear with this, guys? Any issues here? And that's about this question as well. Now, this is why I keep on hammering on conceptual learning, right? Now, if you were to mug up all these charts, right, you might not even know in which sum you need to use which formula. Did we even go as per the formula? We first saw what was the question. We put it on a statement. It led us to the solution. While presenting, we did the formula, right? This is the right way of learning marginal costing. So marginal costing can either be too easy if you learn it by concept, or it will be extremely difficult if you mug up by formula. There is no middle ground here. It can either be on extremes. You can either fall in one of the category, and the choice is yours. Guys, are you all able to understand this, right? At the time when you're learning the concept, you might have felt, sir, why are you doing all these things for half an hour, 45 minutes in a revision batch? But you just see how quickly we did so many number of numerical problems. Right? Do this for all the subjects. That's what I would suggest, because it is a very smart way of cracking all the papers. Learn things conceptually. It is going to be easy for you in your exam. Your life is going to be simple, first of all. Right, guys? Done? Okay, just a minute. Is there anything else left out? Let me just see. In the basic concepts, is there anything else left out? Okay, break-even point is okay. Okay, let us also do this. Okay, there's something called as a break-even chart. That is, they might ask you, rarely test it, but if you were to plot all these things on a chart, how would it look like, right? So this is an example given. Selling price is 25, the variable cost is 10, the fixed cost is going to be 15,000 rupees, right? And they have given that the present sales is 1500 units. Draw the break-even chart and the profit volume chart. Guys, am I being audible? Is it fine? Yes, it's going on fine. Okay, right. Yes, great. Now again, so here sales minus variable cost gives you contribution minus fixed cost gives you profit. So now here we know that the selling price is 25, variable cost is 10. That gives me a contribution of 15 rupees, and the fixed cost is going to be 15,000 rupees. So now first with this we can calculate the break-even point. What is the break-even point here? Fixed cost divided by contribution per unit. 15,000 upon 15, it's going to be how much? 1000 units. Correct, guys? It's going to be 1000 units, right? So now if you were to plot this on a graph, you can see that exactly at 1000 units, what happens? Okay, so I'll tell you what to do here. So here what happens? Now there will be two lines that you need to draw. One is with respect to the total revenue. The other one is with respect to the total cost. Total revenue will start from the origin. Why? If I am selling, if I'm operating at a volume of 0, my sales will be 0. Correct? Slowly as the number of units increases, what happens? Your revenue will also proportionately increase. Are you clear with this? This is a total cost line. If I am selling 0 units, still I will be incurring fixed cost. So it starts at the fixed cost and proportionately it will increase from there because of the variable element. Are you clear with this? There will be a point where my total revenue is equal to total cost. That point is called as my break-even point. That is going to be 1000 units. Less than this point, if I am operating at less than 1000 units, what will happen is my total cost will be more than my total revenue and hence it will be a loss situation. Clear with this? Right? Now the tables will change automatically. If you are operating above the break-even point, your total revenue will be more than the total cost. That will be a profit situation. Are you clear with this, guys? Right? Now the angle that gets formed here, there is an angle, no? Right? When two lines are intersecting, there is one angle that forms there, no? This angle is called as angle of incidence. Are you clear with this? It is called as angle of incidence. Suppose instead of this, suppose it was like, let's say there are two lines here, right? And these two lines were like this. That is, if the angle of incidence is wide, it means that the gap between my revenue and cost is more, which means that it is reporting a more profit. Are you clear with this? Or in other words, wider the angle of incidence, more will be your profit. Are you clear with this? Because at the end of the day, angle of incidence represents the gap between your total revenue and total cost. If the gap between the revenue and cost is more, it means you have a more margin of profit. Are you clear with this? These all could be tested as conceptual MCQs anywhere. So please catch up running notes. Mark this somewhere. Clear? In your institute study material, it runs into pages. Right? I am not saying, there's nothing wrong about it, because if I'm explaining it in a lecture, yes, I can give you an examples and right away do it. If it has to be printed, it needs to run into pages. No other option. Right? So this is what I said. This is the reason why I'm saying. In fact, institute has honestly done a very good job with respect to coming up with a good material, because the quality has drastically improved as compared to how it was before. So we need to give the credit where it's due. Yes, there are certain things like sequencing which could have been better, certain quality of examples could have been better, but still the quality of the study material as compared to what it was before has drastically improved. So that needs to be said. Anyways, guys, are you clear with this? This is about the angle of incidence. It is the angle that gets formed between which two lines? Total sales and total cost. Are you clear with this? Right, guys? Fine. That's about it. Now, if you were to plot the profits, the profit line will look like follows. Clear with this? That is, at 0 units, what will be your profit? Your profit will be equal to, you will be having a loss that will be equal to your fixed cost. Correct? I haven't sold anything. My contribution is 0 minus fixed cost gives you a profit of that is equal to a negative profit equal to the fixed cost. Correct? So it starts off here, right? And at any point you calculate one profit, you touch the two lines here, so automatically you will be getting it. And exactly at the break-even point, you can see that it cuts the origin. That is no profit, no loss. Are you clear with this, guys? You just go through it once. If at all they ask something like this, maybe you can handle it. Are you clear with this, guys? And that's about this particular break-even chart. Now, one more thing I think is the cash break-even point. I saw it somewhere. Can anyone help me out? Yes, here we go. Okay. Now, guys, one more thing. What do you mean by a break-even point? Break-even point is a point where my contribution is sufficient enough to recover my fixed cost. That's why we said it is fixed cost divided by contribution per unit. If you want it in value, it's going to be fixed cost by PV ratio. Correct, guys? Now, what do you mean by a cash break-even point? It refers to the point of sale where my contribution just recovers my cash fixed cost. So the formula is going to be cash fixed cost divided by contribution per unit. Sir, can you give us an example? Yes. Now you have fixed cost here, right? Let us say this fixed cost is going to be 1 lakh rupees. Out of this 1 lakh rupees, the cash fixed cost is 80,000. When I say cash fixed cost, it means the amount that I actually pay and incur. Example is going to be factory rent, supervisor salary, any kind of other fixed cost that involves payment of cash, right? And even depreciation, amortization are also fixed costs. Correct? Depreciation is also a fixed cost, right? Let us say depreciation is 20,000 rupees. You tell me, will I pay depreciation to a third party out of my pocket? Will I pay depreciation out of my pocket? I will not pay depreciation out of my pocket. But why I do it is because of matching concept. I use an asset for production. So I have already capitalized it to the extent I am using it. So over a period of time, I am writing it off. So though it is ideally a cost for me from a perspective of, an accrual concept, but what we are doing here is we just want to know. I'm just starting off on a business. Generally, when a person starts off on a business, they will not be too greedy to recover the entire fixed cost. They will say, tell me what is the cash fixed cost. I want to know the point where at least my contribution will recover my cash fixed cost. I don't want to recover my full fixed cost. It's enough if I recover my cash fixed cost. In that case, the cash break even point will be what? Cash fixed cost divided by what? Contribution per unit. It tells you how many units you should sell so that your contribution exactly recovers the cash fixed cost. Are you clear with this, guys? Now, at a cash break even point, will there be a profit? Will there be a loss? Or will there be a no profit, no loss? At cash break even point, will there be a profit? Will there be a loss? Or will there be a no profit, no loss? Tell me, guys. No, there will not be no profit, no loss. No profit, no loss will be there only in break even point. At the cash break even point, you have still not recovered 20,000 rupees, no? At the cash break even point, your loss will be equal to the depreciation amount. Are you clear with this? Are you clear with this, guys? At the cash break even point, you would not have recovered your non-cash fixed costs. Clear with this? So you still will be reporting a loss, that's fine, but I just want to know the point where I will just be able to recover my cash fixed costs. Clear with this, guys? These could be conceptual level MCQs. So please watch out for these things, maybe catch up running notes somewhere. Clear with this? Yes, done. And that's about the concept of break-even point and cash break-even point. So now, what are the concepts that we have done here? This is, okay, contribution PV ratio, break-even point, cash break-even point, margin of safety, CVP pairs is also done. This charts is also done. Okay. Okay, now, let us move on to another concept, an interesting concept called as, yes, volume analysis. I think I missed mentioning the name, but the illustration is here. Volume analysis. By the way, guys, honestly tell me, the ones who maybe are attending or may have not attended my regular batch, because in regular batch I list out the learning objectives at the start of every chapter. So how many of you are seeing that there are so many concepts in marginal costing? For the first time you're seeing that, okay, there are so many concepts in marginal costing, is it? Right? So you guys knew this before, like there are so many concepts in marginal costing? Because many students, as I have seen, they know a lot of concepts, but they don't know it by name. Right? So they don't know, oh, this is called as volume analysis or this is called as sensitivity analysis. Sir, if you give us some, we will be able to answer, but we didn't know that these are the names for this. Okay, so it is better to know it by concept name so that it will be easy for you to revise towards the end. That is the reason why I'm giving the name. Okay, now look at this volume analysis, what it talks of. It's a very, very favorite area personally for me, because I still remember in my, when I wrote my CA intermediate, right? I didn't learn by all these names and all this. I have classified it only, while I started my teaching thing. So I didn't know this. Actually, this came as the first question of my CA intercosting paper. First question, I was blinking what to do, but again, conceptual learning only helped me. So I just prepared some statement, tried figuring it out. But at the end of the day, fine, I was able to crack it. But again, I'm telling you, this is ideally a concept. After writing the exam only, I got to know that this has a name called volume analysis. Let me tell you what that is. Now, just a minute. I've just coined up an example. 1 second. Okay. Now, I hope you guys are catching up running notes. Are you guys doing it? Yes, good. Now, volume analysis. Guys, in exam, please don't expect the institute to mention the name of the concept and all. It never works that way. You should be able to figure out what concept they are testing in a chapter. Now, let us say, I'm again giving an example. Let us say selling price is 10, variable cost is going to be 6, fixed cost is going to be rupees 10,000. Okay, done. Now, I am preparing a marginal costing income statement for two volume levels, 5,000 units and 7,000 units. Just an example. Now, what's your marginal costing income statement? Sales minus variable cost gives you contribution minus fixed cost gives you profit. Now, so what's going to be your sales at 50,000 units level? It's going to be 5,000 units level. It's going to be 50,000. Variable cost will be 5,000 into 6. That's going to be 30,000. Your contribution is going to be 20,000 rupees here. Your fixed cost is going to be 10,000 and your profit is going to be 10,000 again. Now, suppose I'm selling 7,000 units. So my sales is going to be 70,000. My variable cost is going to be 7 into 6, 42,000. Right? And my contribution is going to be 28,000. Fixed cost remains to be 10,000. And my profit is going to be how much? My profit is going to be 18,000. Now guys, if you make an observation here, now can I say that in this case what happens? Your profit increases by how much? Your profit increases by how much? 8,000 rupees. Your profit increases by how much? 8,000 rupees. Can I say this increase in profit is purely on account of the increase in contribution? The contribution has also increased by 8,000. Why else will my profit increase? There is no change in the fixed cost in between. So if at all my profit is changing, the change in profit is always equal to the change in contribution. Agreeing with me on this? And why is my contribution changing? Because now what am I doing? Instead of selling 5,000 units, I am now selling how many units? 7,000 units. So there has been an increase in the volume by 2,000 units. Agreeing with me on this? Or in other words, can I say that 8,000 rupees, right, is nothing but the contribution generated by this extra 2,000 units? Agreeing with me, guys? Right? Or in other words, can I say the contribution per unit is equal to delta profit divided by delta units. Delta means what? Change. In this case, it is nothing but 8,000 rupees. The change in profit is nothing but the change in contribution, and that contribution is pertaining to the change in units, correct? So 8,000 rupees is the contribution pertaining to how many units? 2,000 units. So how much is the contribution per unit? 4 rupees per unit. This way also I can find out. Guys, correct? This is what we found out there itself. 10 minus 6 is 4. Suppose the per unit data and all is not given. Correct? Assume in the question they have just given you sales 5,000 units, 7,000 units. If 5,000 units is sold, the profit is 10,000. If 7,000 units is sold, the profit is 18,000. This is all they have given. Can you find out the PV ratio? Yes. Just the top figure and the bottom figure they are giving you. Sorry, can you find out the contribution per unit? Yes. How will you do it? Difference in profit is nothing but the contribution pertaining to the change in units. So my contribution per unit, one more formula is now available. That is nothing but delta profit divided by delta units. Are you clear with this, guys? Right? Suppose you want to calculate the PV ratio. How will you do it? Very simple. PV ratio is equal to delta profit divided by delta sales. Or in other words, can I say this 8,000 rupees is the contribution that got generated from the extra sales of 20,000 rupees. Correct? So can I say that 8,000 upon 20,000 into 100, that's going to be how much? 40%. Are you clear with this, guys? Right? This is called as volume analysis. So in your volume analysis, suppose in a sum, if they just give you year 1, year 2, two top figures and two bottom figures, can you end up calculating the PV ratio or the contribution per unit? Yes. Are you clear with this? Right? Here I will say the PV ratio is the delta profit divided by delta sales. I was earning a negative profit, that is a loss of 15 lakh. It has now become how much? 75 lakh, which means I have earned an extra profit of how much? Extra profit of 90 lakhs. This 90 lakhs is nothing but the contribution generated due to the incremental sale of 150 lakh. So 90 lakhs upon 150 lakhs into 100. In this case, the PV ratio is going to be 60%. Are you clear with this, guys? If they just give you the top and the bottom figures, still you can find out the PV ratios or the contribution per unit. Clear with this, guys? See now how many formulas are there for PV ratio? PV ratio is equal to contribution by sales into 100, correct? Or fixed cost divided by break-even point into 100, or profit divided by margin of safety into 100, or now we also have one more formula, delta profit divided by delta sales into 100. Clear with this, guys? You need not mug this up. The situation, based on the situation, you yourself can arrive at the formula and write it by yourself. Clear with this, guys? Done? Are you all able to understand this? Yes, you guys are able to follow this? Fine. Shall we move on to the next one? Okay, so what have they asked? Yes, now once you find out the PV ratio, now you can prepare the entire marginal costing income statement, right? So you know that the sale, take year 1 or year 2, whichever you want. So the sale is 100 lakhs. What will be the contribution? 60% on 100, 60 lakhs. They have given us the profit was how much? The profit was 15 lakhs. So the balancing figure has to be your fixed cost. Are you clear with this? Are you clear with this, guys? Yes, this way you can find out and prepare the rest of the income statement. Now for any output level, you can calculate prepare your income statement. Clear with this, guys? And that is about the concept called as volume analysis. Done with this? Are you all done with this? You guys are clear with this, right? Shall we move on to the next one? Yes, guys? Yes, done. Shall we move on to the next one? Yes, okay. Now, let's move on to the next one, which is called as sales mix, merger of plants, sensitivity analysis, indifference point. Okay, let me take up sensitivity analysis. Okay, sensitivity analysis. Now, what do you mean by sensitivity analysis? First, guys, what do you mean by sensitive? Have you might have seen this advertisement on Colgate sensitive. What do you mean by sensitive? So, while other things remaining constant, an introduction of a change in one variable impacting the others is called as sensitivity. That is, you would have seen advertisements where they will eat one ice cream and they will say like it really becomes very difficult for them to that the way your teeth responds to it, right? That is called as sensitivity. Similarly, even in marginal costing, we are going to see how a change in a variable is going to impact the other components, right? Now, if you see in this chapter as of now, what we have learned, what is marginal costing all about? We are just playing around with 4 numbers. What are those 4 numbers? You have selling price per unit, you have variable cost per unit, you have fixed cost in total, and you will be having volume, right? Yes, guys, right? Actually seeing till now, your marginal costing is nothing but we have 4 input figures. Selling price per unit, variable cost per unit, fixed cost in total, and volume, right? Now, how these 4 inputs will impact my profit is the study of marginal costing. Correct, guys? To put it in short, right? How these 4 inputs, change in these 4 inputs is impacting my profit is what we have been seeing in marginal costing. You take any of the sum, these are all the figures that we have been seeing. So, but what we are doing is, we are seeing how these 4 figures will impact my profit. So, to understand the study, we are having some tools called as PV ratio, right? You have this break-even point and you have this margin of safety. So to put it short, your marginal costing is nothing but the study of how these four variables impact the profit through the tools called as PV ratio, break-even point, and margin of safety. This is all the study of marginal costing. Clear with this, guys? Clear with this? Now, what is sensitivity analysis saying? Now, suppose I am slightly increasing my selling price while keeping the other factors unchanged. How is it going to impact my profit? Or suppose I'm slightly decreasing my variable cost while keeping the other three input factors unchanged. How is it going to impact my profit? Right? Or in other words, the sensitivity analysis talks about how a change in one variable while keeping the other constant is going to impact my profit through the PV ratio, break-even point, and margin of safety is called as the study of sensitivity analysis. Clear with this, guys? Clear with this, guys? Right? That is about the concept of sensitivity analysis. Now, how and all we will just be seeing right now. Now, I always get reminded of this sensitivity analysis. The moment I say sensitivity analysis, I get reminded of one student who, so in just like how I told you guys that, this Colgate sensitive advertisement and all. So by mistake, I thought of that Colgate active salt, that advertisement is there, no? So I told one madam will immediately break open the wall. She will come and she will ask, do you have your toothpaste and all? By mistake, I said that madam was Kajal Agarwal. That guy said, no sir, now it's Samantha. How can you say Kajal Agarwal? No? I said, they evlo highlights ra irukidala idella vittittu idha paakranga nanu. But see, our students are always on the top of all the current affairs. Okay, right. Coming back here, guys. So sensitivity analysis. Now, sensitivity analysis. Now, I told you that it is a study of how a change in one variable is going to impact your profit through these three tools called as PVR, break-even point, and margin of safety. Now, guys, you all participate and I want your interaction on this. Now, what we're going to do here is, first, let me just put it up here. The three tools, PVR, break-even point, and margin of safety. Right? Now, first, let me talk about the selling price. First, let me talk about the selling price. Let us say I am increasing my selling price while the other factors remaining constant. I am just increasing my selling price. Let us take an example. Let's say presently my selling price is 10. Variable cost is going to be 6. My contribution per unit is going to be 4. Right? And let's say the fixed cost is currently going to be 10,000. Correct? Just an example, guys. Right? Now, while other aspects remaining to be constant, and let us say the volume is how much you want the volume? Let's say it's 1 lakh. Okay, right. Now guys, now what happens? Let us say while the other factors remaining constant, I am slightly increasing my selling price. Now what will happen to the PV ratio? Now the selling price alone I'm changing. Instead of 10, let us say it becomes 12. Okay, right? So now what? The variable cost continues to remain 6. My contribution becomes how much? 6 rupees now. Correct? Now what happens to my PV ratio? Earlier my PV ratio was 4 upon 10 into 100, 40%. An increase in your selling price while the other things remaining constant will obviously increase your contribution per unit, and hence your PV ratio will also increase. Correct, guys? Right? So obviously my PV ratio will increase. Correct? Right? Now what happens to my break-even point? Earlier every unit was generating 4 rupees, right? Now every unit is generating 6 rupees. So now you tell me, logically speaking, it will take lesser time for me to recover my entire fixed cost. Agreeing with me on this? So obviously my break-even point will go down. Correct? Now I am not changing anything else. The volume also continues to remain the same. Now what happens to your margin of safety? So volume is the same, right? But my break-even point has come down. So now the balancing figure will obviously increase. My margin of safety will increase. And when my margin of safety increases, my profit will increase. Are you clear with this? Because margin of safety after all is nothing but your profit generating sales. Clear with this, guys? Clear with this, guys? Now you are able to understand what is sensitivity analysis. A change in one variable impacting my profit through these three tools is called as sensitivity analysis. Similarly, if I'm reducing my selling price, what will happen? Instead of 10, let us say it is now 8. This continues to be 6. My contribution per unit becomes how much? 2 rupees. So 2 upon 8 into 100, that's going to be how much? 25%. Or in other words, my PV ratio will fall down. Correct? Now, since the contribution per unit has reduced, it takes more time for me to recover my fixed cost. My break-even point will increase. Volume is same. Now, break-even point is more, which means the balancing figure is going to be less. My margin of safety will increase, and when my will decrease, and when my margin of safety decreases, my profit will also decrease. Clear with this, guys? Clear with this, guys? Now, second one, let's talk about variable costs. Suppose I'm increasing my variable cost. What will happen? So while everything else is constant, let us say I'm keeping everything else is constant. So now selling price is 10, but variable cost, instead of 6 rupees, I'm now making it as 8 rupees. What happens to my contribution? It becomes 2 rupees, correct? So PV ratio will now obviously fall, guys, correct? Right? When my PV ratio falls, now what happens? Now every unit recovers only 2 rupees of contribution. It takes more time for me to recover my fixed costs. Break-even point increases, and when my break-even point increases, the balancing figure, margin of safety, will obviously fall down, and hence there will be a fall in my profit. Guys, correct? Right? Similarly, what will happen if you decrease your variable cost? Now what happens here? Now let us say instead of 6 rupees, my variable cost is just 4 rupees. Now what happens? My contribution per unit will increase, right? This increases my PV ratio, right? Now I'm generating more contribution per unit. What happens here is, right now I will be able to recover my entire fixed cost more quickly, correct? So my break-even point will fall down, and when my break-even point falls down, the balancing figure of margin of safety will be more. An increase in margin of safety will result in a higher profit. Guys, clear with this, guys? Right? Done. Next, third one. What is the third input factor we've got? Fixed cost. Now guys, logically think and tell me, if there is an increase in the fixed cost, how will it impact my PV ratio? What will happen to the PV ratio? If my fixed cost increases, what will happen to my PV ratio? Come on, think and answer. Guys, come on, use the chat box.
Overall profit decreases.
I'm not asking about overall profit. I'm asking about the impact it has on the PVR. Exactly. Very good. Very good. So now here, your PV ratio will not get impacted. PV ratio is dependent on contribution and sales only. If directly you increase your fixed cost, that will not impact my PV ratio. I'm not saying it will not impact your profit. I'm just saying it will not impact your PV ratio. Correct? Now, how will it impact your break-even point? Will it impact your break-even point? Yes, it will. Now you have more fixed cost to recover. Right? The contribution per unit is the same. You have more fixed cost to recover. What will happen now? Your break-even point will be more. It will increase. And when your break-even point increases, the balancing figure volume will obviously decrease. Are you clear with this, guys? Right? Suppose I'm decreasing my fixed cost. Once again, no change in my PV ratio, but now I have only lesser fixed cost to recover, which means my break-even point will fall down. The balancing figure, margin of safety, will increase. Guys, clear with this? This will end up in a more profitable situation for me. Are you all able to understand this logically? Right? Now let's go on to the last one, the fourth one, volume. Now tell me, if I increase my volume, what will happen to my PV ratio? What will happen to my PV ratio? If I increase my volume, what will happen to my PV ratio? Again, no impact. You are only increasing your volume. How will it impact my PV ratio? On a per unit level, the selling price and my contribution per unit variable costs are one and the same. So it will not impact your what? It will not impact your PV ratio. What will be the impact on break-even point? What will be the impact on break-even point? Once again, no change. Very good. Why? Because break-even point is about fixed cost upon contribution per unit. Fixed cost is also not changing. My contribution components are also not changing. Now, break-even point is a point. Are you clear with this? That point is fixed. That's about it. Unless and until there is a change in your fixed cost or in your contribution per unit, this will not change. Correct? Now, as there is an increase in volume, now what will happen? Only your margin of safety will increase. Are you clear with this? That's the reason why more the volume, more the profit. Clear with this, guys? Right? Now similarly, what happens if there is a drop in the volume? Right? Now your PV ratio, there will be no impact on the PV ratio. Similarly, no impact on your break-even point. But now what happens? Your margin of safety drops, and hence your profit will also drop. Are you clear with this, guys? Are you clear with this? This study is called as sensitivity analysis. This study is called as sensitivity analysis. And remember one thing, if you make an observation here, if my PV ratio gets affected, definitely my break-even point and margin of safety will get affected. Correct? If my break-even point gets affected, definitely my margin of safety gets affected, but it need not be the case where my PVR will get affected. That is, if my break-even point is getting affected, definitely my margin of safety will get affected because it's a balancing figure. but it is not necessary to affect my PV ratio. Similarly, if my margin of safety gets affected, it is not necessary that the PV ratio and the break-even point should get affected. Are you clear with this? Are you clear with this? This is the overall conclusion that you can draw from the concept of sensitivity analysis. Are you clear with this, guys? Are you clear with this? Yes, you guys are fine with this? Yes, shall we move on to the next one? Shall we move on to the next one? Right? Yes, yes, yes. Okay, great. 1 second. I have a question here. The change in profit is equal to change. Okay, right. That's a sensitivity analysis as same in financial management. Yes, it is the same. Sensitivity analysis, the concept will always be the same. It depends on which variable and which final effect that you're talking about. In marginal costing, you're talking about the impact these 4 variables will have on your profit. Yes, in your marginal, in your financial management, in fact, in final and all, you'll be having, even in capital budgeting, we'll be having sensitivity analysis. I think even in intermediate level, to some extent, we have. Yes, the concept of sensitivity analysis is the same, right? The components which you do the sensitivity analysis alone will be different. That's about it. Fine, guys, done. Let's move on to the next one. Let's move on to the next one. Right? Any other doubt? Just a minute. Let me just take it up. Okay, fine. Right. Now let's move on to the next one. Now the next one, the next concept is about sales mix and marginal costing. Sales mix and marginal costing. Sales mix and marginal costing. Now guys, what is this? Now carefully listen. In sensitivity analysis, there is a reason why I did sensitivity analysis first and then I'm moving on to this particular sales mix immediately. In sensitivity analysis, I told you that only 4 components will impact your profit. Correct? Right? That is your selling price, variable cost, fixed cost, and your volume. Correct? These are the 4 components that will impact your profit. Any change in these 4 components alone will actually impact my profit. This is what we saw till now, guys. Yes. Now we will now see there is a 5th component that can also impact your profit, right? Sir, which means till now poi sollitengla? Have you lied to us? Not like that, right? It's a gradual learning. That's why. Okay. So there is also a 5th component that impacts your profit, that is called as sales mix. Clear with this? What do you mean by sales mix? Now, let me just take an example to tell you, to explain the concept of sales mix and also help you understand how the sales mix is going to impact your profit. Let us take an example of a company called BMW. You guys know BMW? Yes, the automobile company, right? Now, BMW is actually into the business of manufacturing cars, and they also manufacture bikes. Right? So everyone knows that they manufacture cars. Maybe some of you might not know that they manufacture bikes, but yes, they also do. Clear with this? In reality, they also do manufacture bikes, super bikes they manufacture. It will not be like normal, the price range itself will be high. Fine. Now, what happened was, now BMW, what they are saying, year 1, year 2, right? 2-year data they published. In both the years, they didn't change the selling price, they didn't change the variable cost, they didn't change the fixed cost, and in both the years, the total volume was 1 lakh units. They have sold 1 lakh units, right? So as the volume changed, volume also did not change. However, in year 1, the profit was different. In year 2, the profit was different. Why? I'm again telling you, they did not change any of these 4 components. Still, in year 1, the profit reported was different. In year 2, the profit reported was different. Now, what happened was, in year 1, I told you, that they sold 1 lakh units, right? The breakup was, they sold 60,000 cars, right? And they sold 40,000 bikes. Clear with this, guys? Whereas in year 2, what they did, They sold the same 1 lakh units only, but the internal sales mix or the composition alone changed. They sold 40,000 cars, right, and 60,000 bikes. Are you clear with this? Now you tell me everything was the same, but the internal composition alone changed. Maybe cars might be having a higher contribution per unit, right? And bikes may be having a lower contribution per unit. In year one, though the total number of units were the same, but if you see in the internal composition, in year one, they have sold more of a high profitable product. Whereas in year two, they have sold only lesser of a high profitable product. Maybe that is the reason why in year one, the profit reported might have been high, and in year two, the profit reported might have been less. Are you clear with this? Or in other words, you're not just these four factors, one more factor called as sales mix. Sales mix is nothing but the composition of the different products being sold also impacts your profitability, and the study of this is called as sales mix and marginal costing. Clear with this, guys? Right? Now, sir, how is this going to impact our profitability? Now, it is not just that, it is also how do I calculate the break-even point when the company is selling more than one product? These are all a few extra learnings that we are going to do here. Now, guys, remember one thing. This sales mix will be applicable only for companies that deals in more than one product. If the company deals in only a single product, whatever we've seen till now, that alone will stand, right? Over and above all the concepts we have learned, if a company is dealing in more than one product, 2, 3, 4, 100, whatever number of products, in that case, your sales mix concept will come into play. Are you clear with this, right? To understand the concept of sales mix better, now let us do a numerical illustration. Let us do a numerical example question. So please take the second question for classroom discussion. Please take the second question for classroom discussion. Here it is. Yes, guys, please take the second question. Shall we get started? Right. Now, the following set of information is presented to you by your client AB Limited, producing two products X and Y. So X and Y, they have given that the direct material is 20, direct labor is 6 rupees per unit for X, for Y it's 18 and 4. The fixed expenses during the period is expected to be 1600 rupees. The variable expenses are allocated to the products at the rate of 100% of direct wages. The selling price per unit of X is 40, Y is 30. The proposed sales mix, they are saying, alternate one, they are planning to sell 100 units of X, 200 units of Y, alternate 2, 150 each of X and Y, and alternative 3, 200 units of X and 100 units of Y. As a cost accountant, you are required to present the management the following. Number 1, the total contribution and profit from each of the above sales mixes. Then, number 2, the proposed sales mix to earn a profit of 300 rupees and 600 rupees when the total sale of X and Y being 300 units. Calculate the break-even point when the sales mix is 2:1. Recalculate the break-even point when the sales mix is 1:2. Now, this is about the question. Now, first, what we need to do is let us calculate the contribution per unit of each of the two products. Now, if you look at this, product X, product Y, they have given the selling price 40 and 30, correct? So, this contribution is 40 and 30. From that, reduce all the variable costs. So, you have the variable cost here, your direct material, direct wages. Apart from that, there is one direct expense also, which is equal to 100% of direct wages. So, here if you see 26, and you also have your direct expenses, which is being given, right, minus 6. So, here it's going to be every unit of X generates a contribution of 8. Similarly, every unit of Y generates a contribution of 4 rupees. Clear with this? This is the first step that we have done. That is calculation of what? The contribution that each of the products are generating. Now, what have they asked here? First, what we need to do, we need to calculate, okay, what should be the proposed sales mix to earn, okay, fine, there are three alternatives given in the question. We need to calculate the profits for each of these three alternatives, right? Now, let us do that. Calculation of profit under different sales mix. Now, suppose scenario 1, 100 units of X is being sold and 200 units of Y is being sold. Now, you tell me, guys, what will be the total contribution? 100 into 8, that will be the contribution generated by X. Similarly, 200 into 4, this will be the contribution generated by Y, correct? So the total contribution generated is going to be 1600 rupees. Now from this they have given that overall the company incurs a fixed cost of 1600 rupees. This 1600 rupees is a fixed cost that is pertaining to both the products put together. Clear with this? It's a common fixed cost. So from that you reduce your fixed cost. So now the profit is going to be 0. The profit will be 0 when I'm selling 100 units of X and 200 units of Y. Suppose in the second situation where I'm selling 150 units of X and your 150 units of Y. In this case, what will be the total contribution, right? So once again, we've got it here. So it's going to be 150 into 8 plus 150 into 4, right? That is going to be the total contribution, 1200 plus 600, which is 1800. From there, you reduce your fixed cost, you will end up with a profit of 200 rupees, right? Suppose I'm selling 200 units of X and 100 units of Y. Then multiply the same with the respective contributions per unit, 200 into 8 and 100 into 4, right? You get a total contribution of 2000 rupees. From that, subtract 1600, you will end up with a profit of 400 rupees. Clear with this, guys? If you notice here, in all the three situations, 100 plus 200, I have sold 300 units. 150 plus 150, here also 300 units. 200 plus 100, here also 300 units, right? Overall, the volume has not changed, but a change in the mix results in different profits here. So if you see in the first scenario, the profit reported was 100 rupees. The second scenario it was 200. The third scenario was 400. This way we can clearly see that a change in the sales mix can also impact your profit. Are you clear with this, guys? Are you clear with this, right? Next, what have they asked as a second one? Now, what should be the proposed sales mix to earn a profit of 300 rupees? Right, and the second scenario they've asked to earn a profit of 600 rupees, but they have given one condition: the total sales of X and Y put together should only be 300 units. So first let us calculate how many units of X and Y I need to sell in order to earn a profit of 300 rupees. Now very simple and logical calculation. Let the number of units of X be X, so which means the number of units of Y is going to be 300 minus X, because they've given us a condition that number of units of X plus number of units of Y has to be 300. So if you keep this as X, Y has to be 300 minus X, correct? So now the total contribution will be how much? 8X, that is every unit of X generates a contribution of 8 rupees and every unit of Y generates a contribution of 4. So 4 into 300 minus X, we are replacing Y as 300 minus X, right? So this is going to be the total required contribution minus my fixed cost of 1600 should be equal to 300 rupees. With this, we can frame an equation. So we can arrive at the fact that it is going to be 4x is equal to 700 rupees. So now how much is my X value is equal to, I think they have done a mistake here. Just a minute, guys. It's going to be 700 divided by 4, right? So it's going to be 175, right? This is not 1754. Right, it is going to be 175. Are you clear with this? So now with this, we have calculated that I need to sell 175 units of X. Obviously, Y is going to be 300 minus 175, 125 units. So when the company sells 175 units of X and 125 units of Y, they will end up making a profit of 300 rupees. Are you clear with this, guys? Are you clear with this, right? So easily we can find out how many units of X and Y respectively need to be sold in order to earn the required amount of profit. Done, right? Now moving on to the next one which they have asked for. Suppose the company wants to earn a profit of 600 rupees. How many units of X and Y needs to be sold? Once again, you frame the same equation: 8x plus 4 into 300 minus X minus of the fixed cost of 1600 should give you a profit of 600 rupees. Frame the equation. Now you will get the X value as 250 units. The Y value is going to be 300 minus 250. It's going to be 50 units. So when the company sells 250 units of X and 50 units of Y, they will end up making a profit of 600 rupees. Are you clear with this? Right? That's about this particular segment. Now coming to the most important part, calculation of the break-even point. This is where this entire, the crux of the matter lies here with respect to the calculation of break-even point. When the sales mix is 2:1. Now guys, now you tell me what is the issue here. You tell me what is the issue here. Now, let me write it up. I have two products, X and Y. Product X generates a contribution of how much? It generates a contribution of 8 rupees and product Y generates a contribution of 4 rupees, right? And I have a common fixed cost of rupees 1600 to be recovered. Guys, correct now? Yes. Guys, yes, you there? Guys, there?
Yes, sir.
Right. Now, what happens is, generally, we know that your break-even point is nothing but fixed cost divided by contribution per unit. Correct? Now, fixed cost, I know it's 1600. Now, contribution per unit, which one should I take? Should I take 8 or should I take 4 or should I take both? Right? This is where the case becomes little interesting when it comes to your sales mix. Now, basically, you tell me, guys, logically, you tell me, this 1600 rupees of fixed cost is being incurred not only for selling units of X, it is also towards units of Y, correct? Right? And what do you mean by a break-even point? A break-even point is a point of sale where I generate a contribution that is sufficient enough to recover my fixed costs. Now, this 1600 rupees should be recovered not just by any one of the two products. These two products should jointly go on to generate a contribution that is sufficient enough to recover my 1600 rupees. Agreeing with me on this? Agreeing with me on this? So here the contribution per unit is neither X nor Y. It needs to be a weighted contribution per unit. Are you clear with this? What is the meaning of weighted contribution per unit? They have given in this question that the sales will always be in the ratio of 2:1. Correct, guys? It will always be in the ratio of 2:1. Or in other words, every time I sell 3 units, if you see, 2 units will be X, 1 unit will be Y. This is the meaning, no? Guys, correct? Right? Every unit of X generates a contribution of how much? 8 rupee. Every unit of Y generates a contribution of how much? 4 rupees. So if you multiply this here, 8 into 2 is 16, 4 into 1 is 4. Totally, I end up generating a contribution of 20 rupees for every 3 units being sold. So representatively, the contribution per unit is going to be how much? 20 upon 3, it is going to be 6.6666 or 6.67. Are you clear with this, guys? This is the reason why here, when it comes to sales mix, we don't say it's fixed cost by contribution per unit. We use an additional word and call it as fixed cost divided by weighted contribution per unit. Are you clear with this? And how will you calculate the weighted contribution per unit? It is nothing but the contribution of a particular product multiplied by its weights. This calculation, this is nothing but, can I say this is 8 into 2 by 3 plus 4 into 1 by 3. Correct, guys? This is what we did here. Basically, we did 8 into 2 plus 4 into 1, the whole divided by 3. That only we are writing it like this. Or not, this is nothing but the contribution per unit into weights of each of the products. Are you clear with this, guys? If you do this, you get the weighted contribution per unit, and now with this you can calculate the break-even point. How do we do it? Let me just walk you through here. Now in this case, you look at it here. If you see, the weighted contribution per unit is going to be how much? 6.667. correct? Right? So now my break-even point is going to be fixed cost divided by weighted contribution per unit. So now please do not round it off, retain the decimals in your calculator, that is 6.66666666, right? So if you say 1600 divided by 6.66666666, right, you will get exactly 240 units. So what does it mean? I need to sell 240 units, right, to exactly recover my fixed cost. I need to sell 240 units of X or Y or both. I need to sell 240 units of both. So this 240 units of both means in what ratio? The mix is given. So this should always be in the ratio of 2:1. Are you clear with this? So out of this 240, 2/3 will be X units and 1/3 will be Y units. With that, you can calculate how many units of X and how many units of Y needs to be sold. Are you clear with this? Or in other words, in this case, first you calculate the break-even point by taking fixed cost by weighted contribution per unit. You will get the total number of units required to be sold. Multiply this with the mix or the weight of the product. You will get the product-wise break-even point. Are you clear with this? If I sell exactly 160 units of X and 80 units of Y, I will be in a position to break even. Are you clear with this, guys? Are you able to understand? Are you able to understand? Right? So when you have a mix of products, what is the formula to calculate your break-even point? Your break-even point is going to be fixed cost divided by weighted contribution per unit. Clear with this? Suppose you want to calculate the break-even point in values, what will you do? It is going to be fixed cost divided by weighted PV ratio. Are you clear with this? Take the PV ratio of the respective products and multiply it with what? Multiply it with the weights. Are you clear with this? That's called as a weighted PV ratio. Are you all able to understand, guys? Suppose what will happen if the sales mix is changed to 1:2? Once again, calculate the weighted contribution per unit. 8 into 1 by 3 plus 4 into 2 by 3. So this is what you get as your weighted contribution per unit. Fixed cost divided by weighted contribution per unit. So now you arrive at 300 units. Are you clear with this? So only if you sell 300 units, you will be able to recover your entire fixed cost. 300 units of what? X or Y or both? 300 units of both, right? Break it up and arrive at each and every component. So which means if I sell 100 units of X and 200 units of Y, I will be able to generate a contribution that exactly recovers my common fixed cost. Are you clear with this, guys? Right? You are all able to understand this. You are all able to understand this. This is how you need to calculate break-even points when a company is dealing in more than one products. Are you clear with this, guys? Right? I think this has been mentioned on the top here as a concept. Let me just walk you through that. Just a second. Where is it? Where is it? Where is it? 1 second. I think it's gone. Just a minute, guys. Yes, look at this. The overall break-even sales is going to be what? If the quantity mix is known, I will say it is sales quantity into your weighted contribution per unit. Or in other words, how do you do it is your fixed cost divided by weighted contribution per unit. If the sales value mix is known, you will divide the same by. You will take the fixed cost divided by weighted PVR. Are you clear with this, guys? Are you clear with this? Right? So the contribution value has to be how much? Quantity, the sales, if it is in units, you multiply it with weighted contribution per unit. If it is in value, multiply it with weighted PVR. Are you clear with this, guys? Right? This is what we have seen in the previous question that we just finished right now. Fine, guys. Done. Right? With that, the second sum is also over. Okay. Done. So now, what are the concepts left out? Okay. Let me also do this. Merger of plants. Okay, what do you mean by merger of plants? What do you mean by merger of plants? Now, guys, simple. Let's say I have a plant A and I have a plant B. Now I want to combine these two plants. Let us say these two plants are adjacent, right? There is a wall in between. Now I'm just removing the wall and making this into one, right? I'm merging two plants together, right? When I merge two plants, right, how will you apply the concepts of marginal costing? Nothing great, nothing great. You will think that, so this is nothing, sir. Plant 1 plus plant 2 is going to be equal to the merged plant, right? Use the figures and calculate. Prepare an income statement for the combined sales, combined variable cost, combined contribution, combined fixed cost and all. With that, you can do it. Absolutely correct. But in these questions, only one thing needs to be watched out for. Suppose they would have given the volume data, and they would have mentioned that the plant A is working at 60% capacity, right? Let us say plant B is working at 80% capacity. Now you should always be careful. What you need to do is convert both the plants into 100% capacity, right? And then you add it up. Clear with this? Because 60% capacity of plant A and 80% capacity of plant B can't be added as such, because presently they are working at the 60% and 80% capacity respectively. When you are merging, what is totally available is 100% capacity. So you convert everything into 100% and then apply the concepts of marginal costing for the merged plant at 100% capacity. Clear with this, guys? An example is given here. Look at this. Company A is presently operating at a capacity of 60%, and at 60% capacity level, they are generating sales of 300 crores or 300 lakhs or whatever it is, right? The VC ratio is 50%, which means the PV ratio is how much? 50%, right? And the fixed cost is 30 crores. Similarly, company B is operating at 90% capacity level with a sales of 540 crores, right? The VC ratio is 70%, which means the PV ratio is 30% and the fixed cost is 75. Now, when I am merging the two, I can't say, okay, company A plus company B, merged plant, sales is going to be 300 plus 540, so it is going to be 840. No, please do not do that. What you need to do, first convert both into 100%, because when two plants are merging, obviously what is getting merged is 100% capacity, right? Once you convert that, then you decide what needs to be your activity level of the merged firm. That is different. But when you're merging, you merge it at 100%. So now this is 300, convert it into 100%. How will you do that? If 300 is 60, how much is 100, right? So the merged, the sales value at 100% capacity level of A is going to be 500. Similarly for B, it's going to be 540 divided by 90 into 100. That's going to be 600. Add the two. Now, if I'm merging these two firms, the total capacity sale is going to be how much? 1100. Similarly, they have given that the VC ratio is 50%. So here, obviously, apply this 50% on the 100% capacity level. So 50% of 500 is 250. Here it's going to be 70%. 70% on 600 is going to be 420, right? Add the two, you will get how much? 670, right? Now you get the contribution of the merged firm. Are you clear with this? So now you can say that the merged firm's PV ratio is going to be 430 divided by 1100. It's going to be 39.09%. Are you clear with this, guys? Are you clear with this? Now, fixed cost, don't do the same thing for fixed cost also. Don't say, fixed cost is going to be 30 divided by 60%. No, fixed cost remains constant irrespective of your activity level. So, fixed costs are addable as such. Correct, no, guys? This 30 crores of fixed cost, what they have given here, whether this company operates at 60% capacity or it operates at 100% capacity, it will continue to be 30 only. That is the concept of fixed costs. If you say this is also 30 divided by 60 into 100, then you're treating fixed cost as variable cost. Are you clear with this? So fixed cost can be addable as such because they are not dependent on the capacity or the output level. So now what will I say? The fixed cost of the merged firm is 30 plus 75. How much is this? 105. Are you clear with this? So the break-even point of the merged firm is going to be your 105 crores, the total combined fixed cost divided by the PVR of the merged firm. So now I will say, look, I need to generate sales worth 268.61 lakh rupees in order to break even. Are you clear with this? This is post the merger. Are you clear with this, guys? Right? You guys are able to follow this, right? Next, one more thing. What is the sales required in the merged firm to earn a profit of 20 lakhs? Simple. So the required contribution will now be 20 lakhs plus 105 lakhs, right? So the required contribution divided by, take up the PV ratio of 39.9%, 39.09%, you will get the required sales to earn a profit of 20 lakh rupees. The remaining part are all similar to the basic concepts. The only thing that you need to know here is when you're merging two firms, convert both the firms into 100% capacity and then merge it. Clear with this, guys? Are you all clear with this, right? Yes, please respond, guys. Use the chat box. Are you guys there? The whole point of having a live session is only for that. Done, right? Fine. So sensitivity analysis is also done. Merger of plants is also done. Okay, so now we are left with a few more concepts. Just a minute. Let us just go and take the scoreboard. So this is done. This is also done. Okay, so I think we are just left with 3 more areas in this one, in this particular CVP analysis, and apart from that, we've also got something to do in absorption costing versus marginal costing, right? Done, not a problem. So now, guys, can we take a small break now, and we'll just come back and finish off the remaining part of the chapter? Yes, you guys want a break now?
Yes, sir.
Right? Okay, it's been about 2 hours plus. So yes, we'll take a break right now. Maybe we'll meet back at at 10:45 works, right? About 15 minutes break. Okay, great. Now let's move on to the next concept called as indifference point. Right, so now we are left with 3 concepts plus 1. So overall 4 concepts. We'll be doing it right away. So the next one is the concept of indifference point. Just a minute. Right. Now, what is this concept of indifference point all about? I'm using a short form, IDP. Now, Now guys, right now we all have this, you all must be using this Geo SIM, right? But before 2016, that was before when Geo, entered the market with a bank. Now we all had the other players, like there were so many players, like Aircel, Uninor, there were so many players. And there was always one, decision that we all had to take in our real day, everyday life. So that was regarding prepaid versus postpaid. Now we don't have this decision to be taken because anyways, though we all go for a prepaid plan, it's all unlimited calls and all that. But back then, these guys were looting us literally. They used to charge hefty amount, and they say we are complimentarily giving you 750 MB per month, it seems. So now we use about 2 GB per day. So that's what they used to do quite a while back. That was before 2016 when Jio entered the market. Now guys, using this example of a prepaid versus postpaid SIM, we can understand the concept of indifference point, and let's see what it says. Now, in prepaid SIM, generally what happens is, now they will say per call you need to pay how much? 50 pice. An example I'm saying. They will say per call, or let's say per minute of talk time, you need to pay 50 pice, right? And since we are giving you that SIM card and we are blocking the number for you, that is, they are giving you the mobile number. So the SIM usage charges monthly is going to be 100 rupees. Or in other words, here the variable cost is going to be 50 pice and the fixed cost is going to be 100. Whereas if you go for a postpaid plan, what they will say is, look, it's a postpaid plan. That is, you can talk for how many number of hours you want. It's fine. At the end of the month, we will prepare a bill and we will give you, right? So what happens here is per minute, they will charge us, let us say 30 pice, right? That's 0.3 rupees. Okay. And they will say monthly rentals for us is going to be 500 rupees. Generally what happens in a postpaid plan, if you see, they will have a monthly fixed charges, right, which is slightly higher, and they will be having a lower cost per every minute of talk time. This is how it used to be. And of course, in the prepaid, if you see, the fixed cost will be less, right? But every time you make a phone call, the charges will be high. Now, you tell me guys, out of prepaid or postpaid, which one is better? Out of prepaid or postpaid, which one is better? Now, there is no one such answer, a flat blanket answer saying always prepaid is better or always postpaid is better. Had that been the case, then there would have been only one plan. They wouldn't be having two plans, fully aware of the fact that always one plan is better than the other. Now, sir, how are you saying that, we can't come to a conclusion like that? Because both the alternatives have one disadvantage and one disadvantage. In case of a prepaid plan, the advantage is by way of a lower fixed cost. Whereas in case of a postpaid plan, the advantage is by way of a lower variable cost. Clear with this, guys? So now imagine you are a person who is a missed call party, right? So that is, you will not call anyone. Now suddenly after Jio, everyone started becoming generous. They didn't become generous. That is because of unlimited talk time now being available. But before, let us say you are a missed call party, you don't want to spend much, but you need to have a mobile number for sure. Which one will you prefer? You will only prefer prepaid. Why? Because anyways, you are not going to make much calls, right? You just need to have a number. You will go for that option that gives you a lower fixed cost. Correct, guys? Yes, the reason is that, anyway your volume is less. Correct? The number of phone calls you will make is less. If at all once in a while I make a phone call, it is okay. I am ready to pay some 0.5 rupees instead of 30 pice. I'm ready to pay 50 pice. That is fine. But I will not be ready to commit a higher fixed cost. 500 rupees and all, I will not be ready. I will obviously go for the option that has a lower fixed cost. Correct? Suppose you are a businessman, you need to make a lot of phone calls necessary. Now, predominantly since your volume is higher, your overall cost will be having more of a variable component. So you will be driven by that alternative that gives you a lower variable cost. So now in this case, it makes sense to go for a postpaid plan. Or in other words, to put it simple, when your volume is less, it is always better to go for that option that has a lower fixed cost. And when your volume is high, it is always preferable to go for that option that has a lower variable cost per unit. But there will be exactly one point where both the alternatives will give you the same result, and that point is called as an indifference point. You are not being different to the both alternatives. It's called as an indifference point. Are you clear with this? Right? Are you clear with this? So the point, again, the point here is what? The point of volume, the point of sale, where both the alternatives will give me the same cost, right, is called as my indifference point. Now, how do you calculate the indifference point? Very simple. I need to find out at what point of volume both the alternatives will give me the same cost. Let the volume be X. We need to calculate X only right now. So, alternative 1's total cost will be how much? 0.5X plus 100, correct? It should be equal to 0.3X plus 500. Yes, guys, right? So now this is going to be 0.5x minus 0.3x. I am bringing this to the LHS and taking this forward to the RHS is equal to 500 minus 100, correct? Right? Or in other words, I will take x common out here and say x the whole into 0.5 minus 0.3 is equal to 500 minus 100. Or in other words, x is equal to 500 minus 100 divided by 0.5 minus 0.3. This is nothing but 400 divided by 0.2. How much is 400 divided by 0.2? That is going to be 2000. Are you clear with this? 2000 units, or in this case, I will say 2000 calls. If you are a person who knows that in a month you will definitely make 2000 phone calls, right? If you're exactly making 2000 phone calls, whether you go for a prepaid plan or you go for a postpaid plan, your final bill amount will be the same. But if you are planning to make a number of phone calls which is less than 2000 numbers, which is less than 2000 phone calls, in that case, it is preferable to go for prepaid because it has a lower fixed cost. No, sir, I'm a businessman, I'm going to make more than 2000 calls. Now, predominantly, your total cost will be driven by variable cost. So, you go for that option that gives you a lower variable cost per unit. Are you clear with this? Or in other words, how this indifference point concept helps us is, so there is an indifference point in this case, which is 2000 units. Right? In this case, it's a phone call. Suppose let's say a company is manufacturing, they have two alternative ways of production, right? Which alternative should I go for? Using both, let's say machine 1, machine 2, right? One machine has a higher fixed cost, lower variable cost. Another machine has a lower fixed cost, higher variable cost, as the case may be. Now, in this case, which machine should I use for production? First, you calculate the indifference point, right? If your planned volume is less than your indifference point, go for that option that has a lower fixed cost. And if your planned volume is more than your indifference point, go for that option that has a higher, again, talk in terms of advantage. So that has a lower variable cost per unit. Are you clear with this, guys? And at exactly the break-even point, whether I go for alternative 1 or I go for alternative 2, I will end up getting the same result. And this is the concept of indifference point. Clear with this, guys? So how do you calculate indifference point? If you look at this, it is nothing but difference in fixed costs divided by difference in variable cost per unit. Are you clear with this, guys? Are you clear with this? So your indifference point formula calculation is going to be difference in fixed cost divided by difference in variable cost per unit. Are you clear with this, guys? Done? You guys are able to understand this? You guys are able to understand this? Now, let me just add up one more, let me just continue with this example. Let us say we are running a call center. Okay. Let us say we are running a call center. Now, in this call center, so what is the work of a call center? Basically, a bank will hire a call center. They will say in a month, you need to call and disturb so many number of customers. Correct? So that's why we keep getting a lot of phone calls for all these loans, credit cards and all that. Why are they doing? Are they doing it because they like you or they want to talk to you? Absolutely no. They have targets. Correct? So that is the reason why they do it. Now, let us say a bank has approached us. We are running a a call center. They are saying, look, for every call you make, I am going to pay you 1 rupee. For every call you make, I am going to make you 1 rupee. Now you tell me, guys, Will the bank be bothered whether I use a prepaid SIM or a postpaid SIM? No. The bank is not going to get bothered whether I use a prepaid SIM or a postpaid SIM. Correct? Now, what happens if I use a prepaid SIM, if I use a postpaid SIM, right? The scenario will be as follows. The selling price will be 1 rupee. That is from the perspective of the call center. It anyways will get 1 rupee. Correct? No? Whether I use a prepaid SIM or a postpaid SIM, per call I will get 1 rupee. Who will pay me? The bank will pay me. Correct? Right? Minus variable costs. If I use a prepaid SIM, my variable cost is going to be how much? 0.5 rupees. Whereas if I use a postpaid SIM, my variable cost is going to be how much? 0.3 rupees. Correct, guys? Yes. Now, what's going to be my contribution per unit? My contribution per unit or per phone call is going to be 0.5 if I use a prepaid SIM, and it's going to be 0.7 if I use a postpaid SIM. Correct? Now, what will be the fixed cost? The fixed cost will be, if I use a prepaid SIM, it's going to be 100. If I use a postpaid SIM, it's going to be 500. Clear with this, guys? Now, in this case, now, what is the indifference point? Indifference point is the point, right, where both the alternatives will give me the same amount of profit. Correct, guys? Indifference point is that point where both the alternatives will give me the same amount of profit, right? The results could be either calculated as a cost or the results can be calculated from the profit angle. Correct, guys? So now, at what point of sale, or in other words, how many phone calls should I exactly make so that whether I use a prepaid SIM or I use a postpaid SIM, both will give me the same profit. So now I need to calculate the X value, which is nothing but the indifference point. Can I say the profit generated by a prepaid SIM is going to be 0.5x minus 100 rupees. Correct? Yes, guys. Right? Minus 100 rupees. Similarly, this will be equal to the postpaid's profit is going to be 0.7x minus 500 rupees, right? The profit is going to be contribution minus fixed cost. Guys, correct? Or in other words, can I say this is nothing but 0.5? Okay. So let me just bring it up here. So this is going to be 500 minus rupees 100 is going to be equal to 0.7x minus 0.5x. Correct? Right? Or in other words, again, so here I will just take x out in common and say it's 0.7 minus 0.5 is equal to rupees 500 minus rupees 100, or here x is equal to rupees 500 minus rupees 100 divided by 0.7 minus 0.5. So this is going to be rupees 400 divided by 0.2. So how much is 400 divided by 0.2? It's again, that's going to be how much? Same 2000. Are you clear with this? So exactly if I am planning to make 2000 phone calls, that is at the indifference point of 2000 phone calls, right? Whether I use a prepaid SIM or I use a postpaid SIM, both alternatives will give me the same amount of profit. Clear with this? Suppose I am planning to make a lesser phone call, a lesser number of phone calls, that is if my volume is lesser than the indifference point, then what you need to do, you go for that option that gives you a lower fixed cost. Clear with this? Suppose you are planning for a volume which is more than the indifference point, you go for that option that gives you a higher contribution per unit. Lower variable cost means what? Higher contribution per unit only, no? Are you clear with this, guys? Right? It gives me a higher contribution per unit. Are you clear with this? Or in other words, I can also say that my indifference point calculation is nothing but difference in fixed cost divided by difference in contribution per unit. Agreeing with me on this? Because the difference in contribution per unit is purely nothing but happening because of difference in variable cost per unit only. Are you clear with this? In both the scenarios, the selling price is the same. Still, why am I having a different contribution? It is because of the change in variable cost. So the difference in variable cost is equal to the difference in contribution. Are you clear with this, guys? So in this case, can I say that indifference point is nothing but difference in fixed cost divided by difference in variable cost per unit, or I can also say it is difference in fixed cost divided by difference in contribution per unit. Are you clear with this, guys? Are you all able to understand? Right? Indifference point means what? It is a point of sale. Clear? At which two alternatives are giving me the same result. Right? Clear with this, guys? Now, since it is a point of sale, this can also be expressed in value. Correct? If I want to express in units, I do it like this. If I want to express in value, what will I do? Instead of variable cost per unit, I will use VC ratio. Instead of contribution per unit in the denominator, I will use PV ratio. That's about it. So it will be difference in fixed cost divided by difference in VC ratio, or it is difference in fixed cost divided by difference in PV ratio. Are you clear with this? Now, what am I going to do? Why do I need an indifference point? Only if you calculate an indifference point, right, you will know when to choose which alternative. If the volume level is going to be lesser than the indifference point, always go for that option that gives you a lower fixed cost. If the desired volume is going to be greater than the indifference point, always go for that option that gives you a lower variable cost, or you can, in other words, you can say a higher contribution per unit. Are you clear with this, guys? Right? In your everyday life, you can use the concepts of indifference point. Now, another real life example for indifference point would be, right, in your everyday life, you can maybe help your parents with this, whether to buy a water can or whether to buy an aqua guard and keep it. If you buy an aqua guard, the fixed cost will be high. You will not be having any variable cost, because anyways you take the water from the tap. Correct? Whereas on the contrary, if you are buying a water can, right, the variable cost will be high. Every time you buy a can, you need to pay him 30-40 rupees, whatever it is. Right? Whereas the fixed cost might not be much. So now, when will you go for which alternative? Depends on the water consumption in your house. If you are a joint family, it makes sense to buy an aqua guard. If you are a nuclear family, it really makes sense to buy a water can, because the consumption will be relatively less. These kind of practicalities you can apply in your everyday life as well, and that is about the concept of indifference point. Now clearly understand, guys, the concept of indifference point comes into picture only when I am evaluating two different alternatives. Do not mistake your indifference point as break-even point. Break-even point, I need not have two alternatives. Break-even point is given a fact, given a particular product's income earning capacity, like sales, contribution and all. For this, when will I recover my fixed cost? That's all. There is not much of comparison between another alternative. The concept of indifference point will kick in only when I need to evaluate between two alternatives and take the best one out of it. Are you clear with this, guys? Right? Yes, you guys are clear with this. Please use the chat box. Just tell me if you guys are understanding this. We'll proceed to the next one. And let's see, is that about the number of questions we've got here? Yes, I think that's about this particular concept as well. Okay. So now look at this. This is what we have mentioned here. You can just be, you can just go through it once. That's about the concept. It's nothing but your change in fixed cost divided by change in variable cost per unit, or in other words, it's change in fixed cost divided by change in contribution per unit. And if your expected volume is exactly at the indifference point, you can go for any option. Less than your indifference point, you should always go for the lower fixed cost option. If your volume is expected to be greater than the indifference point, go for the option that has a low variable costs, or in other words, I can say a high contribution per unit. Are you clear with this, guys? Right? And that's about this particular concept of indifference point. See, this is what they are saying. Right? At the indifference point, the two alternatives are better. Right? Two alternatives will give you the same result. Below the indifference point, if you see, one alternative is better than the other. Beyond the indifference point, the second alternative is greater than the first one. Clear with this, guys? And that's about the concept of indifference point. And I think, yes, they have given one example as well. Let's quickly do this. Now, let's say I can carry out the production either using machine 1 or machine 2. Right? If I use machine 1, the fixed cost is 1 lakh, but the variable cost is 5 rupees. If I go for machine 2, the fixed cost is 60,000 only, but the variable cost is more, 9. Now, which machine is better? Now, I can't come to a conclusion on the face of it, because machine 1 has an advantage of a lower variable cost, whereas a machine 2 has an advantage of a lower fixed cost. Both the alternatives are having one advantage and one disadvantage. Only then, the concept of indifference point will kick in. If let's say only one option has all the advantages, then I need not even take a decision. I will only go for that. Are you clear with this, guys? Right? So now in this case, what happens, right? Find the indifference point and recommend the range of activity where one machine is better than the other and suggest which one to buy if the production is 12,000 units. So now what do? The cost indifference point is going to be the difference in fixed cost divided by difference in variable cost per unit. So here the difference in fixed cost is 40,000, difference in variable cost per unit is 4. So 40,000 by 4, it's going to be 10,000 units. So now what will I do? If my desired volume is exactly 10,000 units, whether I use machine 1 or I use machine 2 for production, it's going to give me the same total amount of cost, correct? If my desired volume is less than 10,000 units level, then here I should go for that alternative that has a lower fixed cost. That is, I will go for machine 2, correct? And if my desired output level is greater than my 10,000 units level, the indifference point, now it makes sense only to go for that option that gives me a lower variable cost per unit. Are you clear with this, guys? This is the reason why if you see startups, what they do is they don't invest huge amount in fixed cost. If you look at small companies which are just starting up, at the beginning stages, they will not buy any office space. They will take it on rent because they don't want to commit a huge fixed amount. The moment they grow big, now they buy multiple properties and keep, because now their volume is increased. They will be heavily driven by variable cost. Now they can't afford a high variable cost. They are fine with a high fixed cost. That's when they will end up buying properties for themselves. Clear with this, guys? These are some real life scenarios where indifference point can also be used. Done, guys? And that's about this particular segment. Look at this. If the expected level is greater than 10,000 units, so you go for what? M1. And if it is less than 10,000 units, go for M2. And exactly at 10,000 units, you use any machine. And to answer the second part of the question, so if my expected volume is 12,000 units, it's beyond 10,000, so I will go for the first machine, right? Go for M1. Clear with this, guys? And that is about the concept called as indifference point. Clear with this? Shall we move on to the next one? Guys? Yes. Okay. Now, next one is a concept called as shutdown point. Now this concept again is an extension of indifference point, but it's slightly different, and let me tell you what it is. So this area is also known as shutdown or continue decision. Shutdown or continue decision. Now, what does this concept talk about? I mean, what are we going to learn in this particular concept? Now, let's say I am running a company and it's super successful. It is super successful, not at all a problem. Suddenly, COVID came. Suddenly, a temporary feature is hindering my business. Okay, a temporary feature is hindering my business. Now the government has announced a lockdown, let us say for the next 3 months. Okay, now what happens? The decision that we are going to take here is there is going to be a temporary downfall in the market, right? A temporary downfall in the market. Now, during this 3 months, I know that before this period, my business is running fine. After this 3 months also, my business is going to run super fine. I don't have a problem with that. But I know that there is going to be a temporary hindrance in my business. Now, during this time, I know that the market is going to be dull. The decision that we are going to take here is, should I shut down my business temporarily for the next 3 months, or should I continue? So the question is not about a permanent shutdown. We are not taking a long-term decision. If there is a temporary recession in the market, right? Does it make sense for me to continue, keep my shop open for those 3 months also, or is it better to keep it shut down? Clear with this, guys? This is the decision that we are going to take here. Now, let me just give you an example. Let us say, example, guys, I am running a physical academy. I am running a physical institute, a physical academy, CA coaching. Example I'm saying. Now, what happens is, now, during this COVID time, institute cancelled one attempt. You know that, right? I think in 2020, yes, they cancelled one attempt. May attempt was cancelled, I think so. Now, let us say let us say that, okay, I am running a physical academy. I'm being very clear because only that will relate to this example. A physical academy I have where students will come and attend. Now, what happened is, there was this attempt got cancelled by the institute, right? Now, I have to decide whether I need to keep my shop, that is the physical academy, I need to keep it open for the next 6 months or not, because I know that till now many students were coming. Even after the 6 months also many students will come. The question is only about the temporary period of the next 6 months. Should I keep my business open? That is, should I keep my shop open or should I shut it down? Basically meaning what? If I shut down, will there be any benefit and all? I need to analyze. Clear with this? Now, what will be the cost and benefit of shutting down? If I shut down, what will be my benefit and what will be my cost? Now let us say I am running this academy, I told you, and let us say that I have hired faculties also for other subjects. Example I am giving you guys, right? Now what happens? There are two types of fixed costs that I am incurring in this particular business model. One is called as an avoidable fixed cost. The other one is called as unavoidable fixed cost. Now, what is an example of avoidable? What is an example of unavoidable? Now, let me say I have taken a place on rent, right? Now, irrespective of whether the next attempt is going to get conducted or temporarily if I shut down or keep it open, definitely I need to pay my landlord. Correct, guys? I need to pay my landlord for sure, right? So let us say I need to pay about 1 lakh rupees every month as a rent. Now that is, rent is an example of unavoidable fixed cost. Are you clear with this? Are you clear with this? Right? Now I also hired faculties, right? And let us say I am paying the faculties a fixed amount if they conduct one batch. If you take one batch, I will give you so much amount of money, right? Now the faculty fee is an example of avoidable fixed cost. Sir, how is it an example of avoidable fixed cost? Suppose the next batch is getting cancelled, the faculties need not come and take, right? So if they are not coming and taking, I need not obviously pay them. Are you clear with this? Sir, is it a variable cost? No, it doesn't depend on the number of students who enroll. I just pay them a flat fee. Example I'm giving you, right? Now, a faculty fee is an example of avoidable fixed cost, whereas a rent is an example of unavoidable fixed cost. I need not pay the faculty any fee if the batch is not conducted, whereas I need to pay my landlord the rent irrespective of whether the batch is conducted or not. Are you clear with this? Now, in this scenario, what happens is, if I shut down the business, now what will be the benefit for me? I can save the avoidable fixed cost. Correct? No? If I'm shutting down the batch for the next 6 months, if I'm shutting down my business, what happens is the faculty fees need not be paid. Are you clear with this, guys? Right? The faculty fees need not be paid. That is one savings for me, right? Now, what will be the cost? Now, there are two types of costs that I incur. The first one is called as shutdown cost. Now, this shutdown cost is not unavoidable fixed cost. No, because I am shutting down, I will be incurring some extra cost. For example, let us say I have a factory during the COVID time. Many people shut down their factories, correct? Now, you know what? When the machines are being run every day, it is slightly easier to maintain. If the machines are not being run, they require some additional maintenance. A typical example is during COVID time, they had imposed lockdown restrictions and you guys would have been having your vehicles and all, no? Right? You were supposed to not take your vehicles outside. I don't know whether you did, but yes, we're not supposed to take it. Let's say you never touched your vehicle for about 1 month. So on the 31st day, when the lockdown got lifted, so the first place that you visit is the mechanic shop, correct? Because when a particular engine is not being used, a machine is not being used, it requires some additional level of maintenance. Had you maintained it properly during those 30 days, maybe then your vehicle would be working properly. So why am I saying this? When you are shutting down, you need to spend some extra money on maintaining your machines. This otherwise I will not be incurring. Are you clear with this, guys? So if I am shutting down, extra what I will be incurring, the extra cost is shutdown cost. Are you clear with this? And there is also one more thing, the contribution lost on shutdown period demand. On shutdown period demand. On shutdown period demand. What is it? Now, I know that generally every batch, example I'm giving you, 100 students will come and attend face to face if I announce a batch, right? Now, during the COVID time, even if I announce, only 5 people were ready to come. Example I'm saying. Suppose I shut down, right? That 5 people's contribution that I will be earning, that also I cannot earn. Correct? No? That is, if I shut down, I will be losing out on the contribution that I could have possibly made during the shutdown period demand. Are you clear with this, guys? Are you clear with this, guys? So basically, there is a cost benefit analysis that needs to be done. If I shut down, the benefit is savings in avoidable fixed cost. That's all. And if I shut down, I need to incur 2 additional costs. One is the shutdown costs. That is the additional cost that I need to exclusively incur if my business being shut down, and the other one is if I'm shutting down, I lose out on the contribution that I can possibly make during the shutdown period demand. Clear with this, guys? Clear with this, guys? Now I need to evaluate this cost and benefit, right? If my benefit is greater than the cost of shutting down, then I will go and happily shut down. If not, then I will continue. Are you clear with this, guys? Right? Now let me just give you an example. Let us say I am just shutting down. Oh, one second. Yeah. So now let us just take an example. Let's say I'm planning to shut down, right? And the benefits and cost details are as under. Let's say the avoidable fixed cost is going to be 1 lakh rupees. This is the amount I will be saving. Okay. And the cost will be, if I shut down, I will be incurring a shutdown cost of 40,000 rupees, right? Of 40,000 rupees. And let us say the contribution lost will be, during the shutdown period, I am expecting my demand to be 3,000 units only, right? And every unit gives me a contribution of 4. Example I'm giving you, right? So now what will be the contribution lost? If I shut down, even these 3,000 units I will not be able to sell. So the contribution loss will be how much? 32,000 rupees. So now you tell me, if I shut down, the benefit is how much? 1 lakh, but I am only losing how much? The cost is going to be 72,000. So I will be having a net benefit of how much? I will be having a net benefit of 28,000. Now in this case, it makes sense to shut down. Correct? I will say, sir, fine, please shut down, because the benefit of shutting down is more than the cost of shutting down. So it's going to be a 28,000 rupees is the net benefit. You do it. Clear with this, guys? Now, same example. Yes, hello.
A contribution loss is 3,000 or 8,000. 3,000 into 4 or.
It's I'm sorry, it's 8,000, ma. I'm so sorry. Yes, it's 8,000 into 4. Right, you're right. It's 8,000 into 4. I'm sorry. I just thanks for telling me that. It's 8,000 units. Okay, so it's 8,000 units into 4. Right, so the contribution loss is going to be 32,000 rupees. So assuming that during the shutdown period, the demand is only going to be 8,000 units. Generally, I'm running a business where I'm going to sell 1 lakh units every month. Then I will not be having a question of shutdown and all. Now, because of some temporary phenomenon during this period, there is going to be 8,000 units of demand only. Now, because of this recession, I am thinking. Clear with this, guys? So yes, I stand corrected. It is 8,000 units is going to be the shutdown period demand with a contribution per unit of 4. So now the contribution loss, if I shut down, I cannot even honor this 8,000 units of sales. So it's going to be 32,000 rupees. Clear with this, guys? Now I am just giving another example with a small change. Now, let us say in this scenario, again, the avoidable fixed cost is going to be the same 1 lakh rupees. Right? And if I shut down, the shutdown cost will continue to be 40,000 rupees. I'm just making one change. During the shutdown period, I am estimating a demand of 20,000 units instead of 8,000. Now I'm expecting a demand of 20,000 units. So now you tell me, so the contribution loss will be how much? 20,000 units into 4. Correct? So if I shut down, I'm losing out on 20,000 units of sale, which each of which can generate me a contribution of 4 rupees. So that is going to be how much? 80,000 rupees. Are you clear with this? So now this is going to be how much? I will be losing out 1,20,000, but I will be getting a benefit of 1 lakh rupees. So now tell me, if I shut down, the costs of shutting down is much higher than the cost of, the benefits that I get out of shutting down. Here it is going to be a negative 20,000. The net benefit of shutting down is going to be a negative 20,000. Or in other words, in this scenario, it makes sense for me to continue my business, even though there is a, my business is not up to the mark, I know. But even in this scenario, it makes sense to continue because the benefit of shutting down is less than the cost of shutting down. The costs are more. If I shut down, the costs are more, so it's better to continue. Are you clear with this, guys? Are you clear with this? Or in other words, once again, the hero of this area is what? The demand, the volume. That's why we call this marginal costing as cost volume profit analysis. So, sir, when should I shut down? When should I continue? The decision depends on the shutdown period demand. If you're having a very good demand, right, you can actually, no problem, you can continue. If you're having a very low demand, then you should definitely shut down. But there is an exact point where whether you shut down or you continue, you will be indifferent. That is basically what your benefits will be equal to the cost. Correct? No? That point is called as shutdown point. Why do we need to calculate the shutdown point? If your shutdown period demand is expected to be greater than the shutdown point, then it's always better to continue. If your shutdown period demand is less than your shutdown point, then you should always shut down. And at the shutdown point, if you want, you continue, or you don't want, you don't continue. But anyways, it is going to be the same benefit. Are you clear with this, guys? So now, how do I calculate the shutdown point? The shutdown point is a point of, the volume or the demand where my benefit is equal to cost. Agreeing with me or not? Or in other words, can I say it is going to be 1 lakh is equal to 40,000 plus 4x. That is, I need to calculate x. X means what? The shutdown point, that is exact demand. Clear with this? The demand, the shutdown period demand, which makes my benefit equal to cost. Here the benefit is 1 lakh, the cost is going to be 40,000, that is your shutdown cost, plus your contribution lost of 4x. Clear with this, guys? So now, how do I calculate this? Can I say 4x is equal to 1 lakh minus 40,000, right? Or x is equal to 1 lakh minus 40,000 divided by 4. So how much is this? This is going to be 60,000 divided by 4. That is going to be 15,000 units is my shutdown point. What is the meaning of this? So the shutdown point of 15,000 says that during the next 6 months, right? If I am expecting a demand of less than 15,000 rupees, it is better to shut down. If I am expecting a demand of more than 15,000 rupees, then the market is vibrant. Only then it makes sense to continue. If it is going to be exactly 15,000 rupees, whether I shut down or I continue, I will be getting the same result. Are you clear with this? The formula for shutdown point, hence, is nothing but avoidable fixed costs minus shutdown cost divided by contribution per unit. This is also nothing but difference in fixed cost divided by difference in contribution per unit. So then only one contribution per unit is there, no sir? Because if I shut down, I will not be selling anything, correct? So the contribution of that alternative is 0. This 4 rupees is the contribution that I will be getting only if I continue, right? So it's ideally 4 minus 0. Are you clear with this? So this is actually based on the concept of indifference point, but clearly understand my shutdown point formula is going to be what? Avoidable fixed cost minus shutdown cost, the whole divided by contribution per unit, right? Again, shutdown point is nothing but a demand or a sales volume. If you want to express this in value, shutdown point in rupees is equal to avoidable fixed cost minus shutdown cost divided by what? Divided by PV ratio. Are you clear with this? Wherever demand comes in, whether as sales or as break-even point or as margin of safety or as indifference point or a shutdown point, right? Wherever you are using contribution per unit, replace it with PV ratio to arrive it in value. Are you clear with this, guys? Right? This is the formula which can be logically arrived. It is a point where my benefits is equal to cost. So if your expected volume is greater than shutdown point, please continue your business temporarily only. All these are temporary decisions. If it is going to be if your expected demand is going to be less than your shutdown point, then it makes sense to shut down your business. Are you clear with this, guys? You guys are able to follow this? You guys are able to follow this, right? Fine. And that's what has been mentioned here. Okay. So now, yes, look at this. This is the formula. Avoidable fixed cost minus shutdown cost divided by contribution per unit. Okay. And if your expected sales is going to be less than the shutdown point, you shut down. And if it is going to be greater than the shutdown point, you continue. Clear with this, guys, right? There's one question given here. I think it's just relating to, yes, look at this. The selling price is 20, the variable cost is 14, the fixed overheads is going to be 7,92,000. How many units should be sold to earn a 10% of the takings? Takings means what? Takings means sales. Clear with this? So how many units should be sold here? So now, how do you find this out? It's pretty much simple. So now what you need to do here is, okay, so again, put up the marginal costing income statement. Sales minus variable cost gives you contribution, minus fixed cost gives you profit. Right? So your sales is going to be, so they've given the selling price, so 20x, variable cost is going to be 14x, so your contribution is going to be 6x, right? Your fixed cost is going to be 7,92,000. So they are expecting a profit of 10% on sales. So 10% on 20x is going to be 2x, correct? So now we have framed an equation. 6x minus 7,92,000 is going to be equal to 2x, or in other words, 6 minus 2, 4x is equal to 7,92,000. X is equal to 792,000 divided by 4. That gives you how much? 1,98,000, right? So you need to sell 1,98,000 units to earn a 10% profit. This is very simple. Now, the second part of the question is relating to shutdown point. Calculate the shutdown point if 30% of the fixed overheads are avoidable and interpret the result. Now, what they are saying, out of a total fixed cost of 7,92,000, 30% of it is going to be avoidable. Correct? 30% is going to be avoidable. Clear? Now in this case, what do? Shutdown point, what is the formula? Shutdown point is equal to avoidable fixed cost minus shutdown cost divided by contribution per unit. Now, what's my avoidable fixed cost? Avoidable fixed cost is 30% on 7,92,000. So 792,000 into 0.3. How much is it? 2 lakh. So it's going to be 2,37,600. Now, what many students do and commit a mistake is they take the balance 70% as shutdown cost. No. See, unavoidable fixed cost is not shutdown cost. Shutdown cost means what? Because I'm shutting down, what is the extra cost I incur? In this question, have they given anything? Have they given any shutdown cost? No. Which means in this case, the shutdown cost is 0. Which means I did not spend any extra money because I'm shutting down. Are you clear with this? Right? Divided by the contribution per unit. In this case, the contribution per unit is going to be 6 rupees. So now how much is that going to be? 237,600 divided by 6. It's going to be 39,600 units. Are you clear with this? So if during the shutdown period, you are expecting a demand of less than 39,600, you please go ahead and shut down. The market is not vibrant. It is not feasible for you to run the show, right? If you are expecting a shutdown period demand to be greater than 39,600, then it's always better to continue because the benefits will be, it's better if you continue the business, right? And at the shutdown point, you either shut down or continue, both will give you the same result. Are you clear with this, guys? Right? And that is about the concept of shutdown versus continue decision and the shutdown point area. Clear with this, guys? Any issues? Any problem here? Guys, done? Shall we proceed forward? Let's move on to the next concept called as key factor analysis. Just a minute. Yes. Now, let's move on to the next concept called as key factor or limiting factor. So, key factor stroke limiting factor analysis. I hope the YouTube live is fine. Guys, can you just respond to the chat box, please? I just want to make sure that the live is functioning fine. Is it? Okay, great. Okay, thanks Aarti, thanks Murthy. Yes, Aishwarya. Fine, great. Okay, guys. Yes, Gokula. Fine. Okay, Anup. Okay, fine. Now looks like it's working fine. Now, guys, coming on to the another important concept here, which is called as key factor or limiting factor. Again, guys, let me give you an example. Please catch up running notes for this. Now, what is this concept all about? Now, let's say a company is in the business of manufacturing two products, A and B, right? The selling price, variable cost, and the contribution per unit details are given as follows. Now, A and B, just a second. Yes. So every unit of A has a selling price of 10, variable cost of 6. So that gives it a contribution of 4 rupees. And let's say product B also has a selling price of 10. The variable cost is only 4 and the fixed cost is going to be, the contribution per unit is going to be 6 rupees, right? Now, you tell me, guys, which of the two products will you manufacture? Which of the two products will you manufacture? Product A or product B? Product A or product B? You will manufacture which of the two products? Product A or product B?
Product B.
Product B. Product B, is it? Okay. Now, I would say, why should I take a decision? Why should I say product B? I want to manufacture both the products. As long as a product is giving me a positive contribution, I will be happy to produce both, no? Who is asking me? So contribution per unit can be more. I will also sell unlimited units of B. I will also sell unlimited units of A. What is the problem? Clear? So practically speaking, who is limiting me on telling that no, only produce B? Right? I'm finding another profitable product. Relatively, it is lesser, right? So what? I can produce both, together, right? So why am I taking this example is, when there is no constraint or when there is no scarcity of resources, right? I can go for all the options. I need not say that only one or only two, right? The question of choosing between which one to do happens only when there is some scarcity or there is something that limits my production. Are you clear with this? Suppose I am saying, no, maximum you can produce only 10,000 units, right? Whether A or B, maximum 10,000 units only can be produced. Now you tell me, now I will say, now I want to produce B only more, because that gives me a higher contribution per unit, I will go for it. Are you clear with this? Or in other words, only when there is a constraint or a scarcity will there be a question of choosing which one to produce. Are you clear with this? If I don't have a constraint, unlimited capacity I can have, I will try to produce as many number of profitable products as possible. Are you clear with this, guys? Are you clear with this? Right? Yashwant depends on fixed cost. No, it doesn't depend on fixed cost at all. It doesn't depend on fixed cost. Fixed cost is irrelevant for your decision making, because whether I produce A or B, my fixed cost will be fixed cost. Correct? In a factory, I'm going to pay a rent. Using the same factory, I can produce A as well as B, right? Now, it has nothing to do with the factory rent, has nothing to do with which product I need to produce. So, fixed cost is completely out of this question, right? Clear with this? Now, so the concept of key factor or limiting factor comes into picture only when there is a constraint. Now, let me just take an example here. Let us say both these products A and B, both of them use a common raw material called as raw material X, and raw material X has an availability of only 10,000 kgs in the market. Or in other words, let's say I have to import a raw material called raw material X. Using this raw material, I can produce both A as well as B. Clear? Both these outputs require the same raw material. Now, the government of India has imposed a restriction saying that, look, you can only import a maximum of 10,000 kgs, right? Now, raw material is a constraint, correct, guys? Right? Raw material is a constraint, correct? Now, what happens? They are also giving me a data that, look, raw material X, for me to produce 1 unit of one unit of product A, it requires 1 kg of raw material X, and every unit of B requires 2 kgs of raw material X. Clear with this, guys? This is what they have given. right? And they have also mentioned the demand details in the market, right? Product A has a maximum demand of 2000 units and product B has a total demand of 8000 units. Clear with this, guys? These are the situations, these are the scenarios and constraints that we have got. Now you tell me, right, which product will you be interested in manufacturing? To which product will you give the topmost priority? Tell me, guys, to which product will you give the topmost priority?
Product A, sir.
Which product will you give the topmost priority? Yes. Now, some of you might feel that, sir, then what is the question here? Now, obviously, I will go for product B because it gives me a high contribution per unit. No. The actual answer is you need to give the top priority for product A. And let me tell you why. First of all, find out what is the constraint. Now, I know that there is a market demand of 2000 units of A and 8000 units of B. Suppose if I were to fulfill the entire market demand, tell me what is the total raw material X, quantity of raw material X that I will be needing. So 2000 into 1, right, plus 8000 into 2, 16,000. So if I want to fulfill the entire market demand by producing 2000 units of A and 8000 units of B, the total raw material required will be 2000 into 1 plus 8000 into 2. Agreeing with me? I need 18,000 kgs of raw material X. But how many kgs of raw materials X have I got? Only 10,000 kgs of raw materials X I've got, which means in this case, clearly I know that raw material X is a constraint or it is a limiting factor. What do you mean by a limiting factor? A factor that limits your production. Are you clear with this? Now what I will do, I will not take the decision based on contribution per unit. I will take the decision based on contribution per limiting factor. Sir, what are you saying? So here product A and B are there. The contribution per unit of A and B is going to be rupees 4 and rupees 6 respectively, right? And then they have given that the kgs of raw material required, for every unit of A it's going to be 1 kg, for every unit of B is going to be 2 kgs, right? So contribution per kg of raw material used is going to be rupees 4, and here it's going to be 6 divided by 2, it's going to be rupees 3 per kg. Are you clear with this? Now if you see, the rankings will be, I will give a first rank to product A and a second rank to product B. Sir, why, sir? Now in this case, guys, clearly we established the fact that raw material X is a limiting factor, it is a constraint, correct? Now if you see, no doubt product B has a high contribution, no doubt, per unit. But what happens? It takes 2 kgs of raw material X to generate 6 rupees of contribution. So technically speaking, every time I lift a kg of raw material and use it to produce product B, I earn only 3 rupees. Whereas though product A has a low contribution relatively, it has an advantage by way of a lower consumption. For me to generate this 4 rupees through product A, I only need to use 1 kg of raw material X. So if I lift to 1 kg of product X from my stores and use it for producing product A, then itself I can generate 4 rupees of contribution. Or in other words, every time I use a single kg of raw material for producing A, I earn 4 rupees of contribution. Whereas if I use the same raw material kg for producing B, net off I earn only 3 rupees per kg. Now, since raw material is a constraint factor, I need to use it so judiciously and properly. So I will go based on the contribution per kg of raw material, and that is the concept of limiting factor. Are you clear with this? So step 1, what I do is, first I establish the fact that my raw material is a limiting factor. Then step 2, what I do, I calculate the contribution per limiting factor and do the rankings. Clear with this, guys? Now I do step 3, which is allocation of the limiting factor. Sir, how will you allocate the limiting factor? First, you will use the raw materials for producing product A. As many units of product A as possible, you do it. Then if there is any kgs of raw material left out, you use it for producing product B. Are you clear with this? How we do this is, we use this template, rank product units, kgs per unit, kgs and sigma kgs, right? So first rank product is product A. Now in the market we know that the maximum demand for product A is 2000 units that I just told you, and every unit of product A requires 1 kg of raw material. So now to fulfill the entire market demand for product A, you would have consumed how many kgs? 2000 kgs, right? So now as of now you've consumed how many kgs? 2000 kgs, that is sigma kgs, that is cumulative kgs. Now you go on to the second rank product, which is B. Now come from the back. After producing product B, that is A as well as B put together, what is the total raw material you would have consumed? 10,000 kgs, because that is the maximum you've got. Out of this 10,000, you've already consumed 2,000, which means only 8,000 kgs of raw material are left for producing what? Product B. Are you clear with this? This is nothing but 10k minus 2k, that is 10,000 minus 2,000. And every kg of every unit of product B requires 2 kgs of raw material, and I have only 8,000 kgs left for the purpose of producing product B. So max how many units of product B can be produced? So I would say 8,000 kgs are available, and every unit of B requires 2 kgs. Max I can produce only 4,000 units of product B. Now this is the best possible sales mix that can give you the maximum amount of profit given the limiting factor. Are you clear with this? So if you want to make the maximum profit given the constraint, now what you need to do is you need to produce 2000 units of A and 4000 units of B. If you deviate from this, definitely your overall profit will be lesser only. Are you clear with this, guys? Are you clear with this? This is the concept of limiting factor. Are you clear with this, guys? Yes, done. Now, shall we quickly do one numerical problem in this regard? I've kept one numerical problem here. So, yes, it's question number 3, I guess. Yes, question number 3. 1 second. Yes, look at this. The following particulars are extracted from the records of a company. So, product A, product B there, right? So, they have given the sales, consumption of material. Every unit of A requires 2 kgs, every unit of B requires 3 kgs. Material, direct wages, direct expenses, machine hours used is also given. The overhead expense, fixed is unitized and given, right? And variable is given. Now always remember, for the purpose of decision making, the fixed costs are irrelevant. Why? Whether I produce or not, anyways I'm going to incur it, right? Then why would I consider it? Are you clear with this? So fixed costs are not considered for the purpose of decision making. Now the direct wages per hour is going to be 5 rupees. So this is what they have given. Now A, comment on the profitability of each product, assuming that both the products use the same raw material, when A, raw material is in short supply, and B, the production capacity in terms of machine hours is a limiting factor. First, they are just asking you to comment on the profitability. That's all they are asking you. They are not asking you to do the allocation and all. They are just asking you to comment, which means what? When raw material is a limiting factor, what will you do? You will do the rankings based on raw material contribution per kg of raw material, correct? Similarly, when your machine hour is a limiting factor, you will take the decision based on contribution per machine hour. Clear with this, guys? Clear with this, guys? Right? So that is what you need to mention here. First, they have listed out the selling price and the variable costs. Finally, they have arrived at the contribution per unit of A, contribution per unit of B, and as I just told you, fixed cost should be ignored for the purpose of decision making, because as the name suggests, they are fixed. Okay? So based on your decision, this is not going to change. Clear with this, guys, right? Now, ranking of the two products when raw material is a limiting factor. So, contribution per unit is given. Contribution per unit is given. Yes.
Expenses are they are 15 rupees and 16 rupees.
Sorry, ma. What is it?
Direct expenses.
Direct expenses.
15 rupees and 16 rupees are they.
Okay, just a minute. I think there has been some. Is this calculation coming out to be correct? 1 second. No. So then this is not 15 then. Then this has to be, this is 5 ma. I'm sorry, this is, okay. Direct expense is 5. Right? This is 5 and this is 6. Sorry, that's a typo error. Thanks for pointing out. That's a typo error. So remove this. They have just done. The calculation is correct, I think. The calculation is correct, no? So it's 10 plus 15 plus 5 plus 15. So it's 30, 40, 45. Yes. Here it's 30, 45 and 51. Correct. right? So it's they have just, it's a typo error, but the calculation they have considered only 5 and 6 respectively. Okay, right? Hope your doubt is solved. Okay, so now yes, this is what it is, guys. So they have arrived at the contribution per unit. Now in case your raw material is a limiting factor or a constraint, what do? You take the contribution per unit of both the products divided by the kgs of raw material consumed. You will get the contribution per kg, right? Contribution per kg of raw material. Obviously based on that, I will give a first rank to product A and a second rank to product B. Are you clear with this, guys? Are you all able to follow this, right? Similarly, suppose in this case machine hours is a limiting factor. Machine hours is a limiting factor. What will you do? You will take the decision based on contribution per machine hour. So you take the contribution per unit. Every unit requires 3 hours of machine hours and 2 hours of machine hours respectively for A and B, right? You calculate the contribution per machine hour based on contribution per machine hour. So I will go for product B first, right? And then only if any machine hour is left out, I will use that towards producing product A. Are you clear with this, guys? Are you clear with this, right? That is about this particular, that is about this particular part A. Now, one more thing I want to tell you, guys. One more thing I want to tell you. Limiting factor. So what could be a limiting factor? Raw material could be a limiting factor. Your direct labor could be a limiting factor. Your units could be a limiting factor. Your machine hours could be a limiting factor. Anything could be a limiting factor. Correct, guys? Guys, yes, you guys are able to follow this, right? Now, if raw material is a limiting factor, we saw in this sum, right? So what happens? I will first give the priority to product A. Anything left out, I will give it to product B. Correct? If machine hours is a limiting factor, I will give the first priority to B. Then anything left out, I will give it to A. Correct? Now, you might be having a doubt, sir, what happens? Can there be two limiting factors parallelly? In real life, that can happen, no? Import restrictions are also there. Local machine hours are also a constraint. Both together can also happen, right? So now, sir, if I do this based on raw material, which is also a constraint, it is asking me to produce product A first. But machine hours is asking me to produce product B first. There is a conflict of ranking. What will I do? In this case, marginal costing cannot be used. In this case, marginal costing cannot be used. Instead, you use a concept called as LPP, linear programming. You guys would have studied in your 12th standard that linear programming, some graphs will be there, shaded region and all. They will say maximize Z is equal to so and so, subject to constraints. They will say 3x plus 5 is less than or equal to so much. 4x plus y is greater than or equal to so much. So you will list the constraints and try to maximize your profit. Using a graphical method or a simplex table, you can arrive at your decision when you have more than one constraint that is anyways not there in your syllabus, in your interest syllabus itself. It's not there. It is a subject matter of discussion in CA final. But remember, those LPP which you would have already studied in your class 12th basics, that is your graphs and all. You guys remember that maximize Z is equal to something, subject to constraints and all. They will give you 5x plus 3y is less than or equal to 0, is less than or equal to 5000, something like that. They will list out the constraints, and where x comma y is greater than or equal to 0, they will list out the constraints and they will solve it, right? So basically, to put it short, when you have more than one constraints, marginal costing will not be able to do it, right? It can be done only using something called as linear programming problems, which is a subject matter of discussion CA final. Just giving you a bird's eye view on that, right? Now B, they are asking, that is part B of the question. Assuming raw material as a key factor, availability of, and the availability of which is going to be just 10,000 kgs, and the maximum sales potential of each of the products is 3,500 units. Find out the product mix which will yield the maximum profit. Now what you need to do? You need to do the allocation. So they are saying clearly, assume that raw material alone is a limiting factor, right? In that case, ranking will be what? First I will try to produce A, then any raw material left out, I will try to produce B. Correct, guys? So what will I do first? Now allocation of 10,000 kgs of raw materials to maximize the contribution. So first rank product is A. So 3,500 units is the maximum market potential. Every unit of A requires how many kgs? 2 kgs. Yes, it requires 2 kgs of raw material. So for producing A, I would have consumed a total of 7,000 kgs. So sigma kgs, that is as of now the cumulative kg consumed is only going to be 7,000 kgs. Clear with this, guys? Now after producing B also, the total consumption would have been how much? 10,000 kgs. Out of this, I have used 7,000 for A, which means only 3,000 is available for product B. And every unit of product B consumes 3 kgs, which means the maximum possible number of units B that can be produced is 3,000 divided by 3. It is going to be 1,000 units. Are you clear with this, guys? So now this is how I allocate the limiting factor, and when raw material is a constraint and I have only 10,000 kgs of raw material, the best possible mix that can yield my maximum profit is going to be 3,500 units of product A and 1,000 units of product B. So what would be the contribution in that case? 3,500 units into 55 rupees, that gives me 192,500, and 1,000 units into 69 rupees, it's going to give me 69,000. If you add up the two, you get what? 2,61,500. Are you clear with this? This is the maximum possible contribution that you can earn when raw material availability is only 10,000 units. Are you clear with this, guys? And this is the concept of limiting factor analysis. Are you clear with this, guys? You are all clear with this, right? Fine. So in exam, this could be a 10-mark question as well. And one more thing, some students are saying, some students and some even in some YouTube channels, I've seen this. They feel that limiting factor has been removed from our syllabus. Absolutely not. It has not been removed, guys. So what they have done is, in the earlier version of the material, there was one sum that they have removed. They have not removed the concept of limiting factor. That one sum they removed. So many people started creating a buzz saying that, you know, the limiting factor concept itself they have removed from the new syllabus. Absolutely not. It is very much a part of your new syllabus only. Clear with this, guys? So don't fall for it. It is definitely that, because it's one of the key aspects of marginal costing. Now, with this, we are done with all the aspects of CVP analysis. We are just left out with marginal versus absorption costing, which we'll be doing right now. Okay. So now all these things are done: indifference point, shutdown point, and key factor analysis. So now we are left only with the last concept or the segment C of this chapter, which is called as absorption costing versus marginal costing. Now, shall we get started, guys? Yes. Right? Shall we get started? Okay. Now, absorption costing versus marginal costing. Now, what is this concept all about? But before that, let me tell you, this is the only segment in this entire chapter that talks about stock valuation and profit computation, right? Now, guys, absorption costing is nothing but the overage chapter that we saw. Now, what does absorption costing say? Now, as per absorption costing, we have seen that costs can be broadly classified into two: manufacturing costs, right, and non-manufacturing costs. Correct? When I say non-manufacturing costs, I mean your AOH and SOH. Clear? That is all the costs incurred outside the factory. Non-manufacturing costs. Correct? Right? And you have manufacturing costs. Right? Manufacturing costs, I can further split it into four. I can further split it into four: direct material, direct labor, direct expense, and production overhead. Right, guys? Yes. So overall, in costing, these are the costs that we consider. Correct, guys? And again, I'm telling you, this segment of discussion talks about what? stock valuation and profit computation. That's why we are looking at cost from the perspective of your manufacturing, admin and selling. Clear with this, guys? Now in your production overheads also, if you see, there could be fixed production overheads, there could be variable production overheads. For example, your power and fuel could be a variable production overheads, whereas a factory rent could be a fixed production overhead. Correct, guys? Correct? Yes, done. Okay. Let me just change the sequence here. I will put it here. I will put this one as variable and I will put this one as fixed. Now what is it? Now a company can follow either marginal costing or absorption costing. A company can either follow marginal costing or absorption costing for the purpose of maintaining their costing records. I'm not talking about decision making, I'm talking about records. Costing records, a company can either follow marginal costing or they can follow absorption costing. Now, what we have seen in absorption costing, all the non-manufacturing costs, that is any cost incurred outside the factory, these are all period costs. These are all period costs, correct? Period cost means what? Not considered for stock valuation directly. P&L items, they get knocked off against your revenue, so they are not used for stock valuation, correct? Yes, guys. And what does our absorption costing says? So stocks, every unit should be valued at full manufacturing cost, correct? No, right? That is, to value every unit of a product, it should be valued at the prime cost components, direct material, labor, overheads, and your entire production overheads, that is variable as well as fixed production overheads. Correct, guys? Yes, this is what our absorption costing says. Now, what our marginal costing says is, look, we are also saying any cost incurred outside the factory should not be considered for your stock valuation. So they are all period costs, no problem. But they are saying every unit should be valued at variable manufacturing cost. That is, marginal costing is also saying use direct material, direct labor, direct expense, and also variable production overheads. So these four are always product costs. They are always product cost, whether I follow marginal costing or I follow absorption costing. Clear with this? But what marginal costing says is, look, fixed production overheads. Fixed production overheads. First of all, marginal costing says your fixed cost itself should never be unitized, right? Fixed cost doesn't make sense if it is unitized. Marginal costing says just because that fixed cost is incurred inside a factory, please do not consider it for the purpose of stock valuation and all. So what your marginal costing says is, wait, fixed production overheads will never form part of your product cost. That is, treat your fixed production overheads as period cost. Who says this? Marginal costing. Whereas absorption costing says no, even fixed production cost will be considered as a part of your product cost. So here the issue arises only with respect to the fixed production overheads, right? Wherein the absorption costing says that it needs to be considered as a product cost. It needs to be considered as what? As a product cost. Whereas my marginal costing says no, anything which is fixed, irrespective of the location, is always treated as a period cost. So now marginal costing treats this as a period cost. Are you clear with this, guys? Are you clear with this? So remember this. Marginal costing and absorption costing, both of them are agreeing on this area, right? And both of them are agreeing on this area also, right? Both the methods or both the techniques of costing say any non-manufacturing costs are always period costs, right? And the prime cost components and even the production overheads, variable production overheads, are always product costs. The issue arises only with respect to fixed production overheads. where marginal costing says we will not unitize anything that is fixed. So even the fixed production overheads should not be unitized and should not be considered as a part of your stock valuation. Clear with this, guys? So anything that is fixed production overheads, you directly take it to your P&L. Don't take it to my trading account. Clear with this, guys? Don't consider it for stock valuation. Whereas absorption costing says, no, I will value the stock at full manufacturing cost. Clear with this, guys? Are you clear with this? Right? This is the only difference. So look at this. Absorption costing says product cost is going to be direct material, direct labor, direct expense, and my production overheads. Production overheads means what? Full production overheads, variable and fixed. Marginal costing says every unit should be valued at material, labor, direct expense, and only the variable component of production overheads, which means what? The fixed component of production overheads should never enter into my stock valuation as per marginal costing. Clear with this, guys? Right? Now, in both these, so in case of absorption costing, what is a period cost? Only the non-manufacturing cost, that is my AOH and SOH. Whereas in my marginal costing, what happens is not just my admin and selling overheads, but even my fixed production overheads is also forming part of what? It is also forming part of my period cost. Are you clear with this, guys? Are you clear with this? So in marginal costing, the fixed production overheads and admin and selling, not fixed, even if it is a variable. See, guys, admin and selling, even though they are variable, they are also treated as period only, even under marginal costing. See, your AOH and SOH, whether they are fixed or variable, I don't mind, right? They are incurred outside the factory. Both the methods say that they should not be considered for the purpose of stock valuation. So the only difference is happening with respect to the fixed production overheads. Are you clear with this? The fixed production overheads is not considered as a product cost under marginal costing, whereas it is considered as a product cost under absorption costing. Are you clear with this, guys? Then the fixed production overheads are charged as product cost under what? Under absorption costing, whereas the fixed overheads are not charged the products. They are always taken as a period cost on actual basis. Now let me tell you one thing. Now look at this, guys. AOH and SOH are there, right? Whether they are variable or they are fixed. Now, whether they are variable or they are fixed, they are incurred outside the factory, right? They are always period cost under both the techniques of costing. Clear with this, guys? Don't think that in marginal costing, if it is variable, I will always treat it as a product cost. No, I'm being very clear. Marginal costing considers only variable manufacturing cost, which means what? The cost needs to be variable and it needs to be incurred inside a factory. Clear with this, guys? So don't say that all variable costs are considered as a product cost under marginal costing. No, if it is a variable cost incurred outside the factory, marginal costing also says don't include it. Are you clear with this? In fact, marginal costing is being extremely cautious, extremely conservative. Here you are taking the full manufacturing cost. I am only taking the variable manufacturing cost. So clearly, I am avoiding the fixed production overheads. Are you clear with this, guys? Basically, what marginal costing says is, if a cost is fixed, right, irrespective of its location, that is whether it is incurred in the factory or if it is incurred outside the factory, fixed, whenever the word fixed comes, it should not be unitized and it should not be considered for the purpose of stock valuation. Clear with this, guys? Clear with this, guys, right? This is similar to that, the dialogue that we have in a movie. Nanban le eduma nalla nanban ketta nanban nanbanale nallavan dhaan. Something like that. Marginal costing says, right? Fixed le enga product or period. Fixed nale period dhaan. So whenever fixed comes in, marginal costing says it's always a period cost. Do not unitize it, right? Because it really doesn't make sense if you unitize a fixed cost and push it into the product. Clear with this, guys? Are you all able to understand this? Yes, that is what our marginal costing says. Clear with this, guys? Now, based on this, of course, there is one major difference again. In your absorption costing, you have all the procedures of absorption. That is, first, we need to calculate the absorption rate, charge it off to the products, compare it with the actual, and at the end of the year, you need to calculate the under or over absorption. Are you clear with this? Whereas, if you're following your marginal costing approach, there is no concept of absorption only. Why? Because I've made life simple. Your fixed production overhead should not be unitized. Just now we saw. Then where is the question of absorption? Sir, variable production overhead is there, no, sir? Yes, but it is variable, no? So, as and when the product comes out of the machine, I will know how much it has actually gone into it. Are you clear with this, guys? Are you clear with this? Yes, you guys are understanding this. There is no concept of absorption when it comes to what? When it comes to your marginal costing. Whereas since we are doing it under absorption costing, in this case, at the end of the year, I need to do that rectification entry of under or over absorption. Are you all clear with this? Are you all clear with this? Now with this, let us go and do a numerical problem. Let us go and do a numerical problem. Take question number 4. Please take question number 4. A very, very good example. It's a masterpiece. Mark this sum as important because again, this sum is there in CA final as well. The exact sum, because in marginal versus absorption costing, this is all the concept is. Fine. This is all the concept is. Of course, there are some advanced level as well, but yes, this is a common example which is used in both inter and final. So in your final self-study, self-paced modules, you can also find the same example maybe. Right, now look at this. From the following data, compute the profit under marginal costing and absorption costing and reconcile the differences in profit. Now what they have given, the selling price is 8, variable cost is 4 and fixed cost per unit is 2, right? Now be very careful here. What they have said is, if I am using absorption costing, right, every unit will be valued at 6 rupees, 4 plus 2, correct guys? Full manufacturing cost. If I am using marginal costing, every unit will be valued only at 4 rupees. Are you clear with this? Are you clear with this? Right? Now, the normal volume of production is 26,000 units per quarter. So per quarter, the normal volume is 26,000 rupees, right? Now, so with this, you can clearly make out, so 2 rupees is the fixed cost they have given. 2 into 26, it's going to be how much? 52,000 rupees is the fixed cost per quarter. Are you clear with this? So the fixed cost planned per quarter is 52,000 rupees. This will be needing for marginal costing approach. Why? Because marginal costing says fixed cost doesn't make sense if it is represented on a per unit level. Convert it into total value and remove it. That's all. Contribution minus fixed cost. Bulk figure only. No per unit and all. Clear with this, guys? Now, the opening and closing stocks consisting of both fixed goods and equivalent units of WAP are as under. So they have given it here. Quarter wise, they have given us how much is the opening stock, how much is the production, how much is the closing stock, and how much is the sales and closing stock. Quarter wise data is given. Clear with this, guys? Clear with this, guys? Now, they have asked us to prepare a quarter wise profitability statement under marginal costing and under absorption costing. Yes, shall we get started with this? Shall we get started with this? Right? Done? Shall we do this, guys? Right. Now, first, let us do it under the marginal costing income statement. Now, marginal costing income statement, how it looks like, we all know. Sales minus variable cost gives you contribution minus fixed cost gives you profit, right? But till now, we didn't see any kind of stock adjustments and all. So when stock comes in, how do you prepare? The base is the same, but there are some extra things that need to be taken care of for your stock adjustment, right? So first, what do you have? The sales figure. The sales figure will be what? The respective month's sales units, the respective quarter sales units multiplied by the selling price. So you will be having the sales value. Correct, guys? Yes. So from my sales, right, I need to reduce the variable cost. When I say variable cost, not the entire variable cost, the variable cost incurred in respect of units sold. Matching concept only, no? Guys, correct? So sales minus variable cost gives me contribution, correct? But what variable cost will I reduce? Variable cost incurred in respect of units sold only. Clear with this? How will I arrive at the variable cost of goods sold? Very simple. Opening stock plus my variable cost of production minus closing stock. If you look at this, this is my FG, right? If I want to calculate the value of my cost of goods sold, say opening stock plus the current period cost of production minus closing stock. If I adjust for these three, only then I will get my cost of goods sold, correct? But remember, we are in marginal costing area, so which means all these units are only valued at variable manufacturing cost. Hence, I use the word opening stock plus variable cost of production minus closing stock. So variable cost of production means what? Every unit is valued at 4 rupees. Are you clear with this? Are you clear with this? Sir, are you ignoring this 2 rupees, sir? No. 2 into 26. I take it as 52,000. 52,000 will come and hit in bulk. After my contribution, I have minus fixed cost. There I will adjust. I will not unitize it, because if I unitize it, a part of it will enter into the stock valuation and escape to the next year. That I don't want to do. Are you clear with this, guys? Right? So now what happens? The respective number of units are there. So here opening stock quarter wise it's there. So whatever is the number of opening stocks, right, multiply that with 4. Opening stocks are also valued at 4 rupees. Even if there is a closing stock, that is also valued at 4 rupees only. All the units are valued at 4 rupees only. So here if you see the production and all, so 4 into 26,000, that gives you how much? 1,04,000, right? Here into 30,000 gives you how much? 1,20,000. Then into 24,000 gives you 96, and into 30,000 gives you 1,20,000. Basically what you do, opening stock plus variable cost of production minus closing stock, if you do quarter wise, you get what? Variable cost of goods sold. Are you clear with this, guys? Variable cost of goods sold. Are you clear with this? So now sales minus my variable cost of goods sold, sir, it gives me contribution. I call it as gross contribution. Why, sir, is it gross contribution? It is not net contribution, because now we have only considered the variable manufacturing cost. There could also be some variable cost on the selling side and the admin side, correct? No? Even AOH and SOH could be having some variable component. That's why I'm calling this as gross contribution. From here, I will subtract the variable admin and selling, right? In this question, it is not there, but I am preparing the format and I'm giving you. Clear with this, guys? If there is a variable admin and selling, remove that also, you get the net contribution. Are you clear with this, guys? Are you all able to understand this? You will get the net contribution. Clear with this, guys? Now from here, reduce the fixed cost. Sir, what fixed cost, sir? Whether it's going to be POH, or is it going to be AOH, or is it going to be SOH? I am not bothered. Fixed means period, always, right? Irrespective of the location, take all the fixed costs and knock it off here. Are you clear with this, guys? Are you clear with this? In our case, quarter wise, it's going to be 52,000. AOH and SOH data is not given. If that is given, you can also add it up here. Clear with this, guys? You reduce that also, you will end up with a quarter wise profit, which is being reported as 52,000, 44,000, 60,000 and 76,000. Clear with this, guys? Clear with this? This is the way to do it. Are you all able to understand this? Are you all able to understand this? Right? Right? Now, suppose we are doing the same question under the absorption costing system. Now, what do? Under absorption costing system, every unit is valued at full manufacturing cost, that is 6 rupees fully, right, guys? Basically this is nothing but this 2 rupees is nothing but the absorption rate, correct? No? Yes, they would have used the absorption rate and arrived at the fixed cost per unit level. Clear with this, guys? So now what would have happened? So you have the same sales figure. Now here what will I do? From sales, I reduce my cost of goods sold. How do you do that? Opening stock plus the full cost of production minus closing stock. Here I value all the units at 6 rupees. Are you clear with this? So multiply the respective units with 6 rupees. You will get what? You will get what? You will get sales minus cost of goods sold gives you your gross profit. This is like your trading account. Are you clear with this? From your gross profit, you reduce your selling and admin. Selling and admin, whether it is variable or fixed, both will come. Variable and fixed, both will come. Here we are following absorption costing system. We don't bifurcate variable separately, fixed separately and all, arrive at contribution. No. So after gross profit, right, all the variable and your fixed selling and admin overheads will be coming here, right? And one more adjustment is required, which again many students miss, is under or over absorption. Sir, in this question, will there be an under or over absorption? Yes, of course there will be. Of course there will be. Now look at this. In this question, what have they given? The absorption rate of fixed overheads is how much? 2 rupees. Correct, no? 2 rupees per unit, right? So which means 2 into 26,000 is going to be 52,000 rupees was the budgeted fixed overheads. Correct, guys? Budgeted fixed overheads. Now, in the question, have they given how much was the actual fixed overheads? It is not given in the question. If nothing is given in the question, you can take that as the actual fixed overheads. Also, you can assume that budgeted fixed overheads is equal to actual fixed overheads. Clear with this, guys? Right? Now, when budgeted fixed overheads is equal to actual fixed overheads, will there be an under or over absorption? Will there be an under or over absorption? Guys, will there be an under or over absorption? Yes, there could be. Because under or over absorption is a comparison between absorbed overheads and my actual overheads. It is not between budget and actuals. Are you clear with this? Now, in this case, can you calculate the absorbed overheads? Yes, every unit I absorbed 2 rupees, and month wise I know actual number of units of production is 26,000, 30,000, 24,000 and 30,000 respectively. Correct, guys? So now what will I do? I will calculate under or over absorption. Actual overheads is 52, 52, 52, 52. Absorbed overheads will be month-wise units produced, the quarter-wise units produced into 2 rupees. So I will be getting the figures respectively. So now for first quarter, there is no under or over absorption. Second quarter, what has happened? Actual overheads is 52, but I have accounted how much? 60,000. So now what has happened here? There is going to be an 8,000 rupees of over absorption. Are you clear with this? Which means what? I have accounted for 60,000 rupees of overheads. Ideally, I should have accounted for only how much? 52,000. So now what should I do? I should add back 8,000 rupees to my profit. I have already accounted for more cost. Reduce your cost. If you reduce your cost, your profit will increase. So add back this 8,000 in Q2. Are you clear with this? In Q2, I added back. Now what happens here in Q3? You should have accounted for 52. Till now, you have only accounted for 48. So now you go and further include a cost of 4,000. If you further include a cost of 4,000, your profit will reduce by 4,000 now. That's why they have put it within the bracket. Clear with this, guys? And in the fourth quarter, you should have accounted for 52,000. That's your actual, but you have absorbed 60,000. You have considered a cost of 60,000 rupees. So now what has happened here? Now you have over absorbed. You have already accounted for a more cost of 8,000. Now reduce your cost by 8,000. Or in other words, a reduction in cost will only increase your profit. Your profit should stand increased by 8,000 rupees. Are you clear with this, guys? Are you clear with this? So now, having considered all these things, now you find out that your overall profit under your absorption costing system is going to be 52,000, 56,000, 52,000 and 72,000. Are you clear with this, guys? Any problem here? Any issues here? Right? Now comes the most interesting part of this entire discussion. That's the final part of it. Now the profit under absorption costing is 52, 56, 52 and 72. Right? Now what is the profit under marginal costing system? It is 52,000, then 44,000, then 60,000 and 76,000. Right? Now what happened? Why is there a difference in profit reported under the absorption costing system and the profit reported under the marginal costing system? Can anyone tell me? Why is there a difference between the profit reported under the marginal costing system and under the absorption costing system? Can anyone tell me, guys? Can anyone tell me why is this happening? Yes, Ramya, can you tell me? Yes, Bharat, anyone? Tell me, guys. Yes, you can even use the chat box. Come on, tell me. Why is there a difference in profit reported under the marginal costing and the profit reported under the absorption costing? In both the methodologies, the units sold, everything, units produced, stocks, everything was the same, right? Cost also didn't change, but what happened here? What happened here? Now, some of you might be thinking it is because of under or over absorption. Under or over absorption? Absolutely not. Yes, very good, right? So yes, it is because of the fixed cost. Now let me come to it. If some of you are thinking it's because of under or over absorption, it is not right, because in marginal costing, what we do, we have no concept of absorption, right? Directly whatever is the actual fixed cost that hits my P&L, correct? In absorption costing, what we do, we first absorb something, right, that is different from actual, but at the end of the year we match it with the actual by doing an under or over absorption. So technically speaking, even in absorption costing, finally the fixed overheads that has entered into my profit and loss statement is also actuals here. Are you clear with this? So it is not the under or over absorption that causes the difference in profit. Then what is the reason for the difference? The reason for the difference between the profit reported under marginal costing and absorption costing is wholly and solely the fixed cost lying inside my net stocks. The fixed cost lying inside my net stock. So what do you mean by that? Now you see here, always absorption costing, right? In our example, values every unit of stock at 6 rupees, whereas marginal costing values every unit of stock at just 4 rupees. Correct, guys? Right? Now, what happens is, right? Let us say I am having a closing stock. I am having a closing stock here, right? In a particular question, I'm having a closing stock. Now, what happens? This closing stock, let us say I have 1000 units, right? Each of these 1000 units are valued at 6 rupees by absorption costing, whereas they are valued at only 4 rupees by marginal costing. This closing stock is on the credit side, correct? So if there is a closing stock, what happens? Obviously, the credit side will be more under absorption costing, because of which the profit under absorption costing will be greater than the profit under marginal costing, correct? Suppose instead of this, I'm having an opening stock of, let us say, 1000 units, right? Each of these 1000 units will be valued at 6 rupees under absorption costing and 4 rupees under marginal costing. Anyways, whether it's on the opening stock or on the closing stock, the stock valuation will be done higher by the by absorption costing system as compared to marginal costing system. It depends on which side it is. If you are having a net closing stock, right, then marginal costing will be reporting a higher amount on the credit side, and hence your absorption costing will be reporting a higher amount on the credit side, and hence absorption costing will be reporting a more profit. If there is a net opening stock, right, more the debit side, it means what? Obviously lesser will be your profit. Now absorption costing will be reporting a lesser profit. Or in other words, now in this scenario, if you see in our example, in the first case, what happened? How much was the opening stock? 0. How much was the closing stock? That was also 0. So the net stock was 0. Opening, closing, both adjusted together, it was 0. Since there was no stocks here, if you notice, the profit reported under the absorption costing and marginal costing was the same. Are you clear with this? Now, in the second situation, what has happened? Do I have an opening stock? No. Do I have a closing stock? Yes. I had 6000 units as a closing stock, correct? Now, closing stock is on the credit side, correct? And absorption costing values every unit at 2 rupees more, correct? No? So 6000 into 2, so absorption costing has a higher amount of 12,000 rupees on the credit side, because of which, to the extent of 12,000 rupees, absorption costing's profit will be more. That's why marginal costing was 44, right? The absorption costing's profit was 56. Are you clear with this, guys? Are you able to understand this? Similarly, in the third quarter, what has happened? There was an opening stock, right? Opening stock of how much? 6000. There was a closing stock of how much? 2000. If you see net of the two, there was a net opening stock of 4000 units. Correct, guys? Right? And each of these 4000 units would have been valued more. Always absorption costing only values more by 2 rupees, right? 4000 into 2, 8000 rupees. The debit side was more in absorption costing by 8000 rupees. So more the debit side, it means what? Lesser will be your profit. So now your absorption costing will be reporting a lesser profit to the extent of 8000 rupees. So look at this. That is the reason why absorption costing was reporting only 52, while marginal costing was reporting 60,000 rupees. Are you clear with this, guys? Are you all able to understand this? And finally, if you see, I think there is also another scenario. Yes, you have what? An opening stock of 2000, a closing stock of 0. Once again, this fourth quarter is also a scenario where you have a net opening stock. So 2000 into 2, 4000 rupees more on the debit side, which means a lesser profit as per absorption costing. So absorption costing would have reported a lesser profit to the extent of 4000 rupees. Look at this. Absorption costing has 72,000 rupees of profit, whereas your marginal costing is reporting a 76,000 rupees of profit. This is what we have reconciled here. Are you clear with this? We have taken opening stock, we have taken closing stock, and we have taken the net stock. Are you clear with this? If I'm putting net credit, it means that it is lying on the credit side. That is, there is a net closing stock. This case, the third case, is going to be a net opening stock, right? And the fixed cost sitting inside the next net stock is going to be 2 into the net stock. Are you clear with this? So this is going to be the reason for the differences between your absorption costing and your marginal costing profit. Are you all able to understand, guys? Are you all able to understand? This has been explained here as a conceptual, as a concept point. Just a minute, let me just show this. Look at this. Have they given it anywhere here? Okay, I don't think it's been mentioned. Okay. Okay. Now let me just write a conclusion here. Please write it down if you want. Now, yes, when opening stock is equal to closing stock, right? So the marginal costing profit is equal to absorption costing profit. Correct, guys? Correct, guys? Or let me just put it, let me keep absorption costing as the base. Absorption costing profit is equal to marginal costing profit, right? Or when there is no opening stock and closing stock, even then my absorption costing profit is equal to marginal costing profit. That is, there is no net stock. No net stock can be can happen in a scenario when you don't have any stocks, or when your opening stock is exactly equal to your closing stock. Clear with this, guys? Suppose my opening stock is greater than my closing stock. That is, now my debit side is more in your absorption costing. When the debit side is more, the profit will be less. What happens? The absorption costing's profit will be lesser than the marginal costing profit. Why? Because absorption costing always has higher only, right? That higher you should see whether it's on the debit side or the credit side. If there is a net opening stock, absorption costing will be having a higher debit side, which will report a lesser profit. Suppose if the closing stock is greater than the opening stock, now absorption costing has a higher credit side, which will increase its profit. So absorption costing's profit will be greater than marginal costing profit. Are you clear with this, guys? This is the conceptual understanding of the differences between your absorption costing and marginal costing. Are you all able to understand this? Are you all able to understand this, guys? Yes, you guys have got this. You guys have got this, right? And that is about this entire chapter. We have taken about 4 hours approximately, right? And we have covered almost the entire chapters. I mean, the revision, obviously it was revision, because in our regular lectures, as I told you, we'll be doing more than about 35 numerical problems will be done, along with detailed explanations for every single concept. But here we have touched upon all the major aspects. There are even some small aspects that we generally cover in the regular batch, but of course in a revision we can't cover everything, but the maximum extent possible that has been covered here. And I hope you guys are also clear with all the concepts that we just finished. Fine, guys, right? And with that, we are concluding with this particular chapter called as the mighty marginal costing, right? Have we left out anything? Can you guys just check and let me know? Have we left out anything? I hope I've covered everything. All the concepts mentioned. Let me just see. Yes, I think yes, I've just ticked up everything. Yes, guys, and that's about this chapter. Please don't fall into the trap of mugging it up. Marginal costing is an absolute beauty. It's an absolute beauty. So now, guys, have you all understood it? Are you all getting the confidence in this chapter? Are you all getting the confidence in this chapter? Please use the chat box. Right, please use the chat box. Tell me, let me know, are you getting the confidence in this chapter? Is there even a single formula to be mugged up? Absolutely not. There is not even a single formula to be mugged up, right? Please tell me, guys, are you all clear with this, right? Even if you are later on watching it on a recorded mode, please use the comment box or on the comment section. Please tell me whether you have understood this or not, right? Fine, guys. Fine, guys. I hope you found this very useful. Fine. Done. Great, guys. Great. It's good to know. It's good to know that you guys are getting a lot of confidence in this. Superb. Great. Fine, guys. Done. So now let's start off with the revision of the next chapter, which is process costing. Now, first, let me tell you. Let me give you a background of this chapter, but before that, so this chapter is slightly heavy in terms of the intricacies and complexities involved. So again, in this revision batch, I will try to touch upon all the important aspects, but let me be honest with you, the depth of the coverage, it's generally done in the regular batch. But nevertheless, this will help you in revising the entire chapter properly, right? Because this chapter is slightly heavy. It's not voluminous, but it's slightly heavy in terms of the depth of concepts involved. So I will just give you an overview of the entire chapter with certain intricacies involved. We'll be solving a few numerical problems as well. Definitely, there will be some value addition, but as compared to a regular batch, you can't expect the same level of the depth of knowledge in this chapter, because it requires a lot of time in explaining certain aspects. So here for a revision, what is required will definitely be done. Clear with this, guys? Now this chapter, process costing. Now this process costing, this chapter is basically an advanced version of unit costing. So what do you mean by unit costing? So an example of unit costing was your cost sheet. That is, what we do is, how do you calculate the cost per unit? You take the total cost incurred for a period divided by the number of units, you arrive at the cost per unit, right? Fine. An advanced version of that chapter, an advanced version of unit costing is only process costing. Now process costing is generally used by industries where the raw material gets converted into an FG by passing through multiple processes. A typical example for this would be a cement industry, right? If you see in a cement industry, right, limestone is a raw material, right? Just like that, it cannot get converted. It has to pass through multiple processes like grinding, blending, cooling. It has a long process. So it needs to necessarily pass through multiple processes, and the most important part is, now the output of one process is going to be the input of the next process, and the output of the next process is going to be the input of the following process, and so on. Are you clear with this? It has to be a continuous chain. Are you clear with this, guys? Right? Now let me give you an example. Of this cement industry that I told you. So in a cement industry, as I just told you, you have a main material which is limestone, right? Let us say I'm inputting 1000 kgs of limestone at the rate of rupees 100, right? So that's going to be 1 lakh rupees worth of limestone. That is the main material I am adding, right? Now this gets inputted into the first process P1 called as grinding. Okay, so there's a grinding process where the stones need to be grinded, right? In this process I add material, I add labor, and I add overheads, right? All these things put together is going to be 20,000 rupees, right? The process 1, I'm incurring a cost of 20,000 rupees over and above the main material 1 lakh. In process 1 alone, I'm incurring a cost of 20,000 rupees. So here also one more material you are adding. You said material is limestone. Yes, over and above that, in process 1 they add a new material. Let's say in this case it's going to be sand, right? So limestone alone will not get converted into cement. You need to add sand to it, and it needs to be mixed. So sir, sand is an indirect material. No, sand is also a direct material, but it is not the main material. Are you clear with this? It is not like a main material. For example, it is like saying I need to prepare a bowl of vegetable rice, right? So the main material here is the rice, that is the base. But what I will be doing is I will also be adding vegetables to it, correct? That also adds up to the weight. Here I will say for every bowl of vegetable rice, of course I will be needing rice, which is the main raw material. But yes, I also need to add on some vegetables. I can't call it as indirect material. There is also a direct material, but the predominant weight comes out of my rice. Are you clear with this? This is something like that, because had it been an indirect material, it would have anyways been included in production overheads. Clear with this, guys? Now the input, I input the main material, it enters into the grinding process. The output of grinding process enters into the second process P2, which is called as blending. Here once again I add material, labor, and overheads of this particular process. Sir, what material you will be adding? Let's say clay gets added here, right? Really, clay gets added, right? So material, labor, overheads, once again I incur of this department. How much is it? Let us say it's going to be 30,000 rupees. The output of blending department now becomes the input of the cooling department, which is going to be P3, right? So cooling department. In cooling department, once again I add its own material, labor, and overheads. Let's say that P3 department, or the P3, the process 3's cost is going to be, let's say, 50,000. And finally I get the output. which is cement, right? So how many kgs I get? So let's say I get the entire 1000 kgs as output of cement. Are you clear with this, guys? Now, the objective of this chapter is to calculate the cost per unit of output. That is, we are here to calculate the cost per kg of cement, that is output, right? Now, sir, what is the big deal again, right? Just now you gave us all the cost data, 1 lakh plus 20,000 plus 30,000 plus 50,000. Total cost is how much? 2 lakh rupees. So, can I say cost per kg of cement is going to be rupees 2 lakh divided by how much was the output that I got? 1000 kgs. So per kg it is going to cost me 200. That's all, chapter done. This is what anyways we did in our cost sheet chapter also. Then why do you have a separate chapter called as process costing, right? Clear with this. First, are you able to understand the issue involved here, right? Are you able to understand first the question that I'm raising here? Anyways, you are saying the objective of this chapter is to calculate the cost per unit of my output, correct? Right? That anyways can be done in a simple unit costing setup. That is your cost sheet area. Why do we need a separate chapter called as process costing? Two reasons. Reason number one. Now, whatever I input need not come out as output. That is, or in other words, there could be some losses in between. Correct? Yes, guys. There could be some losses in between. Now, if the loss happens at the end of grinding department, every unit lost will be valued only at the costs incurred in the grinding department. That is my main material cost plus the grinding department cost. Suppose if the loss happens at the end of blending department, every unit lost would have been incurred a cost of main material plus grinding department cost plus blending department cost. Suppose the loss happens at the end of the third process. In that case, then every unit lost, I would have spent my main material cost plus my process 1 cost plus my process 2 cost plus my process 3 cost. Or in other words, the losses can arise at any different process, at the end of any different process. So now I also need to know, where exactly the loss is happening, based on which the losses can be valued. Are you clear with this? So if I just say, sir, take the total divided by 1000, no. So the units lying at the end of process 1 will not be valued similarly as that of the units lying at the end of process 2. If the loss happens at the end of process 2, then every unit lost at the end of process 2, I would have spent the main material cost, the grinding cost, as well as the blending cost. Whereas the loss happens before itself, then for me, the cost incurred on these units would have been slightly lesser, because I would have only incurred the cost up to this place. Are you clear with this? So the first reason why we are seeing this chapter is losses can be incurred, or you can be having losses at the end of any different process, and the treatment of losses will be different based on where the loss happens. That is number one. Number two, now whatever I input in a process need not necessarily come out as output, correct? Now at the end of the period, maybe some units are still in process at the end of process 1, some units are still at the end of process at P2, some units are still in process at the end of P3, or in other words, I will be having a WIP stock, and the WIP can be happening at the end of process 1 or at the end of process 2 or at the end of process 3. If a unit is lying as a WIP in process 2, which means on every unit lying as a WIP in process 2, the cost I would have incurred would have been my main material cost, plus processing 1 would have also been done, plus processing 2 would have also been done to some extent. Whereas if the unit is lying as a WIP here at the end of process 1, then only the main material cost and the process 1 department's cost would have only been incurred. The other 2 and 3 costs wouldn't have been incurred. Once again, the similar thing, the place where my stocks are lying will also play an important role in valuing the WIP. So I cannot just say, WIP is so much. No, you need to know that WIP is lying at the end of process 1 or at the end of process 2 or at the end of process 3, based on which they need to be valued separately. Are you clear with this, guys? So here, though I say that, every unit of output needs to be valued, It depends on where they are physically present. Are you clear with this, guys? Because of these technicalities, that is the reason why we have a separate chapter called as process costing. Clear with this, guys? Now, in process costing, generally what happens is, so they will ask us to prepare a process account, right? Wherein the debit side items will be given. That is the main material. You will be having the ancillary material. I told you right now, right? So here the limestone is a main material. Maybe sand is an ancillary material. Then you will be having your labor. You will be having your overheads and all that. The debit side items will be given, right? They will ask us to find out the credit side items. The credit side items would be units completed, right? Units completed and transferred. Units still lying in my closing WIP. There could be some losses also. Those loss could be normal loss. Those loss could be abnormal loss. So the debit side items will be given. They will ask us to find out the credit side items. This is what this entire chapter deals with. Are you clear with this, guys? Are you all able to understand? This is the big picture of this particular chapter. Now, before we enter into this area, first there is one small thing that I need to tell you guys, a small prerequisite or a background. Now, let us just take an example. Let us say I inputted 10,000 kgs, right? 10,000 kgs of some raw material into a process, right? The overall processing cost, meaning what? All the material, labor, overheads, everything put together came out to, let us say, 10 lakh rupees. Okay, let us say it came out to 10 lakh rupees, right? Manoj, can you just mute yourself, please? Thank you. Right. So now the overall processing cost comes out to 10 lakh rupees, right? Just an example I'm giving you. Now what happened? I inputted how many units? 10,000 units. Okay, let us just call it as units. Okay, 10,000 units got inputted, right? And I incurred an overall cost of how much? 10 lakh rupees, right? Now let us say the output that I got was how much? The output that I got was only 9,800 units. The output that I got was only how much? 9,800 units. Clear with this, guys, right? Which means what? Which means I have actually lost how many units? I have actually lost 200 units. Are you clear with this, guys? Are you clear with this? Now, what they are further saying in this question is, see, out of these 200 units, they know that 60 units are normal loss. Means what? Generally, if I am in this business, I know if I input 10,000 units, I know that for sure I will lose 60 units, because that is because of the inherent nature of the particular business, right? But what has happened? Over and above my expectation, the actual loss was not 60, it was 200. So beyond my expectation, how many units have I lost? I have lost how many units? 160 units. It is called as abnormal loss. Are you clear with this? So the units, 140. Yes, I'm sorry. So 140 units is your abnormal loss. Are you clear with this? That is, I know that if I input 10,000 units, I will generally lose 60 units. But what has happened? I have actually lost 200 units. So 140 units were lost beyond my expectation. Are you clear with this, guys? Are you clear with this? Now, how do you value this? How will you value this? First, in this case, what I will do is, so first I should calculate the cost per unit of output. The cost per unit of output. How I will calculate this? Now, it's a very important thing. And one more thing, guys, scrap income is equal to rupees 10 per unit. Means what? Whatever units I lost, I was scrapping it. I can scrap it and generate a revenue of how much? 10 rupees per unit. Clear with this, guys? I'm consolidating the sum. So what we have done, what is the given data here? I am saying that I am inputting 10,000 units, right? And I am incurring an overall cost of how much? 10 lakh rupees, right? And at the end of the day, I am actually getting an output of how much? 9,800 units only, which means I have lost 200 units. Out of this, 60 units, I know it's an expected loss, 60 units, and 140 units were lost beyond my expectation. Clear with this, guys? And every unit that I just scrapped, every unit lost can be scrapped off at the rate of 10 rupees per unit. Clear with this, guys? This is the data given. Now, with this data, first, we need to calculate the cost per unit of output. Now, always remember, cost per unit of output is calculated as follows. It will be calculated as total cost minus normal loss scrap income divided by input quantity minus normal loss units, right? This is always the formula which we will be using. Why? Logic, I will tell you right now, right? So what is the formula for cost per unit of output? Total cost minus normal loss scrap income divided by input quantity minus normal loss units. Now let us put the figures here. What was the total cost I incurred? I incurred a total cost of 10 lakh rupees. Correct, guys? I incurred a total cost of 10 lakh rupees minus normal loss scrap income. Now, I inputted how many units? 10,000 units. At the time of starting the process itself, I knew. At the time of starting the process itself, I knew that I'm going to lose how many units? 60 units. Correct? That was expected, right? At the end of the process only, I knew the actual loss and all. But at the time of beginning itself, I knew that, yes, I am going to incur 10 lakh rupees. Correct? And I'm inputting 10,000 units and I know that I'm expecting to lose how much? 60 units. Each of these expected units will generate me how much? 10 rupees of scrap income, correct? So technically speaking, my expected cost, even before I started the process, my net expected cost was how much? 10 lakh rupees I know I will have to spend. But anyway, 60 units I will be losing, and on each of these 60 units, I will be generating a scrap income of 10 rupees. So my net expected cost will be what? Total cost minus the scrap income generated out of normal loss units. Correct, guys? Because normal loss units are the ones which are expected, right? Abnormal loss are unexpected units. Are you clear with this, guys? Right? Divided by input quantity. How many units I inputted? 10,000 units minus normal loss units. How many units were normally lost? 60 units. Or in other words, this formula is nothing but in the numerator we will be having expected costs. In the numerator we'll be having the net expected cost. At the time of the start of the process itself, I know that my expected cost is going to be how much? I know I will be incurring 10 lakh. I know I will be losing 60 units, and on each of these 60 units I'll be generating a scrap income of 10 rupees, right? The net expected cost divided by the expected good units. Expected good units, that is, I know I will be inputting 10,000, and at the time of starting the process itself, I know that I'll be losing out on 60 units. Expected good units. Are you clear with these? Are not actuals, these are expectations. Clear with this? That's why in costing, stock is always valued at normal cost, not at actual cost, because actuals can have inefficiencies. Clear with this, guys? So now tell me what's the numerator here. What's the numerator here? So it's going to be 10 lakh minus 600. That is going to be 9 lakh 99,400, right? Divided by, so it's 10,000 minus 60 is going to be 9,940, right? So what is the cost per unit? What is going to be the cost per unit?
100.5.
So how much is this? 100.5433, right? So 999,400 divided by 9940, it just keeps on going. Okay, so it's going to be 100.54333 something. It just keeps on going like that. Okay, fine. Right, clear with this, guys. So technically speaking, what I need to do is every unit needs to be valued at how much? It needs to be valued at 100.5433. Clear with this, guys? Are you all clear with this? Right? But strictly speaking, what happened originally, if you see this, I know that I was incurring a total cost of 10 lakh rupees, right? By inputting how many units? 10,000 units. 10 lakh divided by 10,000 units. You would have thought that, sir, the cost per unit is only 100 rupees, right? But what has happened here? No, No, what has happened here? My expected cost after adjusting for normal loss scrap income, and in the denominator you had what? Your expected units. That is, you know, you will be inputting 10,000 units, but you were also expecting for a loss of 60 units. So technically speaking, every unit of output should be valued only at how much? 100.5433. Are you clear with this, guys? This is the expected cost, and this is always the cost at which we will be valuing every unit of output. Are you all able to understand? Right now, with this backdrop, what we will do is we will go and do one illustration here. Now let's look at this. Take this illustration, a simple and a basic illustration. Now guys, look at this. Input was 10,000 units at the rate of rupees 20, right? The labor cost was 1 lakh rupees. The overheads was 150% of labor. The estimated normal loss was 10% on input. Scrap is 5 rupees per unit, and the actual output was 8,500. Now, look at this. How many units did I input? 10,000. How many units did I get as output? It was 8,500, which means the actual loss was how much? I have actually lost 1,500 units. Correct, guys? Out of these 1,500 units, how much was normal loss? How much was abnormal loss? Normal loss was 10% on input, 10% on 10,000. I knew that I will be losing 1,000 units. But what has happened? I have actually lost 1,500, which means I have lost 500 units beyond my expectation. Are you clear with this, guys? Are you clear with this? So technically speaking, here the normal loss is 1,000 units and your abnormal loss is going to be 500 units. Now how do I put it up in a process account? So basically, I inputted how much? 10,000 units, right? I inputted how much? 10,000 units. Out of these 10,000 units, where are they lying on the output side? If you see, out of this, normal loss was 1,000 units. My abnormal loss was 500 units, and the balance output, right, that I was able to transfer to the next process is going to be 8,500 units. Clear with this, guys? So basically, whatever I inputted, am I at least able to track where they have went? Yes, I have lost something, but at least I have a tracker. This 10,000 units, they are lying as 1,000 units are normal loss, 500 an abnormal loss, and 8,500 as your output. Now look at this. In your process account, how it looks like is, the process account is a stock ledger. It's a stock ledger, right? It's nothing but a WIP ledger. Clear with this, right? Here, obviously, all the costs that are incurred to build my WIP will get debited. Correct. So to material, so the quantity was 10,000 units at the rate of 20. So it's going to be 2 lakhs, labor 1 lakh, overheads 1,50,000. Right, guys? Fine. Now have this thing very important set in your mind. Now immediately what will happen? So technically what has happened is the net expected cost. So how do you calculate the cost per unit of output? The cost per unit of output is going to be the total cost minus normal loss scrap income, right, divided by my input quantity minus normal loss units. Correct, guys? So now what was the total cost? The total cost was 4,50,000, right? So 4,50,000 minus normal loss scrap income. What is your normal loss scrap income? Normal loss units were 1,000. The scrap rate was 5 rupees. So 1,000 into 5, that is going to be 5,000 rupees. Correct, guys? Divided by what is the expected good units? Whatever I had inputted, 10,000 minus the normal loss units of 1,000. So 10,000 minus 1,000. So here what I have is, so finally what I have here is, so 4,45,000 divided by 9,000 units. So every unit is valued at how much? It is valued at 49.44 rupees. Are you clear with this? Right? Now how do we present it in a process account? First you will put all your expenses on the debit side, right? Immediately what you do, by normal loss scrap income, 1,000 units I scrapped. Each unit had generated me a scrap revenue of 5 rupees. So 1,000 into 5, that's going to give me 5,000 rupees. So now basically what has happened is my net cost, my net expected cost is only going to be 4,50,000 minus 5,000, 4,45,000. Are you clear with this, guys? Normal loss units are not valued separately. Normal loss units are never valued separately. Clear with this? Because what we are doing here, even in the denominator, we are only valuing 9,000 units. That is all the units except the normal loss units. Correct? No? Right? Because the normal loss units should not be valued separately, but its presence will only inflate the per unit cost of expected good units. Are you clear with this? So technically speaking, in a process account, I'll be debiting all my cost, and from that I should subtract what the normal loss scrap income. That is basically nothing but the formula we used, right? It needs to be presented in your process account as well, right? Now this is represented by way of, so I was expecting how many units? 9,000 units. Where are these 9,000 units right now? Sir, out of this 500, over and above my expectation, I lost, and 8,500 units, I am having it properly with me. So now you can multiply this 49.44, whatever it is, into 500. That gives you this figure. So 24,722, right? Instead of rounding off, if you retain the decimals, you will exactly get this. Similarly, your 8,500 into 49.4444, that gives you how much? 4,20,278. Are you clear with this, guys? So basically, when you're preparing a process account, how it works is, on the debit side, you park all your expense, and immediately on the credit side, you reduce your normal loss scrap income. Are you clear with this? So this is your net expected cost. Net expected cost. This is represented by expected good units. Expected good units was how much? 9,000 units. So in this case, the expected good units are represented by abnormal loss and what? The units completed and transferred to the next process. That's why they have written it as process 2. Are you clear with this? Sir, abnormal loss, you're calling it as expected good units. Yes. Abnormal loss means what? Originally, I expected that to be a good unit only, but unexpectedly it turned out to be bad. Are you clear with this? So it is also an expected good unit. So what will I do? Each of these 500 units, I will value it separately at 49.44. And what will I do? I will take it to my costing P&L. I will take it to my costing P&L. It's a loss for me. Sir, normal loss is not valued separately. No, because I knew that. I knew at the beginning itself that, look, I'm going to lose these units. Accordingly, I prepared and I calculated the cost of every unit of output. So that's why I said normal loss is not valued separately, but its presence will increase the per unit cost of expected good units. It is being borne by these expected good units of 9,000 units. Are you clear with this, guys? So the cost of 1,000 units is being borne only by, the cost of 10,000 units is being borne only by 9,000 units, which means the cost incurred of the normal loss units are also shared by the expected good units. So hence it is not valued separately. Are you clear with this, guys? Hence, if you see, you don't have anything called as normal loss account at all. In entire costing subject, there is nothing called as normal loss account, because normal loss is not valued separately. If at all you find it somewhere, that is actually a normal loss scrap income account. It's an income ledger. It's not a normal loss ledger. Are you clear with this, guys? Are you all able to understand, right? So now, basically, how do you value your every unit of output? This is the formula we follow always. The total cost minus normal loss scrap income. Visualize that process account. This is how it is, right? Divided by input quantity minus normal loss units. That is nothing but my expected good units. Are you clear with this, guys? Are you clear with this, right? Now what we will do is, we will move on and do the first question, which is question number 1. We will move on and do question number 1. Now slowly we will increase the complexity. Now in process 1, so question number 1, in process 1, 1,000 units were introduced during January and 200 units, 40% complete in all aspects, remained as closing WIP at the end of the month, right? Compute the equivalent production and obtain the cost of closing WIP if the total process costs during the period were 1760. Now what they are saying is, how many units were inputted? 1,000 units, right? And what they are saying, at the end of the month, 200 units were only 40% complete, meaning what? They were lying in my closing WIP, right? And the remaining was all completed and transferred to the next process. In this question, there is no loss and all that. Now, if you look at this, I inputted 1,000 units, right? out of this, what has happened is, now 800 units were completed and transferred to the next process, right? 200 units were only 40% complete and they are still lying in my closing WAP. Clear with this, guys? Now they are asking you to value, that is, they are asking you to prepare a process account. Is that what they compute the equivalent production and obtain the cost of closing WAP? Fine. Now guys, tell me guys, how will we calculate the cost per unit? The cost per unit is going to be total cost minus normal loss scrap income divided by input quantity minus normal loss units. Correct? Right? Now in this case, what was the total cost? 1760. What was the normal loss units? Scrap income. First, there is no normal loss only, so it is 0. Correct, guys? Right? Divided by what is the input quantity? I have inputted 1000 units. Correct? And what is the normal loss units? That is 0. I didn't expect to lose anything. So if you use this formula, what is the cost per unit of output that you are getting? So you will be getting how much? You will be getting 1.76 rupees as the cost per unit of output. Correct, guys? Correct? Yes. Now what happens here is, now if I do this, what happens here is, now these 800 units, what will I do? So I will say there are 800 completed units. Correct, guys? These 800 completed units will be multiplied with 1.76. What is the value of completed units? 800 into 1.76, that is going to be 1408. Right? And how many incomplete units were there? So 200 incomplete units were there, right? So that multiplied with 1.76, if I do, what happens? So 200 into 1.76. So now what I will be doing? I will be giving it a share of 352 rupees, and total, if you see, it will match with your overall figure of 1760. That is 1760 is a cost that is represented by the units completed and my closing WAP. Now, if I do this, there is one big mistake I will be committing. What? I am valuing my completed units as well as my incomplete units in a similar fashion. Whether it is a completed unit or an incomplete unit, what am I doing? I am giving both a share of 1.76 rupees as a cost. Is this correct? Absolutely not, because each of these 200 units were only 40% complete. First of all, you tell me, can I add this 800 units with this 200 units? No, this is like adding donkeys and monkeys, right? They are dissimilar items, they cannot be added, right? So 800 units are completed units, 200 units are incomplete units. So first of all, why did we end up adding the two? Because we use this formula. That is, guys, in this case, what has happened? The input was how much? 1000 units, correct? The normal loss was nothing was there. Right, the units completed were 800, right? And in this case, you had your closing WAP. Your closing WAP was how much? 200, correct? Now, input minus normal loss, right? This way I can compute, or I can say this is represented by units completed and my closing WAP. Agreeing with me on this or not, right? So whether I say 1000 minus 0, or if I can add this individually, both will give me the same result. Agreeing with me on this or not? Now, in this case, what we did, if we use the formula, we are saying 1000 minus 0, we are indirectly, unintentionally adding two dissimilar items. Are you clear with this? So now in this case, you can't use the formula. So this denominator alone needs to be computed separately, and that is the reason why we have something called as statement of equivalent units. So now in the statement of equivalent units, what will we be having? Now guys, in this denominator, this is nothing but expected good units only, no? Right? What they are saying is, look, if you use the formula, right, you will commit a mistake of adding dissimilar items together because each of them have different degrees of completion. So what you do is go and find out which are all exactly your expected good units, track them, convert them all into equivalent completed units, and now you add it. Are you clear with this? So now in this case, I had inputted 1000 units. On the output side, where are they present? Units completed were 800 and units incompleted were 200. So I'm just having a tracker column. Don't think I'm adding the two. This is a tracker column. Whatever I've inputted, I'm able to track it on the output side. Now what I do is, each of these 100 units are 100, each of these 800 units are 100% complete. So I multiplied the two and I say, okay, so 800 completed units are equivalent to 800 completed units only. Whereas 200 units, 40% complete, can I say is equivalent to 80 units fully complete, correct? Each of these 200, physically I have 200 units, but each of them are only 40% complete. So the cost consumed by 200 units, 40% complete, can I say will be similar to the cost consumed by 80 units fully complete, right? So what am I doing? I'm converting an incomplete unit into an equivalent complete unit. So ideally 200 units 40% complete is only equal to what? 80 units 100% complete. Now can I add the two? Yes. So now what I do, I add up the two. So now technically speaking, my expected good units is 880 equivalent units. Sir, physically I'm finding 1000 units. Yes, but I can't add my completed units and my incompleted units because they have a different degree of completion. So what am I doing? I am still using the same formula, but instead of using it as a formula, I'm going out and finding out which are all the expected good units, converting each and every one of them into equivalent completed units and arriving at the denominator. Are you clear with this? Or in other words, this step 1 called as calculation of equivalent units, statement of equivalent units, is nothing but the denominator calculation of this formula. Why are we using it? Because each of the ingredients of the expected good units are having a different degree of completion. Clear with this, guys? Clear with this, guys? Are you all able to understand? Now what do I do? Now what do I do? Of course, I need to calculate the cost per equivalent unit. Guys, this is what we all need to do anyways, right? Cost per equivalent unit. So how will you find out? So they have given that the total cost is 1760, right? The denominator is how much? Just now we got in step 1 880. So you divide the two, you get what? The cost per equivalent unit as 2 rupees. Right? And now you have a step 3 called as statement of apportionment of cost. So the units completed and transferred, how many equivalent units are there? 800 units. So 800 into 2, the value of the units completed and transferred is going to be 1600, right? And the incomplete units, how many equivalent units are there? 80. 80 into 2, that's going to give a value of 160 rupees. So now whatever was the total cost has now been properly apportioned between completed units and incomplete units. And now step 4 is just a matter of preparing the process account. In your step 4, what will you be having? In your step 4, it's just the process account. I think this is not there. Sorry. So your total cost, that is all the cost, material, labor, overheads put together, is 1760, right? And this is being apportioned between my units completed and transferred and units still lying in my closing WAP. Here I will not be mentioning the equivalent units and all. This is a tracker column, 1000 and 1000. So whatever I input, it should be represented on the output side. I will be having a tracker column, and these values are picked up from the previous step, step 3. Are you clear with this? And with this, I can prepare the entire process account. So to sum it up, I am always use that formula only. But in this case, when I have a closing WAP which has a different degree of completion, so because I cannot add dissimilar items, I am forced to have a step 1 called as statement of equivalent units. That is nothing but my denominator calculation. Clear with this, guys? And once I do that, I now calculate the cost per equivalent unit, which is the step 2. And now step 3 is going to be each of these expected good units will now be valued. That is called as statement of apportionment of cost. This is nothing but my credit side items of my process account, and step 4 is just preparation of process account, wherein the debit side will be picked up from the question and the credit side will be picked up from step number 3. Are you clear with this, guys? Are you all able to understand? This is the 4-step process in process costing. Are you clear with this, guys? Are you all able to understand? This is a very basic level sum. Slowly we will be increasing the complexities. This is why I said this chapter is kind of heavy in terms of concepts. So in a revision, right, whatever best is possible, I'm just trying to give you guys an insight into whatever is important from an exam perspective. But strictly speaking, there are so many other things in this particular area which requires actually a lot of time to learn. But anyway, since this is a revision, I hope that you guys would have already studied process costing to some extent so that you will be able to appreciate the discussion. Clear with this, guys? Clear with this, guys? Fine. And that is about the first numerical problem. Now, so what we did till now was See, if I don't have a closing WIP, I can directly use this formula. In the example that I gave you, we didn't have a closing WIP, right? So we can directly use this formula approach. Suppose you have a closing WIP, the denominator cannot be calculated as such. So what you need to do, list out each of the components of expected good units, convert them into equivalent completed units and add it up. Clear with this, guys? 4-step approach. What are the 4 steps? Number 1, statement of equivalent units. Number 2, calculation of cost per equivalent unit. Number 3, statement of apportionment. And finally, number 4 is your process account. Process account debit side given in the question, and on the credit side, you will be having what? You will be having the figures that you just got in your step 3. Clear with this, guys? It's a very structured approach. It's a very structured approach. Now, guys, what happens is, things slightly get little complicated and little tricky as we proceed into the next few problems. Now, just a minute. Let me just see if I've given this up. Just a minute. 1 second. Okay. Okay. Now, let's move to the next question and see what is there here. The following data are available in respect of process 1 for the month of Feb 20x1. They have given that the opening WIP is 900 units, right? And the value of opening WIP is 4500. The degree of completion they have given, with respect to material, it is 100%, labor 60, overhead 60. Input of material, they are inputting 9100 units at a material cost of 27,300. The direct wages is 8,200, production overheads is 16,400. The units scrapped is 1200. The degree of completion for the units scrapped is given component wise. Closing WIP 100 units are there, and again the degree of completion for closing WIP is also given. The units transferred to the next process, that is also being given here, that is units completed and transferred. The normal process loss is 10% of the total input, that is basically your opening stock plus units put in, and the scrap value is going to be 3%, 3 rupees per unit, right? They are asking you to prepare the process account and all of that. Now guys, now this is where the subject gets little complicated. Now I'm just representing the sum here. I'm just representing the sum here in a simple tabular format. Now this is my process account, right? This is process number 1. Okay, process account, process 1 account. Now see what happens here. What happens here? I have an opening WIP, right? How many units have I got? 900 units, right? Forget the degree of completion. No, first let me just present the question here. In the current period, I am inputting how many units? I am inputting 9,100 units. I am inputting 9,100 units, right? Next, what they have said, now they have completed how many units? 7,800 units. So basically, the total units of input were how much? 10,000 units. That is, I already had an opening WIP. Plus in the current period, I have freshly introduced how many units? 9,100 units. Now, one more thing they have said, units completed fully and transferred to the next process is how much? 7,800 units. That is units completed and transferred. Correct? And then they've also mentioned that the closing WIP, how much is the closing WIP? 1,000 units are there. So, 1,000 units of closing WIP are also there. So, clearly, you have inputted how many units? 10,000 units. But now, how many units are actually physically present here? Units completed were 7,800 and still lying in your WIP is going to be 1,000. So, technically, only 8,800 units are present somewhere, which means you have lost how many units? 1,200 units. That is what they have mentioned here. Units scrapped. Are you clear with this, guys? Are you clear with this, guys? Right? So they have given it as units scrapped here. So the units scrapped is going to be 1200 units, and out of this they have mentioned generally 10% of the total input is going to be what? 10% of the total input is going to be my normal loss, which means 10% of 10,000. So normal loss is 1000 units. Expected loss is 1000 units. So over and above my expectation, I am losing how many units? 200 units. That's going to be my abnormal loss. Are you clear with this, guys? Right? So basically, this is how your input side and output side will be looking. You have an opening WAP of 900, right? And you freshly introduced 9100 units, right? So that makes your total input equal to 10,000 units, right? The represented on the output side, you have your normal loss 1000, abnormal loss 200, your units completed and transferred 7800, and your closing WAP as 1000 units. Now, in what way is this sum different from the previous sum? In the previous sum, no doubt we had a closing WAP. The moment you have a closing WAP, clearly it means that you need to use the statement of equivalent units. You cannot use your formula, right? Now, what extra thing we are having in this question is you are also having an opening WAP. Sir, if I have an opening WAP, what is the big deal? Now recall what I told you in cost sheet. When you are having multiple lots of receipts and each of them are valued separately, then stock valuation issues will come. That is FIFO, weighted average and all. In this case, what happens? Yes, you have completed 7,800 units, right? It will be valued at what? Because opening WAP are valued differently. They have given the value of opening WAP as what? 4,500 and all. And in the current year, whatever cost you have incurred are completely different. These are the costs you have incurred. If you average out, the per unit cost will be different. So now how am I going to value this? Obviously, you need to go for valuation techniques. Are you clear with this? In this question, we will be using first in, first out method. We will be using what? First in, first out method. This is one aspect of the question. The other aspect of the question is, now what they have mentioned component wise degree of completion. What is the meaning of that? Now look at this. Closing WAP is how many units, guys? They have mentioned 1000 units are lying in your closing WAP, and they are saying each of these 1000 units are 100% complete with respect to material, 80% complete with respect to labor, 80% complete with respect to what? With respect to overhead. Sir, what is the meaning of this? What is the meaning of this? Now, let me give you a small example for you to understand this. Let's say you are actually boiling, you're boiling milk, right? A bowl of milk, right? Now, let's say that you have on a gas burner, on a gas stove, you have 3 burners, right? So you have 3 bowls, bowl 1, bowl 2, bowl 3, right? So what you're doing is you're going to boil a milk, okay, a bowl of milk. Let us say it takes 10 minutes for the milk to be completely boiled, okay? Let us say it takes 10 minutes for the milk to be completely boiled, okay? Now, what happened was, this stove 1, what you did, you turned on the stove at 11:50 p.m. 11:50 p.m. on 31st March, you are doing this exercise. At 11:50 p.m. you turned on this stove number 1, right? This stove number 2, you turned it on at 11:54 p.m. okay, right? And stove number 3, you turned it on at 11:58 p.m. Just an example I'm telling you. Now, what has happened is, at the stroke of 12, what happens? The year gets over, correct? No, right? At the end of the year, at the stroke of 12, if you see, your bowl number 1 would have been fully boiled. Agree? Yes. So you will say this is a 100% completed product. Now, at the stroke of 12, if you look at the burner number 2 or bowl number 2, so you started it at what? 11:54 p.m. So only 6 minutes of boiling would have happened. So you will be saying, so this is only 60% complete. Correct, guys? Right? Whereas if you take the burner number 3, you will say it's about, I turned it on only at 11:58. So this is only 20% complete. Correct? No? Right? No. Now, for you to boil the milk, what are all the costs that you will be incurring? Now, three costs. One is your material, then your labor, then your overheads. Material will be milk. Labor will be, let us assume you are hiring a chef to perform this job, right? You are paying him based on the time he spends. Clear with this? Then overheads is your stove, your gas burner, your gas charges. Now, tell me, in all the three cases, so case 1 100% complete, case 2 60% complete, case 3 20% complete. Now, irrespective of which burner you're talking about, with respect to material, the entire milk was poured in this year itself, no? Correct, guys? Or in other words, can I say, irrespective of whether you call it a WIP or an FG in this case, with respect to the material cost, all the three burners or all the three the vessels have actually consumed the entire 100% of my material cost. Agreeing with me on this? The cost consumption pattern of your FG or your WIP in this case, just to give an example, right, irrespective of its degree of completion, what you call, with respect to raw material, in this case, it has completed 100% of what a completed unit would have consumed. Agreeing with me, right? Similarly, but with respect to labor, what will I say? Yes, the first stove, it took what? Entire 100% labor, 100% overhead. It is complete in all aspects. But what about the second vessel, the second bowl? The second bowl, it is only 60% it would have consumed labor and 60% overheads at the end of the period. Correct, guys? Similarly, the third bowl, it would have consumed only 20% of labor and 20% of overheads. Or in other words, what happens is, if I am saying something as WIP, the consumption of resources needs to be seen component wise. That is, if this particular bowl, I'm calling it a 60% complete, it need not have consumed 60% in all the components of cost. You see here, with respect to material, it consumed fully, right? So with respect to material costs, right, it has consumed fully as what a completed product would have consumed, right? Only with respect to labor and overheads, in this case, what has happened? It has consumed partly. Are you clear with this, guys? So now what you need to do, now you need to prepare an equivalent unit, statement of equivalent unit for apportioning each and every component of cost. So using my material cost, how many equivalent units have been produced? Using my labor cost, how many equivalent units have been produced? Using my overhead cost, how many equivalent units have been produced? So I need to look at it component wise. Are you clear with this, guys? Right? So now all this entire exercise now needs to be done for each and every component of cost. That is the first learning in this particular question. Are you clear with this, guys? Are you clear with this? So now what we do here, so first we need to prepare a statement of equivalent units, right? And for the statement of equivalent units, it needs to be prepared component wise. And of course, one more thing, remember, in your statement of equivalent units, you should only consider what? Expected good units. That is all the units except your normal loss units. Are you clear with this, guys? All your units except your normal loss units. This is what needs to be considered here. Clear with this, guys? Now, what we do here is, one more thing that is quite important and slightly advanced here is the use of first in first out method. Now, what about first in first out method here? Now, as you know, first in first out means what? So whatever cost came in first will actually be consumed first. Correct? So first in, first out. Correct? So now what I do here is, so the opening WIP value will now fully sit into the units completed and transferred to the next process. Agreeing with me on this? So the opening WIP value, that is the ones that got processed in the previous year and carried forward to the current year, the value of opening WIP would be completely entering into my units completed and transferred. Are you clear with this, guys? So when I am following first in first out method, what needs to be apportioned is only my current period cost. Why? Because anyways, the entire value of opening WAP will enter into my units completed and transferred. So the concept of apportionment of cost arises only with respect to the current period material, labor, overhead and all. Are you clear with this, guys? So now in this case, what I will be doing here is, look. So first I will prepare a statement of equivalent units under first in first out basis. Now carefully listen. So what was the total input? Opening WAP 900, units introduced 9100, and a tracker column I tracked down that, look, I have 10,000 units with me, right? This is represented on the output side. Now be very careful. Look at this here. Look at this here. What has happened? I have an opening WAP of how much? 900 units. Correct, guys? Now 900 units I have in my opening WAP. So this breakup I will say, so in the current year I have completed and transferred how many units? The completed units were 7,800. So the breakup of this I will say, this 7,800, out of this 900 units came from my opening WAP, and the balance 6,900 units is coming out of the current period units introduced. Correct, guys? The breakup is given here. Look at this. These two put together is actually units completed and transferred. So out of this, 900 units came from my opening WAP and 6,900 units are coming out of the units introduced. That's why it is written as units introduced and completed. Introduced and completed. Are you clear with this? Then what is the closing WAP units? That anyways we have 1000 units, right? The normal loss is 1000 and the abnormal loss is 200 units. We are just catching up the tracker column here. So the closing WAP is 1000, the normal loss is again 1000 and the abnormal loss is 200. So whatever I have inputted, first I am tracking down as to where it is being present. Are you clear with this, guys? Right? Now what we do? Now component wise we prepare the statement of equivalent units. Why? Because the consumption pattern changes for each and every component of cost. Using my material cost, how many equivalent units have been produced? Using my labor cost, how many equivalent have been produced? Using my overhead cost, how many equivalent units have been produced? So I need to come up with this kind of breakup. Only then I can properly apportion each and every component of cost. Now if you see, now in this current period, I have completed how many units? I have completed 7,800 units, correct? Out of this, 900 units have come from my opening WAP and 6,900 units have been introduced and completed. Clear with this, guys? Clear with this, guys? Now, in this case, what happens here? Now look at this. They have said that the opening WAP units were already 100% complete with respect to material, 60% complete with respect to labor and 60% complete with respect to overhead, which means what? During the current year, with respect to material, I would not have consumed anything on the opening WAP units because it is already 100% complete with respect to material. With respect to labor and overheads, the remaining 40% would have been complete by consuming the current period cost. Correct, guys? Right? I am repeating, each of these 900 opening WAP units were already 100% complete with respect to material, right? 60% complete with respect to labor and overheads. So which means in the current period, I would not have consumed any material cost on this opening WAP units. With respect to labor and overheads, remaining 40% alone would have been completed by consuming the current period resources. So that's why what I do on the opening WAP units completed, what we do here is with respect to material, I put it as 0. With respect to material, I put it as 0. With respect to labor and with respect to overheads, we put it as 40-40 each. So 1 minute. So they have mentioned it as 8% and all. It is not 8%, it is 0%. It's a typo error. So with respect to materials, the opening WAP units are already fully complete. Now in the current period, on the opening WAP units, I need not do any working with respect to material. So it will not consume any material cost in the current period. But with respect to labor and overheads, it is only 60% complete. The remaining 40% will be completed by consuming the current period's material cost and current period labor cost and overhead cost. So I will take 40% and 40% here. Clear with this, guys? Now what about these 6,900 units? See, they were introduced and they were completed. They were started from the scratch and they got completed also in the current period. So with respect to material, labor and overheads, they were started from the scratch and they have also been completed fully. So now the consumption will be 100%. These are all completed units, right? Now, what about closing WAP units? The degree of completion is given here. With respect to the closing WAP units, material is 100%. Obviously, when the closing WAP units were introduced freshly, they were started in the current period, but at the end of the period, they could not be completed. Are you clear with this? So now what happens here? With respect to material, it is 100, labor 80 and overhead 80. So you can just take it as such, 100, 80 and 80. Are you clear with this? Now, most important part here is normal loss will not be valued separately. Why? Basically, this entire calculation that we are doing is nothing but the denominator calculation. I should only consider the expected good units. I should only consider the expected good units for the purpose of calculating the equivalent units. What do you mean by expected good units? Input minus normal loss, or in other words, everything except normal loss. So I will not consider normal loss because the cost of normal loss units should be borne by the expected good units. If I once again consider the normal loss here, then it defeats the purpose. Are you clear with this, guys? Hence, the normal loss units will not be valued separately. In your statement of equivalent units, the normal loss will always be nil. Now, what happens to abnormal loss units? What happens to abnormal loss units? The units scrapped, the degree of completion is given 100% and labor and overhead 70%. So the degree of completion with respect to abnormal loss units. What do you mean by abnormal loss units? It was originally planned to be a good unit only, but what has happened? Because of some reason, it turned out to be bad. So the degree of completion 100, 70 and 70 needs to be done here. Sir, what do you mean by this, sir? How can units scrapped, how can it have a different degree of completion? Very simple. The same example I'm giving you. So your mom boiled a milk, right? She boiled a bowl of milk, right? Now what happened? She poured the entire milk into the pan, right? Into the bowl. Now what has happened? It got boiled for 7 minutes. In the 7th minute, she noticed that the milk got spoiled. Now, what will she do? No, it should fully boil for 10 minutes. I will fully boil it for 10 minutes and then only I will throw it off. Or now anyways, I have noticed that it is already spoiled. She will turn off the gas in the 7th minute itself, correct? Now, the loss was identified when it was 70% complete, right? However, with respect to material, it was 100% complete. With respect to labor and overheads alone, it only consumed 70% of what a completed unit would have consumed. Hence, in this case, the degree of completion with respect to material alone was 100%. For my labor and overheads, it was just 70%. Are you clear with this, guys? This is the reason why even for abnormal loss units, you have a separate degree of completion. Are you clear with this, guys? Now, what you will be doing, you will take the respective units, multiply it with the respective degree of completion. So finally, you will arrive at the equivalent units. Or in other words, the material cost, using the material cost, now what has happened? 8,100 equivalent units have been produced. Similarly, using the labor cost, 8,200 equivalent units have been produced, and using the overhead cost, 8,200 equivalent units have been produced. Meaning what? The material cost needs to be apportioned between 8,100 units. Labor between 8,200 units and overheads between 8,200 units. Now, once you do this, automatically what happens is that each and every component of cost gets properly and evenly apportioned based on their degree of consumption. So that's about the step 1. Now comes the step 2. In your step 2, what will you do? So material cost was how much? 24,300, right? The material cost was 24,300. How did you get this? Wait, look at the question here. Now, in this case, what have we got? The material cost was, yes, they have given 27,300. That was the material cost here, 27,300. But wait, recall, we are still in that formula approach only. But because we are not able to use the formula, we are putting it in under a different statement approach. Now, in the numerator, what will you have? The total input cost. Yes, the total cost of the process minus normal loss scrap income. So the normal loss scrap income needs to be adjusted. In this case, how many units of normal loss were there? The normal loss were 1,000 units, and each and every normal loss each and every unit was scrapped at 3 rupees. So 1000 into 3, 3000 rupees. What needs to be done? It needs to be subtracted from my overall material cost, and I have the material cost net of scrap income as how much? 24,300 rupees, right? The labor was 8,200, overhead was 16,400. These are all the costs, each and every component wise costs. Now the material cost should be apportioned between how many equivalent units? 8,100 equivalent units. Take it from step 1. Similarly, your labor should be apportioned between 8,200 equivalent units, and overhead should also be apportioned between 8,200 equivalent units. So now what happens? The material cost per equivalent unit is going to be 3. The labor cost per equivalent unit is going to be 1, and the overhead cost per equivalent unit is going to be 2. Or in other words, if a product is fully complete, it should get a share of 6 rupees as the total cost. Are you clear with this? And that is about the step 2 of this particular the equivalent question. Right now, the next one talks about the statement of apportionment. Now, guys, in the process account, if you see, what are all the expected good units I've got? Everything except the normal loss. That is, I have three different components of expected good units. That is my abnormal loss units, my units completed and transferred to the next process, and I also have a closing WIP, right? Now each of these figures need to be valued separately, right? That is, I have a separate step called as apportionment of cost that deals with how I'm going to value each and every component of the credit side. Now in this case, you see, first we are going to value the closing WIP. How will we value the closing WIP? Very simple. Step 1 into step 2. Now closing WIP has consumed how many materials? So closing WIP has consumed 1000 equivalent units of material, and every equivalent unit of material should be given a share of how much? 3 rupees. So now look at this. So 1000 into 3. So the material value sitting inside closing WIP should be 3000 rupees. Clear with this, guys? Similarly, in case of labor, how many equivalent units were there for labor? 800 into 1, that gives me 800 rupees. Similarly, for overheads, it is going to be 800 equivalent units into 2 rupees per unit, that is going to give me 1600 rupees. So overall, if you see closing WIP, right, the cost consumed by closing WIP is going to be 3000 rupees of material, 800 rupees of labor, and 1600 rupees of overheads. So the overall closing WIP should be valued at what? 5400 rupees. Are you clear with this? Now, what about abnormal loss? Similarly, in abnormal loss, we know that you can go to the step 1 and you can find out, look, there are 200 equivalent units for material, 140 equivalent units for labor, and 140 equivalent units for overheads. So there you have the respective equivalent units, multiply it with the respective cost per equivalent unit. So now you will be getting the total value of abnormal loss. Are you clear with this, guys? Now finally, about the units completed and transferred. Now this is where you have two steps. Now here, basically, how many units were completed and transferred? I think it's 7800. No? Yes, look at this. We had 7,800 units, right? Out of this, 900 units were opening WIP completed, right? And the remaining 6,900 units were what? The 6,900 units were units introduced and completed. Now, each of the units introduced and completed, 6,900 units, were started from the scratch, correct? So if you look at this, it was 6,900, 6,900, 6,900. That is, with respect to each and every component of cost, it was 6,900 in all aspects, right? So multiply that with fully 6 rupees per unit, because each of these units were started from the scratch and they were also completed by the end of the year. So now what happens here? So 6,900 into 6, this is going to be 41,400. This is the cost pertaining to the units introduced and completed. Are you clear with this? How about the opening WIP of 900 units? Wait. Opening WIP of 900 units were partly completed in the previous period and the remaining were completed in the current period. How, sir? How do you know that? Because it is given in the question, no? Opening WIP, the degree of completion was, it was complete in all aspects with respect to material, but labor and overheads, only 60% was completed in the previous period. The remaining 40% we completed only using the current period cost. Correct, guys? So now here it has a two components here. Look at this. It has a current period cost and it has a previous period cost. The previous period cost is nothing but the value of opening WIP itself. Clear with this, guys? The value of opening WAP is how much? The value of opening WAP is going to be what? 4,500 rupees. That is the value of opening WAP. I think they have taken a lot of, one second, I think there's a calculation error here. One second, guys. This is notes. This is 4,500. So sorry, guys, there's a calculation mistake. I just request you to make a correction. Yes, there's a calculation mistake here. It is going to be 4,500. It is not 45,000. They have taken the wrong figure here. It's going to be 4,500. Now, the previous period cost is nothing but the opening WAP value already processed in the previous period. Now, in the current period, the remaining 40% of labor and overheads alone got completed, right? That's why in the current period cost, if you see, material is 0. Labor and overhead, however we got this, you go to the equivalent units. Look at this. 360 equivalent units were produced by consuming the labor, and 360 equivalent units were produced by consuming the overheads figure. So now 360 into 1 plus 360 into 2. This is going to be your breakup for labor and overheads. 360 into 1 and 360 into 2. So 1080 is going to be your value of opening WAP now completed. Clear with this, guys? Value of opening WAP now completed. So it's 1080 plus 4,500. So that is going to be a total of 5580, right? I think they have given a wrong figure here. One second. They have just, is it tallying, guys? Can anyone help me out with the figure? Is it tallying? One second. Let me just do the calculation. Units completed. I think some mistake is here in the typo error. So it's 41,400 plus 1080 plus 4500. So okay, the total is correct. 46,980. Correct. This is correct. So what they have done is they have added everything. So 41,400 is the value of units introduced and completed, right? Then opening WIP's current period cost is 1080. Previous period cost is 4,500. So all these things put together, 41,400 plus 1080 plus 4,500 is going to give you 46,980, which is the overall value of units completed and transferred. So basically, guys, this 6,900 units were fully manufactured using the current period cost of 41,400, right? This 900 units, what happened? Partly were produced by consuming the previous period cost of 4,500 rupees and partly by consuming the current period cost of 1080 rupees. So overall, the value of these units completed and transferred of 7,800 units is going to be 46,980. So now if you look at the process account, what they do is these debit items are all given in the question. Your opening WAP, value of material, value of labor, value of production overheads, all these are given. Immediately what we do is normal loss scrap income 1000 into 3 that we will reduce. So basically this will be what? This will be my net expected cost, my numerator calculation. Clear with this, guys? This will be my expected cost. This is going to be my numerator calculation, right? And now this is represented by expected good units. What are the expected good units? Units completed and transferred 7,800, that is transferred to the next process. That's why they have written by process 2. Your closing WAP of 1,000 units and your abnormal loss of 200 units. And how do you get these figures? Go refer step 3. So units completed and transferred, the value is 46,980. So this is the figure. The closing WAP value is 5,400. This they have just populated it here, and your abnormal loss is going to be how much? 1020. This is going to be your abnormal loss. Okay, again here they have done some mistake, I guess. It is, isn't it 1020? Isn't that right? Yes, I think this also they have done 1020. Please correct it, right? Everything else is correct. Clear with this, guys? So basically your process account, this figure is your net expected cost and this is going to be your output side. Are you clear with this, guys? So your step 4 is the easiest step because debit side are given in the question and credit side you can find it from your step 3. Clear with this, guys? In most of the cases in process costing, what is the observation that I have made is that, you know, if you get your step 1 correct, that is your statement of equivalent units correct, the entire sum, you will mostly, the chance of getting it right is going to be almost 95%. Unless and until you do some silly mistake, the entire question you will get it right, provided you get the first step correct. If the statement of equivalent unit is wrong, the entire sum is gone for a toss. Clear with this, guys? Clear with this, guys? Right? Yes, Surya Kumar. Okay, sir, will you please tell the abnormal loss of 70%, how it came? Which one you want, ma? 70% of abnormal loss, as in, see, they have given it in the question, no? Abnormal loss, the degree of completion. See, abnormal loss are basically units scrapped, and the degree of completion of units scrapped is given here. With respect to material, it's 100%. Labor and overhead 70%. It is given in the question, right? So since it is given in the question as 70%, we have taken. Suppose the question is silent, you assume that the loss is getting identified only at the end of the process. You take all material, labor, overheads as 100% complete, right? That is how you need to take it. If the question is silent, that's how you need to take it. Okay, will the method be to be used? Will it be mentioned in the question? It might be mentioned. If not, you can use any method. That shouldn't be a problem. Clear with this, guys, right? Now, this is predominantly about this particular segment of your the predominant portion of process costing lies here. The 4-step approach, guys. What are the 4 steps involved here? What are the 4 steps involved here? I have just summarized it and I've mentioned it here. Look at this. Look at this. Debit the process account with all the expenses. Immediately credit the process account with your normal loss scrap income. You remember this? Yes, this amoeba you draw. Fine. So this is going to be your normal loss scrap income. Then calculate the estimated cost per unit. Then find the value of abnormal loss, abnormal gain. Adjust the normal loss account with cash or abnormal gain. So basically that is what they have mentioned. And whatever it is, calculate the expected good units. Your expected good units could be your abnormal loss units, units completed and transferred to the next process, and your closing WAP. This is what it is. I think I had mentioned the 4-step procedure here somewhere. Yes, look at this. The 4 important statements of your process costing is statement of equivalent units, statement of cost per equivalent unit, then your apportionment, statement of apportionment, and your process account. This is nothing but your denominator computation. This is nothing but numerator upon denominator computation, right? Once you find out the cost per unit, find out the credit side items, and now you prepare the process account. Clear with this, guys? It's a very structured approach. Now, whatever I have done here is just on a bird's eye view, because process costing is such a chapter that requires a huge level of intricacy, right? It requires a lot of numerical examples to be explained. But what I did here was I picked the topmost sum in such a way that it covers all the major adjustments. Clear with this, guys? Not all the adjustments have been covered, but I have taken the major adjustment and I have covered it. Now, one more small area is there in this particular chapter, that is called as waste multiplier. What do you mean by waste multiplier? Now look at this. This was a past exam question, once tested for 5 marks, right? So it's like an easy puzzle only. So nothing great here. Look at this. What they have said, suppose, so there are 4 processes, A, B, C and D. Now what they are saying is, in process A, the normal loss will be 25% of its input. Process B, the normal loss is going to be 20% of input. Process C is going to be normal loss is going to be 20% of its input, and process D, the loss is going to be 16.67% of input. The question is, what will be the initial input required to produce 4000 kgs of the final product? What they are saying is, I have 4 processes, A, B, C and D, right? If I input something in process A, right, the output of process A will become input of process B. Output of process B will become input of process C. Output of process C will become input of process D, right? And finally, they are saying, I want an output of 40,000 kgs, right? At the end of process D, I want an effective output of 40,000 kgs. They are asking us how many kgs should be inputted at the beginning of process A. This is what is being asked here. Are you clear with this, guys? Now, they have also given that if you input some units in process A, 25% will be normal loss, which means only 75% will come out of it, right? And whatever gets inputted in process B, of that 20% will further be lost. And whatever you input in process C, out of that 20% will be further lost. And whatever you input in process D, out of that 16.67% will be lost. So now they are saying, I want an effective output of 40,000 kgs. How many kgs should I input at the beginning of process A? Very simple. What you will do is, let the input in process A be 100. Okay, right? Now they have given that the normal loss is 25, which means what will be the output, guys? Hello? The output will be how much? 75 units, right? Now this output of process A will be the input of process B, right, guys? Now in process B, 20% of its input, which is 75, is going to be lost. How much is that? 75 into 0.2, that's going to be 15. So net off, what do you get as an output from process B? 75 minus 15 is going to be 60. Now this is going to be the input in process C. There I further lose another 20%. So 20% on 60 is 12. So what is the output of process C? It's 60 minus 12. It's going to be 48. Now this 48 is going to be the input for process D. And out of this, 16.6666% is going to be lost in process D. So 16.666% on 48 is going to be 8. So technically I will get an output of only how much? 40 rupees at the end of process D. Now 40 units at the end of process D. So now what they are saying, if you input 100 at the beginning of A, you will get an output of 40 at the end of D. Correct, guys? So if I input 100, right, I will get an output of how much? 40. They are saying they want an output of 40,000 kgs. Now how much input should be done? So if 40,000 is equal to 40, how much is going to be 100? So 40,000 divided by 40 into 100. So we can say that overall, only if you input 1 lakh kgs at the beginning of process A, after all the losses, effectively you will get an output of 40,000 kgs. Are you clear with this, guys? This is called as waste multiplier. You just keep on accumulating the waste, and you finally find out the net input to the output ratio, and with that you can see how much kgs of raw material should be inputted to get an effective output of whatever is given in the question. Are you clear with this, guys? Yes, you guys are clear with this? Done? Right? Now that is about this particular chapter. Now guys, this particular chapter is slightly heavy. Now please be very clear about this. I have seen students skipping this chapter. So generally in a revision batch, I generally don't take process costing because process costing is one such chapter that requires a lot of explanation, and of course if at all it needs to be done in a regular batch. But still I did it here because I've been getting a lot of messages from students asking me to specifically do this chapter. That's the only reason why I at least wanted to cover the major areas, the important areas, and the logical reasoning behind every steps involved, right? That is the reason why I did process costing here, because the moment you take process costing, it's not like the other chapters where at least you can quickly give a brief introduction and move on to it, because in a revision batch that's what generally happens. Whereas in process costing, you need to start off with something called as treatment of losses, and slowly I increment it, and in a regular batch it takes about 10 hours for this particular chapter itself. It cannot be properly diluted, so as in it cannot be given as a nutshell. If I enter into it, it's going to be very huge. But still I made an attempt just to give you a big bird's eye view of this particular chapter. Now I think there are two other sums. I think I asked the DTP person to keep 2 questions. I think they have also kept some other questions here. But anyways, I had planned to discuss these 2 main questions and the waste multiplier in a revision batch for a simple reason that, if at all you are left with, about 1 or 2 weeks away from the exam. Now what I would suggest, let me tell you. Now, if you already have attended my regular batch or elsewhere, or you've already prepared process costing, in that case, yes, definitely please do practice a few more numerical sums in this area. No sir, I do not know anything about process costing. I'm just left 1 week away from my exam. You do the other chapters, and if you still have time, you come to this. This would be my suggestion with respect to process costing. This chapter alone, I would say, because it is not from an exam viewpoint or anything of that sort. It has so much depth of concepts involved in it, right? If you notice, even in a regular batch, I would have told certain things. If you were learning it for the first time, maybe even marginal costing or other chapters you might have appreciated, by learning it for the first time, but process costing, it definitely requires at least one time of preparation from your side. That's when the process costing can be understood, because this chapter is slightly heavy in terms of the conceptual background and the conceptual knowledge required. So what I would suggest is, right, for those who feel that, for those who have already learned this chapter once, yes, this is going to be like, definitely you practice a few more sums in this regard. For those who are just 1 or 2 weeks away from the exam and you feel that, sir, I am not very sure or confident about this chapter, you finish the other chapters, right? Focus so much on the other chapters, and if you have time, you come back to this chapter. Clear with this, guys? Clear with this, guys? Yes, you guys are clear with this, right? Fine, guys. Done. So, yes, you have a doubt here. Tell me now.
On which basis we did the previous sum in FIFO method, sir?
Okay, so on which basis we did the previous sum on FIFO, based on FIFO method? Okay, so based on the data given in the question, that would be the answer. Again, that's what I would say. If I have to explain that, that's going to be one big explanation, not for a revision batch. That's why I wanted to be very, very concise with respect to this. Anyways, since you have asked, let me just tell you, let me just give you a bird's eye view again on this. Now you asked me on what basis did we do the sum on FIFO method. Now, this was based on the figures given in the question. Opening WIP data, they have given only the degree of completion with respect to each and every component of cost. Had it been a weighted average question, they would not have given it like this. They would have given component wise how much is the cost. That is, they have given the value of opening WIP is how much? 4,500, right? Had it been a weighted average question, they would have given us the breakup of, out of this 4,500, how much is material, how much is labor, how much is overhead. So the breakup, cost wise breakup, component wise breakup of opening WIP, if it is given, then the sum needs to be done under weighted average. If you look at this, the next sum, actually, they would have given it. Opening WIP, they didn't give you a single figure. They gave you component wise breakup. In that case, it needs to be done under weighted average. Clear with this, guys? Right? That's how it needs to be done. See, that's why I didn't want to confuse you much, because generally a revision batch is something students watch just before the exam. So I should not do something because I know it, right? And at the same time, if I'm not able to, condense something and give it to you, I would rather not do it in a revision batch. That's what I would generally prefer. So this is the reason why I stopped here at this particular, just by taking up the major areas and covering it. Clear with this, guys? Because this chapter is kind of, it requires a lot of explanations, to be very honest. In your regular batch, if you see this chapter, every single thing we will be seeing with a lot of numerical examples. Here, time is a constraint. That is the only reason why I try to cover the major areas and I'm leaving it here. Clear with this, guys? But all other chapters can be easily condensed and presented, whereas this particular chapter has this particular limitation by itself, right? It's a normal loss, inherent nature of process costing. Okay, done, guys? Fine, done. Any other doubts? Any other doubts you've got? Is inter-process profit important to look on? Okay, I can only tell you based on the past exam trends, not much. But again, if I say something is not much important, then if it comes in the exam, I know what you guys will do. You will pull the top 3 generations, the next upcoming generations. So you will pull everyone, my ancestors and all, you will start scolding. So based on past trends, I think it has not been tested for that frequently. That's all I can say. It completely doesn't guarantee that it is not going to come for your attempt. So it depends on your luck. That's what I would put it as. Else then I'm the one to suffer. So okay, right? Inter-process profit, that's what. So it is not been tested much, but it can come. See, there is nothing called as important or unimportant in a CA exam, because generally what we feel as less important is what the institute is really interested on. Because if you omit something and institute gets to know about it, that is the first concept they would like to test. So there's nothing called as important or less important. But yeah, this is the bird's eye view of the overall chapter. It's like what we have seen right now in this revision class of process costing is just a trailer. It is just a trailer. So in actually the real big picture, is only seen in the regular batch. So I am admitting that only with respect to this chapter, it needs to be condensed like this. Okay, fine guys, done. Anything else? Right, so then we will sign up for the day. Okay guys, fine. So now we are done with these chapters. Rest of now, we are done with what? So cost sheet, right? Overheads, ABC, marginal and process costing, right? So this is what we have completed as of now.